news offsets new EU sanctions on Russia. Brent trades around $69 a barrel. Meanwhile, gold prices gain on the back of a weaker US dollar. Reliance reports record quarterly profits thanks to one-time gain of 8,900 crore rupees from Asian Paints stake sale. Even adjusting for this gain, profits are up 20%. Rapid store expansion helps retail business revenue rise 11%. Mukesh Ambani reiterates the group will double in size every 4 to 5 years. HDFC Bank's net profit grows 12% on a year-on-year basis, while asset quality saw some weakness. ICICI Bank continues to spot strength profit and net interest income beat estimates. Asset quality remains stable. The monsoon session of the Parliament is set to begin today. Prime Minister Narendra Modi will address media ahead of the House proceedings. Trump's tariff, the Air India plane crash and Operation Sindoor will be the top of the agenda of the discussion. 15 bills are also likely to be tabled through the session. Hello, good morning. You've tuned into CNBC-TV18. You're watching Power Breakfast with me, Vinny Motiwala. An interesting day that's going to be shaping up today. A lot that happened on the global front as well. So let's look at how Asian markets have opened, right? Asian markets have opened up a bit mixed. While we're seeing Taiwan index that's down 0.3%, we're seeing Hang Seng that's trading with an uptick of around 0.5% in today's trading session. Similarly, the Australian index, ASX 200, that's opened with cuts of more than 1%, while we're seeing Shanghai that's managing to hold on to gains of 0.3%. We have Nikkei that's closed in trade. That's the Japanese index. And as of now, let's see what the Nifty implied open is doing, right? It's a very, very muted start is what we're watching out for. Not much of an uptick or a downtick that we should keep an eye out on. The last I checked, it was down around 0.04%. So, it will be important to see what the Nifty implied open is going to be indicating. But as of now, a muted start down 19 points is what the Nifty implied open is indicating for the Indian market. So, that is going to be interesting to see where we'll be headed during the day and during the week as well, given the mixed global cues. Now, in the US, when you're looking at it, what happened to S&P 500 and NASDAQ? That closed near the flat line. The Dow's ended with cuts of almost 0.3% on Friday. This is overcoming a brief dip triggered by the news report of US President Donald Trump pushing for steep tariffs on European Union products. Now, the report adds that Trump was eyeing a minimum tariff between 15 to 20%, which sent the markets lower before they partly recovered in trade. So, flat, mixed opening overall is what we're seeing for the Indian markets. Now, when you're talking about the Indian markets as well, let's, get in how these overnight cues are going to be impacting our Indian markets. Obviously, we have a team of research, as always, joining in with us to set you up for trade, important stocks to watch out for, as well as what's going to be happening in the world of F&O. Gaurav as well as Sudarshan, good afternoon. But before I come to you all, I'm going to talk about what the trade setup is looking like for the Indian markets, given that, Indian markets actually, when you look at it, have underperformed this last week as well versus the Asian markets. Now, is that going to be continuing today will be key to watch out for, given that we're still watching out for a mixed opening. Even last week, we saw that fall coming in for the markets for the third straight week. So overall for July also, the markets versus Asian markets were a weak performance. Financials continue to be the top laggard last week. Sensex Nifty, that also saw a fall coming in of almost 1% last week, while mid-cap was something that was seeing a rise. That was a bit of a bright spot. Now, in terms of FII, DII cues that we have, FII is bought 375 crores, while DII is bought 2,103 crores. But will this buying by FII sustain will be key to watch out for in today's trading session. We have a lot of reactions and a lot of factors to watch out for today. So that's going to be one in terms of India-US trade, that fifth round of these trade talks that are going on also. That was over. As of now, we have no deal that has come out yet. Key points are still left in terms of agriculture, automotive. That's still left to be decided. So will be key to watch out for in terms of what comes on that front. IPO listing of Anthem Biosciences. So keep an eye out on that. We have earnings reactions, important and big companies, right? Reliance Industries, HDFC Bank, ICICI Bank, among the top companies coming in with earnings over the weekend. So that reaction of that will be important in the market and will give a direction to the market as well. So keep an eye out on that. And earnings today, we'll keep an eye out on CIE Automotive, Automotive, Ultratech Cement, Havells, IDBI Bank will be important to watch out for in terms of numbers that we keep an eye out on. Monsoon session is in the Parliament has started as well. Like I said in the headlines as well, a lot of bills that will be passed as well. So we'll keep an eye out on all that happening. But let's go over to Gaurav, who's here to tell us which are the important stocks to watch out for in today's trading session. How should we be watching out for in terms of what are we expecting here?
Well, yes, it's an important day for Nifty because big companies have come up with their earnings. First, let's talk about Reliance Industries. Profitability increased almost to around 26,900 crores, which was at around 15,000 crores a year ago. So a big jump. And with this, now Mr. Mukesh Ambani has also said that Reliance will continue its stellar track record to double every 4 or 5 years. So that is something that we will be watching out for. HDFC Bank also came up with the result. Good set of numbers is what we can say. Profitability increased almost by 12% on a year-on-year basis. And credit calls also remained somewhere in the range of what the street was expecting. ICICI Bank once again actually came up with a good set of numbers. We saw the bank actually beating expectations across parameters, and what was actually a key thing to understand is that the net interest margins actually declined only by 7 basis points. That was actually a huge positive surprise, and at the same time profitability also increased almost by 15% on a year-on-year basis. Bandhan Bank on the other hand, we saw a good set of numbers, but at the same time we saw some kind of concerns rising because of the asset quality. So profitability was above CNBC poll, but at the same time there are some stress which is rising in terms of fresh slippages because the entire slippage is coming up from their EEB pool. Other than that, AU Small Finance Bank is in focus, and the reason being that they have increased their credit cost guidance somewhere almost by 10 to 15 basis point to 1%. Net interest margins also declined a bit higher than what the street was expecting. So a little bit of negative reaction is what we can see in the trade today because the valuations are also a little high. On the other hand, let's also talk about some stocks which will be in focus on the back of the news flow. First, let's talk about Sona Comstar. Now, CNBC Newsbreak has been confirmed. Sona Comstar is going to enter in the Chinese EV market via joint venture. Company said that they will be investing around $12 million and will hold 60% of the joint venture. IDFC First Bank is also in focus. Other than that, BML, JSW Steel, Mahindra Lifespace, all these companies are going to be in focus today on the back of the news flow that we have received today.
Absolutely, Gaurav. Keeping an eye out on whole host of names, whole host of earnings reactions as well. But finally, we have Sudarshan here to tell us what should we be watching out for in the world of F&O. Sudarshan, we've seen that range-bound sessions continued for the market, and Friday was a lower session for the Nifty. What are we watching out for today?
Good morning, Vinny. So after being range bound for 2 to 3 days, Nifty has given up 25,000 for the first time since June 2024. And last week, if it was about reacting to IT companies' earnings, this week or basically especially today, it would be about reacting to heavyweight earnings like Reliance Industry, HDFC Bank, ICICI Bank, and in mid-cap space, Bandhan Bank, AU Small Finance Bank. So we'll have to see if Nifty managed to hold on to levels above 25,000. As far as GIFT Nifty is concerned, it's indicating a subdued start for today as well. On the flows front, in the cash market, you'll see both FIs and DIs buying. FIs have bought more than rupees 370 crore, DIs buying more than rupees 2,100 crore. But if you look at derivative markets, it's about that they are building on positions on the short side. So in the index futures, FIs have sold nearly 2,400 crore. They have reduced long positions of more than 2,300 contracts, and also they have added short positions of more than 10,000 contracts, and now FI's long exposure has reduced to almost 15%, which is lowest in last few months. As far as option market is concerned, now major action on the call side was seen in 25,100 call, which had seen addition of more than 54 lakh shares, and 25,000 call was active as well and has seen addition of more than 43 lakh shares. And on the put side, the most active put was 24,900, which saw addition of more than 15 lakh shares. So that's the reason support now for Nifty has moved lower to 24,800, and resistance is now around 25,100 or 25,150. Stocks that remain in the band are RBL Bank, Hindustan Copper and Angel One. One stock that entered in the band ahead of its earnings was Bandhan Bank. Keep an eye on heavyweight stocks like Reliance Industries, ICICI Bank and HDFC because these stocks are the biggest contributors not only to Nifty and also to Nifty Bank as well.
Absolutely, Sudarshan. Thank you so much for that. Important to watch out for those stocks in F&O ban as well as in terms of the levels for support and resistance for the Nifty. Thanks for that, Sudarshan. But on that note, we're going to zip into a very short break, viewers. And after the break, we'll tell you how Reliance's performance was in Q1 FY26. So stay tuned in for that. Welcome back to Power Breakfast on CNBC TV18. Now, Reliance Industries had reported its Q1 FY26 numbers on Friday after market hours. Here's Sonal joining in with us to tell us how the consolidated numbers were looking like and what should we expect in terms of a move today. Sonal, good morning.
Good morning, Winnie. Well, Reliance reported numbers Friday post-market hours. In terms of revenues, it was largely in line with expectations. That came in at 2.44 lakh crore rupees. EBITDA came in higher at 42,905 crore rupees, which is higher on a YOY basis. Margins came in at 17.6%. And the net profit element at a record high this time around, 26,994. That was aided by higher other income as well. So other income came in at 15,120 crore rupees. And out of that, around 8,900 crore rupees came in from the Asian Paints stake sale as well this time. In terms of segments, the Reliance retail business saw double-digit growth this time. Their revenue per square feet increased by 16.5% on a YOY basis. Jio, on the other hand, reported inline numbers this time. Their revenue growth of 2% was led by higher subscribers and also higher ARPU that came by for the company as well. O2C EBITDA margin, it increased on a YOY and on a quarter-on-quarter basis, but do remember there was a maintenance shutdown that the company took in the month of April. Mukesh Ambani reiterated their plans of doubling the business every 4 to 5 years. So that was a big statement made again. In terms of brokerages, Morgan Stanley said that new energy, telecom, balance sheet, these were the bright spots in Q1 results. They have an overweight rating with a target price of 16.17. Jeffrey says that this time around O2C was impacted by refinery shutdown, but refinery outlook is quite constructive going forward. And now focus will shift on the AGM. Remember, it will be sometime in August or September. And the possible listing of Jio with tariff hike is something they'll be watching out for. They projected an 11% EBITDA growth in FY27. And Motilal Oswal says while first quarter was a little soft according to their expectations, they expect good growth going forward. And accordingly, they've also increased the target price on the stock.
Okay, Sonal, thank you so much for that. But let's move on to some other earnings that were reported over the weekend as well. HDFC Bank's Q1 numbers, how were they looking at? It seems like net profit grew by 12%. What are the other details in terms of asset quality? What should we be watching out for? Gaurav is here with us again. Gaurav, HDFC Bank, overall, how were the numbers?
Well, yes, we can call HDFC Bank as a good set of numbers for Q1. And the reason being that net interest income increased almost by 5%, which was in line. But there was another element of other income. There we saw a sharp spike. And the reason being that there was a stake sale of HDB Financial, because of which HDFC Bank recorded gains over worth 9,100 crores this quarter. And after that, when we exclude that gains, then also PPOP, which is pre-provisional operating profit, actually was higher than what the street was expecting. Other than that, when it comes to the provisions, what bank has done is that the 9,000 crores that they have gained from the deal, they actually made a floating provision out of that, and they have also made contingent provisions worth 1,700 crores, and that is the reason why provisions also look a little inflated. But if we exclude these numbers, then again the number remains in line with what the street is expecting. As a result, profitability increased almost by 12%, which was higher than the street's expectation. Now, there was a little bit of hiccup in terms of net interest margins, because they have gone down almost by 19 basis points, but brokerages believe that the core net interest margins have gone down just by 11 basis points, once again in line with what the street is expecting. Lastly, the management commentary remained very strong. What they have said is that in FY26, they will grow in line with the market, and in FY27, they will actually outpace the market pace. And at the same time, there are other factors to consider. First is that the bank has now declared special dividend of 5 rupees per share. And other than that, they have also declared bonus share in the proportion of 1:1. So that is something that will also cheer up investors. And as a result, we will be definitely watching out on HDFC Bank today.
Okay, keep an eye out on that one. But Gaurav, do wait by, because ICICI Bank also reported its numbers on Saturday. You had a busy weekend. Tell us, what should we expect from ICICI Bank now?
Well, ICICI Bank once again came up with a good set of numbers. We have already seen bank delivering numbers which were higher than expectation for the last few quarters. And we can definitely say that the bank has continued the same trend. Net interest income increased almost by 11% on a year-on-year basis. When we talk about the operating profit, there also we saw 17% growth, and that was something positive because there was some push from other income as well. But even if we exclude that, operating profit growth was healthy. Profitability, now that increased almost by 15% on a year-on-year basis. And what was the key positive is that net interest margins, now they have declined just by 7 basis points, whereas street was expecting net interest margins to decline almost in the range of 16 to 18 basis points. Another key thing to highlight is that there were some changes in the accounting policy, and as a result, management also stated that the net interest margin fall would have been somewhere in the range of 4 to 5 basis points if we compare on a like-to-like basis. So definitely that that was something which was positive for the result. When we talk about asset quality, that also remained fairly stable. Gross NPAs were stable, net NPAs increased just by 2 basis points, and the loan book growth, now that has continued to outpace the industry. That came in at around 12% on a year-on-year basis. Deposit growth was also strong at around 13%. So all in all, a very good set of number once again from ICICI Bank. And on the back of that, we already saw some brokerages actually increase their target price. So definitely this counter is also worth watching for today.
Okay. Thank you so much for that. We'll be keeping an eye out on both those banks on the back of its earnings. But staying with the banking space, now sources are saying that Axis Bank is expected to spike in bad loans and provisions in its first quarter earnings was not entirely result of the bank's own internal decision. Ritu is joining in with us to give us details on this one. Ritu?
Well, the surprising spike in bad loans which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages, and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that this should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
Okay, Ritu, thank you so much for that. An important update coming in there for Axis Bank. Now, let's focus on getting you some trade-related updates. As August 1st tariff deadline looms, India and US negotiators conclude their fifth round of trade talks in Washington, D.C. Both sides are yet to resolve issues around the agriculture, automobiles, while decisions on interim trade deal is also yet to be taken. Government sources tell CNBC-TV18 that the fifth round of talks saw discussions held on trade, especially in terms of chemicals, organisms, material equipment, technologies, and as further talks are expected to continue with the US in the coming weeks, here's what the Commerce Ministry Piyush Goyal had to say.
There is absolutely no way we will compromise on the interests of our farmers, MSMEs, the interests of our workers. Our effort is to give them more opportunity, to give them more trade internationally, along with their growing markets in India with growing incomes. Our effort is to make sure workers get better, higher skilled jobs. Our effort is to get investments and technology. Our effort is to focus on innovation, like we did with the EFTA countries, Switzerland, Norway, Liechtenstein, and Iceland.
Okay, on that note, we're going to slip into a very short break, and after the break, we'll get to what's happening in the world of commodities. Stay tuned in for that. Welcome back and thanks for staying tuned into Power Breakfast on CNBC TV18. Now we have Manisha Gupta joining in with us as always to tell us what should we be watching out for in the world of commodities. Good morning, Manisha. Keeping an eye out on gold, crude and everything commodities. What are you focusing on?
Well, I'm looking at metals really, Vinny, because this is an area where we've seen gains come back into the markets. Well, remember, we're looking at better economic data from the U.S. markets, whether it was retail, sales, or jobless claims numbers. And then even as the U.S. is notifying over 150 trade partners on trade tariffs, the markets have seen a cognizance of that as well. So the copper prices in the U.S. markets are trading near all-time highs. Remember, the U.S. tariffs of 50% will be enforced from 1st of August. So the U.S. copper is trading at a premium to LME and Shanghai right now. But the other metals also seem to be doing well. You have aluminum trading at March highs. Zinc is trading at April 2025 highs, and steel futures in China also are trading at a 2-month high. The markets are anticipating stimulus measures coming in from China. The China Politburo meeting also could be setting up standards for economic policies for the rest of this year, and the markets are quite positive ahead of that. When it comes to gold, well, after that profit taking in the previous week, we've started this week on a stronger note. Actually, when you look at silver, it's trading firm. Crude oil prices, after declining a percentage point in the previous week, also are trading firm. So most of the commodities have started Asia on a firm footing.
Okay, Manisha, thank you so much for that. So keep an eye out on metals and other commodities as well. Thanks for that. But on that note, we're absolutely out of time on this edition of Power Breakfast on CNBC TV18. Thank you so much for tuning in. Up next, to Bazaar.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, coming out of a weekend, start of a new week, and we are getting closer and closer to another one of those deadlines, August 1st. So not very far away. Still no deal, still no trade deal between India and the US. Will the next few days change that? I think that remains top of mind, really, from the market perspective and from the economist perspective as well. We're, of course, going to track all of that and more over the next 2.5 hours. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, morning.
Hi, morning, guys.
Morning.
And, no letters over the weekend as well. Yeah. No one's got any letter. So we'll see how that goes. But I guess the next 10 days promise some more action till we get to the deadline.
Oh, no, absolutely.
I think before we come back next Monday morning, it'll be in. The news should be in, I think. We've been waiting for quite a bit. Stop tracking the letters, guys. Go play some football, beautiful weather. I mean, I had a good weekend, actually. So
I did some indoor sports. Can you guess what? Cubing.
Oh.
Rubik's Cube. By the way, it's a real sport.
Yeah.
I mean,
Cubing, I was
we'll
like,
talk
what
about
is this after cricket and paddle? I mean, cubing is the next new thing, okay.
All right, well, let's just take it from the top in terms of what you need to know as we begin the session. And actually, what I want to do today is really basically describe what's going on in terms of the tension between what markets are doing, which is their own thing, and what the headlines are telling you, right? And both are going in different directions. Can we figure out a way to find common ground? Markets are all-time highs, trade-related uncertainty, tariffs, etc., are also at all-time highs. But what's going on? So first things first, markets, if you just generally sort of read through global literature, etc., they've raised their assessment of what, by the time everything is said and done, end-state tariffs, so as to speak. Well, all letters are issued, all deals have been made. What will effective US import tariffs be? Well, that number has actually gone up. I mean, I would reckon over the last 2 months, 3 months, the number has gone up another 3 percentage points or so. We're close to about 18 to 20%, depending on who you ask. I mean, this was supposed to be between 10 and 15%, but markets have upped their estimates on where this is. But now we come to the second point, right? I mean, assessment of what end-state US tariffs are rising, but equity markets are also rising. They appear to be unconcerned. S&P 500 is at a new all-time high. I'll get to the reasons why. The first is what the US is taking in terms of new revenue because of tariff revenues. That number is starting to appear in the horizon. So latest estimates suggest that that number could be $240 billion in additional new revenue over last year. So if last year US collected, say, X in terms of revenues, this year it's X plus $240 billion annualized, right? And that number perhaps is going to rise even more. And this is the number that many have been talking about as a possibility, whether this could, over a 10-year period, could you sort of do that, $2.5 trillion? If this goes to $300 billion a year, what then, et cetera, et cetera. That's one. Second, and this is, I think, what the market has spent less time on, which is President Trump's policies. One is AI, and the second is big tech. AI and big tech. Let me explain one by one. With regards to AI, the news, of course, we all heard, relaxation of chip exports to China. And that triggered NVIDIA's market cap to go above the $4 trillion mark. NVIDIA, of course, is a big weight on the NASDAQ. It's one of the largest tech companies, and, of course, big say on the S&P as well. So that is one. The second is, the big, beautiful bills, the Trump bill, their treatment of R&D expenses. And what they basically have done is that R&D that big companies, and actually any company, spends over 3, 4, 5 years, the bill allows them to expense those R&D costs in 1 year, upfront, straight up. And that is expected to lead to big tax savings. Now, guess what? Who spends the most on R&D? It's, again, these same big tech companies, the so-called Magnificent Seven companies, who are responsible for almost 45 to 50% of R&D spends in America. And again, largest weight. Big tech is 30% plus of overall S&P 500 weight. And these are the two lesser talked about reasons why the market continues to push higher, even as, tariff-related uncertainties are also perhaps peaking. By the way, related, on Wednesday, in the next 2 days, this week, President Trump is going to be speaking at what is, there's a summit. It's called Winning the AI Race Summit. And I think it'll be interesting to see what he says as part of that. I think I guess we'll hear a fair bit about China, etc. as well. The other bit, of course, is the constant barrage of demands by the administration for the Fed to cut rates. Fed's Waller, by the way, Fed Governor Christopher Waller on Friday argued that cuts should start as early as the July meeting. So we'll see if that that does happen or not. Tariff deal headlines should continue to be top of mind. EU, India, South Korea are really, in terms of if something were to happen, these are what markets are assuming will be the first in that sense to get perhaps deals. Bloomberg, by the way, on Friday reported, and this was according to their sources, that sectoral tariffs would also come into effect from the 1st of August. And they said that it'll be on chips, critical minerals and drugs, pharmaceuticals in that order, starting the 1st of August. So we'll see if there is a deal before that, and that becomes crucial. Just to tie in the levels on Friday, the last week, of course, there was a bit of a drift and then the market sold off. We on the Nifty closed below the 40-day exponential moving average and breached the prior low of 25,001. We'll have to, but the Nifty managed to hold on to the 61.8% retracement, which is 24,930. Actually, there was almost a touch on it and then the market bounced. So we'll see if that really comes into play today. But 61.8, 24,930 remains the first kind of level that we'll need to watch out for. For the Nifty Bank, it broke the previous low, which is 56,594, and it tested. It kissed the 40-day exponential, which is 56,252. Need to watch if this level goes, which is 56,250, simply put. If that goes, then the 61.8% comes into view, which is 56,000 odd levels. 56,000, 56,030 or so is that particular number, the 61.8% retracement of the recent move higher that we've seen. GIFT Nifty will give you a quick sense of how we're likely to start. A lot of what we're going to talk about, of course, is going to be a long plethora of financial and bank earnings, which I think we will get to in just a bit from now. But that's the broad setup. The way to think about markets at a top-down level as we kick off a new week. Surbhi.
Yeah, absolutely. And I think right now, at least the next 2 weeks, it's earnings that are center stage, unless we get a completely unexpected missive on the tariff front. It's earnings actually here, earnings in the US, that's driving the market's focus and attention. So, by the way, US futures are showing a little bit of, green, tiny hint of green, 0.1 to 0.2% higher. And last week was a very solid week for the US market as well, because earnings have been coming in along expected lines, topping estimates. In fact, just to put this on the record, according to FactSet, which picks up the data, out of the 59 S&P 500 companies that have reported, guess what? A whopping 86% have beaten estimates. So that tells you why the market has been just simply galloping along, narrowly focusing on the earnings action the last couple of days. This week is going to be heavy because we'll hear from some of the tech giants. For instance, Alphabet is reporting on Wednesday. Tesla is also reporting on Wednesday. So watch out as the earnings, juggernaut keeps rolling on. On tariffs, the headline that everyone's talking of this morning is coming in from the U.S. Commerce Secretary, Mr. Howard Lutnick. He's saying August 1 is a quote-unquote hard deadline for tariffs. But in the same breath, he also adds that, however, nothing stops countries from talking to us after August 1. And that's perhaps why the market has not been too perturbed about the 25%, 30%, in some cases like Brazil, 50% that's been handed out to countries, because it seems that the window of negotiations is open even after the 1st of August, going by this particular comment. So let's see how this plays out. In Asia this morning, things are pretty mixed. In fact, I was looking at the markets right now. So you've got the Japanese market, by the way, is shut. And the big event was over the elections over the weekend in Japan, where the ruling prime minister has lost majority, so his future is unclear. But the market is not trading today, at least the equity market. So you're not getting an immediate reaction. Hang Seng is up 0.5%. Shanghai is up about 0.5%. So some of the regional markets are still flashing green. So let's see which way we go with. So range bound as far as Asia goes. Now, this complete range bound action in India with the negative bias, the headline is it's gotten us to a near 1 month low. The last time the Nifty closed below the 25,000 mark was the 23rd of June. And today we're sitting on the 21st of July. So almost 1 month lows for the market, grinding, slowly lower. Let's see if the market can snap out of that, because earnings actually are very good over the weekend. I'll come to that in just a bit. But first, the fund flows. FIIs, well, buyers of hardly 400 crores in the cash market. Domestic institutions were buyers of about 2,100 crores in the cash market. But now let's come to the good part. Most of the weekend results have been fairly good, if not great. Reliance itself, a very, very steady show. Jio has been firing up. The ARPU has gone to 209. On the oil and gas side and the O2C side, there's some sequential weakness because of planned shutdowns, lower KG-D6 production, for instance. But retail is firing so well. Double-digit growth for Reliance Retail, steady margins. So Reliance is good. ICICI Bank, I call it another pristine quarter. You just cannot complain. Margins have not fallen as much as market was worried about. The growth is fantastic. When the system-wide credit growth is 9%, ICICI Bank's advances up 12%, deposits steady, but provisioning is higher. You can see it as a glass half full as well. The bank is just being prudent. Provisioning also higher for HDFC Bank, so we'll talk about that as we go forward. Pretty steady. No negative surprises like Axis from HDFC either. Tier 2 banks would be very interesting to watch because they're all flashing mixed signals, especially AU, which has increased its credit cost guidance. And then there is Bandhan, etc. But this trio is looking very, very good as well. Actually, JSW Steel and JK Cement, Nigel will tell us more about this. Pretty good news from India Cements as well. So as I put all of it together, there's more good news than bad news on weekend earnings. And that gives us a good feeling as we kickstart trade this morning. Nigel.
Well, that's right. That could be a bit of a positive outlier. However, on a day-to-day basis, the Nifty is making a low, and we are breaking those technical levels as well. So some of those factors that we talk about, the PCR, the net shots, they're indicating a bounce, but it's not yet to be seen, which is a bit of a worry. So today, I think, is a very, very crucial session. You'll want to see the bulls fight back. Let's focus on that short point, that I was talking about. The FIs, they added close to around 10,000 short contracts. The swing factor out there is close to around 12,000 contracts, with the short positioning at around 85% of the mix. And if you look at it in the last few trading sessions, for the last week itself, the FIs, they've got aggressively net short, while clients have got more net long. So in the last week, the short positioning from the FIs has gone up by around 40%, and from the clients as well has gone up by really around 35% or thereabouts. So both of them are moving in the opposite direction as we speak. That combination indicates a bit of a bounce, but as of now, no sign of that. In addition to that, there was aggressive call writing that we saw in Friday's trading session. So from both the big participants of the markets, the clients as well as the FIs, more calls than puts were written. And that's why we have the PCR that's actually come down a little bit. So the PCR is now down to around 0.78. Normally at around 0.7 is when you get a bit of a bounce. So the FI's net short contracts nearing the 1.5 lakh contract mark and the PCR moving to 0.7. That combination indicates a bounce. Let's see whether or not we see it either today or tomorrow. But a bounce is very much due. For the time being, the structure is a little bit worrying. Call writing, 25,100 call, 25,000 call. Both those two strikes are fairly active, and the call writers, they are feeling very, very confident. However, on the downside, this 24,900 put is seeing some addition. You'll want to see some addition out there. You want to see some writing at that particular strike because the 24,800 mark is the extremely important support level that we're looking at. So the levels come up for you on the screen. On the downside, 24,800, important support zone. Friday's high, you'll want to get past this level because on a day-to-day basis, you're making lower highs. So that's important. And after that, the 20 DMA. The Nifty Bank, it's broken the 20 DMA, on the downside. Now all eyes on the 50 DMA. That's going to be the important mark that we're looking at. It, in case it dips, by the end of today, you'll at least want it to conquer this 56,000 odd mark. Stocks that I'm looking at, well, the one that's moved into, in the F&O band, that's Bandhan Bank. I'll keep an eye out on this one. Massive volumes last week as well. The stock ended up 1%, that one. And in terms of indices that I'm looking at, metals, that's the one that ended quite strong in Friday's trading session. The commentary coming out of China yet again is indicating that they will support growth. They will be looking at boosting measures, and pricing as well has moved up. So because of the commentary from China, as well as the prices this morning, base metals, as well as ferrous prices, I'll keep an eye out on the metal index from here on.
All right, Nigel, thanks very much for that. So we'll keep an eye out on those sectors specifically. William Lee is Chief Economist and Executive Director of the Milken Institute. William, good to have you on the program. Have you yourself raised, overall, there's no way to hard-code these numbers, but generally, do you think the final end-state tariffs will settle at over 15% now? William, what's your sense?
There's going to certainly be a permanent level of tariffs that everyone's going to face. I think President Trump has made that very clear. Whether it's 10%, 50%, that really doesn't matter that much, because I think the key to how companies are successfully able to engage with the United States is whether or not they invest and whether or not they open their markets to the U.S. Secretary Ludnick, everybody in administration has been saying, all we are looking for is for the world to open up their markets for U.S. companies, and we will open up ours similarly. And I think the level of tariffs represents a failure to do that. And I think the higher the level of tariffs that countries face reflects their unwillingness to open their markets. I think that's been the general rule of thumb that we've seen in the last several weeks.
And as these revenues are collected, it'll give more confidence, right? Annual estimates now that US will collect additional new $250-odd billion in revenues.
CBO,
and perhaps that number goes up. Yeah.
Exactly. CBO came up with an estimate a while ago that said that given the minimal level of tariffs of 10% and some of the specific tariffs that are in place, they're anticipating revenues on the order of $2.5 trillion over the 10-year period, which is not counted by the CBO in their scoring of the tax revenues that are used to offset the deficit. So these are significant revenues when you come to think about how much the U.S. Treasury is going to have to borrow in the future with all the lack of success in closing the deficit that we've seen in the legislation so far. These tariffs will play a big role, even though they're not counted in the legislation so far.
Mm-hmm. Now, William, what about the other markets that investors are looking at this point in time? Japan, pretty significant because of the election results. Here in India, we're tracking earnings, some of them so far looking pretty okay. So how are some of these larger Asian markets looking to you? And of course, China continues to move along as well.
Well, China's got their own problems, you know, their domestic problems. They are, in some ways, their own worst enemy because they really can't get the domestic economies going. The electric vehicle industry, which is where China really is absolutely supreme in in introducing the new technologies, they're killing themselves in China over excess competition, trying to lower prices to knock each other out. And so we have essentially price deflation in China. In part because there's lack of demand, but also because the companies themselves are trying to knock each other off. And I think the government, as you mentioned earlier, is trying to put some order to that, but we have yet to see that. The rest of Asia, you know, the political unrest in many of these countries has really been a cloud over a lot of the investment potential that U.S. investors and other foreign investors would look at these markets. And as far as India is concerned, I think the question really is the big one that has been asked over and over again. Will India open up its markets for the U.S. and avoid the higher tariffs that are about to hit them? So I think the Asia-India complex of possible investments for global investors really depends upon how the governments will view protectionism and whether they really want to protect their domestic industries or are willing to let capital flow out of the countries, invest in other parts of the world, especially the United States, and that will lower the tariff barriers immediately.
Okay, all right. William, hi, good morning. Good to see you, Ben. A quick word on the earnings season in the United States. You know, some of those banking names, numbers didn't look too bad, but some of those stocks are selling off post numbers. However, we had a couple of positive numbers. PepsiCo, case in point, the numbers were, you know, welcomed very, very well. What are you making of that? Because most of the growth in earnings in the United States will be because of the Magnificent Seven. X of that will be, you know, around 3% or thereabouts. So your expectations with regard to earnings season, and just comment on that factor that you're talking about. Tariff, the fear is inflation moves up, but you're saying gasoline prices as well have come down, which actually won't move the needle too much. Quick comment on earnings as well as inflation. Go ahead.
Nigel, as far as the earnings front is concerned, I think your President's opening remarks are absolutely spot on. There are a lot of policy interactions that are not being talked about and that are being ignored. The interaction of the investment incentives in the tax bill and the tariffs, I think, are now coming home to roost and showing that the big tech companies are benefiting from that. You know, Jensen Huang is going around the world saying, hey, I've got chips to sell, and he's doing a phenomenal job selling to sovereigns, and the sovereign AI market has now become a very, very real phenomenon. The tech industry is doing very, very well, but as you say, other parts of the U.S. economy are also starting to catch fire. If you look at the latest GDP numbers, very few people have reported that actual fixed investment, business fixed investment, especially on the research side, has been growing double digits. And as consumers are slowing down, business investment is really on fire. And I expect that to show up in future profits and better performance on the stock market. As far as the inflation front is concerned, again, I've said so many times on this show, and I hate to repeat myself over and over again, but the U.S. is a relatively closed economy. The consumer basket for U.S. People is about 70% domestic services, 30% goods. Of the goods, about 25-30% come from imports. So if you knock that stuff together and talk about, say, a 25% tariff or 20% percentage point jump in tariff rates, that will raise consumer prices by under a percentage point, especially if you consider the drop in energy prices. You mentioned gasoline prices have dropped by 10% over the last year, and if President Trump's policies continue, they will likely be either stable or continue to decline. So the inflation front looks very good, and the excuse that the Fed has been using for not raising rates, as Governor Waller has been telling you, that excuse is starting to fade very, very quickly. And as soon as we hit, say, autumn and September, when we get 1 or 2 more price readings on the CPI and other inflation measures, we're going to see that the tariff increase may be much, much less than the fear mongers have been saying.
William, thank you very much. Good speaking with you. Appreciate you joining us here on the program. It's always a pleasure. We'll take a quick break, but let me just quickly run you through what's coming up here over the next 2.5 hours. 8:35, you'll hear from Prabal Sen of ICICI Securities. Karun Thonari, Velara Capital, and Gaurav Malhotra of Axis Capital will join us to discuss Q1 earnings for Reliance Industries. That's a little later. After that, 9 o'clock, you'll have the management of Hindustan Zinc for their first quarter numbers. 9:20, Devina Mehra on markets. 9:30, you'll have the management of L&T Finance to talk about their first quarter earnings. Jayant Acharya of JSW Steel at 9:40 on their numbers. 9:50, Suresh Iyer of Canfin Homes about the performance for the quarter and the outlook ahead. And Latha in conversation on Bandhan Bank's first quarter numbers with the management. That's coming up at 10:15.
Time to slip into a short break. A lot of stock-specific action in our special Top 10 segment. I give you a sneak peek. Reliance, HDFC Bank, ICICI Bank, JSW Steel, JK Cement, Sona BLW Precision, and Jio Financial Services. They react to positive news flow. Axis Bank, AU Small Finance Bank react to negative news flow, while we could see a neutral reaction or a mixed one on Bandhan Bank. Take that break, come back, get into further detail.
Welcome back. Well, like we've been telling you, markets across Asia are giving mixed signals today. The Japanese market is shut, but there's some green across the Hang Seng, even mainland China for that matter. So mixed picture. Let's pull up the implied open. I mean, we've been grinding low for the past 4 weeks now, almost coming down to a 1-month low on the Nifty. And that implied open is not offering too much of comfort. Let's see, maybe the real opening manages to defy that, because the earnings have not been too bad. So let's get to the good news, actually. Starting off with the CNBC-TV18 list of top stocks to watch, and our team is standing by with all the top stocks that we need to look at. Guys, good morning to all of you. Let's start first with Reliance Industries. Sonal, how does the consolidated picture look?
Inline set of numbers this time. If you look at the EBITDA number, it came in higher on a YOY basis at 42,900 crore rupees. Margins higher at 17.6%. Profits, quarterly record that we saw this time, around 26,994 crore rupees. This was aided by higher other income, which was aided by that stake sale in Asian Paints by the company. That was around 8,900 crore rupees. This time around, the company saw double-digit growth in Reliance Retail. In terms of the Jio business, revenue growth was driven by both the subscriber growth and ARPU growth as well. O2C EBITDA margins came in higher, though there was an impact of a maintenance shutdown that the company took, but the outlook is positive going forward. Mukesh Ambani reiterated their plan of doubling the business every 4 to 5 years. So that was an important statement that came by. In terms of brokerage commentary, Morgan Stanley has an overweight rating with a target of 16-17 on the stock. Jefferies is projecting 11% EBITDA growth over FY26. They also maintain a buy with target price of 17.26. And Motilal Oswal, they've gone ahead and increased the target price on the stock to 1700 versus 1685 earlier.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Gaurav. He's here to tell us about the other big boy, HDFC Bank. Morning, Gaurav.
Well, yes, a good set of numbers from HDFC Bank in this quarter because net interest income increased almost by 11%. We saw 11% growth on pre-provisional operating profit and PAT increased almost by 12%. That was actually higher than what the street was expecting. Now, there was a one-off impact in this quarter because of the HDB sale worth 9,000 crores. But what bank did is that they actually created a floating provision worth 9,000 crores. So definitely net off, there was no impact on the profitability because of that. In fact, they also created a contingency provision of 1,700 crores. And if we exclude that, the provisions were also in line with what the street is expecting. What was positive is that the credit cost actually in line as a result in the range of around 0.54%. And at the same time, the net interest margins, they declined a little bit, almost by 19 basis point, but core net interest margins declined just by 11 basis points as per brokerages. As a result, we saw some upgrades from brokerages as well. We've got Nuvama, Investec actually giving their bullish call. We also have some other updates. Company has declared the dividend, special dividend of 5 rupees per share, and they have also declared bonus issue. So that is also something that we will be watching out for. And as a result, definitely a positive reaction is what we are expecting in HDFC Bank today.
Gaurav, morning. What about ICICI Bank?
Well, a good set of number here as well. ICICI Bank did not actually disappoint in beating the street's expectations. When we look at net interest income, that increased almost by 11 basis point. Profitability increased almost by 15 basis point. When it comes to operating profit, there also we saw a good set of number, around 17% of increase on a year-on-year basis. What was actually positive is that the net interest margins declined just by 7 basis point versus the expectation of 18 to 19 basis point decline. In fact, there were some changes in the accounting policy. And as a result, management also indicated that if we compare on a like-for-like basis, the net interest margins have declined only by 4 to 6 basis points. So that was actually a very big positive. In terms of loan book and deposits, there also we saw a good set of numbers, 12% growth in terms of loan book and 13% in terms of deposits. Actually, when we talk about the cost of funds, now management has indicated that cost of fund will go down in Q2 FY26. There will be some kind of pressure in net interest margins in the coming quarter, but definitely management remains sound in terms of the optimism coming up from the bank, and that is the reason this bank is also in our list today on the back of the good set of numbers and good commentary also coming up from the management.
Okay, all right. Thanks a lot for that, Gaurav. Busy weekend for you. But let's focus on JSW Steel then. Those numbers look quite good. That's why I'm going with green. And as I mentioned earlier, Chinese commentary could keep some of these metal stocks quite in bit better than what we're working with. The standalone EBITDA per ton, yes, there was an improvement. One would say they wanted a bigger improvement out there, but 10,600 rupees per ton is good. The bigger beat, though, came in from their other India operations. That is the coated steel products out there. There was a good bounce in the EBITDA. Even Bhushan Power and Steel, well, out there as well. Solid bounce out there. So both those two really made up for any kind of miss if in case you're looking at the standalone EBITDA per ton and, saying that it's not good enough. So the India operations on the whole look solid. US operations very good out there as well because you had improvement in profitability. For the quarter, they delivered $20 million of EBITDA, which is encouraging. Net debt number moved up a little bit, but that's par for the course because the net debt to EBITDA is still under check. In fact, that came in lower. The con call takeaways as well were quite encouraging because quarter two volumes actually will be higher, which will make up for some kind of softness that we're likely to see in the seasonally weak quarter because of the monsoon. So going with green on JSW Steel. And we'll have a chat with Mr. Acharya at around 9:40 a.m. later today. Hopping across to Ritu. She's here to give us some scoop on Axis Bank. Ritu, tell us more.
Well, the surprising spike in bad loans, which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact, was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages, and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that they should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
All right, Ritu, thanks very much. And that explains, I mean, that was a big question that was unanswered till now, that why suddenly now? Why change your NPA recognition policy now, which led to that huge rise in slippages? And Ritu confirming with her sources that this seems to be a nudge from the Reserve Bank of India. Very important story there, Ritu. Thanks very much for that. But let's get back to Nigel. Nigel, JK Cement looking good?
Well, the stock is near a 52-week high and valuations are not cheap. And they justify that. Numbers look very, very good. Top line, there was a growth of close to around 19%. The EBITDA number went up by more than 40%, indicating there was margin expansion. And when you grow by 19% on the top line and you have your power and fuel costs going up by only around 7%, telling you that operating leverage is playing out. And also the focus on cost is definitely playing out there. Profit number as well jumped up by more than 75%. What worked for them? Sequential basis, realizations were up only around 1%. But if you're looking at the volume front, the grey cement volumes was up 16%. And that's where the big beat came in, because the operating leverage played out. And the EBITDA per ton on a year-on-year basis, it improved from sub 1,000 rupees to more than 1,200 rupees per ton. On a sequential basis, there was a bit of a dip, but that's par for the course. So short point being, these numbers look good. Operating leverage playing out there. They've gained market share in their core markets as well, in Bihar and other central region markets. And also their debt pretty much intact. They're on their way to be a 30 million ton plant. So going with the bright green on JK Cement. Remember, the stock, though, is at a 52-week high. Gaurav, coming back to you, though. AU Small Finance Bank and Bandhan Bank, how are the numbers?
Well, when it comes to AU Small Finance Bank, the beat was there in terms of profitability, increased almost by 15%, which was actually higher than the street's expectation, but that was specifically led by the treasury gains. Now, what remains as a key concern is that now bank has increased their credit cost guidance somewhere in the range of 1%, which was earlier in the range of 0.85%. So what they are saying is that there will be some kind of pressure in second quarter as well because of the stress in MFI. They are not seeing the stress in MFI easing specifically because of the collection issues. On the other hand, there was another issue as well, which is net interest margins that declined almost by 40 basis points on a sequential basis, where street was expecting around 30 basis point of fall. So definitely a little bit of negative sentimental reaction is what we can see, given that there was an outperformance for the stock for the last few days. Another news is that that is on the Bandhan Bank. Now, here again, the numbers are actually fairly in line, or rather better than what the street is expecting. NIM decline was somewhere around 30 basis point, again with what the street was expecting. What was concerning is that the write-off factor. Now, in this quarter, slippages, although they have come down, the write-off is specifically from their emerging enterprise business segment. So let's look at the numbers. There was a write-off around 1,047 crores in this quarter, out of which EEB contributed to around 952 crores. So that is something which is concerning, because a huge chunk of EEB is going in the write-off, and that is something that we will be also watching out for Bandhan Bank.
Okay, all right, Gaurav, lots of financials, so busy weekend and busy day for you ahead as well. The management will come up at 10:15 in conversation to talk about numbers and the outlook forward. Well, Sona BLW is the next one we focus on. This is a CNBC-TV18 exclusive, and Vivek had reported, along with Parikshit from Delhi, that the deal was happening, and as the announcement has come through now, Vivek, what are the details?
Well, that's right. On July 17th, CNBC-TV18 had reported that Sona BLW was most likely going to go ahead and onboard one of China's largest EV companies, BYD, and it also told you that the company was likely to set up a manufacturing plant in China to support the OEM story over there. Along those expectations, in line with what we had reported yesterday, Sona BLW informed the exchanges that the company had formed a JV with a Chinese company, JNT. Now, Sona will be going ahead and investing close to $12 million in this particular JV to take a 60% stake. JNT will contribute the remaining $8 million. Now, along with that, what is the company saying? The company is saying that the JV is expected to commence operations in H2 FY26. The JV will manufacture and supply driveline systems as well as components, indicating that the order is already in land. Whole host of brokerages have reacted to this particular material development as far as Sona is concerned. Elara says there's a significant positive in terms of supporting valuations for Sona. Investec says that the JV with JNT will provide exposure to the largest EV market and will help tap Chinese OEMs. JV with JNT will help reduce customer risk. ICICI Securities says that the stock has underperformed the overall auto universe, and they believe that from this point on, the stock has bottomed out and should start outperforming from here on. And JM Financial says that this particular JV represents a substantial growth opportunity. And JM also goes ahead and names the likely anchor customer, which is BYD. It's important to note that Sona generally does not go ahead and call out the name of their client. Even in the case of Tesla, they do not call it. And even in this particular case, they have refrained from naming BYD as a client.
Okay, all right. Got it. Thanks for that, and congratulations on that news break, Vivek. Well, with that, let's quickly move on. Jio Finance announced a tie-up. They're getting into the insurance space. Vamakshi is here with the details. Morning, Vamakshi.
Good morning, Subri. Well, going with the green for this counter because the company has announced a 50-50 JV agreement with the Allianz Group for the domestic reinsurance business here in India. Keep in mind, this comes after 4 months wherein, the Allianz Group had exited its 2-decade-long partnership with the Bajaj Group. The JV operations will be launched only after statutory as well as regulatory approvals will be in place and will leverage Allianz's existing Allianz RE as well as Allianz's commercial portfolio and activities in India, and will also benefit from the global setup that Allianz Group brings with them. Now, in addition to this, what they've also done is entered into a non-binding agreement with the group for setting up equally owned JVs for general as well as life insurance businesses here in India. So therefore, the agreement for reinsurance as well as a non-binding agreement for general and life insurance bodes well for the company.
Got it. All right. Thanks a lot for that, Vama. Well, let's drift away from equity markets, focus on the commodity space because there's plenty happening out there. Manisha Gupta joins us to tell us exactly that. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, we've started Asia on a positive note. That's because the dollar index has seen a bit of a decline. So gold, after posting a weekly decline, has started nearly 0.5% on the higher side right now. The U.S. is to notify over 150 trading partners on tariff trades. There are geopolitical tensions, escalating Russia-Ukraine conflict as well. All of that supporting gold prices, which is staying above $3,300 an ounce. Gains also have come back in silver. Even crude oil prices, after booking a 1% weekly decline, have seen gains after mixed economic data that we saw from US and China. But I'm really keeping an eye on the metal as a sector because the strong economic data, expectation of stimulus from China, and the China Politburo meeting are all in focus. Is the reason you're looking at U.S. copper prices near all-time highs, aluminum at March highs, zinc at April highs, steel at a 2-month highs. So metals really outperforming various other sectors.
Okay, all right. Got it, Manisha. So we'll keep all the metal stocks on her radar as well. Thank you very much for joining us with that roundup. We'll take a quick break, but coming up on the other side, a complete breakup discussion on Reliance Industries' Q1 performance. Prabal Sen of ICICI Securities, Karan Taurani of Elara Capital, and Gaurav Malhotra from Axis Capital joining in for a complete view. Welcome back. So let's look at Reliance Industries and the performance in the Q1 and what that tells us, the expectations for the rest of the year as well. Thanks to that one-time gain of 8,900 crore rupees from the Asian Paints stake sale, of course, profits were substantially higher. But even after adjusting for that gain, profits are still up 20%. And the rapid store expansion at Reliance Retail helped that part of the business show up an over 11% rise in revenue or a near 29% increase in profits with very steady margins for Reliance Retail. Mr. Ambani has reiterated that the group will double in size every 4 to 5 years. We now have Mr. Prabal Sen, energy analyst at ICICI Securities, Karan Taurani of Elara Capital and Gaurav Malhotra at Axis Capital, all of us to join in to discuss different parts of Reliance's business. So let's start, with the good, and very clearly retail firing along, telecom being very steady has been good, and then we'll talk about the energy and O2C as well. But Karan, since I think retail was perhaps the best in the business considering the growth rates that have been outlined, what is your sense on retail and, how would you expect the build-up for the rest of the year?
Hi, good morning. If you look at Reliance in terms of the performance this quarter for the retail business, it's been a steady performance. Majorly one big negative impact, which was there in the last 4 to 5 quarters in terms of store closure, that is kind of moving away right now. So if you look at the numbers on a quarterly basis, they were largely shutting down 4 to 5% of the network stores in terms of the retail business. This quarter, that number is shrunk to about 0 to 1%, which is largely in the range of what it was about 5 to 6 quarters back. So they had expanded aggressively in the last 2 to 3 years. And because of that, there was some rationalization in place. One more key thing to watch out here in terms of numbers would be the performance of JioMart. So JioMart on a small base has grown well. They continue to focus in terms of the non-metro market. Quick commerce, as we all know, will scale up in the non-metro markets also eventually, and there JioMart could have an edge. Execution is a key here in terms of how they actually execute JioMart through the network of Reliance Retail, because they've got more than 2,000 grocery stores. So I think that's one category which is very important in terms of how things pan out from here on. Thirdly, I think in terms of the other digital businesses, if you look at the white goods business, if you look at Ajio, there's steady double-digit growth there, and the momentum continues over there.
Okay, that's Reliance Retail. Coming to Gaurav now. Gaurav, were you satisfied with the telecom performance? I mean, we're talking about, I think, the ARPU going up to 209. And everyone's watching out for some indication of when this Jio IPO will happen. We don't know if we'll get some indication in the AGM or not. But your thoughts?
Yeah, so see, Jio actually was a very good set of numbers. If you see across the board, the net adds were very strong, the highest across the industry. ARPU, there was an uptake both on the fact that, this quarter had one additional day, but there was also some premiumization happening. FWA, the fixed wireless broadband, that is going very good. The company has almost an 80% market share there. And lastly, on the operating leverage side also, we saw a healthy margin expansion. So on the whole, there's really nothing to complain. The company is doing quite well, both across operating as well as financial parameters.
Okay, got that. Prabal, coming across to you then. How are you feeling about the numbers? The O2C business, it had a couple of one-offs. There was a shutdown out there. Production was a little bit lower. But your take on the O2C business, which was a bit of a sore point, but the street doesn't seem too concerned. Your reading?
Yeah, I think it missed estimates primarily because I think the impact of the 21-day shutdown was perhaps underestimated to a certain extent. If you look at petrochemicals, in fact, QQ, most of the product spreads have actually improved, even in refining. There seems to be a little bit of traction because of diesel inventories being lower and the US driving season likely to provide some incentive. I think long-term prospects remain a bit uncertain. Nobody really knows where the cycle will end up, both on refining and petchem. But as far as this quarter numbers go, I think, people will shrug it off because there was a one-off. And what would be more interesting is to see the second and third quarter numbers, if there is some recovery that happens in refining, as well as, petchem remaining steady itself will provide some traction. So, I wouldn't be too worried about the miss, at least in this quarter.
Prabal, hi, morning. I wonder if you've started ascribing some sort of value, some numbers to the new energy business. I saw some notes over the weekend where now that we have, I think, timelines, 10 gigawatts of this entirely integrated facility, right? Polysilicon going up to modules. I think it comes on stream maybe by the end of this fiscal. So any sense on how we can start valuing the new energy business?
Actually, while it's still very difficult to build in numbers in terms of earnings, we have anyways been ascribing about 1.5 times capital employed, the initial plans of 750 billion rupees. So that's something that we have been ascribing for some time, which translates to about 150 rupees a share. You're right that the visibility on this business continues to improve. I would just like to say that I think the timeline mentioned by the management in terms of getting everything done is in the next 4 to 6 quarters. So maybe FY27 second half is when we would probably see more, all of this coming together and really starting to flow. But it would be done in phases. So some part of it may start to reflect from the second half of this year itself, some part from probably first half of next year. So we'll have to see that. But we have been ascribing some value to it in any case as a multiple of capital employed.
Okay, so basically by the end of this year, beginning of next fiscal, we'll start getting clearer visibility on that side of the business as well. So that'll be one important trigger for the stock overall. Second trigger, like Gaurav mentioned, obviously is going to be any hint of the Jio IPO and value unlocking is going to be a big one. Karan, back to you on retail. Q1, as you said, was phenomenal. What is the kind of growth rate you're penciling in for Reliance Retail at a time when, the overall consumer space still seems to be in a funk and the expectation is it'll grow? I mean, I'm talking from a pure play retail perspective. There's D-Mart, there's obviously Trend. Now, this is part of Reliance. So how would the growth rates here for Reliance Retail compare with some of the others in the market? And what are your expectations for the year?
So on a high base, I think, Reliance Retail has kind of executed well. If you look at the likes of Trent, the growth rates are closer toward 20%, but that's when the fast fashion business. Reliance Retail is a conglomerate and they're present across multiple categories and segment and even in online. So from that perspective, I think these kind of growth rates will largely continue for the next 3 quarters going ahead. They may accelerate more towards 13-14% kind of a band. But we don't see like big delta positive surprises as far as numbers are concerned from here on for Reliance Retail. One is because they're at a very large base, reasonable base right now. Second very big reason is the stores, right? So I think if you look at the number of stores they're operating right now, the worst is over in terms of rationalization, in terms of cutting down stores. But still, we don't see any big expansion initiatives because the online business in every category, if you look at the BPC or if you look at the apparel category or the grocery category, all are struggling because of the online threat. So I think we don't see a lot of physical store expansion, which is why I say that the positive delta in terms of Reliance Retail seems to be over, at least in the near term. We'll have to see in terms of how this trend reverses in the medium to long term perspective.
Okay. All right, gentlemen, helpful conversation and gives us a fair amount of visibility on all the different parts of the various businesses. Thank you for joining in, all three of you. Well, on that note, we do have to take a very quick break. We'll keep discussing more stocks. So many earnings to go over. We'll have Prakash Devan joining in for exactly that in just a bit.
Welcome back. Hope you're having a good morning. Well, markets open in the next 10 minutes or so. For the time being, let's get in Prakash Devan, our market expert who helps us with some fundamental analysis. Prakash, the banking names, the two big banks came out with their set of numbers. HDFC Bank, you can quibble on a couple of parameters, but ICICI Bank, it was beauty. How do you approach both these two stocks?
Good morning, Nigel. So I think, yeah, you're right. HDFC has quite a few questions that need answers. And I think it's still work in progress. You know, if this HDB financial thing wasn't there, the numbers would have really paled in significance. So my sense is that the market will want to hear better things in the days to come for it to kind of get that kind of a leadership position. But ICICI Bank, yes, I think what was commendable was the credit growth that they have notched, 12% against an industry average of 9.5, which means that they're off to the races already. You'll see credit growth numbers expand for most banking players, and that's the only way to grow. Because if you look at even in ICICI Bank, there is the element of treasury gains which has aided the profits, but that's not something which you can bank on for the subsequent quarters. So good numbers, but I think it's most of it is in the price.
You know, out of the long Prakash morning, is there anything tradable this morning on bank from financials, which is all reported?
I think.
And one more question, and just a brief one on that. Our own story, Prakash, on Sona BLW, of course, it was confirmed over the weekend. Vivek and Pariksha that they put together.
Yeah.
And I'm seeing some estimates of what this could be potentially is business size. I mean, it looks pretty meaningful. Could be pretty meaningful. We'll try and speak with the management as well. And your thoughts on Sona BLW as well. Financials first, anything tradable, and Sona.
So within financials, I don't think any of the top players have any juice left as of now. The numbers just justify the moves that we've already seen in some of the banks. But as the entire sector continues to get re-rated, you'll probably have a lot of the mid-sized banks, the smaller banks, PSU banks participate. Bandhan is something you could look for, and I'm waiting to hear the management speak on a channel sometime later to figure out if there is organic traction and they're out of the woods, which clearly they seem to be from the numbers. So that's one part. On Sona BLW, I think it's an amazingly strong, symbolic, if not materialistic, material change that India and China can collaborate on a lot of these things at a company level. You know, while we could keep squabbling over other things as nations, but I think the synergies that will emerge and the access on the Asia side, where India and China get stronger on technology transfer, collaboration, that's actually a part of that theme. What it does for Sona BLW is it kind of catapults itself into mass scale, high tech, new age businesses, new age products, which the Chinese are already ahead. The Chinese are finding it extremely difficult to sustain the kind of scale that they have built up, and that's exactly why there's a lot of dumping of ancillaries and fully made cars all across the world. If they were to get an entry into India, it will have to be through these kind of arrangements, and that's where Sona BLW actually benefits a lot. So I'll wait to see more details come through, percolate as we go along. But this is going to be, if this is a trend, you could expect a lot of these other companies also to be emboldened to go ahead and strike deals with Chinese companies. So, which was, for a long time, it was a touch me not saying you could go to China and collaborate. But here's an example of how it's a win-win. So from that perspective, it's very, very positive.
Okay, all right, got that. Prakash, stay on. We'll have lots more questions for you, including more financials. But we also need to take stock of how the trading setup for today is looking like. We have Sudarshan Sakhani as well as Mitesh joining in as always. Gentlemen, morning to you. It's been a slow grind down, right? And the slow grind down has almost taken the Nifty now to 1 month lows. What should the stance be? Let's talk index and then we'll come to stock ideas. Mitesh, morning. Let's open with you.
Good morning. So we've been calling for a test of 24,900 odd zones, and I think with the 30-40 point kind of a gap down, we'll be right there. Now there's some important modified moving averages being placed over there. So I would want to see a strong rebound from those levels. But in case we don't do that, then I think we are preparing for a slightly bigger decline, which could see us test and head towards 24,500 as well. So to me, 24,900 on a closing basis is very important, and we still aren't in a very a strong technical structure. I would say the indicators are still pointing downwards, so that risk of breakdown still remains. So in that sense, I would not want to trade the index immediately, but see how it reacts afterward.
Got that. So 24,900 on a closing basis is important to track. Gentlemen, morning. Sudarshan, what about you? How would you look at things?
Yeah, good morning. Well, last week I had suggested that the markets look as if they are moving towards 24,500, and I hold to that view. Now, that doesn't mean, Prashant, that the markets will go there. Obviously not. It's just the probability or the possibility is stronger as of today. So the trend is that there is a minor correction. That minor correction should see the Nifty drifting down. So unless proven otherwise, stay away from long positions, focus on stocks.
Okay, got it. Morning, gentlemen. Good to see you all in. Sudarshan, you go first. What about individual stocks?
Well, the individual stocks are always usually on the buy side. And there are two reasons. First, some stocks do outperform. And second, short selling stocks in an uptrending, broadly uptrending market is always dangerous. So I don't usually recommend it. Now, buying comes in TVS Motors, buy with a stop point at 26.90. Manappuram, and Prashant was asking for some financials. So Manappuram is there as a buy with a stop under 266. Godrej Properties is a buying opportunity with a stop under 2,300. And finally, NMC is a buy with a stop under 70. But there's no rush. Don't rush to buy.
Okay, all right. Don't rush to buy, but these are the stocks. It looked like you said Godrej Properties, I think. So Godrej Properties is the stock that you're focusing on. Mitesh, coming across to you. Which stocks are on your radar?
Yeah. So I have a mix of buys and sells as well. On the buying side is Dalmia Bharat, which made a fresh swing high. The structure is very positive. So keep a stop below 2218, look for targets of 2340. And a conditional buy on Bajaj Finance. If it starts getting past 952, 953, buy with a stop at 939 for a target of 980. On the selling side is Hoodco with a stop at 230 half for targets of 217, and ICICI Prudential, that's a sell at the stop at 644 for targets of 610.
Okay, all right, gentlemen. Thanks a lot for that. We'll come back to you all for a couple of more calls once market opens. For the time being, slip in a short break. Pre-open on the other side. We'll also be joined by the management of Hindustan Zinc. They'll detail their past quarters numbers. Mr. Arun Mishra will be chatting with us. Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, Prakash Diwan is still in conversation with us. Prakash, over the weekend, we had a couple of numbers. You know, India Cement, the impact of Ultratech Cement is clearly showing, right? Under their parentage, things have turned around. They reported their first positive EBITDA number after multiple quarters of losses. And JK Cement, so expensive, trading next to a 52-week high. But volume growth of 15-16% is beautiful. What's your view?
So, Nigel, there's always a reason for the kind of premiums that some of these companies start attracting. And the market is wise enough to anticipate that. But then, I think the volume growth will eventually, even if it were to stabilize in the early teens or let's say even the late single digits, it's going to be far better than industry. And what JK Cement has always had an advantage of is the premium product positioning that it has, right? So, I mean, especially white cement, they've been leaders for a long time. My sense is this will continue. The numbers are very impressive, very strong. But you have a buy on dip strategy if you really don't want to pay very rich valuation and don't get succumbing to FOMO. But what it tells you is that a lot of the integrated cement units will start reporting some very good numbers. And JK has done well even on the cost metrics very brilliantly. So I think that's a trend to pick from these set of earnings. And India Cement, of course, as you rightly said, it's already started the transformation journey. We've seen that happen to some of the other acquired businesses by the Adani Group in the past. This is something which will help, and it does give Ultratech a very strong foothold in the south. And if they were to make that as the spearhead for their presence in the south, things could look very different and very northwards from here. But I would still go with something which is more tested and tried, like a JK as compared to India Cement on the basis of the earnings at least. And then I continue to like some of the other names like Shree, as I said in the past, ACC also, because those are much more resilient plays once the industry starts getting re-rated on the volumes.
Okay, got it. All right, stay with us, Prakash. Let's get in Hindustan Zinc. Well, they reported a pretty much inline set of numbers, net profit beat estimates. They also saw a fairly decent and stable set of numbers. We're now joined by Mr. Arun Mishra, the CEO, whole-time director at Hindustan Zinc. Hi, Mr. Mishra. Good to see you in, as always. How do you see the demand-supply dynamics in the zinc market shape up? And if you could tell us, based on that and all this noise about tariffs, what kind of impact it could have on zinc prices? Give us a range.
See, the uncertainty in the Western world continues, which is due to the tariff issues. But I believe that by next year, as we go forward one by one, the trade deals will be done and the tariffs will stabilize. That is number one. Number two, the Chinese demand is still weak. So that has an impact on the zinc prices. But we have seen recent upsurge in zinc prices to come more than $2,800 per ton. India presents a beautiful scenario with a lot of expenditure on infrastructure. We see very good, strong domestic demand, and we want to cash in on that. Currently, we are about 75% of the market share, and I'm sure going forward, we will continue to get the benefit of Indian expansion as well as good demand from Southeast Asia and India's neighboring countries. So we are safe that way. But yes, my prediction, as I had stated earlier as well, that till next year, March, I don't expect it to leave the range bound parameters of 2650 to 2850. It will remain within that.
2650 to 2850. Got that. That's about zinc. But the one that's actually done very well is silver. Silver prices have outdone even gold prices in the recent past. But could you tell us, post this recent run, it's already around $38 per ounce. And you had predicted earlier, that it will do well. But where is it headed from here?
No, my prediction, as I had stated, that based on various world over, will that next year by February or so, it should be around $41, $42 per ton. And so current movement is towards that direction only. And we are very hopeful that this run will continue for at least another 7 to 8 months.
Okay, all right. Mr. Mishra, going by the silver price moves, do you want to tinker with the guidance given earlier? Because silver could be far more profitable now. Any kind of change in that number?
No, it is just one quarter. So we don't revise guidance so soon. And let's continue first focus on increasing volume. In the first quarter, we have done just 250 KT of metal. Perhaps another 15 KT metal we could have produced. So let's focus on volumes, and then we'll see whatever happens. If the guidance to be revised sometime in quarter 3, we'll take a call if it needs to be revised.
So phase 1 capex has been announced, but what about phase 2? When is it due?
The rest of the thing, as I said, all capex announcements for 2 million ton expansion will be closed by 30th of September. So we are working aggressively on that. First phase we have announced, we have already placed order for smelter construction. We are in the process of placing order for mining, then on concentrator. You can expect other announcements to happen between August and September.
Mr. Mishra, what is the outlook on the cost of production, sir?
No, so Q1 cost of production is lowest ever as far as Q1 is concerned. Of course, it went up sequentially from Q4. But if you compare to same quarter last year, it's about $100 lesser. So we are working closely. Had we produced 265 KT production, our cost would have been even better than or same as Q4. So we are in that direction. We have the capability to take the cost to $1,000 per ton or slightly lesser than that. So So I have no worry on cost. Our renewable power mix has improved to 19%. I can see this year we exit at 30% renewable power mix. Our powerhouses have consumed 51% domestic coal. There was a time when we could not consume more than 30% domestic coal. So with all these structural changes being in place, there is no reason why we should not go down on cost even further.
Got it. Focus on the cost side continues. Zinc prices 26.50 to 28.50 and cost of production dipping below $1,000 per ton. Got that. What about value unlocking though in Hindustan Zinc? One would like to see some kind of unlocking there. Separate businesses, list them separately.
So first we'll wait for the Vedanta demerger to happen. Once that happens, we also have 2 million ton expansion, all these projects to be announced. All these are announced, then yes, FY26 is perhaps the time, 2026 is the time when we can again talk to Government of India and then come out with some clarification on the subject.
So we'll wait by 2026 is where we could actually see that unlocking of value. What about the rare earth, mineral foray? When do we hear about some revenues coming from this business? We know you've got some blocks, there is work going on, but revenues by when?
It is still too early in the day because all these blocks that are coming in the critical mineral tranches, they are hardly explored. So first we have to explore, establish the reserve, then the metallurgy of it, how much to be extracted, business viability. So all that is still remain. It's quite early in the day. I can see anywhere between 4 to 5 years when we actually see the revenue stream coming in.
Mr. Mishra, it's a question which I think we've asked you before. Will Vedanta sell more stake in Hindustan Zinc? What is your sense?
No, how can I comment on my shareholders or what decisions they take? I can comment on my operations.
That's true, Mr. Mishra, but the street wants to know what's the plan. Is there more, sale that's going to come about? So we'll wait by for that. A quick word before we let you go. Viceroy has made various allegations against Vedanta Group as well as Hindustan Zinc as well. What have you made of all these allegations that Viceroy has made? And do you want to comment on it?
No, first is every time I open the report, I have to accept and agree that this is only for educational purpose. Saying that the report is based on the numbers that we have put out in the public domain are already available with every one of us. It's a question of how we look at the same number, and so they have looked at in a particular way. If you ask me a particular question, then for a specific question, I can say what is the way we look at. So we are very transparent. We know we have followed all rules of the laws of the land. We have followed perfect governance as far as taking issues to board, discussing transparently, disclosure to stock exchanges, disclosure to our shareholders. So we are very transparent, and we are transparent, hence the numbers are available.
Interesting. I think the numbers are speaking louder. Deleveraging being done at Vedanta Limited and Vedanta Resources as well. Thanks a lot for joining in, Mr. Mishra. We look forward to having a chat with you as the quarter does progress. That said, Prakash Diwan still with us. Prakash, what do you make of the commentary on Hindustan Zinc? At around 530, 550, I recall saying this numerous times. The two interested parties are there, they'll come to sell because, it got too expensive. But at around this 430 rupees, are you interested?
It does make for an interesting case for sure. And especially the commentary just seems to be getting better. I think they've allayed all doubts related to the balance sheet very clearly. And silver is the silver lining, right? So that's where it stands. But I'm sure, given the volatility around the name, you'll probably see lower levels as well. So I would best to buy it in a staggered way and then hold it for at least 2.5 years till the commodity cycle matures.
Okay, all right, got it. By the way, look at the tier 2 banks, and that was always a bit of a story for me today because each of them have specific issues, and the market is taking note of that. For instance, AU Small Finance talking about an increase in their credit cost guidance. RBL is slightly lower as well. So tier 2 financials, even Bandhan for that matter, Bandhan is down 3% in the pre-open. Tier 2 financials not shining too bright, but large financials. Look at ICICI Bank and HDFC Bank. Both those stocks up between 1 to 1.5%. On tier 2, any further comment you'd like to make, Prakash? specifically on AU. AU, on their MFI business, the credit cost guidance has been increased just a little bit.
Yeah, I mean, which is fine, and that's a business which they would ideally going forward not want to pencil in too much of growth and focus upon. But you have a lot of much smaller than AU and RBL and Bandhan that will probably make for interesting cases as the numbers come along. So we'd rather wait for that. But in fact, I would stay away from the larger ones at this point in time. The way they're opening, it's already, as I said, priced in. There's nothing much to trade. But from a long-term perspective, the smaller banks, not the mid-size, the smaller banks will start making a lot of sense as the credit cycle, upcycle starts beginning.
No, absolutely. Prakash, Geo Finance, any thoughts? You saw that agreement with
Allianz.
Allianz, right? I mean, but not for insurance, but for reinsurance. That was the surprise. Anything here?
It's a very smart move, Prashant. The reinsurance market is fairly, underpenetrated. There is, with so much of insurance happening, there is bound to be a reinsurance market that will emerge. We've been depending a lot on the foreign companies all this while, except for a GICI, which is probably the lone player. And that structure is a little bit inflexible of sorts to leverage on the opportunities that are emerging. I think if they use the Allianz experience, and Allianz itself globally has been realigning towards more of reinsurance than insurance, and that's where you saw the Bajaj marriage also kind of take a different shape. So I think it's great. It's just that it's not retail, and that's why you probably will not get to try it out. But I think it makes for a great annuity kind of a business, especially when you have capital.
Okay, all right, got it. By the way, the pre-open has settled and it's a 30-point up move. And it's led squarely by the results that have outperformed. So the two banks, ICICI Bank, HDFC Bank, doing pretty well. And JSW Steel, very good quarter. So that stock's up 1.5%. So few stocks driving the Nifty higher as we get ready for open this morning. Let's go back to our technical experts for the 9-10 calls then. So Darshan, what stock would you go with?
I would go with TVS Motors with a stop under 27.90.
Okay. And Mitesh, what about you?
Dalmia Bharat on the buying side for targets of 23.40.
Okay, all right. Let's just look at, gentlemen, thank you very much for that. 4 minutes to go for market open. Let's talk about our exclusive, which was confirmed over the weekend. Sona BLW shined the spotlight in this one last time before markets open. Vivek, take us through what this would mean.
Well, that's right. We'll go through what the brokerages have said. Almost 5 to 6 brokerages have reacted to this important development as far as Sona is concerned. What Elara is saying is that it's a significant positive, especially in terms of supporting valuations for Sona BLW, which has corrected quite significantly in the recent past. Investec says that the JV with JNT will provide exposure to the largest EV market and will help tap Chinese original equipment manufacturers. And along with that, it says that it will reduce the customer concentration risk. ICICI Securities says that the stock currently is trading at 32 times FY27 EPS. So they're saying that the stock has underperformed its peers. They believe that the stock has now bottomed out and should now outperform the peers going forward. JM Financial says that this particular JV represents a significant growth opportunity. The company would not have entered this venture without a strong anchor customer, and they name BYD as the likely anchor customer, which is something that we've been highlighting. Kotak Institutional Equity also says that this is a significant opportunity, but they also warn, saying that this could mean that margins could get compressed as far as this particular opportunity itself is concerned.
All right, lots of brokers writing in on what is now, of course, come out confirmation. As I said, we'll try and speak with, the management at Sona for specifics. We'll try and do that. Mitesh is with us. Mitesh, any thoughts here on Sona? If you have a view.
I think we had a trading buy there a few days back, and then we had a big breakout on Thursday and a mild pullback on Friday. Once the stock starts getting past 485, 488 zones, I think it should head towards 500, 510 to begin with, and then maybe even higher.
Mitesh, very quickly, I'm pulling you back to the banks because by the way, Axis Bank is under pressure after Ritu's story, which makes it clear that it seems that nudge of changing the way the bank is recognizing bad loans that came in from the RBI. So there's some further selling this morning on Axis Bank. Very quickly, Mitesh, levels on the big banks, ICICI, HDFC, Axis, if you see trades anywhere in any of them.
So, I think on all these stocks, the one which is the strongest, and I think that also goes with the way numbers have been reported, is ICICI Bank. 1405, 1410 is a very good support, and I think once this holds, and I think it will because positive numbers are there, I think it should head towards the highs of 1460. Beyond that, even 1500 is possible. Axis, we had a sell call a few days back, and HDFC Bank also looks weak to me. I'll avoid both of them. On the buying side, we'll look at much lower levels, and some kind of reversal tends to buy into them.
Okay, Mitesh, talk to you at 10 this morning for more. But I think we'll get a sense of how markets are opening. I mean, 30 points higher in the pre-open, at the end of the pre-open session at 25,000. The Sensex at about 160 higher, 81,900. Nifty Bank is starting much better, about 0.25% higher, 276 points in the green. We look at the mid and small cap part of the market, absolutely flat in the mid caps. And then the small cap index, not very much as well. Just coming up, first rates, we look at indices and then dive straight into stocks. As we always do. What do we have? Should be in line with what the pre-open left us with. 24,986, 24,970 opening up this morning. We've got the Sensex, which is up 80 points, 81,846. Nifty Bank was showing some traction. It's still got about 0.5, almost 0.5%, 230, 240 odd point gain. Mid caps are slightly lower, about a quarter lower on the index. And the small cap index will come up as well on your screens. The Nifty heat map gives you a quick sort of state of play with regards to how many up and down on the Nifty before we dive into financials and the other stocks which are moving. There you go. More down than up. Clearly more down than up. And the Nifty's now, whittle those gains down to nothing. It's actually down about 3 points. It's basically blinking red and green, flat. Surabhi.
Actually, the biggest drag today for the market is Reliance Industries, down 2%. And that's perhaps because, at least at a sequential level, the O2C business was a little weaker than estimates because of that planned maintenance shutdown. And even on the oil and gas side, there's lower output from KG-D6, and those are still very large part of course, Reliance's businesses. So some profit taking is happening on Reliance. That's a big drag. What else? IndusInd Bank is down 2.5%. Axis, we were just discussing. After Ritu's story is down another 1%. So this is where the weakness is really coming in. Actually, it's if it hadn't been for HDFC Bank and ICICI Bank, the Nifty level would have been very different from the 6-7 point cut that you're seeing. Single-handedly, these two stocks are pulling things on the upside. Metals, Manisha has been telling us globally as well, prices have been up and about. So Hindalco, Tata Steel looking good. Let's pull up JSW Steel. JSW numbers are very good, Nigel was telling us, but stocks down. Not really rubbing off. Today, you don't have consumer stocks batting for the bulls. ITC, Lever, Nestle, all of them are on the way down. So short point, only two banks batting on the upside, some green on metal stocks. Otherwise, it's a weak opening for the Nifty, 24,950 on the index now.
Well, that's right, Surabhi. The one from the broader markets in the metals pack is Nalco. So a couple of factors that are playing out here, all global in nature, nothing company specific. But China is talking about boosting up the economy yet again. That could spell good times for metal stocks. And the other factor is that pricing, in fact, has recovered a little bit. Sona BLW, as well mentioned, that one as well has opened up with a gain of around 2.5%. But, the contours of this deal are going to be important. So after the kind of run that we saw post Vivek's story, and post this morning's gap up as well, I'll be interested to see whether or not it can build on from here. How material is it? So that's going to be important. The stock has already run up 10% in the last few trading sessions. You have Vintage Coffee. That's another one we don't normally talk about, but I recall Nimesha told us about fundraising in one of the D Street chatters, and the numbers as well look quite good. So they raised some money, some pretty decent names came in there, and the results over the weekend look good. So that stock is high and volume's quite high. Aadhar Housing is another one that's looking up, I think. The volume's pretty high on that one. Aadhar Housing up close to around 2% as we speak. PVR, let's pull up that stock. You had a newbie that debutants that were launched in a movie over the weekend. Sayara, the gentleman Ayan Pandey lives down my road. In fact, young lad out there, 83 crores when you have two debutants, in a movie. So PVR, I think it trades at around 10 times EV per EBITDA. The pipeline is strong for the remainder of this year. For the time being, the stock is up close to around 2% because there's a box office surprise over the weekend. 85 crores coming in from debutants. Bandhan Bank, the stock's under pressure. This is in reaction to its numbers. And the stock as well has moved into the F&O band. So we'll have to keep an eye out on that one. And MRPL, I think it came out with a set of numbers. That stock, after seeing a big run, actually it's come in for profit taking. It's down 7.5%. So that's one of the casualties of the morning. And AU Small Finance as well. That's the other one that's selling off big time, down more than 7% as we speak.
Well, that's how we're starting up this morning. 2.4-point change on the Nifty. Nifty Bank is got a little bit more green at this stage. Otherwise, it's a very, very flat kind of start to things. So, do you want to come in?
I was just talking about AU Small, and that's why I was highlighting the stock right from the word go, because the positioning, the build-up on Tier 2 banks has been very, very smart. The market believing that that's where you'll get better growth than top-tier financials. On AU, profits are fine, but everyone's focused squarely on their guidance of higher credit costs, specifically for their MFI business. And the market doesn't want to deal with anything where there could be an asset quality issue or something that's not been baked in. And that explains the sharp reaction on AU this morning.
Absolutely. And keep an eye on this one. Big volumes, 1 million plus shares already. Devina Mehra is now joining us, founder, chairperson and managing director at First Global. She's the market master of the day. Devina, great to have you with us on the program as always. At a broader level, Devina, briefly, if you can sort of run us through your thoughts. Are you constructive that the market does well? Very soon, if you were to look at the silver lining, very soon, earnings growth has been poor, we all know that. But very soon, you're going to sort of flip over and start to look at FY27 estimates. And that maybe provides us some leeway, some flexibility to maneuver. But what's your sense, Devina?
Good morning, Prashant. My view, I was looking at my February interviews. I had said at that time that if you were waiting for a correction to invest, have you invested? And we know that markets, depending on which index, are up 15 to 20% since then. But even now, I would say that whatever is your equity allocation, remain invested. Markets could be choppy for a while. There could even be some downside from here. But in the medium term, I remain positive. You mentioned earnings. Yes, Q1 earnings have not so far been particularly great, and that was to be expected. I think you'll see improvements in the coming quarters because there have been some positive macro developments. We, of course, know that the GDP came out ahead of expectations. But besides that, the one big positive has been inflation. So inflation, especially food inflation and crude. These two things are important for India and important for the corporate sector also because they impact consumption. And there has been over the last 1 year good news on both. I even saw, some newspaper which does an estimate of the household thali, and not just the inflation. Actually, the price has come down, which rarely happens. And as we know that when inflation is high, because India is still largely a fairly poor country, it crowds out other kind of consumption. If dal prices are too high, people don't buy shampoo. It is as dire as that. So now you're seeing the other side. So this is the good thing on the revenue side, and also on the margin side, you will see some improvements, especially since crude and downstream are a big portion of inputs for many industries. So I think you will see improvements on both those fronts in the coming quarters. You may not have to wait till FY27 for that.
Devina, if someone came to you and with a meaningful amount of money and said, well, I want to put this to work, right? Would you tell them to sip it into the market slowly through funds, etc.? Would you say this is this is as good a time as any to sort of take slightly chunkier, deploy in a more chunkier fashion? Just that specific question, Devina. What's your sense?
You could deploy it probably over a few months, maybe 3 to 4 months. You can split what you want to invest. So that it's something that you can do rather than deploy it all at once. But I think definitely you should, whatever is your equity allocation, again, I'm repeating, never have 100% in equity because equity predictability is always low, not just on a 1 year basis, but sometimes even on a 5 year basis. So whatever money you deploy in equity, you should not have to touch for at least 8 to 10 years. So give that caveat. And then whatever is your equity allocation, yes, if you are not invested fully, you can do it over 3-4 months.
You know, Prashant, when you asked Devina about you have a pot of money which you want to deploy, well, at least she said deployed in India, staggered. I thought she'll say deployed in other global markets because Devina, as we all know, you know, is a big sort of votary in favor of diversification, global markets, global assets as well, and not being squarely focused, very narrow on India. On that, Devina, I mean, and there, it's easy to get negative, but really help us find the right lens through which we need to look at the Indian market right now. I mean, look at reactions today. Numbers weren't too bad, but the market is drifting in. It's just expectations are still continuing for solid growth, 15% plus growth, and very, very few companies are able to deliver that. So is this a temporary patch? Do you think we should just keep investing in this patch? Or is it a bigger concern?
So, Surabhi, coming to what you said at the beginning of your question, yes, I mean, global diversification you must do. I mean, that is something, one area where Indians are normally lacking. So over a period of time, at least 30 to 40% of your investment should be in global markets. And I see now other fund managers picking up sort of my arguments here and there. And suddenly in the last 1 year, I see fund managers now saying that I'm investing personally globally, whereas their last year's portfolios didn't show any global exposure. But that apart, I mean, it is a good thing to have global exposure. And but coming to what you said, yes, I mean, as I said, the markets could be choppy for a while. There could be some downside, but in the medium term, I still remain positive, which is why I'm saying that you must invest to the extent of your equity allocation. And this is a data point I have repeated often, that when there is no imminent, very overwhelming evidence that a crash is coming, most of the time it remains, it makes sense to remain invested because in 40 years, you miss out the 10 best days, you miss out 2/3 of the return. And normally, those good days come only when there are these questions in the market that should I be invested, shouldn't I be invested, should I, is the time to go out, should I stop my SIP? That's when the good days come. They don't come in a mad bull market. So in 2024, everybody was convinced that they could make 30-35% compounded forever. I had family officers tell me that, let alone small investors. And even saying that I don't want too much, 30% is great. Like 30% is too much. So at that time, people were not asking me that should I stop my SIP. So the questions always come when there is uncertainty, and often that is the time when the market actually gives sharp moves.
All right. Hi, Devina. Good morning. Good to see you, Ben. Markets are drifting lower actually as we speak, but you were talking about some pot of money or gold or something. Wow, that really, brightened up the morning. That said, just to clear the point, a lot of retail audience will be looking in there. What would your advice be in terms of equity allocation if you're allocating fresh money today? What would it be? And I think the point that you made on within equity, 30% should be allocated in global equities, if I got that correct, just to reconfirm.
Yeah, actually, of your total investment, 30% should be overseas. So even non-equity investment, there is no reason why it should be 100% in India. So that remains. So I mean, when you're talking of equity allocation, the first part of your question, you're talking the sectors?
No, total overall equity allocation. And then we could get to sectors. So that will be the next part. But first, what would your advice be?
Yes, I just said that if you, I think you should be invested. If you want to stagger it, you can stagger it over 3 to 4 months of whatever is your equity allocation. That is still not invested in the market.
Fair enough. By the way, Devina, so many other things, and the US, for example, right? I mean, big tech is doing well, and all these policies are aimed at the AI-related policies and the R&D expenses, where big tech is one of the largest spenders. So yeah, I mean, firing on all cylinders. Nvidia, so that's that entire pack doing phenomenally well. The other part of the market, I don't know if you have any thoughts here, Devina, is crypto. I'm just asking you this. I mean, the stance of the regulator, the government here over the last couple of years has been absolutely clear. But here you have the president of the US, the White House, trying to mainstream crypto. And let me tell you, by the way, they've signed the first bill into law. And I was just looking at Coinbase. Coinbase is up 3x since the lows in April. I don't know. You think this will force a relook at this as an asset class around the world? I mean, many countries share the skepticism that we do here in India.
Okay, so first of all, let me just, I've been talking global investment. So global does not mean US only. It does not mean the 7 stocks you know the names of in the US and the 3 stocks you know the names of in China. Global means truly global because the themes change. So the same themes, the same countries, the same assets don't do well forever. So this is an important caveat. Very often, people in India talk about only this because that's the only thing they know of or kind of understand. So I'm not saying that put all your money in US or US tech for that matter. Currently, in our global funds, we are underweight US, just to let you know. Of course, it's still the largest equity holding, but we are underweight. And as far as crypto is concerned, I mean, my position, I had written a series, I think back in 21, saying that I do not say that this is not a legitimate asset class or will never become a legitimate asset class. But remember, this is a highly volatile asset class. Even in its limited history, there have been many times when it has been down 70 to 85%. And of course, after that, again, you saw that kind of volatility. So if it is a part of your asset allocation, it should be a very small part. In a global fund, I think maximum we've ever had, not directly holding Bitcoin or something, but crypto-related assets has been maybe 3%. So it can provide some non-correlated gains, but it's a highly, highly volatile asset. So it should not be like 25, 30% of your allocation or anything like that. Yeah, what President Trump is doing is a bit strange because crypto actually undermines government fiat currency. So as the head of the government, should you be doing that? Should you be saying that don't use my currency and use crypto? I mean, just look at that if it actually catches on, it will replace the US dollar in international trade. Is that something he wants? Because all along for every other currency, he is saying that I don't, if you start doing trade in some other currency, that's a negative and you'll be penalized for it. So it's not very consistent at the very least.
Well, we live in a complex world, and I think one clear takeaway is, as Devina, you always maintain, that don't put all your eggs in one basket. Make sure you're well spread out. And I think that's a great piece of advice that our viewers can take back with them. Thank you so much for joining us this morning. Good to have you on, and we look forward to more conversations soon. Thanks for being with us.
Thank you.
Okay. That's Devina Mehra with her view on the market. The market, by the way, is down 60 points. And the Nifty is now trying to keep its head above 24,900. So there's definitely downside pressure, despite the fact that the 2 big banks have not disappointed on earnings. ICICI Bank and HDFC Bank are still trying to hold up. Well, we're going to stick with the financials, actually. Lots and lots of other names beyond the Nifty also reported numbers. And L&T Finance is the next stock, the next company that we're putting on the radar. It was a slightly mixed set of numbers for the quarter gone by. We have Sudeep Roy, Managing Director and CEO at L&T Finance, joining in. Mr. Roy, thanks for being with us. As I come to you, I just want to tell our viewers, just remind them, your growth is looking absolutely fantastic, right? The overall book is growing by 15%. The retail part of the book, I think, is even better, 18%. And you're continuing on your journey of, as you call it, retailization of the book. So that's very much on track. I think your NIMs plus fee, 10% plus, no problems there. But I want to start by understanding what's happening with provisions and asset quality. So let's look at this. You have utilized 300 crores of prudential provisions. And so far, out of your entire, provision buffer base, I think 700 crores have been utilized. So what is the thought process? This is why your credit cost has also come down. Sequentially and year on year, your credit cost is down. Just help us understand what is happening with the asset quality. Will you be rebuilding these provisions? Is there any stress? And what can you guide for asset quality this year?
Thanks. Good morning, and thanks for giving us the opportunity. To answer your question, obviously, yes. As you are aware that we are one of the largest microfinance players in the country, specifically the 3rd largest. And obviously, last year, the entire microfinance industry went through an asset quality cycle. So overall, some of them, given this product where it's like almost 90-95% loss given default, any customer who misses his payments, tends to flow forward. We actually have sort of had a reasonably sort of tight control on credit costs. We are the lowest in industry against an average sort of industry loss rates of 10% plus. Last year, we ended last year with about 4% loss rates. So in a way, we are probably, an outperformer in terms of credit costs in the segment in the industry. However, a couple of sort of incidents happened, which obviously we couldn't predict. The Karnataka ordinance happened in February of last year. And in a short period of February of this year, actually, last financial year. And in a short period of 2 to 3 weeks, we saw collection efficiencies in Karnataka come down by almost close to 300 basis points. Now, that is something that you cannot plan for. And the fact is that the climb up on collection efficiency when such an event happens is a slow and gradual progress. We have been climbing up in collection efficiency in Karnataka by about 30, 40 basis points with every passing month. But that sort of gave a little bit of flows which we had sort of originally not planned for. However, in the rest part of the country, the collection efficiencies have been inching upwards quite well. We ended the overall collection efficiency in Q1 FY26 in the microfinance business at about 99.34%, which was, and we expect that this gradual restoration to what we call normalized collection efficiencies of 99.6 to 99.7% will happen over the next 3 to 4 months.
So, Mr. Roy, just a couple of further questions on that. Has all of that Karnataka impact, this MFI ordinance, has that played out? Could there be further stress? Again, I'm going back to the provisions which you utilized. Will you have to, are you thinking of building up your provision buffers as well? Because you have, I think, just about less than 300 crores left now.
Yeah, we have.
So what's the plan? And your credit cost guidance, the guidance you've given so far is, I think, 2.3 to 2.5%. Are you confident that that will hold?
See, the total amount of macroprudential provisions left is about 275 crores. And coming to your Karnataka question, the collection efficiencies have gone up from the sort of dip that we saw in February, but it's nowhere near normal of 99.5 to 99.6% what we expect. I think we will take till about end of September, maybe early October to reach those numbers in Karnataka. As regards to the sort of the usage of macroprudential provisions, you said that we have 275 crores left. The objective of the management to be as prudent as possible and to use as little of that as possible. And I do believe that the guidance on the credit costs that we have given, I do believe that we will be able to test those marks without sort of support on any macroprudential provisions in Q4 of this year. Because by that time, I expect sort of the asset quality headwinds which had appeared in the microfinance segment and to a certain extent in the two-wheeler and the unsecured asset segments to completely dissipate by then. So yes, we continue to steadfastly guided to that particular range of numbers. And our three-dimensional credit engine, Cyclops, which we had implemented and now almost over 12 months of implementation in our two-wheeler business, implemented now in our SME as well as our tractor business. In September, it will be implemented in our personal loan business, is giving actually quite encouraging results.
MFI, sir, you said that the MFI business asset quality issues will bottom out by which quarter?
It will bottom out. I do believe that it will bottom out by Q3. Our original estimate was Q2, but the fact is that the Karnataka ordinance actually slowed down the recovery process. But I completely believe that on the back of a very good monsoon and improving rural liquidity, it will bottom out by Q3.
All right. Hi, Mr. Roy. Good morning and good to see you, Ben. Growth you were aiming for, I think, was around 20%. Do you stick to that? And give us which segments will be driving this growth? Particularly rural, I think you were guiding for 10 to 15% out there. So let's focus on growth first.
Yeah, I stick to that growth numbers. In fact, if you see on a QOQ basis, our disbursements have grown strongly by about 10% on a QOQ basis. In fact, the rural business finance vertical, which is our microfinance vertical, actually delivered a QOQ growth. Average last quarter, we were disbursing anywhere between 1,600 crores to 1,650 crores a month. In this particular quarter, we have inched that up to about 1,800 crores a month. And I do believe that on the back of improving credit quality situations in the microfinance industry, we will be probably touching anywhere between 1,900 to 2,000 crores of fresh disbursements every month. Since our two-wheeler sort of credit quality has also improving sharply, this quarter our two-wheeler disbursements have gone up. And I do believe that the two-wheeler disbursement will continue to grow strongly. Personal loans disbursement on a year-on-year basis have grown at a very strong pace of almost 60% plus. Our partnerships with Cred, PhonePe and Amazon Pay are scaling very well. We'll be adding a couple of new large big tech partnerships over the next couple of quarters, which will add volumes to that. Our home loans business is also growing strong. And the gold loans business that we acquired from Paul Merchants, actually we'll be setting up about 150 to 175 branches in the remaining part of new branches in the remaining part of the year. So our gold loans business also will grow strongly. So overall, yes, we continue to guide toward that 20 to 25% AUM growth for the rest of the year.
Very quickly, Mr. Roy, NIM plus fee will be in that targeted 10 to around 10.5%, and ROA moves to around 2.8 to 3%.
So the NIMs and fees should be within the guided range of 10 to 10.5%. You know, we have seen a weighted average cost of borrowing reduced by about 17 basis points on a QOQ basis. And I do believe that over the rest of the year, we will see rate efficiencies almost close to 25 basis points, primarily because of the transmission of the rate cuts to the sort of the liability side, liabilities originations. And we are also pushing, taking our yields up in every line of business. So yes, you know, we will try to sort of get our NIMs and fees in the corridor of 10 to 10.5%. And
ROA?
In terms of ROAs, you know, probably by Q4, we should test near 2.8%. However, that remains also to see how the credit quality pans out, which are very hopeful right now, that we should be near to 2.8% at the end of Q4.
Got it. Thanks a lot, Mr. Roy, for joining in and filling us in with all of those details. Well, we've got another management that's joining in, Mr. Jayant Acharya, the joint MD and CEO at JSW Steel. Hi, Mr. Acharya. Good morning. Thanks a lot for joining in. Well, let's first get out that steel demand factor out of the way. There are various sectors that have been a slowdown, but in steel, it appears things are still solid amidst the global uncertainty.
Yeah, so the steel demand, if you've seen in India, the last quarter grew by about 7.9%. It has been strong, considering the fact that the quarter YOY grew by 15%. So the base was seasonally higher. So 7.9% is good. The capex by the central government for April and May numbers are also positive. I think we are on track to achieve this 11.2 trillion of capex, which was announced. From the domestic side, so therefore we see stable economic growth. We see good steel demand in India. As far as the global challenges are concerned, I think we have seen quite a few in the last few months. The uncertainties have not fully settled down, geopolitically as well as on the tariff side. So we see still a resilient economy in spite of all this. And World Bank has still maintained the growth at 2.9%, slightly lower than the last estimate, but still at 2.9%, which is reasonably good.
Well, the problem is the gray area with regard to China. China, well, the production has come down, but exports continue to remain elevated. That's what's weighing on prices. How do you see this panning out going ahead? Will things improve with regard to the Chinese factor from here on?
Yeah, so just to go to the Chinese production side first. So China production for the first half of this year has moderated by about 3%. The domestic growth has also moderated by close to 6%. And their exports have been elevated, so went up by 17%. So that's the area of concern which we see. On the price side, I think China has improved over the last few weeks. We see that as a positive. The inventory in the China's monitored areas or monitored markets are down by 4 million, from 14 million to 10 million, which is again a positive. So given the fact that 30 million tons of production cuts are expected, or let's say production moderation is expected this year, I think going into the second half of this year, maybe we will see a better moderation on the export side as well. Coming to India, yes, I think the safeguard has been very timely, and it has certainly been of great help to the Indian steel industry at large. As you know, the global challenges, as I mentioned, have been quite high. The tariff uncertainties have also caused trade flows to get diverted. And India is it's a high growth market and is open to barriers. So therefore, this safeguard was very timely. We do expect that the government will be looking into the final safeguards, which are due in the next few months. And we'll take necessary steps to see that dumping of steel in India does not happen.
Absolutely, and the government has come in with some measures, and that seems to be helping the industry. Mr. Acharya, morning. Thanks for joining in. I also want to talk about the benefits that you're getting because of a drop in some of the input prices, for instance, in coal costs. What is your expectation for the second quarter, for the rest of this year? I mean, do you expect a further decline?
So on the coking coal side, last quarter, as we had guided between $10 to $15, we have seen a drop of about $14 in line with our guidance. Going forward into quarter two, we expect a lower drop. As you said, the prices are stabilizing. So maybe between $0 to $5, say up to $5 is something which we see a moderation possible on coking coal side.
Oh, okay. So that's good news. I mean, there's a safeguard duty on one hand, some of your input costs are coming down. So what could this mean in terms of your standalone EBITDA per ton?
So on the Indian operations side, rather than the standalone, I would look at the Indian operations. Indian operations, the EBITDA stood at 7,496 crores, which was up sequentially by 16%. We were helped, or we benefited by the movement in prices, which went up. Also, on the coking coal cost side, we gained from the drop in coking coal. However, we had certain shutdowns. We had a blast furnace shutdown in Dolvi for a plant maintenance, and the same in BPSL, which increased our specific consumption and had some cost. So therefore, what you see here is net of that. These shutdowns expenses are not likely to be continuing. So therefore, that would be a positive going into quarter two. The other abnormal movement which we had was the foreign exchange movement. We actually had a forex loss of 343 crores, which is a mark-to-market on euro appreciation. Euro appreciated sharply between end of March to end of June, and that's had an impact. On the consolidated EBITDA, as you said rightly, the overseas operations have done well. US operations from a negative 3 million swung to a positive 20 million. Europe from a marginal negative swung to a positive 1.3 million euros. So therefore, the overseas operations contributed sequentially, to the EBITDA, and therefore you see the consolidated EBITDA at about 7,576 crores, which went up again by 19% sequentially.
Well, indeed, US has really turned around in this quarter, and maybe things could look up from here on as well. Got that. But Mr. Acharya, what is the outlook on debt from here on?
So on the debt side, 79,850 crores, we are about 3,200, 300 crores higher than last quarter exit. Primarily the build-up of some of the inventories in our new operations at JVML and certain other assets where we had to build up the inventory. If you recall, the inventories were sharply reduced in the previous 2 quarters. So we reduced our inventories in excess of 300,000 tons. We had to rebuild some of it because of new operations and for better servicing. The exports was also lower. If you see quarter on quarter, the exports also went down, primarily because of the international market situation. So that also resulted in a bit of a built-up in inventory. And that is the reason why you see debt going up. So the working capital will get unlocked as we go into progressively into the coming quarters of the year. So that looks fine. The ratios are very good. I think what you should watch is that 3.34, which was the net debt to EBITDA, has now improved to 3.2. The net debt to equity remains flattish at about 0.95. So from the ratio side, we are very prudent, and we continue to look at the ratios and see that we are aligned to a prudent ratio management.
But what about the fundraising plans? Any equity raising plans in the near term?
Nothing as such. Nothing so far.
Okay, all right. So no fundraising immediately on the equity side. Got that. Finally, before we let you go, Mr. Acharya, I have to ask you about this, right? Bhushan Power and Steel, we know the matter is sub judice. It's in the courts, and you filed that review petition. But how are you thinking about it? I mean, just in case you don't get a favorable review, I mean, what can you tell shareholders right now on this?
Yes. So, this operations, as you're aware, in BPSL, we have turned around after JSW Steel has come in. The operations from a loss-making entity to increase in production, increase in capacity, and to making profits. That has been the contribution which JSW Steel has brought to BPSL. Last quarter also is reflective of that. So we had a EBITDA of about 760 crores, which went up substantially YOY and QOQ both. As far as the review petition is concerned, we have filed a review petition on 26th of the last month. And, we believe we have strong grounds to pursue the review petition. The COC and the resolution professional, the RP, have also filed their separate review petitions on the subject. So the court has opened. I think we will await the listing in front of the bench and then await the outcomes. But we believe we have strong grounds to pursue this case.
Thanks a lot for that, Mr. Acharya. Wishing you all the best, and we look forward to chatting up with you. By the way, that initial dip that we saw in the Nifty has got bought into. Big recovery from the lows, 80 points recovery from the day's low. Let's see whether or not this can sustain. For the time being, though, slip into that break, come back. The management of Can Fin Homes is waiting for us on the other side.
Okay, welcome back. Can Fin Homes is the next company that we want to talk about. They reported a mixed set of first quarter numbers. Profit after tax has jumped about 11.5%, while net interest margins have declined. Disbursements have remained weak as well. Let's talk about this in some detail. Suresh Iyer is Managing Director and CEO at Can Fin Homes. He's with us. Suresh, great to have you with us on the program once again. Good morning, Prashant this side. Let's just talk about margins. Your cost of borrowing is down, spreads have increased, but NIMs are down. Can you just sort of start there to kick this conversation off, and then we'll get into details?
See, in the Q4, of course, it was slightly elevated at 3.82. But compared to Q1 of last year, the net interest margin is higher. In fact, it was 3.57. It has increased to 3.6 plus. So 3.64. So in terms of the NIM, compared to the quarter, it has improved, and the spread has also improved. So that's the situation. Q4, we generally have, in the net interest margin improves because we also have reversals of the provisioning and everything. So that's the reason.
Where are NIMs headed directionally, Suresh, if you can give us a sense? Rates are down, and that should perhaps put further pressure?
Not exactly, because we generally see that we have a spread target where we try to keep it at 2.5% plus. And generally, we pass on to the customers after we experience it on our liability side. So basically, we are able to manage in terms of our spreads and everything. And therefore, the NIMs also, we have quite a bit of a control in that.
So your guidance was 3.5%, Suresh. So should we work with that for the
Yeah, we are quite confident. 3.5% NIMs and 2.5% plus spread is what we will be. We are confident we will be able to maintain.
Okay, got it. Hi, Mr. Iyer. Good morning. Good to see you again. So we've got that out of the way in terms of NIMs. Let's focus on growth. You know, earlier you were guiding for a 15% growth, I think, in AUM. Do you think it's going to be a tall ask for the year? Or do you stick to that guidance, 15% AUM growth? And also in dispersals, it was a little bit disappointing at around that 2,000 crores ballpark for the quarter. I think earlier you were guiding for roughly around 12,000 crores for the year. Do you think that's on AUM and disbursements? Please go ahead.
We had actually guided for 10,500 to 11,000 crore as a disbursement target for the year. And consequently, that would result in about 13% to odd percent of AUM growth. Because we normally have about 5,000 crores, which is the rundown because of our prepayments, part prepayments, BT outs, and amortization. So keeping that in mind, we had about this. And incidentally, this is the first time in the history of Canfin that we have actually crossed a 2,000 number in terms of the first quarter disbursement number. And that's the one thing. In terms, if I break it up into our performance zone-wise, then our North Zone, West Zone, Tamil Nadu, which were performing last year, have continued their performance in this quarter as well. Additionally, East Zone, which is Andhra Pradesh and entire Eastern belt, they have also, which was flat last year, has also in Q1 shown an impressive growth. What remains is our main market, which is Karnataka, where in fact the state government has now taken some steps to ease out the e-Khata pressure. So we are hopeful that going forward, we'll be doing well there also. And in fact, what we have done in this quarter also in Karnataka has been roughly in the range of about 200 odd crores for disbursement. So it's not very off from what we have been looking at. And once the e-Khata issues are resolved, we should be able to see a good push coming from Karnataka as well.
Okay. So, Mr. Iyer, that means you're sticking to your guidance of 20% growth? Loan book growth?
No, we are not talking about 13% AUM growth. 13%, which we are sticking to because 10,500 crores is what we will be looking at.
Okay, so 13% AUM growth. And what are the plans for branch expansion to fuel this growth?
So actually, there are two things mainly which we are looking at. One is we have about 15 additional branches we are looking at. And the last couple of years, we have opened 29 branches. And this year also, we are targeting 15 additional branches. And mostly this will be in the west and the north. And additionally, what we have done is last year we had started with a sales team, dedicated sales team, which was contributing about 4%. This year we are increasing the strength of the sales team. And from 37, 39 people who were there in the sales team, now we have from 1st July, we increased the staff to 100 people. So that is also a good jump that we are seeing. And we should be able to now improve the performance coming from the direct business from the sales team. Incidentally, the sales team contribution in Q1 has increased from 4% to 5%. So that also it shows that the sales team experiment and the experience that we are having is quite good.
What does it mean, sir, in terms of cost to income ratio?
Cost to income ratio, we are targeting about 18%, 17 to 18%. Around this quarter, it is a little higher because in the first
18.3%, so it stabilizes at 17 to 18%.
18%, about 18%, because we have had the increase in our salary and everything for the staff because we had a benchmarking the competition and everything. So because of that, there's also an actuarial implication which has come, which is entirely in the first quarter, which in the coming quarters will probably even out a little bit.
All right. Where are the return ratios headed? The ROA is around 2.2% and ROEs is ballpark around 17%. Where do you see these numbers stabilize at?
ROA, we are, we will be able to maintain 2.15 to 2.2%. That's the thing that we are looking at. That should be maintained. ROE also around 17%. Of course, at this time the costs have been slightly elevated. But going forward with our provisioning also, which will kind of reverse a little bit, and also the evening out of the expenses, I think that also would be around 17%.
Okay. All right, Mr. Iyer, we'll leave it on that note then. Thank you very much for joining in. Good to get that perspective from you on the business. That's Canfin Homes. By the way, let's quickly go back to the market and what a recovery. It's really firing on all cylinders. Look at the U-shaped on the Nifty. And it's because of a lot of buying that's come in financial. So anyway, HDFC Bank and ICICI Bank are continuing their good work. But stocks like Bajaj Finance, etc., they've also joined in. There's buying on Eternal in the last 30-40 minutes as well. So this is where the bulk of it is coming in from. Reliance is still under pressure, mind you. IT is still under pressure. So that hasn't changed. But some of the financials where the market has conviction, they're simply getting a bulk of the buying.
Even where there is little conviction. Axis low, 25 rupee recovery from the day's low.
Yeah.
Axis low was today was about 1,070. It's back at about 1,090.
Yeah,
rupees.
absolutely. I just want to point out one more stock, by the way, beyond the Nifty. You've got to look at Mastech. 9% up on Mastech, and look at that. Maybe we'll get Rima in to explain this to us in a bit. The first quarter was subdued. I mean, the constant currency revenue was under pressure. Margins were, again, lower. But from what I recollect, it's the deal win commentary, and they've had strong deal wins, including several AI wins. Perhaps that's what the market is really like, looking forward to the future. What a move. I think the best that we've seen from IT so far.
Well, indeed. And, actually today in terms of the recovery that we've seen in the banking index, the banks that matter are doing well. Because you still have IndusInd Bank, you still have RBL Bank, you still have AU Small Finance Bank who are taking it on the chin. But the ones that matter...
The big boys are standing up.
HDFC Bank, Kotak Mahindra Bank, ICICI Bank. All of them have seen a big recovery from the day's low. So the banks that matter, they are putting their hand up, they're getting counted. Explains why we've seen that sort of recovery. And just to word a technical factor on the Nifty Bank, went down to around the 50 DMA and bounced from around that 56,000 odd mark, which is another important technical level out there. That said, Mitesh is back with us. Mitesh, what are you making of this recovery? Sell into it, or do you think it's good for more?
Not yet, Nigel. I think, so I spoke about 24,900 being the decisive level. We did marginally below that. We had a low of around 24,880 or thereabouts, 882. And the bounce back has started. But I think you will see this markets, possibly make an attempt towards 25,200 odd zones. 25,200 and then 25,320. So I think these are the two levels I'm watching on the upside. So for the timing, it looks like we'll possibly be heading towards the upper end of the range. And therefore, I think, there's a good chance that this recovery could extend. On the stock side, I have a buy on Ambuja Cements. That's a buy with a stop at about levels of 597 for targets of 630. And AU Bank, though, I think that's a negative chart, very negative kind of a breakdown over here. So sell with a stop at 755 for targets of around 700.
Okay, so those are some trades that you can work with. Let me ask Mitesh on this. Mitesh, I'm just wondering, just even if it's an intraday trade, short trade, anything on Mastech? Stock surging 9%.
Yeah, I think, this very strong breakout which has taken place over here. My sense is that the stock will possibly see more upsides. We saw the stock kind of peak out at about, levels of 2,800, 2,790, 2,800 way back in February 25. So I think that top would be the first target area. So 2,790, which is about 170, 80 points higher from here. And then 2,875, which was important pivot in December. So I think these are two targets which Mastech can do.
Okay, all right, Mitesh, thank you very much for that. So those are individual trades and views on stocks as well. Mastech, of course, flying away with a 9% pop. Manisha is here with what is top of mind for her as far as commodities go. Manisha, good morning.
Morning, and thank you for that, Prashant. I'm looking at the base metal as a sector because we're looking at strong gains as we start a new week. The dollar index is off its highs, and that has been supportive. The market's also looking at strong U.S. economic data that we saw in the previous week, whether it was the strength in U.S. retail sales numbers or the U.S. jobless claims number actually seeing a decline, telling you that perhaps an interest rate cut is far away, but that clearly has supported the markets. Even the Chinese data, for that matter, beat street expectations, whether it was about the second quarter GDP numbers or the retail sales. That is exactly where the metals are taking strength from. And then there are expectations of stimulus measures coming in from China. China has reiterated, pledged it yet again. And interestingly, it also is the China Politburo meeting, which is on, which sets course for the policy measures for the rest of the year. And that is something that the street is watching out for. I'll start with copper then, and we've seen this price continue to see higher trends there. We're not trading too far away from its all-time highs, and that is also because the U.S. tariffs of 50% take effect from 1st of August. Ahead of that, we've seen a lot of copper flow into the US markets. But even now, as we stand, and until the 1st of August, the expectation is that the US copper premium to LME, which is at 25%, perhaps could just be as strong. Aluminum also has continued to gain, and we are trading at a March 2025 highs at this point in time. And the last 1 month has seen nearly 4.5 to 5% of gains come in for aluminum. Strong gains continuing for zinc as well, as we see China do a lot in sense of construction there. We're looking at prices trading at April 2025 highs. The Chinese smelters are facing pressure to cut production as capacity has output demand, and that clearly has been supportive. In any case, the kind of production that we have seen come in for zinc in the global markets for the previous quarter also has seen a bit of a decline, supporting prices there. And then you have the Chinese steel and iron ore prices continue to trade on the higher side. It's a 2-month highs for steel. It's a 3-month highs for the iron ore prices as well, which has been quite supportive. And if you look at what we've done in sense of metal prices on a month-on-month basis, we are looking at stronger gains. For copper prices, it has been 15% of gains. Aluminum has gained up by 4.5%, 6% gains in zinc as well. And it has been a 13% of gain come in for the iron ore prices, and 6 to 7% of gains also in case of nickel and steel. So good going as we look at the previous month in case of metal prices.
Okay, and no wonder all the metal stocks are shining bright in the market today. Thank you so much for that, Manisha. We do have to take a very quick break. Come back on the other side, and we'll get you more stock-specific action from the day. Welcome back. Okay, we've been talking about some of the stocks that are working really well, and that's large banking names. On the flip side, look at AU Small Finance Bank. That stock has been down 7%. The market seems to be really focused on why AU Small Finance has increased their credit cost guidance for the year. Gaurav is here to explain the details to us. Gaurav?
Well, yes, AU Small Finance Bank is down in trade today, and the reason being that they have upped their credit cost guidance from 0.85% to 1%. And the major reason what the bank has given during their con call is that in the MFI segment specifically, their recoveries are still soft, and that is the reason why they have upped their guidance. What they're also saying is that in the MFI segment specifically, they're expecting this to rise almost to 5% versus what it was guided in the range of 3 to 4%. So definitely there is some pain which is coming up from the MFI segment. Another disappointment from the result was the net interest margins. Now they had declined almost by 40 basis points. Now they are reported at around 5.4% versus what it was expected to fall almost by 30 basis points. That was again a little bit of disappointment for the market. From here on now, management is expecting NIMs to decline in second quarter because of the rate cut impact and will improve from third quarter onwards, and it will also be better and flattish in terms of the overall average that we have seen by FY27. On the other hand, now profitability, although it has increased, but because of these two specific reasons, we are seeing some kind of pressure in the stock price. Let's also not forget that in the last few days, we have seen AU Small Finance Bank performing really well. In fact, in the last 6 months, we have seen the bank outperforming the major indices. As a result, now Investec has actually cut their target price to 910 rupees. What they're saying is that the recoveries is something which is hurting the margins right now, and that is the reason why they have also cut their PPOP estimates. And on the other hand, we also have Nomura, who gave a target price of 610. So definitely some pessimism is coming up from the brokerages as well, and as a result, we are seeing the stock is down in trade today.
Okay, that's AU Small Finance. Stocks down 7%. By the way, I don't know, Prashant, are you one of those people who's anti-dairy and don't do dairy?
No. Why?
That explains, right? There's no anti-dairy feeling when it comes to Hatsun Agro. If you look at the stock, it's like 7-8% higher. So it's dairy all the way.
Dairy all the way. What is that famous Amul ad? Dood. Anyway, we'll take a...
No, we've got actually Mangalam on this to explain really how the dood is helping.
Mangalam, did I take away your punchline?
No, you didn't. That was an Amul tagline. I'd just say the dude's here to talk about dood. But, results post-market on Friday, good set coming in. Hatsun Agro also benefits in the first quarter on account of it being summer, irrespective of the rains that took place, etc. Their ice cream business has been doing well. And add to that, they've gone ahead and acquired Milk Mantra a couple of quarters ago as well. So that is aiding their consolidated numbers. But the real, cream, so to say, lies in their gross margins. That's coming at a multi-quarter high this time around. And all the dairy companies have been calling out increased procurement prices, because of which they've gone ahead and taken price hikes on milk as well. We heard Amul, Mother Dairy and the likes go ahead and increase their milk procurement, milk selling prices by about ₹1.50 per litre, up to 2.5 rupees as well. Add to all of this the higher contribution of value-added products, be it ghee, butter, and the others coming in would support their margins, and that's really happened for Hatsun Agro as well. 9% revenue growth. The gross margins have expanded by nearly 60-70 basis points. The EBITDA, as a result of which, has also grown at 9%. The net profit growth has been slower, largely because of higher depreciation, the acquisition that I alluded to. So the key to track is growth via scale of acquisitions, and secondly, outlook on further contribution coming in from value-added products. Add to all of this, the stock hasn't been doing much. In fact, it's down almost 24% from its 52-week high. And in the last 12 months itself, it's down by almost 18%. So this is adding further power to the milk.
Power to the milk. Mangalam, thank you very much for that. So that's Hatsun for you. We'll take a quick commercial break here. We get into our next conversation. Lata will be speaking with the management of Bandhan Bank on the back of their fourth quarter earnings. Remember, Bandhan over the last couple of months has been saying that slowly but steadily, maybe by the third quarter of FY26, things will start to look much better. So we'll ask them whether they're on track for that and more. Stay tuned. Coming up.
Welcome back. We are still with corporate earnings. Bandhan Bank's results were actually a mixed bag. The positives were there. A quarter-on-quarter rise in the ROA, return on assets, which is what investors will look at. A 12 basis point increase to 0.8%. Rise in the return on equity by 70 basis points to 5.9 from 5.2. All quarter-on-quarter. But there have been some share of worries as well. Margins are down, as it is for every bank. But quarter-on-quarter fall is 30 basis points for Bandhan. Gross NPAs are up by about 25 basis points. Again, quarter-on-quarter to 4.96. Net NPAs also up by about 8 basis points. However, the positive here is that fresh slippages are sharply lower. And that's very important. Separately, profits and NII have fallen year on year. But that was obviously because of a very high MFI base year ago. Otherwise, they have done the profit and NII are better than street expectations. To understand more, we have with us the MD and the CEO, Mr. Parthapratim Sengupta. Mr. Sengupta, good morning and thank you very much indeed for your time. Well, first, just a jargon. When you say emerging enterprise business or EEBs, you mean MFI?
It's basically MFI, but within this segment also there are individual loans. So it consists of also group loans and it consists of individual loans, but not that to be truly by the definition of MFI, not everyone's household income is below 3 lakhs or with 3 lakhs for the day. It consists both, but the segment target is different. They're coming up from the micro segment.
Yeah, no, I mean, this is just a clarification for, the lay reader, the lay viewer who looks at your investor presentation and may get a little confused. But thanks for that. So it's also over 3 lakh household loans. Now, your MFI, I'll call it the MFI segment, okay? Your EEB, you've seen a sharp fall in the amount of loans lent to that group. Can you tell us whether this is the fall and you will start improving in a quarter or two? Because you told us that the MFI pain will bottom out. So do we start to see more loans this quarter itself, next quarter?
So I have also told last time also when the Q4 results were announced, the challenges are going to remain for almost 2 quarters. That is the market trend, though Bandhan Bank in this segment has performed much better than the market. But still the challenges, definitely we are not insulated from those challenges. And if you look at it today, the problem of over-leveraging has been contained to a large extent after the guardrails have been imposed. It has an effect. Definitely it will have a short-term effect. And we think that another 3 months, probably the effect of these guardrails that would be eased out. And then the industry would start picking up. But let me tell you, strategically, we have also decided to increase our secured book mix. Because we are a universal bank. Though our base has been very strong in this MFI segment, we will continue to be a leader. But definitely, we will go for a moderated approach in this segment. We are focusing on both a particular balance between the secured and the MFI segment for the day. So we made a very reasonable target of 8% only growth, for 8 to 9% growth for this financial year. We hope that, yes, this growth probably would be achieved by the end of this financial year.
Oh, okay. Actually, you've taken away some of my questions. This secured loan book that you are leaning towards, that will reduce margins even more, no?
Yeah. So
what is the margin guidance?
So let me again tell that it was very clearly told, I think, when I took over the charge, that as we are a universal bank, we need to have a proper balance. The secured book, we are going, and definitely the margin would be moderated. But we are taking some steps for this. You see, from April, we made a major cuts in our deposit rates for that year. And that effect, we have seen almost 19 basis point in this quarter. And as soon as the fixed deposits would get matured and new renewals would happen, further positive effect of the cost of funds would come. So that is number one. Number two is that even today, my books in the fixed interest rate, that is almost 50%. And going forward also, we will maintain a ratio of around 45 to 40 to 45% in this particular book. So that way we are not affected. And the third one, you have already said that slippages are improving. And if this improvement continues, and we are expecting it to be much better in the coming months, so there will be definitely all these three factors will have some, will nullify the, I would say, the adverse impact of NIM because of the rate cuts, and also because we are going to the secured books further. And but
so what is the NIM guidance, sir? Net interest margin?
So we will try another 20-25 basis point. Definitely, we are expecting to reduce, but we will see. But as I was told, that these steps would definitely have a positive effect on this year also.
Okay. Now, about your EEB, again, I would like to say MFI, but you're saying there is a definition issue there. You had said that you will increase your, your emerging enterprises book by 5,000 crore. That was there in your target last quarter, if I'm not mistaken.
Yes.
Is that still holding?
Yes.
So after reducing now, are you going to increase? Because now you have to increase it by 16%. My colleague Gaurav is calculating, if you have to meet your 5,000 crore target, you have to increase it by 16%. You'll do that.
Let me tell you, the last quarter only, Q1, we have seen almost more than 20% growth in this segment. So we are capable. It's infrastructurally, if you look resource-wise, we are definitely capable. If the industry, we are expecting that it will go forward. So the disbursements, we know that we have to make a large number of disbursements, but yes, we are keeping the target. And we hope that from Q3 onwards, we will probably be able to do it.
Okay. Now, I wanted to ask you about your SMA1 also. While your overall slippages have gone down, SMA1 has gone up. Now, just for those who don't follow this unnecessary jargon, SMA1 is if people don't pay within 30 days. It doesn't become NPA. There is a long time before it becomes NPA, but those who don't, those whose dues are 30 days past the date of payment is called SMA1. That has gone up sharply. Why that? Should that give us some worries about slippages?
You see, yes, but the main thing is that if you look at my SMA2 figures for that, so in the EB book especially, it has reduced. And a large number of these SMA1 remains in this category, or it goes back to SMA0, and many of them are getting...
Sorry, one minute. Sorry. What I meant was SMA0 has gone up, sir. Sorry. SMA0 has gone up from 860 to about 1,000 crores.
Let me tell you this very clearly, that SMA0, the main reason is that we have introduced a new accounting principle in the EB segment, whereby we are raising demand on the holidays also. Previously, this was not there. Now, just understand that if in a particular geography, say West Bengal, if you take, there are festive holidays. Almost continuously 4 days, my people will not be available for collection, but the demand is raised. So what will happen once the bank opens after the collection will happen. But during these 4 days, almost say per day, almost 6% of the total book, or 1/6 of the total book will go to SMA0. So if it is 4 days, it is almost 1/6 into 4. So that much will go to SMA0. So it will always look inflated whenever there will be holidays. But let me tell you, we are trying to build up a culture to collect these installments a little bit in advance. We are also exploring if we can actually tune it like the bond market, that is the next working day can be the demand raising period. That what we are experimenting, but it is not a cause of worry. It happened because of the accounting change.
Fair enough. Yeah, if see, SMA0 has risen, but SMA1 has not. So, perhaps what you say is right, that people are just collecting it later. There was another question during the investor presentation, which I didn't understand. I was more puzzled by your answer. The question came from Macquarie, and they said that, your vintage book in Q4, the MFI book, the EEB book, rose by about 15,000 crores, and simultaneously your NPA went up by 0.1%. Did some loans become NPA the moment you gave them? And you didn't say no. You said your point is valid. Can you explain what this is?
No. So let me tell you, there has been cases of some quick mortality. We can't deny it for that year, but that has been contained to a large extent. That's why
it is only 0.1, but why does it happen?
There are, because I would say that whenever you say disburse in the month of March, I think we made a total disbursements of close to almost 1,500 crores or more than that in that, or maybe more than that, much more than that. So there will be some quick mortality cases. Let us accept that in this segment it happens a certain percentage, but we try to recover it through our NPA recovery efforts. So what we are doing now is that, one, we are making some hygiene changes also. So in the credit underwriting process also is getting revamped, number one. Number two, we have introduced the QR code of recovery so that even on holidays or on other days, or the customer is away from the station and my people could not reach him. So they can now pay them through the QR code also. We are going to introduce AEPS also and doing away with the biometrics. So a lot of hygiene change and EAR correction. So going forward,
you said March we give a lot of loans, we give 1,500, and that is why this may be happening. This hurry to give March loans, is it because to reach a target? And so some wrong loans are given?
No, it was, you see, it was not there for that. If you look at my last year book for that year, we have consistently degrown. So we have been growing for the, we consistently taken a decision to degrow in this segment. We have taken it, but let me tell you, when such large number of loans happens for that year, some quick mortality do come. We are doing a proper staff accountability and these things for that measures, but taking measures.
Okay, so let me now squeeze quickly two questions because I'm told I'm running out of time. One is, why is it your housing GNPAs have risen? Isn't that supposed to be the safe, secured sector?
Oh, so one thing you would know that Bandhan grew up by taking an NBFC.
Yep.
And that NBFC, of course, for the day, as you are all aware, that NBFC and bank had previously, now of course, everything has been aligned for that day, had different accounting systems, have different ways of doing the business for this. So some of them are legacy problems, let me tell you. If you take my housing book, last 2 years, what we have disbursed for that year, that book is quite strong enough.
Okay. Well, the Prime Minister is walking and he will make his speech before the session begins. So, Mr. Sengupta, just one quick question before the Prime Minister speaks. Will we get a 1% ROA this year?
Our target is 1.5. We hope that we'll be able to achieve. We have not yet revised the target because last time also we have said that we will be Q1, our ROA target will be 0.7 and we have achieved 0.8. Let us see. So I will look for.
नमस्कार दोस्तों.
Thank you.
मॉनसून सत्र में आप सभी मीडिया जगत के लोगों का स्वागत है. साथियों, मॉनसून नवीनता और नवसर्जन का प्रतीक है और अब तक जो खबरें मिली हैं, देश में मौसम बहुत ही अच्छे ढंग से आगे बढ़ रहा है. कृषि को लाभदायक मौसम की खबरें हैं और बारिश किसानों की अर्थव्यवस्था, देश की अर्थव्यवस्था, ग्रामीण अर्थव्यवस्था और इतना ही नहीं, हर परिवार की अर्थव्यवस्था में एक बहुत महत्वपूर्ण होता है. अब तक जो मुझे जानकारी दी गई है उस हिसाब से पिछले 10 वर्ष में जो पानी का भंडार हुआ है इस बार, वो करीब 3 गुना हुआ है, जिसका आने वाले दिनों में भी देश के अर्थतंत्र को बहुत लाभ होगा. साथियों, ये मॉनसून सत्र राष्ट्र के लिए ये बहुत ही गौरवपूर्ण सत्र है. ये मॉनसून सत्र राष्ट्र के लिए एक अपने आप में विजयोत्सव का रूप है. और जब मैं कहता हूं कि सत्र राष्ट्र गौरव और विजयोत्सव का सत्र है, तो सबसे पहले तो मैं पहली बार इंटरनेशनल स्पेस स्टेशन पर भारत का तिरंगा झंडा वहां लहराना, यह हर देशवासी के लिए गौरव की पल है। देश में साइंस टेक्नोलॉजी के प्रति, इनोवेशन के प्रति नया उमंग और उत्साह भरने वाली ये सफल यात्रा रही है और पूरे सांसद, लोकसभा राज्यसभा दोनों सदन देशवासी जिस गौरव का अनुभव कर रहे हैं उसमें एक स्वर से जुड़ेंगे, एक स्वर से इसका यशगान होगा जो भारत को अंतरिक्ष में नई ऊंचाइयां पर पहुंचाने वाले जो भावी कार्यक्रम है उनके लिए भी प्रेरक बनेगा, प्रोत्साहक बनेगा। साथियों, ये मॉनसून सत्र एक विजयोत्सव है। पूरी दुनिया ने भारत की सैन्य शक्ति का, भारत के सैन्य के सामर्थ्य का रूप देखा है। ऑपरेशन सिंदूर में भारत की सेना ने जो लक्ष्य निर्धारित किया था 100% अचीव किया। आतंकियों के आकाओं के घर में जाकर के 22 मिनट के भीतर भीतर ऑपरेशन सिंदूर के तहत उसको जमींदोज कर दिया गया। और मैंने बिहार की एक कार्यक्रम में इसकी घोषणा की थी, जो हमारी सैन्य शक्ति ने बहुत ही कम समय में सिद्ध करके दिखा दिया। और इसमें मेड इन इंडिया सैन्य शक्ति का ये नया स्वरूप, इस पर भी दुनिया बहुत आकर्षित हुई है। इन दिनों विश्व के जिन जिन लोगों से मिलना होता है तो भारत के इस मेड इन इंडिया जो औजार तैयार हो रहे हैं उसके प्रति दुनिया का आकर्षण बढ़ रहा है। मुझे विश्वास है कि जब सदन इस विजयोत्सव को एक स्वर में विजय के भाव से इस सत्र के दरमियान उन ओजस्वी तेजस्वी भावनाओं को प्रकट करेगा तो भारत की सैन्य शक्ति को बल मिलेगा, प्रोत्साहन मिलेगा, देशवासियों को प्रेरणा मिलेगी और सैन्य क्षेत्र में जो रिसर्च, इनोवेशन और मैन्युफैक्चरिंग हो रहे हैं, मेड इन इंडिया डिफेंस इक्विपमेंट बन रहे हैं, उसको भी एक बल मिलेगा और जो भारत के नौजवानों के लिए नए रोजगार के अवसर पैदा करेगा। साथियों, ये दशक हम एक प्रकार से देख सकते हैं कि शांति और प्रगति कंधे से कंधा मिला करके आगे बढ़ने के कदम कदम पर प्रगति के एहसास करते रहे हैं। देश कई प्रकार की हिंसक वारदातों का शिकार रहा है, लंबे अरसे तक शिकार रहा है। देश आजाद हुआ तब से ये समस्या को झेल रहे हैं, चाहे आतंकवाद हो, नक्सलवाद हो। कोई प्रारंभ में शुरू हुआ होगा, कोई बाद में शुरू हुआ होगा, लेकिन आज नक्सलवाद का, माओवाद का दायरा बहुत तेजी से सिकुड़ रहा है। माओवाद को, नक्सलवाद को जड़ से उखाड़ने के संकल्प के साथ देश के सुरक्षा बल एक नए आत्मविश्वास से, तेज गति से सफलता की ओर कदम रख रहे हैं। और मैं गर्व से कह सकता हूं, देश में सैकड़ों जिले नक्सल की चपेट में से निकल करके आज मुक्ति का सांस ले रहे हैं। हमें गर्व है कि बम, बंदूक और पिस्तौल के सामने हमारा देश का संविधान जीत रहा है, हमारे देश का संविधान विजयी हो रहा है। देश के उज्जवल भविष्य के लिए साफ दिख रहा है कि कल तक जो रेड कॉरिडोर थे वो आज ग्रीन ग्रोथ जोन में परिवर्तित होते नजर आ रहे हैं। साथियों, एक के बाद ऐसी घटनाएं देशभक्ति के लिए, देश की भलाई के लिए संसद में पहुंचे हुए हर माननीय सांसद के लिए गौरव का पल है। और संसद के इस सत्र में ये गौरव गान पूरा देश सुनेगा, हर सांसद से सुनेगा, हर दल से सुनेगा। साथियों, आर्थिक क्षेत्र में भी जब 2014 में आप सबने हमें जिम्मेवारी दी, देश फ्रेजाइल 5 की अवस्था से गुजर रहा था। 2014 के पहले वैश्विक अर्थव्यवस्था में हम 10वें नंबर पर थे और आज भारत तेज गति से दुनिया की तीसरे नंबर की अर्थव्यवस्था बनने की दिशा में आगे बढ़ रहा है, दरवाजे पर दस्तक दे रहा है। इन दिनों 25 करोड़ गरीबों का गरीबी से बाहर निकलना, जिसको विश्व की अनेक संस्थाएं सराहना कर रही है। देश में एक जमाना था 2014 के पहले जब महंगाई का दर, इन्फ्लेशन रेट डबल डिजिट में हुआ करता था। आज 2% के आसपास आकर के देश के सामान्य मानव के जीवन में राहत बन गया है, सुविधा बन गया है। लो इन्फ्लेशन के सामने हाई ग्रोथ एक अच्छे विकास यात्रा की दिशा है। साथियों, डिजिटल इंडिया, यूपीआई आज भारत के एक नए सामर्थ्य को दुनिया देख रही है, पहचान रही है और ज्यादातर देश में उसके प्रति एक आकर्षण पैदा हो रहा है। यूपीआई ने फिनटेक की दुनिया में अपने एक नाम कमाया है। रियल टाइम डिजिटल ट्रांजैक्शन दुनिया में सबसे ज्यादा हो रहे हैं। दुनिया में जितने हो रहे हैं अकेले भारत में उससे ज्यादा हो रहे हैं। साथियों, पिछले दिनों इंटरनेशनल लेबर ऑर्गेनाइजेशन का एक वैश्विक समागम था और उसमें भारत ने बहुत बड़ी ऊंचाई प्राप्त की है। आईएलओ का कहना है कि 90 करोड़ से ज्यादा लोग भारत में अब सोशल सिक्योरिटी के दायरे में है। ये अपने आप में एक बहुत बड़ा अचीवमेंट है। उसी प्रकार से वैश्विक संस्था WHO ने ये कहा है कि भारत अब आंख की जो बीमारी आमतौर पर बारिश के सीजन में ज्यादा देखी जाती थी, ट्रैकोमा, अब भारत को WHO ने ट्रैकोमा फ्री घोषित किया है। तो आरोग्य के क्षेत्र में भी ये अपने आप में एक महत्वपूर्ण भारत के लिए सिद्धि है। साथियों, पहलगाम की क्रूर हत्या, अत्याचार, नरसंहार पूरी दुनिया चौंक उठी थी। आतंकवादी और आतंकवादी के आके दुनिया का ध्यान उनकी तरफ केंद्रित हुआ था और उस समय दल हित छोड़ करके देश हित में हमारे ज्यादातर दलों के प्रतिनिधि, ज्यादातर राज्यों के प्रतिनिधि विश्व भ्रमण किया, दुनिया के अनेक देशों में गए और एक स्वर से दुनिया के सामने आतंकवादियों का आका पाकिस्तान को बेनकाब करने का एक बहुत सफल अभियान चलाया। मैं आज राष्ट्र हित में किए गए इस महत्वपूर्ण कार्य के लिए उन सभी सांसदों की सराहना करना चाहता हूं, सभी दलों की सराहना करना चाहता हूं और उसने देश में एक सकारात्मक वातावरण पैदा किया। विश्व ने भारत की बात को स्वीकार करने की दिशा में अपने मन के द्वार खोले और इसके लिए ये हमारे सांसदगण, हमारे राजनीतिक दल सराहना करने के मेरे लिए सौभाग्य है। साथियों, हम जानते हैं कि ये स्पिरिट, एक स्वर, एक एकता का वातावरण देश को कितना उत्साह से भर देता है। विजयोत्सव का ये पर्व इस मॉनसून सत्र में भी उसी भाव से प्रकट होगा। देश की सैन्य शक्ति को सराहना करेगा, देश के सामर्थ्य का गौरवगान करेगा और देश के 140 करोड़ नागरिकों को नई प्रेरणा का कारण बनेगा। मुझे विश्वास है कि हम सब मिलकर के डिफेंस के क्षेत्र में आत्मनिर्भर होने के इन प्रयासों को बल दें, सेना के सामर्थ्य की सराहना करें और मैं आज देशवासियों के सामने जरूर कहूंगा और देश के राजनीतिक दलों से भी कहूंगा कि देश ने एकता की ताकत देखी है। एक स्वर का सामर्थ्य क्या होता है देखा है। तो सदन में से भी सभी माननीय सांसद उसको बल दें, उसको आगे बढ़ाएं। और मैं जरूर कहूंगा, राजनीतिक दल अलग अलग है, हर एक का अपना एक एजेंडा है, अपनी एक भूमिका है, लेकिन मैं इस वास्तविकता को स्वीकार करता हूं कि दल हित में मत भले न मिले, लेकिन देश हित में मन जरूर मिले। इसी एक भावना के साथ इस मॉनसून सत्र से देश के विकास यात्रा को बल देने वाले, देश की प्रगति को बल देने वाले, देश के नागरिकों को सामर्थ्य देने वाले अनेक विधेयक प्रस्तावित हैं। सदन विस्तृत चर्चा करके उसको भी पारित करेगा। मेरी सभी माननीय सांसदों से उत्तम डिबेट चलाने के लिए शुभकामनाएं हैं। बहुत बहुत धन्यवाद।
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And we have got a lot of news flow that's coming in there. So let's get straight to the first management on the show. India Mart Intermesh. They put up a strong showing actually in the past quarter. There was a good growth on various parameters. But what's the way ahead? We're joined by Mr. Dinesh Agarwal, the CEO of India Mart. Hi, Mr. Agarwal. Good morning. Good to see you in. I want a couple of numbers out first out of the way. Paid subscriber growth is still very tepid. On a quarter-to-quarter basis, how do you see this number picking up? If you could give us a guidance on that front. And also collections, well, they perked up. What's the steady state growth we should work with on collections, paid subscriber and collection? Go ahead.
See, on the paid subscriber, we have been saying that our silver customer churn has been elevated, and we continue to work on various items that are affecting our sellers. We are going and meeting the sellers continuously. We have made a lot of changes so far. Hopefully, in the times to come, in couple of quarters, there should be some uptick visible. On the collection side, we have improved the collection over the last 2-3 quarters, collection growth, and we would try and target towards a double-digit collection growth because given the customer churn is still stubborn, I don't think we can give any concrete guidance on either of the two.
So if you could give us a broad range as well. You said paying subscribers should increase. If I look at the last few quarters, it's been between 2.1 to 2.2, somewhere closer to 2.15 on an average. How much better do you expect this number to be? I'm not asking you for specific numbers, but just an indicative range. And even collections in the first quarter grew by 17.5%. You expect the double-digit growth to continue, but there is a big difference between double-digit and late teens, right?
So let's look at the standalone collections first. The standalone collections grew at 5% and then 8% and then 9% and then 10%. And standalone operations account for the large part of our collection. Now coming to the consolidated that you are seeing at 17%, we have made certain changes in the busy partner payout model, and that is why you are seeing this number to be elevated at 17%. We have also given in the earnings presentation that if you do a like-to-like comparison, this is only 13%. So,
got it.
And given that the first quarter of the financial year for the busy, because most of the people change their accounting softwares during either the last quarter or the first quarter. So first quarter is generally a very high quarter for the busy accounting. And that is why I am still guiding you to be at around 10-12% collection going forward.
Okay, 10-12%. And what about on the subscriber? Subscriber should be around 2,500 odd. Should we work with that number?
Yeah, plus minus 2,000. Yeah, plus minus 2,000.
2,000. All right, got that. Tell us about margins. Marketing expenditure as well did vary in the past quarter. So as a percentage of your mix, what will your marketing spend be at? And also, what is the outlook on margins? Steady state, what should we work with?
So I have been guiding that the margins are currently looking elevated because of the fact that we are not heavily investing in the sales and sales side because the churns are elevated. And as soon as the churn comes under control, we would go whole hog on the sales side. So that is why we have been guiding that the margin on the steady state, you should always consider to be around 33% to 35% going forward. However, we have started to do certain marketing spend on the buyer side. We have started some performance marketing, and since we have taken up this activity after 10 years of the last time ever we did any marketing spend, we are taking time to adjust the marketing spend according to the different industries and different geographies, how Google responds and how Facebook responds and how YouTube responds. So I think about 2-3% of the margin we would be spending towards the and that I guided in the investor con call also.
Yeah, you had it would be between 2 to 3% of your sales out there. But on the revenue per client in terms of realizations, if you could give us a sense on that as well. While paying subs are increasing, you expect them to increase by 2,000 every quarter. In terms of revenue or realization per client, what's your outlook here?
So revenue realization per client for the last many quarters has been growing at about 10%. In general, if you see a longer term CAGR, it has been growing at 6 to 8%. If the subscriber base starts to grow up quickly, I think the ARPU growth will come down to 6 to 8% only. Currently, since the customer count is not growing, that is why you are seeing the ARPU growth taking the all the heavy lifting, and that is so. If you take this particular quarter on the standalone, 1% came from the customer growth, and 9% came from the ARPU growth.
So 6 to 8% ARPU growth continues. And what about client concentration? You know, because top 10% of your clients contributed about 40% to your revenues 5 years back, and because of lack of paid subscribers increasing, that numbers increased to 50%. Are you looking to bring it down back to 40%? Because that would be a lot more sustainable, right?
So top 10% customer is quite large number. You know, in our case, almost 22,000 customers. And 22,000 customers, it is not only that the paying subscribers have not grown, and that is why their revenue contribution is growing. See, in a typical marketplace, what happens, top of the pyramid enjoys the largest benefit because they are able to figure out how to do the sales and marketing better using internet. So effectively, we have also introduced category-based pricing and everything, and that all combination put together has slowly increased the ARPU top 10%, and it will continue to remain at about 50%.
All right, very quickly, sir, when will the churn ratio improve?
So I wish I could tell you a timeline. We continue to work towards that, and the management has been doing good over the last so many decades. I am pretty sure, confident that we should be able to bring it down quickly.
All right, sometime in the second half of this fiscal?
Possibly, yes.
Appreciate you joining in, Mr. Dinesh. Thanks a lot. Wishing you all the best for detailing. Thanks for joining in and detailing the past quarter's numbers. For the time being, slip in a short break, come back, continue to focus on stocks and market action.
Welcome back. You're watching us here on Chartbusters while we are speaking to the management of India Mart Intermesh. Don't lose sight of the market. It's been a big recovery from the lows that we saw. Was bound to recover from earlier levels of closer to 24,900, 24,950. That's what the street was pinning its hopes on, and big results helping the overall cause of the market as well. HDFC Bank has moved to the high point of trade. ICICI Bank itself has moved to the high point of trade as well, and both of them are negating the pressure that Reliance is putting on the frontline index. And before we move forward, just keep an eye out on Eternal as well. So the erstwhile Zomato, currently at the high point of trade, reports its numbers today. Two things I'll be watching out for: whether there is any reduction in losses in their quick commerce business, and secondly, is there any improvement in the growth in their food delivery business as well. With that, let's move on to Axis Bank. Loans and provisions in the first quarter were not entirely the result of bank's own internal decisions, but that of RBI's push as well. This exclusive news brought to you by Ritu.
Well, the surprising spike in bad loans which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages, and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that they should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
Interesting one. Thanks a lot, Ritu, for joining in and detailing that particular story. For the time being, though, we'll wrap up on this edition of Chartbusters. Don't go anywhere. The team of Trading Hour is waiting by.
Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormis Vatakia and Reema Tendulkar. Good morning, guys. Well, 100-point uptick on the Nifty is what we are witnessing right now, courtesy HDFC Bank, ICICI Bank, and it is negating the impact that Reliance Industries is seeing. So we saw that recovery around 9:30, and that continues to be the case as well. But while we talk about that moves on the secondary market, there is a new kid on the block, Anthem Biosciences. That stock is in focus. It has listed 28% premium to its issue price. To discuss the company's FY26 outlook and the plans after listing, the usage of IPO proceeds as well. We are joined by Chairman, MD and CEO Ajay Bhardwaj and CFO Gavir Beg. Gentlemen, good morning. Thank you so much for joining in and patiently waiting by as well. Now that we are listed, we can talk about the future prospects as well. Mr. Bhardwaj, let me start with you first up. It has been a decent growth for the company going forward despite the challenging year that has gone by. If you can tell us what are the plans in terms of the growth in terms of revenue and EBITDA margins as well. FY22, we saw margins at around 47%. Do you think you'll get back to that, or the normalized margins will be around that 36% mark?
Well, thank you for having us on the show and good morning. We really not that much has changed since we spoke a few weeks ago with you. Our focus has to be on concentrating on our core strengths, that is adding more firepower to our new modalities like high potent peptides, RNAi, lipids, oligonucleotides. And we are continuing to do that. And we just feel that we have to set, given the type of business we are in, we have to what we have done the last 6-7 years is what's going to bear fruits this year, and we're in a very good position there. And as far as margins go, we are quite sure that we'll be able to maintain what we have delivered, and that's our endeavor going forward as well, that we have very healthy EBITDAs at the moment around 36%, and that's what we endeavor to keep delivering on.
Okay, so margin sustainable at 35-36%. Just one question. You were one of the fastest companies to hit 1,000 crore in top line. Last year, you ended with a top line of close to about 1,800 crore, clocking in a revenue growth of 35%. You said that a lot of the work that the company has done over the last couple of years will bear fruit now. So going ahead, what would be the revenue growth, on an average, say for the next 2 or 3 years? Because you have, I believe, close to about 160 crore, 160 projects in the pipeline. So can we expect this 35% kind of a revenue growth for the next 3 years, sir?
Gavir, you want to take it?
I'll take that. See, historically, if you look at our numbers over the last 5 years, we have grown at about a CAGR of about 24%. Last 2 years, we have grown at 30% as well as 34% across FY23 to 24 and 24 to 25. What we've been doing over the course of this last 10 years is invest more on the new projects which comes in, and these new projects, as it moves across the phases from early phase to late phase, the quantities increase and we keep on supplying more and more batches to our customers. So that's been our endeavor. The numbers that you are seeing right now are coming in from the 10 commercial molecules what we have, plus about 160 projects which are in the early or the late stage development. Hopefully going forward in the future, there would be some molecules which will move from early to late and some molecules which will move from late to commercial, because that's been the probability of success in the drug discovery and development cycle, where the probability of success is about 80% for the late phase and it's lower for the early phase. So we'll continue to do what we've been doing so far, which is to do things differently as well as to do different things also. The pipeline that we have will actually lead our growth going forward. What we are aspiring to do is to deliver a similar growth number as we have delivered over the long-term horizon of the last 5 years, closer to about 20% plus. That's what we endeavor to deliver. And from a margins point of view, margin has been sustainable over the last 2 years at 36-37%, and we aspire to be in the same zip code of 36 to 37% on EBITDA level and continue to deliver numbers in that zone.
So Gavir, 160 projects in all, early to late. Out of that, in late stage, I believe is 16. How many will move into commercial production, say by the end of this fiscal year or the next fiscal year? Do we have any timeline, something which is very close to completion?
There are 16 projects which caters to 10 late phase molecules, 10 phase 3 molecules. Typically, the industry-wide success rate is about 80% across phase 3 to commercial. As and when we come up with our first quarter results, we'll also give an update in terms of the molecules, the stages of the molecules, whether some of the 16 late phase projects corresponding to the 10 late phase molecules have moved or not. Typically, if you look at phase 3 or the projects which have been in the filing stages where the phase 3 results have been filed with the FDA for approval, it typically is an 18 to 24 or 30 months kind of a time cycle for any project to move from the late phase to commercial stage. So I would not comment on how many molecules are moving from phase 3 to commercial this year, but the horizon is what I could comment on because that's the industry-wide horizon.
Good morning. Thank you for joining in. And first,
compared to, sorry.
Please continue, sir.
No, I was saying that we have a lot many shots on goal, and compared to what we had earlier. So we are very optimistic about the future. Things are much better. They're as good as today as they've ever been in Anthem's past.
So be that as it may, sir, but firstly, congratulations on the listing. It's a big day for you and your company. Gavir mentioned that you aspire to do things differently, but is the China plus one opportunity one of those things that you aspire to do differently? Because that has been a big talking point over the last couple of years for your industry as well as for a lot of other industries. And you'd mentioned in the previous conversation that you are trying to decrease the dependency on the China supply chain down. It's already below 20%. How lower can you bring that down to? And the fact that you are investing in facilities for catering to this demand, what is the kind of capex plan that you have envisaged for this year?
So I'll take the first part of it, and then Gavir will tell you about capex. Now, you see, the China plus one strategy that everybody's been talking about is basically comes from the the geopolitical situation in the world where people feel anxious about putting more of their eggs in the Chinese basket. Up until now, they have actually been the major player in the contract research, development and manufacturing business. But we are now clearly seeing signs that people are saying, I do not want to put in my second project in the same place again, or alternatively, when they have a first project going in, they have anxiety about going into China because you don't know what the future holds. So we are getting many more inquiries, and clearly that's panning out. But it's not like flipping a switch that it will happen tomorrow. It is, as I said, even anyway, the gestation periods in our business are long, and we are in that phase where we are seeing a lot of inquiries which will, going again by past history, migrate into future business. So yes, that's going to pan out in the next few years. And as far as capex go, I think Gavir will clarify that.
Yeah, we've been investing on capex across our entire Unit 2, Unit 3, and now we have started on the Unit 4 journey as well. Unit 4 is going to be a large project because from a size point of view, it will be as large as Unit 1 plus 2 plus 3 combined. Hopefully, we'll be giving out in our first quarter results some sense on what is our Unit 4 expansion could look like. But it's going to be a large project which is catered towards our growth going forward in 2028, 2029 onwards, because it's a greenfield project, so it will take about 2 to 2.5 years time to build and get constructed and be ready. By that time, our Unit 2 expansion, which is almost complete, and Unit 3, which is already also commissioned across phases from 24 to 25, will be firing revenues for us. Unit 4 could be in 2028 and 2029, and that's going to be a large capex for us.
We take that point, gentlemen. Thank you so much, Mr. Bhardwaj and Mr. Baik, for joining us today and telling us the future plans. Look forward to more conversations about the company as well. We'll do one thing. We'll slip into a short break now. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta.
Welcome back. It's a very, very significant recovery from the lows of the day for the market, which slipped below 24,900. And since then, it's been an almost 200-point recovery from those levels. And the two major contributors to that recovery, of course, are HDFC Bank and ICICI Bank. And they are the ones that are leading this recovery higher for the index. If you pull up the contribution chart as well, that will give you an idea of the kind of extent of which they are contributing. ICICI Bank, of course, closing in on its record high levels of 1471, so it's at 1460 currently, so 2.5% higher on ICICI Bank. There you can see there 100 points higher on the Nifty and 130 points contributed by HDFC Bank and ICICI Bank. On the flip side, Reliance continues to offset those gains and 50 points contribution to the downside from Reliance Industries. Now take on to the commodity space then, and Manisha is here with us to talk about something that everybody has been talking about recently, and that is the crypto market, Manisha.
Oh, well, yes, and I come in from the Indian point of view because, over the weekend we've been reacting to the coin DCX the story or the release that came in where the exchange has said that $44 million in security breaches what they've lost, and this is the report that came in on Friday. But over the weekend, there are various statements that we've seen coming from the Indian exchange saying that the breach was, one, quickly contained. The customer assets have been untouched and they actually have been in cold wallets. This is where the cyber hackers cannot reach. Third, that they're closely working with the cyber security partners at this point in time. And fourth is that the loss has been absorbed by their own treasury records. This will not impact the buyers or the investors within the exchange. But clearly, there have been various reports suggesting as well that there has been a lot of withdrawal as well coming in from the exchange after this threat. Interestingly, this comes in exactly a year after when WazirX also went through something. And at that point in time, it was also the investors' money that got lost to the tune of $235 million. This is much lower. And as the exchange said, this has been contained quite quickly there. I also want to talk about the Chainalysis report, which says, and it's, this is due to be released anytime now. Chainalysis in last 2 years has said that India continues to be the second largest growing market when it comes to crypto. It has surpassed various other markets like UK, Turkey, Russia, etc. Increasing trading platforms and DeFi, decentralized finance opportunities within India is what clearly has been reading those numbers on the higher side. Having said that, and while there are some positive, there also are concerns with the fact that you're looking at 2025 as the worst year when it comes to cyber attacks, frauds, etc. as well. At this point in time, we stand at around 2.17 billion to 1.5 billion in sense of hacks in crypto services and wallets as well. This is the highest or the worst ever for that matter. 2022 was the worst year in sense of cyber attacks, frauds and rug pulls, and 2025 seems to be making all those record highs yet again into the market. Interestingly, another positive for the crypto clearly has been the US president signing the Genius Act. This was on 18th of July 2025. Now, this will create a regulatory regime for US dollar-pegged stablecoins. The understanding is that a lot of trade is in any ways happening, but with Stablecoin Act being passed like that, you will be looking at more money, higher transactions, purchases from merchandise and buying as well in sense of dollar and treasuries coming in. So a big one really, and the world is watching. For Indian markets, we still are waiting for the discussion paper to come in. It was supposed to come in on 30th of June, but markets do believe that in this quarter itself, we could be looking at that paper coming out.
Okay, interesting. And if it does come out, we'll come to you, Manisha, for all the updates. Thank you so much for joining in, as always, with what's happening in the commodity and currency space. Let's go across to Nagraj Shetty of HDFC Securities for a quick technical check on the markets. Nagraj, good morning. Thank you so much for joining in. Well, can you quickly tell us what's the next important level to watch out for on the Nifty and your individual technical picks as well?
Hi, good morning. Nifty has been in a choppy trend over the last few weeks. What we can observe on the daily chart is lower tops and bottoms. Every rises encountered resistance at the high levels recently also, and Nifty declined. So the trend, overall inherent trend remains weak. There is a pullback rally from the lower levels. I think at the higher levels, 25, 200, 250 is going to be a strong resistance from here onwards. We could see some emergence of selling pressure from higher levels. At the lower levels, if Nifty slips below 25,000 levels, 24,500 is going to be the strong support. That is going to be the range for the Nifty for the near term.
And individual names?
Yeah, I have two stocks, one from buy side, one from sell side. Recently, metals has been doing well during this turbulent Indian markets, and National Aluminium NALCO is the one that after moving to a recent range movement over the last 2-3 weeks has bounced back nicely. The overall chart pattern is looking positive, and it has moved up from near the important support of 200 EMA. Currently trading around 195.50, 196 levels. One can look to buy right now at 196, and target would be around 206 levels, and one can place a stop loss at 190. On the other side, I have one short side sell recommendation, that is from PSA side, REC. REC has been in a kind of a range bound action, has not shown any kind of upside bounces from the supports. Currently showing range movement, downside breakout of the range movement, placed at the support at lower levels around 395. If this stock REC breaks below 395, then that could be a sharp sell-off for the stocks, and we could see the lower level. One can look to sell at this point of time once it breaks below 395 levels, and the downside target will be around 380, and one can place a stop loss at 407.
Thank you very much for that. Let's move on and talk about Sona BLW. Vivek is now joining in. Vivek?
Well, that's right. Along the lines of what we had reported, in last week regarding a company setting up a plant in China, and most likely the anchor customer going to be there is BYD. Along those lines, the company did inform the exchanges that they are setting up a JV with a Chinese partner. In this particular JV, Sona will be investing close to $12 million for a 60% stake, and the JV is expected to commence operations in H2 FY26. What will the JV supply? The JV will manufacture and supply driveline systems and components. A whole host of brokerages have written on this particular development. Investec says that the JV with JNT will actually provide exposure to the largest EV market in the world and help tap Chinese OEMs. JV with JNT over time will reduce customer concentration risk. LRS says it's a significant positive in terms of supporting valuations for Sona, which has gone ahead and reduced quite significantly in the recent past. ICICI Securities says that the stock has underperformed its peers in the last few quarters and currently trading at 32 times FY27 EPS. So what they're saying is that they expect the stock to bottom out and should start outperforming from here on. And JM Financial says that the JV actually represents a significant growth opportunity. The company would not have entered this venture without a strong anchor customer, and they go ahead and name BYD as the likely anchor customer. Kotak, on the other hand, while they believe that it helps the company address a large addressable market, they believe that margins over here could be squeezed given the fact that competition there could be quite intense.
Okay, take that point. Thank you so much for joining us, Vivek, with those details. We'll slip into a short break now. When we return, we'll be joined by the management of Rossari Biotech to discuss their Q1 numbers. Stay tuned for that conversation. Welcome back. You're still tuned into Trading Hour. Rossari Biotech, that is the management on our radar. The company posted a slightly muted set of EBITDA growth this time. The institutional and B2C businesses remain soft. To discuss this quarter gone by and way forward, we are joined by Sunil Shari, the co-founder and managing director of Rossari, with us. Mr. Shari, good morning. Thank you so much for joining in. I wanted to understand, it's a 5% growth on the EBITDA. You've seen better growth on EBITDA in the previous quarters. So what was the volume growth this time around? Which segment was this led by? And if you can also give us the export and domestic breakup, because exports did do very well in the last year.
So normally our first quarter is always muted, and if you compare first quarter of last year to the first quarter of this year, we are 11% up on volumes, 11% up on sales. This quarter we had some project delays because we had to stop manufacturing for a few days because of the expansion which will come up in stream in this quarter, and we expect better numbers for the next 3 quarters. We should look at the yearly figures rather than quarter to quarter only.
No, I do get that. You said the volumes were up 11% this time?
Yeah, compared to the first quarter of last financial year.
Okay, and what was the export growth this time?
Export growth is 6% compared to the first quarter of the last financial year. So quarter on quarter, we have done much better than before. And I think we lost some days because of expansion work when we could not do any production because ethylene oxide is a hazardous raw material. And I think we should do better this quarter.
Mr. Chari, good morning. Thank you for joining in. You've mentioned exports have done better, but what is the export to domestic mix currently? And last year, if you mentioned that it was at 50%, right? It was 50%. What is the kind of growth that you are envisaging this time around for your exports?
So we are in the first quarter of this financial year, we are at about 26% as exports. We had 27% in the last quarter. So I think we should maintain this or grow better than this in exports. The home personal and performance chemical segment, the HPPC segment, is something which is the growth driver for us. Textile was little muted, animal health and nutrition was little muted, but I think we should pick up in the remaining quarters.
Okay, so this 11% volume growth is ex the institutional business, or is it with the institutional business?
The institutional business, but the institutional business also this first quarter was little slower than compared to the last quarter.
Okay, so ex of institutional business, it should be high single digits.
Yes.
Okay. What about ethylene oxide? That's a major raw material. What's the availability looking like from Reliance Industries? What is the split currently when it comes to raw materials for you?
So the ethylene oxide from Reliance, we are expecting the new material to come in next 12 months. That is what is the indication from Reliance. And then I think we should have surplus ethylene oxide availability. We have ramped up the capacity already. So by the time this new ethylene oxide comes, in the next financial year, we have the capex already done for it.
Oh, Mr. Chari, your first half is generally agro heavy, right? And it is the period where the contribution of Unitop is the highest. Now, the first quarter is suggesting some weakness in that portfolio as well. So, have you any comments here on this generic agrochem demand and on the product mix in this space?
No, if you compare the first quarter of the last financial year and this financial year, we are up by 11% even in agro. This second quarter is the highest agro sales, and I think our demand position and order position looks better compared to last year also. So we don't see any slowdown in agro for us. The monsoons have been good in all the regions where we sell.
Okay. So what kind of growth are you looking at in FY26 itself when it comes to the top line, the bottom line, the margins as well? FY25 saw a revenue growth of around 14%. The profits were up 4.5%. Will you be doing better than that?
So when we did our IPO, I always say this, we were at 600, 700 crores. Last year we did 2,080 crores. And I want to be conservative now and say maybe, high double-digit figures, 10% plus, and let the figures speak by itself at the end of the year.
Do you have any targets? You're saying 10% is what you're looking at. What about the margin number? Considering that raw material situation would improve, you'll get the ethylene oxide supplies as well coming by?
The ethylene oxide supplies will come in the next financial year, the additional ones. So I would hold the similar margins as last year.
What about pricing, Mr. Chari? Crude prices have been trending lower, acrylic acid prices and other raw material prices have also remained soft. Have you taken any price cuts this time around? What is the kind of trends that you are envisaging for the rest of the year when it comes to pricing?
So pricing is passed through, as we have said in all the calls. So as the raw material prices fall, our FG prices fall automatically. And that is why also, if you see 3 years from now, volumes are nearly 60-70% up. But you don't see the turnover going so up because per kilo realization in finished goods is less. So I think we are good, and I think this is the bottom I have seen in the raw material pricing in the last 10-15 years. It should become better. I think the per kilo realization should increase for all of us.
Okay, so realizations should increase from here on for raw material prices. I wanted to understand what the freight situation is currently, Mr. Chari. The other expenses hike that we've seen in the PNL, is it because of higher freight? What's the export or import situation looking like when it comes to transportation?
The freight has increased substantially, but still it's not like the 2021-22 types. It is still manageable. Freight from China to India has increased substantially, but from here to the US, to Mexico, to Europe, to Turkey, has seen some increase, but I think it is stable now. We have increased manpower. So if you see, our manpower costs have gone up, and we are adding more people in R&D, we are adding more people in sales, and because the capacity is coming up and we need to have people to service those capacities.
All right, Mr. Chari, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Rossari Biotech on the road ahead for the company. A slight recovery from the lows of the day. The stock still 4% lower, currently at 713. Take a short break, continue our conversation on the markets and the recovery that we have seen from the lows of the day. Parag Thakkar of Fort Capital joins us on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Let's talk about Reliance Industries. Reported earnings post-market hours on Friday. It has been a drag on Nifty today. But if we talk about the numbers overall, it was a revenue number of 2.44 lakh crore rupees. EBITDA was higher on a YOY basis to come at 42,905 crore rupees. Margins at 17.6%, which is higher. Profits at a quarterly record this time, around 27,000 crore rupees. But do remember, it was aided by an element of other income. Other income was higher on a YOY basis, and also it was around 8,900 crores of Asian Paints stake sale that aided other income for the company this time. If we talk about the segments, Reliance Retail continued its double-digit growth. Revenue per square foot, that increased by 16.5% on a YOY basis. Jio reported inline set of numbers, and this time around their revenue growth was driven by 2% increase in subscribers and 1.2% increase in ARPU for the company. O2C EBITDA margins higher on a YOY and on a quarter-on-quarter basis, but do remember, it was impacted that one-time maintenance shutdown that happened in the month of April. Mukesh Ambani reiterated their long-term plan. They say that they will continue to double every 4 to 5 years. So that's an important statement that's coming by. In terms of brokerages, Morgan Stanley says that new energy, telecom, balance sheet, these were the bright spots. They have an overweight rating with a target price of 16-17. Jefferies says O2C was impacted by refinery shutdown, but the outlook continues to be very constructive. Focus will now shift to AGM, where they'll talk about Jio preceded by possible listing of Jio, which is preceded by a tariff hike. They project an 11% EBITDA growth that would come by in FY26. Motilal Oswal says while Q1 was soft, they remain sanguine on Reliance Industries' growth prospects across segments, and they have a target price now of 1700 versus 1685 earlier. So there is a target price revision that has come by on the upside.
Okay, let's move on and talk about HDFC Bank. A steady set of numbers. The bank's net profit has gone up by 12% on a year-on-year basis. Gaurav joins in to take us through the fine print. Gaurav?
Yes, when we talk about HDFC Bank, good set of numbers is what we saw in this quarter. Net interest income increased almost by 5% on a year-on-year basis. But on the other hand, pre-provisional operating profit, there we saw a sharp spike of around 11%. Now, other income, if we look at this aspect specifically, there was an impact of around 9,000 crores because of the sale of HDB financial stake. But what bank has done is that they have converted that 9,000 crores as a floating provision. So that is the reason why we look at the reported numbers, provisions look a little elevated. But if we exclude that, let's also not forget that bank has also created 1,700 crores of contingency provision in this quarter. So if we exclude both these numbers, again, provisions also look in line with what the street was expecting. As a result, profitability increased almost by 12%, which was 6% higher than the street's expectation. Now, when it comes to net interest margin, the fall was somewhere in the range of 18 to 19 basis points on a sequential basis. It was a little higher, but if we look at the core net interest margin, that has fallen only by 12 basis points. So again, it was in line with what the street was expecting. What was positive is that now management is confident on FY26 and FY27 growth. They say that in FY26 they will grow at a pace of the industry, and in FY27 they will outpace the industry's growth rate. On the other hand, on net interest margins also, they are saying that 50 basis point of impact is yet to get flown in the net interest margins, but going ahead they expect credit cost to remain healthy. So that was a positive commentary from the management. Another update here is that they have declared special bonus in the ratio of 1:1, and they have also declared special dividend of 5 rupees per share. As a result, brokerages are also being a little bullish now. We've got Nuvama who increased their target price. Motilal Oswal maintained their target price of 2,300 rupees per share. So definitely some optimism was seen from the brokerages as well. And as a result, we are seeing some uptick in this counter today.
Indeed, one of the top contributors to the Nifty recovery. But Gaurav, the other one that is contributing to the Nifty recovery is ICICI Bank. Tell us more about those numbers.
Well, yes, when we talk about ICICI Bank, a good set of number. Bank has delivered good set of number for the last few quarters, and in this quarter also they are not missing on that expectation. They have delivered higher than what the street is expecting. Net interest income increased almost by 11% on a year-on-year basis, while pre-provisional operating profit, there we saw 17% growth. Now this was because of the higher other income, and this is actually the trend that we have seen across the banking segment. When it comes to provisioning, now this quarter bank actually reported very good set of number in terms of asset quality as well. Gross NPAs have remained flat on a sequential basis. As a result, provisions were also in line with what the street is expecting. And when we look at profitability, there we are seeing 15% increase. Now another big positive surprise in ICICI Bank is the net interest margins. It has declined only by 7 basis points, whereas street was expecting around 17 to 18 basis point fall on a sequential basis. Now there were some changes in the accounting policy as well, and management commentary also suggested that if we compare on a like-for-like basis, the net interest margin fall was just around 4 to 6 basis points. So again, that was actually very positive in terms of the results going ahead. What management has said during the commentary is that there will be an impact of 50 basis point of rate fall going ahead in the second quarter. But on the other hand, cost of funds are also likely to decline from the next quarter. So that is something which is positive. Again, we saw brokerages being a little bullish. Nuvama increased their target price. We also have IIFL and Investec who increased their target price on ICICI Bank. And as a result, we are seeing some uptick in this counter as well.
Okay, take that point. Thank you so much, Gaurav, for joining us with that analysis. Let's take this conversation forward and talk about market fundamentals as well. Parag Thakkar, Senior Fund Manager at Fort Capital, is joining us now to discuss that. Parag, good morning. Thank you so much for joining in. Well, big numbers over the weekend, over post-markets on Friday as well. What's been your biggest takeaway? How are you analyzing these numbers? And what next for these big names?
So I'll talk about three of our holdings which are very important: Reliance, HDFC Bank, and ICICI Bank. So first of all, HDFC Bank, I think they have done the best thing that whatever gain they got from HDB Financial Services OFS, they have done it as a floating provision of 9,000 crores. Plus, they have a contingent provision of 1,700 crores. So they have increased their provision buffer to 36,000 crores now. At the same time, they have brought down their CD ratio to 95.1%, which will allow them to grow in line with the system in FY26 and grow ahead of the system in FY27. Now, if you see, it's a sleeping tiger which has awakened now, right? So now it is ready to grow, and the macroeconomic situation also is great. Monsoon has been good. We are very close to festive season also. Liquidity is very good in the system. So this is the right time for them to start now lending. And up till now, they were lending less and just focusing on deposits to bring down their CD ratio. Now CD ratio is also comfortable. Of course, their medium-term target is to bring it to 87 to 90%. But I think now they can start focusing on growth, which they have said on the call also. So I would say that at 15 PE and at 2.1x on FY27 price to book with 1.9% ROA, I think now they can grow. And of course, one caveat here is for every bank, I think Q2 again will be a margin hit because 50 bips has to be passed on. And so one can embrace for one another, I would say, margin cut in Q2, and then things will start to normalize. But FY27, I'm sure, will be looking very good for banks in terms of earnings also. So HDFC Bank, of course, ICICI Bank, spotless as usual. Nothing to say, nothing to complain about. They always report excellent numbers. Again, as you said, the NIM decline was minimal. Of course, in Q2, again, they'll also see a NIM decline. But just to mention one thing, one private sector bank which reported numbers earlier, fortunately, we were not having that in our portfolio, but that reported extraordinarily high credit cost. Even if you adjust for technical slippages, the credit cost was 1.2%, which in case of HDFC and ICICI was between 50 and 55. In fact, X of agri, which is seasonal, they were below 50 bips. So I would say that this is coming to the back to basics. The banks which lend very prudently, the banks which have a strong deposit franchise, I would say that this will be the winners in the coming cycle. Because see, HDFC Bank, if you see the balance sheet, the tier 1 capital is above 17%. Same is the case.
Right.
I would say,
Parag, since you're on the subject of banking and financials, HDB Financial just came out with numbers, but a common trend that was highlighted in the numbers was the stress in the CV lending business. Right. What does that happen to the other peers that are involved in this, say for the likes of Shriram Finance and the likes? Do you see this stress impacting earnings and thereby seeing some more valuation compression in names like these?
Sure. So I would say that is a common trend. Like AU Small Finance has also increased its credit cost guidance, right? And that is also due to this used CV only, I think. So and all these stocks we don't own in the portfolio, so I would not like to comment. But generally, as a sector dynamics, you are absolutely right that these are risky segments, right, to lend, where your yields are more, so your ROAs are upfront and your profits are upfront. But then over a period of again it normalizes, and so the hits come. So I think that is why we stick to HDFC Bank and ICICI Bank kind of names or Kotak Bank kind of names in our portfolio. And we don't take disproportionate risk by buying this kind of NBFCs, which they also have a good business model, but I would say that they go through this kind of cycles often. And lending is a leverage business, by the way. You just earn 2 to 2.25% ROA at best. Right, ICICI Bank today has 2.4% ROA, which is the industry-leading ROA within the large-cap private sector banks or PSU banks if you include them. And you are taking risk of 100 rupees. So you have to be very, very prudent when you lend, and that is why we stick to them only.
Okay, all right. Take that point, Parag. Thank you so much for joining in today with that take. A whole host of stocks to discuss, and they've been impacting the market moves also majorly today. We'll do one thing. We'll take a short break. When we come back, we'll talk more about the markets on the other side. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. A lot of buzzing elements in the broader markets. Hudson Agro, that is one which is in focus after reporting a solid set of numbers. Mangalam is joining us with the key highlights. Mangalam.
Well, the biggest positive for Hudson Agro this time around has been the improvement that we've seen in gross margins. Remember, dairy companies have been, reporting steady gross margins, some of them declining over the last few quarters as well. But at 32 point some %, we have, the highest gross margin that we've seen in many quarters for Hudson Agro. Now, this is a function of a couple of things. One, a large part of their milk procurement is in-house. So higher prices for the industry means that their margins get better benefits because realizations are higher while the costs are same. Secondly, higher share of revenue coming in from value-added products. And the third part is seasonally, this is the quarter where they also sell a higher proportion of their Arun ice cream brand, and that has aided their overall revenue. So if you look at the numbers, a 9% growth in revenue, gross margins expanding. The company has been investing in back-end, etc. as well, which is why the EBITDA margin has stayed steady at 13.9%. The net profit is lower, led by depreciation, which has come in at 137 crores versus 111 crores. And that's largely because of a couple of acquisitions that the company has made as well, most notably that of Milk Mantra. So how they scale Milk Mantra is something that the street will be watching out for, and how they expand beyond their current geographies and the higher contribution of value-added products is something that we will watch out for going forward as well. Add to all of this, the stock by itself has been a bit of an underperformer, down 24% from its 52-week high, and over the last 12 months itself, it's down 17%. So all of this with improved margins has led to a recipe of an up-move in the stock.
Thank you very much for that. You said how Hudson has underperformed, down 17% in the last 1 year. Its peer, Dodla Dairy, had done well in the last 1 year with a gain of about 20%. But today it's correcting. So there has been a bit of a reversal. And Dodla also came out with their numbers. While the revenues have gone up by 10% on a year-on-year basis, margins are lower. Margins are at 8.2% versus 11.5%, and that is driving a 3.5% fall in the company's profitability. So Hudson up, its peer Dodla Dairy down 3.5%. But let's talk about AU Small Finance Bank. That's been one of the big casualties of the day. Bank's net profit is up 16%, but the asset quality has weakened. Gaurav joins in with a breakdown.
Well, yes. When we talk about AU Small Finance Bank, let's understand what has actually caused this casualty first. When we talk about the credit cost, now bank has increased their credit cost guidance from 85 basis point to 100 basis point for FY26. And the reason being that in the MFI segment specifically, they are seeing a weakness in the recovery. Specifically in the MFI segment, they have said that the credit cost is expected to rise almost to 5% versus earlier guidance of 3 to 4%, and they also believe that the peak of MFI credit cost will be in the second quarter. From third quarter, they are optimistic that this credit cost will come down. But another disappointment here in the result was net interest margins. Now, they have declined almost by 40 basis point versus expectations of the fall of around 30 basis point. What management is penciling in is that in Q2, we will see a further decline in net interest margins because of the rate cuts. And from Q3, we will see some rates actually increasing in terms of net interest margins, and full recovery is expected in FY27. Although when we talk about profitability, there we saw a sharp jump. It increased almost by 15%, but that was led by treasury gains, and that is something which market did not take in a positive way. In fact, brokerages are also being a little pessimistic. We have got Investec who has cut the target price to 910 rupees. What they're saying is that the recovery is going to delay, and that is the reason why they are cutting down the target price. In fact, they have cut their core PPOP expectations almost by 9% for FY26 and FY27. We also have Nomura, who actually increased their target price but still maintain their sell rate and a target price of 610 rupees. So definitely some pessimism was seen in the brokerage notes as well. And as a result, we are seeing the stock is struggling today.
Indeed, but one stock which is doing very well is Mastech. It's up close to about 9%. So numbers were not wow. In fact, they were quite tepid. Revenues were down 1.1%. Revenues have been muted over the last couple of quarters, and this was a particularly tough, challenging quarter for the entire industry. You remember all the large cap IT companies had reported a revenue contraction. Mastech's revenues too were down 1.1% sequentially. Margins too for the company declined for the third consecutive quarter. So in Q1, margins were down close to about 30 basis points sequentially, but they've been declining. And in the last interview, the company had actually spoken about improving margins. They want to get margins back to that 17-19%, but in Q1, margins came under pressure. That said, maybe the street is latching on to the bottom line number. Profits went up because of higher other income, so profits were up 13.5%. There is hefty cash in the books. Cash in the books is close to 550 crore rupees. And their main business comes in from UK, particularly the NHS segment, and that is doing well. So UK is about 65% of their overall revenues. That went up 10% quarter on quarter. Even last quarter, it did very well. Their order wins were healthy. So these could be some of the positives that the street is latching on to. The conference call today is at 1 o'clock. So we'll get some more color on, is there something more that's exciting the street?
The numbers may not be wow, but the stock is definitely looking like a wow right now.
Like a wow.
On the stock, of course, still 20% below its 52-week high, which is 33.75. But among the top gainers in the broader markets today is Nasdaq, 9% higher. Slightly off the highs of the day, but 9%. You take that with both hands any day. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. 70 points higher on the index, but still some hesitation at higher levels. Counting down to the big number of the day, that is Ultra Tech. Of course, one of the big two numbers of the day. Nigel is here with what the street is expecting. Nigel.
Well, Ultra Tech's numbers actually are expected to be a rather good one. And besides the numbers, the street also will be keeping an eye out from the largest player in the cement industry. What's the outlook in terms of demand? What's the outlook on pricing as well? Let's run you through the basic consolidated numbers first up. Revenue is expected to jump up by close to around 20%, but EBITDA number will see a bigger jump. That's by more than 40%, which means that margins will expand. The PAT expansion, though, PAT growth will only be around 35%, though you have the EBITDA number that will grow by more than 40%. Let's explain this to you. What are the key factors at play? Well, volume growth is expected to be mid-teens. If you have Kesoram that's accounted for in the base year, then it will be in lower teens. While if it's not accounted for, then on a smaller base, the growth will be anything between around 16 to around 17%. So we'll keep an eye out on volumes. Will be led basically by inorganic growth. On the realizations parameter, is expected to grow by close to around 2 to around 3% on a sequential basis as well as on a year-on-year basis. So both those two are firing for it. Top line, big growth being led by the volume parameter because of inorganic growth. Moving to the cost focus then, the margin expansion will be because they've been focusing a lot on cost, on reducing the cost of production. So EBITDA margins will expand because of better realizations and lower cost of production as well. And finally, I said the PAT growth will not be as much because there's likely to be an increase in depreciation cost as well as, on interest cost, which will, plague the PAT number to a little bit. But more than the numbers, the commentary is going to be very, very important. So we'll keep an eye out on these numbers. Normally comes in at around 2 to around 3 p.m. So we'll get you a quick analysis on that one. Back to you.
Well, thank you very much for that. And that brings us to a close in this edition of Trading Hour. Thank you for watching.
Stocks bounced early after early weakness as some better than expected earnings boosted sentiment. Financials and industrials lead the charge while IT and energy drag.
Reliance Industries clocks a good quarter, delivering a healthy profit even after adjusting for gains from sale of Asian Paint shares. Brokerages remain upbeat with an eye on value unlocking from the new energy business.
ICICI Bank over-delivers. HDFC Bank too turns in a steady show with only a moderate decline in net interest margins, unlike the mid-sized banks, many of whom also feel the credit cost pressure.
CNBC-TV18 learns that Axis Bank was prodded by the RBI to recognize stress, leading to a jump in provisioning in the first quarter. While regulator found no accounting lapses or violations, it felt the bank's NPA policy was too lenient.
Geo Financial Services and Allianz Insurance Europe will set up a 50-50 reinsurance joint venture in India. The two have also inked term sheets for equally owned JVs in life and general insurance.
A very good afternoon. Welcome to a halftime report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra. With me is Manglam Malu as well as Vidhi Motiwala. Well, we've started Monday at least on a firm note. So the markets are in the green. We have the Bank Nifty, which is up around 0.8%. We have the Nifty, which is above 25,000 as we speak as well. It seems as though earnings and what could happen with the tariffs continues to be in focus. So when it comes to earnings, we have the likes of ICICI Bank, HDFC Bank, as well as Reliance Industries, which are in focus on account of earning reactions, and obviously, what could happen with the tariff situation. In terms of earnings that will be released today, we do have quite a lot to reckon with, especially in terms of the broader markets. We have the likes of Ultratech Cement, Eternal, Havells, IDBI Bank, just to name a few in terms of what we can expect in terms of numbers. So overall, a steady day of trade, but let's see, a lot of data points.
A lot of data points ahead, but bulls would be feeling very happy because after 3 weeks of losses on the frontline index, the Nifty has finally managed to recover from the lows and currently cross past that 25,000 mark as well after closing below that level on Friday's trading session. And this comes on the back of a weak start. So today we tested levels of slightly sub 24,900 as well. And from there has been a big recovery. The Nifty Bank as well bounced off very crucial levels. We'll talk about that in just a bit. The good part is that portfolios would be feeling relatively happier today as well versus morning to now. If you pull up the red and green lines, you would see that there has been an intersection. While the split is right down the middle, they've actually come closer. And, for most part of the afternoon, the red line was above the green line. And then now we have the green line slightly above the red line, about 1,350 stocks in the green for about 1,340 stocks in the red. Nippon Life India moving higher, Aditya Birla Capital moving higher, a couple of these stock market related names, MCX for instance, moving higher. And we are also seeing some traction in names like InfoEdge, etc. So a bunch of stocks now picking pace as we move towards the latter half of trade. Hi, Vinny.
Hi, good afternoon. So other than that, let's watch out for metals also. Some of these metal names are buzzing away in trade. So whether you look at Nalco, Hindustan Zinc, Vedanta Limited, Hindustan Copper, all these names also managing to hold on to strong gains today. And obviously in terms of the Nifty 50, the top gainers, what is, aiding the market right now? Obviously the banking names like we've spoken about before, ICICI Bank, HDFC Bank, Kotak Bank among the top supporters for the Nifty. While in terms of drags, we have Reliance as well as Axis and TCS among the top drags coming for the Nifty 50. But let's talk about the banks then, and what are these individual reasons why these banking names are in focus today. Starting with Axis Bank. Now, sources are saying that Axis Bank's unexpected spike in bad loans and provisions in its first quarter earnings was not entirely the result of the bank's own internal decision. Ritu is joining in with us to give us details on this front. Ritu?
Well, the surprising spike in bad loans, which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact, was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages, and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that this should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
Okay, important developments there, Ritu. Thanks very much for that. So that's on Axis. That stock is down around 1% But let's talk about one of the top gainers on the Nifty. That's ICICI Bank again. From the private banking space. It's one of the top Nifty gainers after reporting what was a good set of earnings over the weekend. Gaurav is here to take us through the fine print of the numbers and what the street really liked about it this time round, Gaurav.
Well, yes, definitely we can say ICICI Bank reported good set of numbers because net interest income increased almost by 11% on a year-on-year basis. Other income actually supported the pre-provisional operating profit growth, where we saw 17% growth on a year-on-year basis. And lastly, when it comes to profits, now company reported 15% growth here. All the parameters were actually higher than what the street is expecting. What was actually a very positive and a key thing to highlight is that net interest margins declined only by 7 basis points on a sequential basis, versus the estimates of around 16 to 18 basis point fall on a sequential basis. Now, management commentary also suggests that there were some changes in the accounting norms. As a result, if we compare on a like-for-like basis, the net interest margin decline could only be somewhere in the range of 4 to 6 basis points. Now, this is really impressive when it comes to the repo rate cut that we have seen across the industry. Other than that, there was another key thing to highlight is that the asset quality remained very stable. So gross NPAs remained stable at around 1.67%, just a 2 basis point increase in a sequential basis in terms of net NPAs. So there also bank delivered fairly good amount in terms of the asset quality. When it comes to commentary going ahead, now banks said that in the next quarter we will see 50 basis point of fall and its impact on net interest margins. But at the same time, they are also saying that the cost of funds will decline. It will continue to decline. That is again, which is something positive. Other than that, when we talk about brokerages, from there also we saw very positive reaction. Now Nuvama increased their target price to 1670. We also have IIFL and Investec who increased their target price, and all these brokerages are sounding bullish. In fact, when we talk about stock performance in the last 6 months, we are seeing ICICI Bank has continued its outperformance, and today's trade as well, it is up more than 2.5%. So definitely watching out on this counter on the back of a good set of number that it delivered in first quarter.
All right, Gaurav, thanks a lot for that. So that's about ICICI Bank. ICICI Bank and HDFC Bank together contributing the most amount of gains coming by on the Nifty Bank today, and as a result of that on the Nifty as well. Let's listen to the management of HDFC Bank, where the profits grew 12% on a year-on-year basis. And our colleague Ritu quizzed the management during their first quarter media call. Let's listen in to what S. Vaidyanathan, who's the CFO of the bank, had to say.
Normally, based on this Kharif and Rabi season, June and December is what the bank has typically seen agricultural credit and slippages elevate in these 2 quarters. And then it starts to subside in the following quarters. So this quarter is no different. It is just that the core, excluding the agriculture, which we have shown, has been very benign and pretty close, 102 basis points or so, compared to 96 basis points or so last year. So very, very close outside of the agriculture. And same with the GNPA too, which I alluded to, which is 114 basis points GNPA excluding agri. And the last year was 116 basis points, and last quarter was 113 basis points. So they are consistent and very stable across. We have taken this as an opportune stage to enhance the floating and the contingent provision. It is not meant for any specific portfolio. It is not meant for any specific anticipated risks. These are counter-cyclical buffers for making the balance sheet resilient. And that's where we have intended to and enhance this. And if you look at it, our contingent provisions were about 51 basis points of the total advances. It has moved to 57 basis points, so enhancing the coverage. The floating provisions were at 47 basis points, and with this addition that we have done in this quarter, we have taken it to 80 basis points. If you look at the credit growth, 2 things are happening. One, at the industry level, you're seeing that the credit growth is coming down. Call it between 9% thereabouts. It could be touching 10, but between 9 and 10%. If you look at our credit growth, our AUM, we reported currently a little more than 8% our AUM growth. Last year, if you see March, we closed at about 7%. So we are moving up in the direction of growing credit. Cost of funds has been the only item that had inhibited the margin from the 4% to 3.4% thereabouts. Cost of funds had two components in it. One is the borrowing mix was higher than typical what the bank had experienced, 7%, 8% or so, went all the way to 21%. We have brought it somewhere midway between the 7 and the 21 right now. So we have more room to go to get that borrowing retired in course of time.
Okay, all right. So that's the update coming in on all the banks in terms of earnings. We need to take a short break with the news that the markets are steady. We have the Bank Nifty, which is up around 0.8%, and the mid-cap index, which is cruising with a gain of around 350 odd points. Take a break. On the other side, we'll connect with the management of Aarti Drugs to discuss their Q1 performance. Stay tuned.
Welcome back. You're watching us here on Halftime Report. We've been talking about how there has been a stellar recovery in the frontline indices. Let's put a number to that as well. From the lows, there's been over 200 points in terms of recovery for the Nifty Bank a lot more, the mid-cap index as well, up nearly 0.6%. Today's low on the Nifty, now important crucial support zone because it's come after 3 weeks of declines. 24,882 on the Nifty today and 56,256 on the Nifty Bank. So these are important levels to watch out for going from here as well. What is it that has led the market higher from these lows? HDFC Bank and ICICI Bank, they've been top contributors and they've negated the downward pressure that Reliance has put in on the frontline index as well. With the Nifty now comfortably above the 25,000 mark, important to see where the put writers are active. And yes, they are. The 25,000 put writers come up for you on the screen. 73 rupees is the premium out there. And the 24,900 put writers as well, both of them equally active, telling you that the support for the market remains at today's low around 24,850 to 24,900. On the way up, however, crossing that 25,100 mark is very crucial because call writers are still standing tall out there at 85 rupees premium, telling you above 25,150 to 25,200, there could be some congestion in the market. In fact, where the Nifty is right now is very close to the 50-day moving average. So crossing that 25,035 mark would be extremely crucial to track. And thereafter, we can look at the 20-day moving average. For the Nifty Bank, the 50-day moving average is where we bounced back from, and now all eyes would be whether it goes ahead and crosses the 20-day moving average, which is at 56,928. looking out for a couple of stocks as well. AU Small Finance Bank, lower in today's trading session post results. Union Bank as well lower. Both of them seeing a lot of fresh shots being added. Eternal ahead of numbers. That stock is up 3% among the top Nifty gainers. We'll watch out for how the food delivery business grows and the losses reducing in Blinkit. So that stock is seeing some fresh long positions. And Angel One, the stock which has been in F&O ban for the last few trading sessions, may exit F&O ban given the open interest action that we've seen on that one.
Okay, all right. Thanks, Manglab, for that. So that's the entire F&O space. But let's talk about one particular company. Aarti Drugs is the first management on the show. It reported what was a decent set of Q1 numbers. Margins came in healthy. Export revenue also jumped 18% year on year. We have with us Adish Patel, who's the CFO of Aarti Drugs, joining in to discuss the company numbers gone by. Adish, hi, welcome to the show. Well, just wanted to start by talking about the API business in particular. You said that last quarter you did see good global demand. Did that come in this quarter as well? Did you see good global demand this quarter? And could you break up the volume as well as the price action that you saw?
Yeah. So the demand was fairly good as far as exports was concerned, but on year-on-year basis. We did saw around 15 to 17% volume growth in exports and around 5% volume growth in domestic market year on year. But having said that, if we compare quarter on quarter, I think there is a lot more potential in demand for the volumes, both in exports as well as domestic market. And the main laggards were mainly antibiotic category in the fluoroquinolones.
Why did you see this kind of sluggishness in terms of the antibiotic API demand sequentially? And what are you anticipating in the coming quarters in terms of volume growth in the API segment?
So I think we can do much better as far as exports is concerned. Definitely, the China has been very active in last couple of quarters in terms of reducing prices, but mainly it is in temporary nature because on the longer term, definitely the demand does come back is what we have seen to us. We might have lost few orders because we were checking on the prices. We were not being too loose on cutting down the prices in last couple of quarters. But going forward, we are quite hopeful because we have got a lot of EU registrations and latest we got US FDA approval as well. So that put us in a very comfortable position to market more and more API in the regulated markets, which were not accessible to us some time back.
So if you could give us three numbers, Adish. One, earlier you were targeting 14 to 15% margins in FY26. Does that number hold? Volume growth between 10 to 15%, I suppose you will have a better clarity on which end of whether 10 or 15 is what you're likely to do in FY26. And prices, you expected a deceleration of 2 to 3%. Will that hold? So prices, volume and margins.
Yeah. So as far as prices were concerned, as we estimated that in the first half, we might see around 4 to 5% negative price variation. So that is what we observed in the first quarter. We did have a 9% volume growth year on year for the first quarter. Definitely the greenfield projects did not contribute in these volumes, and they will to a significant extent in the H2. So the volumes will go up to 15%, especially in second half. First half might be in the same range of around 9 to 10%. So volumes, you can say on a composite level might be somewhere between 10 to 15 this year, and 15% definitely we are eyeing for the next year. And now the price erosion has stopped. Since December, March and June quarters, the prices of APIs were quite stable.
Okay, prices of API were quite stable. And margins, what's your word coming in on margins? 13% to 14% you had spoken about previously. So is that achievable and you still hold on to the target? Or maybe you could expect better margins going forward in FY26? And also just a word in terms of your overall revenue growth. You had said FY26 you would see that double-digit revenue growth. Does that still hold?
Double digit, we might reach closer to that by the end of the year. That is what we are hoping. Means probably 15% for the entire year. Value-wise growth may not be possible, but we will try to achieve 10% at least. Then as far as the next question was regarding what? Margins?
EBITDA margins, that 13 to 14% I think you had spoken about previously. So would that still hold?
Yeah. So the good part is our gross contribution has improved even on sequential basis. So if we have better utilization of plant capacities at that gross margin, definitely 15% we would have got in this quarter itself. But so 15 to 16% EBITDA margins with better utilization of greenfield capacities and the similar kind of maintaining the similar gross margins, I think it's pretty much achievable.
Okay. Adesh, you also had your Tarapur plant, which came back on stream. Your import alert was lifted in the month of Feb. So have you restarted your supplies to the US? If so, in what capacity? And what are you expecting in terms of contribution now from the US market?
So no, we haven't restarted the commercial business yet, though that plant was being used for some other geographies. But we already had a lot of customer audits for the US market for a couple of our products. So the thing is, once those all those approvals goes through, probably after 12 months time, our US supplies might start. But before that, the European supplies will start from the same plant for the same clients, because those clients are exporting to Europe as well as to US market. So
but why is it taking you so long to restart your supplies to the US?
Yeah. So because the thing is, so we were under import alert for quite a long time, around 10 years. So more than saying restarting the supplies, it would be more like launching fresh supplies to the US market. And that typically requires time from the US regulators, because the formulators need to get the new API vendor approved from the US regulator. So that process might take time.
Specialty chemicals, you expected that to contribute about 15% of your sales. Where does that number stand at right now?
Yeah.
And what is your glide path there?
Yeah, so 15% is pretty much achievable. Because the salicylic acid plant that does fall under intermediate category, and then the SICA plant, where we have just started the trials. Means I would like to say that last week only we started the trials. So if that goes through, then that plant would be put to use in this Q2 itself. If not, then probably in Q3. And so both those put together, definitely 15% is easily achievable in spec chem and intermediate category.
Okay. You know, you had mentioned that Pakistan is around 3% of sales. There could be a little diversification in terms of sales. Are you still supplying?
No, we are not allowed to supply to Pakistan. So definitely that might have also hurt our export sale, which is down on sequential basis.
Okay. So where have you diversified your sales or diverted your sales to now? And how much is the export business as a percentage of your total sales, and how much did it grow, and how much do you think it was possibly impacted because of various external factors?
So if you look at year on year, it has definitely grown by 15-16%. But as far as Q and Q is concerned, we have definitely lost volumes as far as export is concerned. Even with that, we are having around 35-36% of our revenues coming from exports for the standalone business, whereas for the formulation, around 57% of the business is coming from the export market. So temporarily, it might get, we might get hurt in terms of exports because of the Pakistan issue, but probably in 1 or 2 quarters, that demand should come back to us.
Okay. Adesh, thank you so much for joining in with us on the show, and giving us an insight in terms of what we should be expecting from the company in FY26. That was the management of Aarti Drugs talking about maintaining and managing to at least reach a double-digit revenue growth in FY26 will be interesting, and in terms of improvement, in terms of pricing going forward will be a key to watch out for.
Right, that's about Aarti Drugs. But, as just that happened, we had a flash coming in on the bottom of your screen for Bajaj Consumer. The intraday of Bajaj Consumer should come up for you. The company is saying that they will go ahead and, consider a buyback along with their results as well. And that has the stock fairly excited. It's up 5% right now. Chances are it could go higher from here as well because of a couple of factors that are working for Bajaj Consumer. The first part is that they, got a new MD coming in the company. And ever since that announcement has happened, the stock has rallied about 45-50%. Secondly, in terms of valuations, there has been a lot more in terms of comfort coming in for Bajaj Consumer as compared to other players. And thirdly, the overall environment for staples has been improving ever since the first quarter updates have started trickling in. A lot of stocks have been doing well in that Bajaj Consumer likely to benefit from that. And now you have the buyback sweetener, which is coming, takes the stock higher. It was already doing well, a smidge higher after that announcement has hit the screen. We take a short break, come back on the other side. Sudeep Shah of SBI Securities joins in with some trading strategies. Stay with us.
Welcome back to Halftime Report on CNBC-TV18. Now we're joined by Sudeep Shah, Head Technicals and Derivatives Research at SBI Securities to talk to us about the markets. Sudeep, good afternoon and thank you so much for joining in with us. Today, obviously one of those better days coming in for the markets. We've come back and about the 25,000 mark, but there are key levels to watch out for, right? 25,100, and if it goes above that, or what is the support that one should keep an eye out on in terms of the Nifty? Also in terms of Bank Nifty, what are we watching out for?
Yeah, good afternoon. See, what we feel is that post the heavy results that had come in the last weekend, say Reliance, HDFC Bank, ICICI Bank, markets have now digested the entire result move. And we feel that going forward now, 24,900, 24,950 will act as a strong support. We are seeing a decent pullback in terms of banking stocks, in terms of financial services, which obviously has a higher weightage in the overall scheme of things. So overall, we feel 24,850, 24,950, that 100-point range will act as a strong support. And steadily, we could see a pullback closer to 25,200, 25,250. Now, the real resistance would be closer to 25,250 zone. So we see a range-bound move between 24,900, 24,850 and 25,250 on the upside. From a Bank Nifty perspective, 56,200 is what we see as an important support. Now, on Friday's low as well as today's low are identical. Out point also. So 56,200 looks to be a very important support, and till this holds upside up to 57,200, 57,500 cannot be ruled out, and that could support Nifty towards it move to 27,250, 27,300.
Right, Sudeep, before you get to your individual stocks, I just wanted a chart check on Bajaj Consumer. The stock has moved higher. The management change has caused the stock to rally about 40-45% as well, and now they're considering a buyback. From a chart check standpoint, do you think there is further up move here, or are we looking at some sort of resistances? And then you can give us your stock picks as well.
Good afternoon, Mangalam. Mangalam, what I feel is that in the last few days, this move seems to be overstretched now from 200 to 10, the stock is low to 250. Although the news is positive, but I feel the stock could head into resistances closer to 255, 257 zone. And that's why the risk-reward ratio does not seem appropriate. So I feel that dips towards 240, 243 should be added to go long rather than buying at current levels. In stock specific, there are a couple of names that are there on our radar. One is Chola Finance, 1565, 1570 is what it's trading closer to. 1510, 1515 zone, we feel that that could act as a decent support, and with the pullback in the financial names, this stock could rebound towards 1650, 1700 zone on the upside. So this could be bought with a stop loss at 1520. The second name is a cement name. Now here we are seeing a decent pullback. Dalmia Bharat closer to 2270, 2280. This should be bought on dips, and on the downside 2230 would be a stronger support, and so the stop loss could be 2230, and we're looking at an upside closer to 2400, 2450. There's a breakout on the weekly charts backed by volumes. So at current levels and on dips, we feel that this should be added, and the stop loss could be around 2230 on the downside.
Okay, all right. We're going to let you go on that note. Thanks very much for joining in and giving us all of your technical recommendations, Sudeep. So that's Sudeep Shah talking about what he's recommending today. Just watch out for cement stocks such as Ultratech Cement, which will be releasing its numbers today. So it's holding up with a gain of around 0.7%. Eternal also is doing quite well ahead of its numbers. It's up around 3% ahead of its numbers today. So do watch out for that particular counter as well. We'll take a break, but on the other side, Manisha Gupta will join in to take us through her conversation with the MD and CEO of Senco Gold and Diamonds.
Welcome back, and joining us on the show now is Suvankar Sen. He's MD and CEO at Senco Gold and Diamonds. Suvankar, hi, thank you so much for joining in. And I absolutely directly want to go to the BIS notification that's come in about the 9-carat gold hallmarking also now introduced. I mean, we do understand that what India buys in sense of jewelry, almost 70, if not 80% of that is 22 carats. Of course, with gold prices going higher, diamond jewelry doing better, you need those lower caratages, but 9 carats.
See, if we look at the international markets, UK or even in certain markets in US and other parts of the world, people have been selling 9 carats and 10 carats. So 9 carats is about 37.5% gold and the rest is all alloy. So I think that if a 24 carat gold price is about 1 lakh rupees, then a 9 carat gold price will be around 3,750 to 3,800 rupees. And I think that it is only going to support the diamond and the studded industry because people there are anyway buying 14 carat. Now with the gold prices going up, I think that the ability to sell more diamonds will also go up. And in terms of affordability, if we look at the gifting segment below 30,000, below 20,000 rupees for an everyday wear, I think that this is a good support from the government to ensure that jewelers can produce jewelry which is affordable, and young generation customers and customers within budgets and more variety that they can buy. This will be good for the industry in the long run.
So Suvankar, what you're saying is that this is not for gold investors, rather for diamond buyers and fashion jewelry buyers. So there is this categorization there.
Yes, because what we are seeing in the market is when it comes to gold jewelry or wedding jewelry, when there is a serious buying for some special occasion happening, there, it is mostly 22 carat. People are looking to reduce the weight. So consumers are facing some challenge in terms of having jewelry within their budget. 18 carat gold jewelry, either whether it is Western design or traditional design, that is also something that the consumers are looking for. So when it comes to those wedding jewelry buying, we are seeing a 22 carat lightweight or 18 carat purity being asked for. But when it came to diamond jewelry, it is either 18 carat or 14 carat. And now we as jewelers and the consumers have an option to provide for a 9 carat base on which the gemstones and the diamonds and other precious and semi-precious gemstones can be given to the consumers.
So Anka, take us through the fact that, and this is for the consumers as well, that if you're buying a 9 carat jewelry, then your making charges are as much or perhaps more than if you were buying a 22 carat jewelry, and the wastage charges are high as well. And then you are using various kind of alloys. Dwell deeper into that, please.
So yes, when it comes to the mathematics of, the breakup of the gold rate and the making charges, when it comes to 9 carat, most of it is casting or machine made, and there is a lot of studded aspect to it because you are studied it with diamonds. So there's extra labor that is needed to make the jewelry complete, unlike a machine made yellow 22 carat gold jewelry. So therefore, when it comes to making charge per gram, it is the time value of the laborer, of the karigar, or the people who are working to make the jewelry. So the making charges in terms of percentage might look high, but in terms of absolute numbers, it might be as the same as it is for a 18 carat or 14 carat jewelry. But yes, when it comes to 22 carat, it is because the gold value itself is so high. Therefore, in terms of percentage terms, it will look as if the making charges are lower, but in absolute numbers, when it is a lot of design and karigari, obviously the making charges will be similar to a 9 carat. So this is how the consumer has to look for it, because it is the design, it is the manufacturing. The only way, the benefit that the consumer will be getting is a lower value of gold because it is 9 carat instead of 14 or 18. And that is how the consumer needs to look at the product.
So Ankur, coming also on the BIS notification that talks about the 24 carat coins to be now minted only by mints and refineries. How does that impact a lot of jewelers like yours?
No, I think that, these are steps taken by the government to ensure that there is a basic quality that is maintained when gold bars and coins are given to the consumer. While when it comes to, these new rules that have come in, what I can see and the talks that are there in the industry, that what exactly is the clarity that, we are looking for from the BIS and the government when it comes to these particular laws and rules. But yes, ultimately, what we all need to look at is that even when we are providing a 24 carat 995 or 999 purity gold bars and coins to the consumer, we do our own internal testing to ensure that there is no mistake in terms of the purity that is being provided to the consumer. So when it is being either given from a proper mint or BIS approved refinery, or even there is hallmarking of the product, there is proper quality control and checking done before we provide the product to the consumer. So I think it's all.
So, Suvankar, is there a clarity right now that whether or not jewelers can now make these coins, or is it only about refiners and mints and you can only sell it and not manufacture it?
No, the clarity is still not very clear, very honestly. I think there are discussions and happening within the industry and with the government. And I think hopefully clarity will come very soon.
All right. We will, of course, await that.
All right. We will. I'm just curious to know, what does one even get in a 9-carat,
37.5% gold.
So is that even worth considering as an investment? Because we're so value conscious when we buy gold that everything that we put in is largely on account of, an investment value. Now, if we're buying it for adornment, then 9-carat, will that be worth the money that we're paying?
Right. See, so there are two kinds of mindset that we see, and especially with the young generation consumers coming in. While there is a value and an investment that we attribute to buying gold jewelry or diamond jewelry, but there is an element of fashion and how consumers can keep on changing their jewelry and try out new designs. So I think more from a perspective of investment, if you look at it, you're paying a lower amount for the gold, and when you're exchanging it, since it's going to be hallmark, you will be getting that much quantity and quality or whatever, the value and amount of gold. So there is actually no loss to the consumer, except that, yes, the making charges that you will pay for the design that you're paying for. But when it comes to fashion,
I think Mangalam,
gifting,
yes, it also is about 9-carat, and it was going to be so strong, solid, that you can have diamond jewelry rather than 9-carat than anything else.
All right, guys. Thanks very much for joining in and taking us through that conversation. So definitely demand picking up for the lesser carat jewelry. But in any case, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m.
Welcome back. Let's talk about the primary market action. Brigade Hotel Ventures IPO, which includes a fresh issue of nearly 760 crore rupees, comes up. They operate the Marriott, Intercontinental, Accor, and betting big on premium expansion as well. Reema caught up with Nirupa Shankar, the managing director of the company, and started by asking them about their expansion plans. Listen in.
We've already signed with Hyatt Group, and then we are looking to add to our existing hotel operators with one more brand.
So 1604 keys as of now,
Yes.
with 10 new in the pipeline.
Yes.
What would the expected key count look like?
So we've declared and given the exact numbers for 5 of them. So that will add to about another 1,000 odd keys. And then with the remaining 5, we've not given the exact numbers yet, but it will add a few hundred more.
Got that. And what's the expected timeline when these will be, come on stream or be operational?
Yeah. So we've already started the construction and design development for some of the hotels. So those will start coming in from FY28 onwards. So you'll see these hotels come in between FY28, 29 and 30.
And what would be the expected revenue contribution from these new hotels?
No, that's, that's a 5-year plan but we are looking for significant increase in the revenue, in the bottom line. We're looking for very healthy growth, I would say, because what we did in the last 16 years, which is the creation of 9 hotels, we're planning to crunch in the next 5 years. So it is a high growth period for us. So obviously we are looking to enhance our revenue significantly.
So what's the debt today? And how much will it come down to?
Yeah, so debt today is about 620 crores. And 468 crores of that is institutional debt, which is what we are looking to repay from the IPO that we're planning to do. So we will have about 120 crores of debt remaining. Yeah.
Will you look to take on more debt as you expand?
So we don't require debt immediately. We have sufficient internal accruals to handle maybe the next 1.5 years.
So promoter holding is 96.3%.
Yeah.
How much will it drop to?
Around 74-75%, yeah.
So you said 2 things. One is that the company is planning for significant acceleration in revenue, margins, profitability. And you want to do in the next 5 years what you've achieved in the last 16 years,
That's
crunch
right.
it all in.
That's right.
So 5 years later, what would Brigade Hotel Ventures look like? I mean, how would the mix change? What's the ambition or aspiration here?
So I believe in the next 5 years, what we have stated is what, business development has already been done. But of course, our BD is going to continue. We're not going to stop with just these 10 hotels. We're going to constantly look and evaluate for new markets, micro markets. And I would also say leisure is a new segment that we did not look at previously. Because I would say the leisure market didn't command those extremely high rates. Very few hotels commanded high rates for leisure. And occupancy was also much lower than business hotels. But COVID, post-COVID, everything changed in terms of market dynamics. Leisure markets have become extremely strong. The kind of ARR growth that leisure has seen has drastically changed. So you will see Brigade adding very high-end luxury resorts to its portfolio. You will see us doing a lot more 5-star hotels and 5-star deluxe hotels. What this implies is ARR will also see a different change and an increase because of the nature of the products we're creating, which will again translate into much higher EBITDA margins because of the flow through of the ARR profitability into the EBITDA.
So you're expecting a significant expansion in EBITDA margins and ARR.
That's right.
Because now you're going to be operating in a very different segment which commands higher ARRs.
Yeah, that's right.
So explain to us what would be the margins, right? There are some peers of yours like Lemon Hotels, Chalet. They all enjoy margins of 40-45%.
Yeah.
Do you think, without getting into numbers or a guidance, but do you think your company can operate at 40% plus margins?
No, absolutely, because we are, even the existing portfolio, many of the properties already operate at those kind of margins. Sometimes the margin is reduced when you have new hotels coming up. They take time to sort of stabilize at 40%. But I think 40% as an industry average is a very doable number. And honestly, even in any sort of segment you operate, so even if you're in the mid-market or even if you're in the higher-end segment, it is possible. So maybe there could be few percentage point difference. I would say in the 5-star luxury deluxe category, anything above 45 to 50% is very possible. In the mid-market category, something between 35 to 40% is very doable.
Is there an ARR number that you're targeting?
No, I mean, of course there is internally, but currently we are looking. Currently, the portfolio is at around 6,800.
Yeah.
And like I said, I think with the portfolio change, you will see the increase in ARR.
Okay. And what about top line? You've been growing at 16-17%. Is that sustainable?
Absolutely. And I would say, last year we did about 16-17% increase in the top line, about 15% increase in EBITDA. And there's nothing to prevent us from doing something similar in the coming year without any addition in the portfolio. A lot of the portfolio, like I said, will come in. It's under construction and will come into play in FY28 and 29.
Occupancy, what's your own view?
Occupancy, currently our portfolio is at 77%, which is a very healthy occupancy for an entire portfolio. Despite the fact that we just launched a hotel last year. So I would say without that one hotel we launched, it's closer to 80%, it's 79% or so. We're pretty happy with the occupancy, but obviously nobody wants to sit on their past laurels. We are looking to see how we can take that up to maybe the mid-80s or so. That is our end objective with all our operating hotels.
Okay, so just one final question. Would you look to launch a hotel under your own brand name?
That's the question we have pondered over. But, today our strategy is that we like to partner with global tier 1 operators. I think, like I said, the Marriott's, IHG and Accors of the world do their job extremely well. And I think we would want to continue with the branded players.
Welcome back to Halftime Report on CNBC TV18. And just want to mark a couple of names, that have recovered in the last 1 hour or trading, from the day's lowest point, seeing a bit of an uptick coming in. Gujarat Fluoro is the first one that we should look out for. In the last 1 hour, it's up almost 2%. Sharp uptick is coming in just the last few minutes for the stock. Other than that, we have 361 WAM. That's also seen a bit of a spike up coming in from the day's lowest point. And this is specifically in the last 30 odd minutes to an hour that we're seeing that spike up coming in. And ABSL, AMC, Aditya Birla Sun Life AMC, that's the other one that I would like to mark out as well. That is buzzing in trade or, actually recovered from the day's lowest point. Other than that, Policy Bazaar has just come up on the screens as well. PB Fintech or Policy Bazaar, that also has seen a bit of a spike up coming in from the day's lowest point. And the last few minutes, if you look at the PB Fintech or Policy Bazaar, that's seen that spike up coming in. So keep an eye out on these stocks as well. Broader end of the markets is also in the green now, trading in the green, even the Nifty small cap. But that's how we're seeing the market setup looking like. A better day coming in this Monday, for the markets. That's what we'll be keeping an eye out on. But we'll wrap up this edition of Halftime Report as of now. Don't go anywhere. Up next, your Business Lunch to take you through all the action ahead and what we're watching out for.
Stocks bounce after some early weakness as some better than expected results boost sentiments. Financials and industrials are leading the charge while IT and energy continue to drag.
Reliance Industries clocks a good quarter, delivering a healthy profit even after adjusting for gains from sale of Asian Paints shares. Brokerages remain upbeat with an eye on value unlocking from the new energy business.
ICICI Bank over-delivers while HDFC Bank also turns in a steady show with only a moderate decline in net interest margins. Unlike the mid-sized banks, many of whom also feel the credit cost pressure.
CNBC-TV18 learns Axis Bank was prodded by RBI to recognize stress, leading to a jump in provisioning in the first quarter. And while the regulator found no accounting lapses or violations, it felt the bank's NPA policy was too lenient.
Jio Financial Services and Allianz Insurance Europe will set up a 50-50 reinsurance joint venture in India. The two have also inked term sheets for equally owned JVs in the life and general insurance space. Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Vamakshi Thoria. Vamakshi, good afternoon. It is that time of the day when we start counting down to major earnings. We're already seeing some flash at the bottom of your screens. But we're counting down to two major numbers today from Ultratech and from Eternal. The markets have been fairly okay, but there is still some hesitation at higher levels.
Well, absolutely, Hormuz. You know, today, if we can describe the market's mood is how actually we feel on Monday morning. Like this Monday morning blues, then you have a cup of coffee and then, you know, you're set for the day. And that is something that has actually played out in the markets. We started on a very, very weak note, but we soon managed to recover. The index is now trading with a gain. That is, the Nifty is trading with a gain of almost 81 points. You know, Nifty has managed to surpass the 25,000 mark yet again. And the mid-cap end of the market is actually very, very vibrant. You know, the mid-cap end of the market is up almost 0.7%. There you go. You know, it is at right now at the day's highest point. The small cap end of the market, though, has seen a bit of a recovery, but trading mildly in the green. Now, you know, what is driving the action today is actually the earnings, right? Reliance, of course, is you know, pulling the Nifty lower. But on the other hand, we now have HDFC Bank as well as ICICI Bank, you know, pulling the index higher. So just some of the banking names that are doing quite well in today's trading session.
Absolutely. ICICI Bank at 1461, now just 10 rupees away from its all-time high, which is 1471. The Nifty Bank continuing on its merry ways at the highest point of the day, 650 points higher on the index as well. And it is that banking space which is contributing to this up move. Of course, that does not take away from the fact that there have been a lot of negative earnings reactions as well. AU Small Finance Bank being a case in point. But that too is seeing some recovery from the lows of the day. But staying with the banking space after the slew of earnings that came out on Saturday, almost double digits. Gaurav is joining in to summarize most of them for us, if not all. Gaurav, tell us more.
Well, yes, when we talk about banking, it was a very crucial weekend, I would say, because there were many names which came with their earnings. But let's look at some of the key counters who are actually also reacting on the back of the earnings. First, let's talk about HDFC Bank. A very good set of numbers is what we saw. Profitability increased almost by 12% on a year-on-year basis. Now, there are a few key things to remember here. First is that the asset quality remains stable, and second is that the core net interest margins declined only by 11 basis points. This is something that the market has taken positively, and as a result, we are seeing some uptick in this counter. When it comes to ICICI Bank, now there also, let's focus on the core key segments where the positivity was driven, and that is the reason why we are seeing some uptick in the stock price as well. First is that net interest margins that declined only by 7 basis points versus expectations of 18 basis points, and here also we saw stable asset quality. When it comes to Yes Bank, there also we saw a little bit of positive news coming in, and the reason being that bank is actually moving towards their target of 1% ROA. They actually improved their ROA almost by 10 basis points to 0.8%, although it was driven largely because of the other income for the bank. When it comes to Bandhan Bank, and now we saw a little bit of weakness in the stock price as well today, and the reason being that when it comes to numbers, they were expected to decline, and they have declined a little lower than what the street was expecting. But on the other hand, there were some concerns on the asset quality. Now, the slippages have actually remained high, and specifically when it comes to EEB segment, which is some of it is actually their MFI book. There we saw higher slippages, and that is the reason why when we talk about the stock price, we are seeing some negative reaction. RBL Bank, on the other hand, again, when it comes to net interest margins, they delivered fairly well, but it was actually lower than what the street is expecting. Other than that, there were also some other areas of concern where the bank actually did well. In fact, what they are saying is that in FY26, they believe that ROAs are going to be somewhere around 1%, but definitely on the back of the net interest margin fall that we saw in the quarter, we are seeing a negative reaction. AU Small Finance Bank, let's move on to this counter now. It has seen a fall of more than 5%, and the reason being that they have increased their credit cost guidance almost by 10 to 15 basis points. They expect credit cost to remain around 1%, and after that, we saw some sluggishness from the investors and as well as brokerages like Investec. They have cut their target price to 910 rupees because they believe that this will actually slow down their journey going ahead. Lastly, let's also focus on Union Bank. Now, we already knew that the numbers for Union Bank was low when we compare it with the market, but another key trigger here is that now brokerages believe that there are no near-term triggers for the stock. In fact, when we talk about valuation, at the same valuation, we are getting better banks as per brokerages, and that is the reason when we talk about Motilal Oswal, they actually cut their rating for the stock, and as a result, we are also seeing some kind of negative reaction in the stock price. So, to sum it up, some good banks like HDFC and ICICI Bank who maintain their outperform across the segment, but there were some weaknesses like AU Small Finance Bank where we are still seeing some stress coming up from the MFI segment.
Well, thanks so much for that. Some hits, some misses from the banking space. But let's focus in on Bandhan Bank. The results were a mixed bag, as Gaurav was pointing out. The positives were a quarter-on-quarter rise in the ROA by 12 basis points to 0.8% and rise in return on equity by 70 basis points to 5.9%. But there have been a large share of worries. Margins are down quarter-on-quarter by 30 basis points to 6.4%. Gross NPAs are up by 25 basis points to 4.96% and net NPAs by 8 basis points to 1.36%. To understand more, we actually spoke to the management and, that was Partha Pratim Sengupta. Let's listen in to their to what their take was.
Definitely, we will go for a moderated approach in this segment. We are focusing on both a particular balance between the secured and the MFI segment for the day. So we made a very reasonable target of 8% only growth for 8 to 9% growth for this financial year. We hope that, yes, this growth probably would be achieved by the end of this financial year. So we will try another 20-25 basis point. Definitely, we are expecting to reduce, but we will see. But as I was told that these steps would definitely have a positive effect on this year also. Last quarter only, Q1, we have seen almost more than 20% growth in this segment. So we are capable. It's infrastructurally, if you look resource-wise, we are definitely capable. If the industry, we are expecting that it will go forward. So the disbursements, we know that we have to make a large number of disbursements, but yes, we are keeping the target. And we hope that from Q3 onwards, we will probably be able to do it.
Bandhan Bank, one of the other negative earnings reaction that took place after the results that were reported on Friday evening. Now, sources say that Axis Bank's unexpected spike in bad loans and provisions in the first quarter results was not entirely the result of the bank's own internal decisions. Ritu, who broke this story, is joining in with more exclusive details on this. Ritu.
Well, the surprising spike in bad loans, which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact, was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that this should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
Well, thanks so much for that, Ritu. That was the news flow on Axis Bank. But there is a CNBC-TV18 news break that was confirmed. Sona BLW will be entering China's EV market via joint venture with the Chinese company Genite Machinery. Vivek is here with more details. Vivek, congratulations on the news break.
Well, thank you so much for that. Well, last week we had intimated to our viewers about how Sona was entering the Chinese market. We understand that they were in talks with BYD. While Sona doesn't really name the companies that they supply components to, in all likelihood, this particular JV partnership is mainly to supply parts to the Chinese automotive OEM, which is an EV giant, that is BYD. Whole host of brokerage. Now, first, there's the JV where Sona will hold close to 60% stake. They are investing close to $12 billion in this particular JV. And what the JV will do will manufacture as well as supply driveline systems as well as components. Now, a whole host of brokerages have reacted to this particular development. Elara says this is a significant positive in terms of supporting valuations for Sona, which has derated quite significantly in the recent past. Investec says that the JV will provide exposure to the largest EV market and help tap Chinese OEMs. The JV with JNT will go ahead and over time reduce customer concentration risk. ICICI says that the stock has underperformed its peers over the past few quarters, currently trading at 32 times FY27 EPS. They expect the stock to bottom out and should start outperforming from here on. While JM Financial says that this particular JV represents a significant growth opportunity, the company would not have entered this venture without a strong anchor customer. In fact, JM Financial says that most likely this customer is likely to be BYD along the lines of what we had reported as well. Kotak Mahindra Bank, Kotak Institutional Equity, on the other hand, indicates that number one, while this helps Sona address a very large TAM, they are slightly conservative given the fact that they believe margins could get eroded on the fact that BYD could squeeze out its suppliers.
Interesting, Vivek. Congratulations for the news break and, of course, a confirmation of that from the announcement that Sona BLW made. The stock trading with gains in today's session. But moving on then, a new entrant on the bourses today. Anthem Biosciences listed at a premium of 28% to its issue price. We caught up with the management on the shift from China, on the China Plus One theme and the capex plans that they are planning for this year. Listening to what they had to say.
People feel anxious about putting more of their eggs in the Chinese basket. Up until now, they have actually been the major player in the contract research, development and manufacturing business. But we are now clearly seeing signs that people are saying, I do not want to put in my second project in the same place again, or alternatively, when they have a first project going in, they have anxiety about going into China because you don't know what the future holds. So we are getting many more inquiries, and clearly that's panning out. But it's not like flipping a switch that it will happen tomorrow. It is, as I said, even anyway, the gestation periods in our business are long, and we are in that phase where we are seeing a lot of inquiries which will, going again by past history, migrate into future business.
Yeah, we've been investing on capex across our entire Unit 2, Unit 3, and now we have started on the Unit 4 journey as well. Unit 4 is going to be a large project because from a size point of view, it will be as large as Unit 1 plus 2 plus 3 combined. Unit 4 could be in 2028 and 2029, and that's going to be a large capex for us.
Well, that was the management of Anthem Biosciences, a very strong debut for the counter. Take a short break, then we'll be right back. Stay tuned to CNBC TV 18. Don't go anywhere.
fully.
Welcome back. You're watching Business Lunch on CNBC-TV18. Now getting you some trade-related updates as the August 1st tariff deadline looms. Indian and US negotiators conclude their fifth round of trade talks in Washington, D.C. Both sides are yet to resolve issues around agriculture and automobiles, while a decision on an interim trade deal is also yet to be taken. Government sources tell CNBC-TV18 that the fifth round of talks saw discussions held on trade in special chemicals, organisms, materials, equipments and technologies. And as further talks are expected to continue with the US in the coming weeks, here is what Commerce Minister Piyush Goyal had to say.
There is absolutely no way we will compromise on the interests of our farmers, MSMEs, the interests of our workers. Our effort is to give them more opportunity, to give them more trade internationally along with their growing markets in India with growing incomes. Our effort is to make sure workers get better, higher skilled jobs. Our effort is to get investments and technology. Our effort is to focus on innovation, like we did with the EFTA countries, Switzerland, Norway, Liechtenstein and Iceland.
Commerce Minister Piyush Goyal there at an ASSOCHAM event. Now, the monsoon session of the Parliament got underway earlier today. Shivani is joining in now to tell us what is on the agenda over the next 32 days. Shivani.
Well, yes, the monsoon session of Parliament opened under the cloud of protest, with opposition members raising slogans in the Rajya Sabha demanding a debate on the Pahalgam terror attack, Operation Sindoor and foreign policy concerns following the US President Donald Trump's controversial ceasefire claims. But even as the political heat simmers, the government is steering its focus firmly towards legislation, with a packed agenda of 15 bills lined up for this session. At the top of the list is the Income Tax Bill 2025, which aims to replace the old Income Tax Act of 1961. It retains the core provisions but simplifies languages and removes obsolete sections from the existing bill. Introduced earlier in February, the bill is now under review by a select committee. In addition to this, 8 new bills will be introduced in this session, from the Manipur GST Amendment Bill and Taxation Laws Bill to the Jan Vishwas Bill promoting ease of business and significant sectoral reforms through the Mines and Minerals Bill, the Geo-Heritage Sites Bill and the National Sports Governance Bill, and also amendments to India's anti-doping law. The government will also move a resolution to extend precedence rule in Manipur and table the demand for grants for the state for FY26. So while the day began with disruptions, the session has a lot of things going on and a lot of things on the table. Back to you.
Well, thanks so much for that, Shivani. But ahead of the Parliament session, PM Modi also addressed the media. Let's listen into what he had to say.
मुझे विश्वास है कि हम सब मिलकर के डिफेंस के क्षेत्र में आत्मनिर्भर होने के इन प्रयासों को बल दें, सेना के सामर्थ्य की सराहना करें। और मैं आज देशवासियों के सामने जरूर कहूंगा और देश के राजनीतिक दलों से भी कहूंगा कि देश ने एकता की ताकत देखी है, एक स्वर का सामर्थ्य क्या होता है देखा है। तो सदन में से भी सभी माननीय सांसद उसको बल दें, उसको आगे बढ़ाएं।
Take a short break here on Business Lunch, but just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC TV18's all-new app, where you can get instant breaking news, in-depth articles, and financial world updates right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. Take a short break, back on the other side. Welcome back. Now, US President Donald Trump celebrated the 6-month mark of his second White House term by declaring that the United States has become the hottest and the most respected country in the world. Meanwhile, Trump sued the Wall Street Journal, seeking $10 billion in damages over the Epstein report. Take a look at this report from NBC's Yamishi Elsninder.
As President Trump eagerly touts his second-term success,
we achieved more in 6 months than almost any administration could accomplish in 8 years.
the ongoing firestorm over his administration's handling of the case of notorious sex offender Jeffrey Epstein dominating headlines, with both parties weighing in.
We should know what happened here. And it is a claim that this president has made time and time again, and the American people have the right to know what happened.
You got 1,000 children that were abused by this dirtbag, and yet the American public's all pointing the finger, trying to play politics with this thing.
This morning, the president defending himself, writing, "My poll numbers within the Republican Party and MAGA have gone up significantly since the Jeffrey Epstein hoax." But new polling from CBS shows the president's approval rating has broadly declined since February. That victory lap coming as many of the president's own supporters demand the Justice Department release more information on Epstein. Meanwhile, Epstein's former lawyer suggesting convicted Epstein associate Ghislaine Maxwell should be given immunity to testify before Congress.
She is the Rosetta Stone. She knows everything. She arranged every single trip with everybody.
Still, the president's celebrating a busy last 6 months.
And it's really promises made, promises kept.
Promises like extending the 2017 tax cuts, more immigration enforcement, and cutting the federal workforce. Still, the continuing Epstein controversy threatening to overshadow the president's future agenda.
Well, moving on then, travelers may soon have to pay a hefty new visa fees to enter the US. CNBC's Monica Petrelli gets us the latest updates on this front.
A part of the new One Big Beautiful Bill Act requires what is called a visa integrity fee. Now, we can see that this fee will be required of all non-immigrant visa holders. In fact, if you are applying for that, that would include people coming from India, China, and much of Latin America. It will be at least $250. This will be on top of other visas, and it may be reimbursable. That is, if you comply with the terms of your visa, like leaving on time. Now, what we don't know is when the fee will start, how it will be implemented, or when those reimbursements will begin. Now, the Congressional Budget Office is estimating that this could net the U.S. government around $29 billion, and that is because it does not foresee that reimbursements will begin for a few years, although sources that I'm hearing from are saying that the fees may begin as early as Q4 of this year. Now, the other word that we're getting from the Congressional Budget Office is that it expects many people won't even ask for the money back. That is because the money is only due when the visa expires, and since many visas are years long to the U.S., many people simply won't bother or won't remember to ask for their money back.
And with that, we call time on this edition of Business Lunch. We leave you with the Nifty still close to around 80 points higher. But from Amak, Shimi and the team that put this show together, thank you so much for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, Vivek Iyer. Good afternoon, Vivek. It's not Monday blues, but greens. We've come up from the highs, but nevertheless, it's a 75-point uptick, and we are above the 25,000 mark so far. That has been an important support.
Absolutely right. Good afternoon to you, Sonal, as well. All of the indices in the green, and that is something to start the week off on a positive note. We have a lot lined up on the show, so let's start off with the top headlines. Stocks bounce after early weakness as some better-than-expected earnings boosted sentiment. Financials and industrials lead the charge, while IT and energy drag. Mid-caps race ahead.
Mastech shares rally over 9% in trade despite a muted set of Q1 earnings. The company's 13.5% growth in profit and nearly 500 crore cash in books lifts investor sentiment.
Hats and Agro rallies nearly 10% after a strong first quarter, where gross margin expands to a multi-quarter high of over 32%.
A CNBC-TV18 news break is confirmed. Sona BLW enters the China EV market, signing a binding term sheet with Jianet Machinery Co. to set up a joint venture in China.
Contract research development and manufacturing firm Anthem Biosciences sees a strong debut on the street, listing at a premium of 28% to its issue price. The management tells CNBC-TV18 that they remain optimistic about the future outlook of the company.
Okay, all right, those are the top headlines. Mid-caps continue to be the focus point of the show. So this is our segment, Mid-Cap Movers. Hormaz is joining us to take us through the mid-caps that are moving around in trade. Hormaz.
Earnings reactions, it's an endless list, but we'll filter out some of them. And the only positive reaction as of now is coming in from Mastech. And that despite having a weak quarter, the stock is still up almost 8% as we speak. But negative reactions from AU Small Finance Bank, MRPL, both have recovered from the lows of the day. But Dodla Dairy has slumped to the lows now, 7.5% lower on that stock. Some of the other newsmakers in today's session at Bajaj Consumer just announced a share buyback, but the stock hasn't managed to sustain that initial spike. GPT Infra Projects just announced a 350 crore order win, as did Titagarh. The stock has recovered from the lows, and Nugent Software continues to get pummeled, 4.5% lower today as well, after a 6% drop on Friday and a 6% drop on Thursday as well. Metal stocks are doing fairly okay today. Nalco, Jindal Stainless, Lloyds Metals, all of them seeing gains of around 3.5 to 4%. Hindustan Copper, though, is up 2.5 as well, but the stock is in the F&O band today. Some of the stocks doing on the volume front, Tata Investment is up 5, MMTC is doing well today. Tanla Platforms, the record date for the buyback is this week, so 3% higher there, and UPL has surged to the highs of the day on very strong volumes. And lastly, stocks that are at a 52-week high in today's session. Asset managers continue to move higher. It was HDFC AMC last week, it's UTI AMC today. Paradeep Phosphates is up 10%, and Mangalore Chemicals too up 6%, and all of them at a 52-week high. Back to you guys.
Thank you so much, Hormaz, for highlighting all of the stocks that are moving as far as the broader end of the markets are concerned. Well, moving on, IREDA is on our radar. Our colleague Rachna caught up with Pradeep Kumar Das, the chairman and MD IREDA, to discuss their business outlook and asset quality picture post the Gensol engineering fiasco. Let's listen in to excerpts from that conversation.
Competition is coming quite a lot in the vanilla iris segment. Since the sector is matured, like us, bank, other NBFCs, they are feeling quite comfortable now to lend in that space. But that is the role IREDA need to play. IREDA being the sole arm of MNRE, which is having capability to understand the nuances of new and emerging area and handhold the industry from a nascent stage to a maturity stage in due course of time. Till such time, this kind of flip-flops happens. Provision going up, NP emerging, but in due course of time, those get sorted out. One example, if I'll share with you, that replies everything with respect to our provisioning and asset quality. In last 38 years, we have financed more than 1.62 lakh crores, and our asset quality is so robust, the cumulative write-off so far in 38 years is just 135 crore. So provisioning, NPA, just the kind of temporary phenomenon in the history of IREDA so far, and we believe we can sustain that kind of quality in time to come.
Okay. You mentioned Gensol. You've moved to DRT for the Gensol 729 crore fiasco that took place. How relative is this exposure to your loan book? And apart from that, you mentioned a similar risk that you saw in an Andhra PBI. Can you give us, can you quantify that also for us?
No, first, I did not say similar. It's quite different. Andhra was a PPA where the Andhra government decided to reprice the PPA, almost half of it. And what I was told that though they reduced to half, but still that did not pay also the half what they had reduced. So not only the total revenue got reduced, even the cash flow 50% what they had to get, that was not happening. Gensel is completely different. So far, as per the investigation is going on by the various agencies, including IREDA, preliminary report what we have received, that is purely the promoters' misgovernance, complete corporate governance lapses, and maybe the mismanagement of their greed and need that has resulted in such kind of thing. But otherwise, if you look at that, unlike this PPA designer of Andhra, in case of this Andhra project, what I said, which has become NPA now, it is a sectoral issue and a call given by the state government. Here it is not like that. There is absolutely no problem in the sector. The company was doing fantastic. We had lended them almost 3 years back, and many of our loans have been repaid in last 3 years, and some of the loans also have been repaid in last 2 years. So typically we lended for 5 years. Normally it's the e-car loans. And since, as per our assessment and what market indicates also, fair amount of good opportunities there in that sector, that space. And not only DRT, we have also gone to NCLT. See, I want to emphasize one point. We are the first agency who could approach to NCLT and get the application admitted, get the IRP appointed. The IRP has already done the COC meeting. Hopefully by today, this COC should get meeting minutized, and IRP may get approval to become IRP. They have already started the principal working. See, this kind of thing is not quite well known in India, since e-mobility is new and emerging. And we do not have such kind of bad assets example in India. So therefore, any IRP or RP, whoever comes to take it, they will take some time. But since this business is not that complicated, running a car is not that difficult, unlike running a thermal project or XYZ project. So therefore, we are confident it is just a question of months. And as the initial indication they have given, so they are trying to bring back those cars on the road. And once it's happening, then the provisioning what we have made, we may not have to require to continue that also.
Right. You recently had a 5,000 crore rupee QIP. How are those funds being allocated?
We did not have 5,000 crore. We had 2,000 crore. Okay. So the approval from Government of India was 5% of post-issue dilution. 3.26% has been diluted, and 2,005 crore we have already raised. And it was raised at the rate of 164, 165, something like that. And despite the market is not doing well, and despite having this Gensel fiasco, which you said, and we could successfully complete our QIP tranche 1 and balance 3.76%, which is available to us for further dilution by raising fresh funds through QIP tranche 2. We are in the pipeline, and we'll be waiting for the right time, not only market condition, our requirement also. Hopefully we'll be successful in that also, and that may add around 3,000. The 5,000 figure what you said, then it will become 5,000. Yeah.
What's the priority for this fund allocation? Are you looking to scale up in particular sectors? Are you shifting towards a specificity of EV hydrogen?
We are only in one sector, that is RE, and we are king in that. We are founder of that, I should say. Many times we call ourselves that we are mother organization as far as RE financing in the country. So any equity infusion or any debt additions and all, we'll be spending in RE only. And coming back to the composition, what I understand that you are asking the asset mix. Since the trend 2-3 years is going on like that, 50-51% is coming from traditional RE, that we need to continue in the same manner. The reason is, in vanilla RE, you have fair amount of de-risked assets. And government loans, you have completely de-risked assets so far, unless the government becomes something like the way some state government decided something. But 76% are vanilla or risk-free assets so far, what we have maintained. And same kind of trend is going to be continued. 21-22% is completely new and emerging. That we also need to continue, because there only we get fair amount of good spread and NIM, which averages out. And if you see 3.7, 3.667 NIM, still we are having, despite all the competition from the new RBL financer in the country, despite the competitive market. And typically in RE assets, till the construction period, the risk is there. Post commissioning, and once the COD happens and 1 year of trial run happens, by that time it is fairly de-risked, then many lenders are there.
All right, those are some of the comments coming in from IREDA. With that, we'll slip into a short break. Ruchit Jain of Motilal Oswal will join us on the other side for a technical check. Welcome back. You're still tuned into Midcap Radar on CNBC TV18. It's a good time to get a technical check on the markets. Ruchit Jain from Motilal Oswal Financial Services is just joining in now. For the markets, continues to be in the green, but yes, some heavyweights which are putting pressure on the gains that we have been seeing. Ruchit, good afternoon. Thank you so much for joining in. What explains the next levels that we'll be watching out for in terms of the technical aspects, and what is your individual technical pick?
Yeah, hi, very good afternoon. Well, it seems that the markets are going through some time-wise corrective phase since last 10-15 days, where the index is traded within a range while there have been more of a stock-specific momentum in the markets. Now, 25,000 to 24,000 is a very important support, being the 40-day exponential moving average for the index. And if this remains intact, we expect the sideways consolidation to continue for time being. I think there would be more of a sector rotations in the short term rather than indices showing any kind of directional move on the either side. So one space that is looking quite positive from current level, we would see the banking and the NBFC space, We have seen that selective large cap banking stocks are leading this move, and ICICI Bank within that space is one of the top pick, where last 1 or 1.5 months some time-wise correction was there. The stock did not break any important support, and post numbers we have seen a resumption of the uptrend over there. So I think ICICI Bank, the risk-reward ratio is favorable post the recent consolidation. So short-term traders can still buy with stop below 1425. We expect upside targets around 1520. And among stock-specific moves, I think UPL is one stock that we are recommending to go long on, since we can see that in spite of market showing some consolidation, or many of the stocks from the broader market showing some corrective phase, this is one stock which has given a breakout and it's trading around its 52-week high, that too supported by very good volumes. So it has already been a relative outperformer if you look at last 6 months move. So I think this trend is likely to continue going ahead. So UPL we are recommending to buy with stop loss below 690 for potential near-term targets around 745.
Thank you so much, Ruchir, for joining us. So ICICI Bank and UPL are the two stocks on your radar that you like as far as technical recommendation is concerned. Well, as you saw on the bottom of your screen, Mahindra Logistics just delivered their Q1 results. On a bottom line basis, it's a loss, but the core EBITDA has managed to jump up close to 18%. That stock now near the 400 rupee mark, down almost 3% in the session. With that, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, even as we stand by for some important results, Ultratech Cement is expected to deliver its results, and we expect the results will come sometime in the next couple of minutes. But Sonal, you've been tracking MRPL, that particular stock, under a bit of pressure today.
Oh, yes. It's a big miss that we saw on MRPL this time around. The stock is down 7% as we speak. It was a revenue decline of 29% that came by. EBITDA was down 84% to come in at 180 crore rupees. Margins almost, actually more than halved on a quarter-on-quarter basis. Actually, we'll talk about MRPL in just a bit. Ultratech's numbers, they are flashing at the bottom of your screen. Net profit has come in at 2,226 crore rupees, which compares with a poll of 2,290 crore rupees. Largely in line, you have to say. It's a 70 crore difference that you're seeing right now. In terms of revenues, that too is a 400 crore rupee miss that we are seeing there. So it has come in at 21,200 crore rupees versus an expectation of 21,680 crore rupees. Yeah, 21,275 crore rupees. That is the revenue number. The expectation is that margins will be higher at 20.7%. We'll take a look at the margin number, calculate that EBITDA. Okay, so the EBITDA number is at 4,410 crore rupees. That is what being flashed right now. That compares with an expectation of 4,480 crore rupees. So that also looks largely in line. That would also suggest that the revenues lower than expectations, EBITDA largely in line with expectations. That would suggest that the margins would be better as well. But quickly, let's take a look at, okay, the margins are absolutely in line actually, 20.7% versus an expectation of 20.7%. In fact, we do have Nigel with us right here in the studio.
Yeah.
Nigel, what's your take?
Well, the top line miss, I think, is because the volume growth is a little bit lower. I'm looking at it, the volume growth that they've said is coming higher by 9.7%. The street actually was expecting a double-digit number on that front. So that's one important parameter to look at, that, the volume growth actually appears it's a little bit lower, though we have to keep in mind the acquisitions of India Cement and the cement business of growing with the acquisitions. Yeah, so including both of them, actually the volume growth is at around 9%. But as you said, I think the profitability, Sonal, is in line with what we were working with. So that's heartening to hear. Power and fuel costs, that's dipped. Just take a look at power and fuel cost as a standalone, as an line item. That's seen a dip both on a sequential as well as on a year-on-year basis. So despite the miss on the top line, a bit of a miss on the top line, we have the margins actually that have caught up because input costs, they have been constantly talking about how they are focused on reducing the input costs. And on a sequential basis, that's actually seen a bit of a dip on that front as well. So the consolidated number should come up for you on the screen. Even the standalone number actually is a little bit lower. The freight and forwarding cost as well on a sequential basis has seen a bit of a dip. Let's get in Prakash Diman. And, I'll have a closer look at these numbers. But it appears these numbers go down, I think, as of now, a mixed bag. Some softness actually on the top line. But I think that's because of relatively lower volumes. Prakash, what do you make of these numbers? The revenue number actually is coming a little bit lower. Your take?
So I guess, there's lots that's happening in terms of assimilation with the acquired businesses that Ultratech is into. And remember, they've just got done with digesting the other acquisitions of the past. So, I think on a standalone basis, they'll probably be re-strategizing in terms of what parts of the new, aggregated business to focus on. But I think, Nigel, if you don't squibble about the volume, and this has happened after we saw JK Cement come up with some stellar volume, metrics. And that's why this is probably looking a bit weak, but it's better than, the era which we just recently saw 6 and 8% and all that. So from that, I think there's definitely an improvement and sets the base for the company to springboard from here on into probably early teens or something in terms of volume growth and a consolidated basis. So I'm kind of okay with it. I know the market has high expectations from this name, but I find the numbers to be fairly in line. At least they managed to do the profit numbers in place because of the efficiencies on costs and all. So that's a heartening thing.
Yeah, that's right. Prakash, so you would be a buyer into this dip?
Yes, so I think if people are looking at allocating, some of these bigger names are the ones to be with, given how they will be the first of the races in terms of the sector re-rating and the entire shift in terms of utilities and all that. But, then it's up for the choice between the top 3, top 4 names. But Ultratech definitely gives you all the checks, most of the boxes that you would need for a long-term allocation to the sector.
Okay, all right. Prakash, got that. So I think these numbers on the top line is a little bit soft, which is the reason why we're seeing a bit of a dip. I think they've given actually the presentation as well has just come up, so I'll just try to pull out a few details on that front. The EBITDA per ton number, they're saying that it's higher by around, at around 1,248. This, as per their calculation, it's higher by around 337 rupees on a per ton basis. So that's an important number that should come in at. And they've also mentioned actually the Q1 numbers has been restated for Kesoram. So that's it's included actually in the base here. which is an important clarification as well that they're giving. So that's why, in fact, you have the volume growth at close to around 10%. Otherwise, it would have been higher if it wasn't included. So they've restated the numbers for Kesoram, which is an important factor. So I think we should get the volume number up for it. And the India Cements acquisition, well, that is included as well. So I think these numbers are actually par for the course, a bit of a mixed number with regard to the top line miss and the EBITDA number a little bit better. But we have Jyoti Gupta of Nirmal Bang Institutional Equities who joins us. Jyoti, what do you make of these numbers? You could quibble at that, but when the EBITDA number comes in more or less in line, a little bit better, you'll have to say that these numbers are pretty okay.
Yeah, I mean, see, I anticipated, so if you look at my preview numbers, I had taken a console level of 9.6% YOY, and if you take India Cements number, then goes to 18.7%. My beta is slightly higher by, to 1248. And why these numbers are slight disappointment? Because of the Orissa market, where, the overall market has declined almost like 12% in FY25, and quarter one was again a washout by almost like a decline of 18%. So I think Ultratech has, a share there. They do sell a decent amount in, so it has an impact on Ultratech's volume on the overall numbers. So I quite well anticipated, so not surprised, but yeah, going forward, the numbers should be in line with what I'm expecting.
Okay, all right. So you're pretty satisfied with these numbers, Jyoti. Thanks a lot for joining and giving us that quick comment. So guys, just to clarify, the volume growth is around 9.7%. Jefferies for one, they had put out a note, but they said that, if Kesoram is not in the base year, then the volume growth will be 16%. But if it's in the base year, they're working with 11%. It's come at around 10%, so you don't really have to quibble on that. And they're clearly focusing on the operating performance. So that's why, in fact, we have, we have the EBITDA number more or less in line. I think we should remove that flash which states that it's at 9.7%. That compares with mid-teens, because now Kesoram has been included in the base year. So we'll just keep it at the volume growth at around 9.7%. Very, very low in comparison to a Jefferies estimate, which was at around 11%. Okay numbers.
Got that point, and that explains the recovery. After the stock fell, it recovered as well after the clarification that we got on volume growth. Thank you so much, Nigel, for joining in, and thank you to the guests as well for analyzing those numbers for us. With that, we'll take your leave on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Now, a quick look at what the market is doing, right? Market is managing to hold on to the gains that we've seen coming in. As of now, Nifty is just holding on to that 25,000 mark of the day's highest point, but nonetheless, 0.1% of gain is what the Nifty is managing to hold on to. Nifty Bank, that's what's pulling up the market, right? So ICICI Bank, HDFC Bank, Kotak Bank, all these private banks are managing to hold on to gains and overall supporting the markets in terms of its up move in today's trading session. Now, let's not forget that what you're looking out for right now is in terms of the mid and small cap. That also is managing to do decently well in today's trading session. You know, not much in terms of an outperformance there, but at least largely the mid cap is doing better than the Nifty. But the small cap, that's a bit of an underperformance. So yes, advance decline ratio as of now is almost equal, slightly bit more in the favor of declines versus advances is the current situation as of now. But yes, that's what the market setup is looking like so far. We'll watch out for the next half of the trading session as well. In the next couple of hours, what's going to be happening to the markets will be key to watch out for. But this is a show where we solve all your stock-related queries, and to do just that, we have Ashish Kyal, market technician and author of Wave Strategy Advisors, as well as independent market expert Shaina Mukaddam joining in with us to answer all your stock-related queries. So Shaina as well as Ashish, good afternoon and thank you so much for joining in with us. Let me get started with those stock-related queries coming in, and this first query for today is coming from Sundar Rawat, who is writing to us from New Delhi. Now he is holding 150 shares of BSE. But before I, come to that query, I think we have some important flashes coming in. Now, IndusInd Bank is saying to CNBC-TV18 that they are firmly denying reports of RBI asking to expand CEO search. Now, that's the latest update. Right now, we're seeing IndusInd Bank that is down in trade as well. So this is the latest update that we have coming in here. Keep an eye out on this one. They're firmly denying reports of RBI asking to expand the CEO search. The appointment of the new MD and CEO, including seeking relevant approvals, is still in the process. So keep an eye out on that. The process is still on, is what IndusInd Bank has told so far in terms of the word that is coming to CNBC TV18. So that will be important to watch out for. The bank will continue to make necessary disclosures as required under the law at an appropriate stage. Important updates coming in there from IndusInd Bank. Keep an eye out on this one. As of now, the stock has seen a mild uptick from the day's lowest point. Bit of an uptick furthermore in the last few minutes as well is what we could watch out for right now. But yes, that's IndusInd Bank that we'll be keeping an eye out on as well. But let's get started with those queries then. So I was talking about the first query for today that's coming from Sundar Rawat, who's writing to us from New Delhi. He's holding 150 shares of BSE. The average price is 791 rupees per share. Long-term story, how does the stock still look for this one? Shaina, BSE, these names have done very well, the capital market names, and specifically BSE as well. What are we watching out for furthermore? Should they continue to hold this for the long term or maybe book out some bit of a profit?
Well, see, I've also been holding it for a very long time. And while I have booked part profits, so I don't say that, I don't say that you shouldn't at any point in time, but I would continue holding a lot of the portion for the longer term. Couple of issues, the recent one being that Jain Securities has been allowed to again, trade on the markets. Basically, there was a halt put on them by SEBI. But now that they have deposited the escrow amount, I believe from today they have been given permission to restart operations. We'll have to see how that goes in the longer term. They will have to be, the investigation will still be on, so we'll have to see. Other than that, on fundamental basis, you have NSDL, you have NSE. These are the issues that will be traded on only BSE, at least for some time post-listing. So I think to that extent, those are the positives. Valuation, shorter term, very short term, yeah, it may look a bit expensive. But if you look at the longer term, like, 1 year down the line, it's about 25 times P. I don't think that's too expensive. So I would say continue to hold. If you need some money or if you want to book some short-term profits, you can, but otherwise you can hold for the longer term.
Okay, you can continue to hold for the longer term coming in for BSE. That's the view on the fundamental front. Ashish, your view for BSE as well. Is it similar? Should the viewer continue to hold it?
First of all, I would like to congratulate the viewer because he's holding from 791. It's not very often we see the retail participants holding the stock all the way for a multi-bagger kind of a thing. It's nearly 3 times from there. And as of now, there are no signs of the reversal in the medium to long-term trend. So there is short-term correction that we saw from 3,000 levels. The stock made a low of around 2,400, but I think that's temporary. And the overall outlook still remain bullish. My suggestion would be continue to hold. There is no time to worry here, and we can expect the stock to reach towards the level of 3,200 again on the upside. On the downside, one can maintain a stop loss, which is going to be around 2,200 levels. So the undertone is still a buy on dips for the stock.
Okay, buy on dip still for the stock as well. So interesting strategy there. Continue to hold for the long term. That's a view for BSE overall. Let's move on to the next query for today. Sandeep is writing to us from Pune. He's holding 300 shares of Bajaj Housing Finance, and this is at a price of 182 rupees per share, and 25 shares of Trent, and this is at a price of 6,700 rupees per share. So overall for this one right now, in both the stocks, they're making some bit of a loss. Wants to know the long-term strategy that comes into play for Bajaj Housing Finance as well as for Trent. Shaina, your view, Trent and Bajaj Housing Finance, what should they be doing now? And Trent is one of those names, where they bought it at those higher levels. Normally, you've seen people make a lot of profit on Trent already over the last few years. So now what should they do?
Yeah, unfortunately, both these stocks are good quality stocks, but the valuations are very high. So if you look at Bajaj Housing Finance, for example, it is 5 times price to book, which is much more expensive than the rest in the category. Similar story for Trent. What I would say is that while both these stocks are doing well, Bajaj Housing in terms of growth, they are showing 25% growth. 2 days down the line, they are the results for the first quarter. I think the 25% growth is likely to sustain because they have raised funds and this will fuel their growth. But at the same time, I would say that it's better to switch. There are cheaper stocks available in the housing finance of equally good quality. Trent also similar story. The Zudio is impacting their margins. Valuations are a bit high. So if you want to add or average, better to average it at least 10% lower from current levels. Or, if you're holding for the long term, then yeah, these two stocks, you can continue to hold. But I would suggest a switch from both if you're looking at shorter to medium term.
Okay, that's a view there, but on the fundamentals. But Ashish, Trent for you as well, and Bajaj Housing Finance also, anything that you are looking at over there right now? I know not much there, but what is your view?
Exactly, because if you look at Bajaj Housing Finance, I think the stock has just moved in a range of 128, 129 levels on the upside. And on the downside, the lower end of the range is around 116. That's a very narrow range within which it has been moving since, I think, nearly May onwards. And as of now, there is no directional move. So my suggestion would be continue to hold as of now, keeping 116 as a stop loss on the downside for Bajaj Housing Finance. And in case the stocks manages to break that level of around 128, 129, we can expect a good upside move from there on. For now, there is no, it's a no trading zone from investment. Continue to hold for now with the stop loss given. And as far as Trent is concerned, we saw a very big gap down on 4th of July, post which the stock is consolidating. The time horizon has to be extended at least for more than a year if you want any kind of a positive outlook on this stock. And we can expect a range bound movement between 5,800 and 5,200 levels. So that's the range within which I think the stock can move. As of now, continue to hold, maintain a stop loss of 5,200. If the stock breaks that level, then better to be exit from here.
Okay, that's a view coming in there for Trent and Bajaj Housing Finance. Let's move on to the next query for today. We have Abhishek who's writing to us from Kolhapur. He is holding 108 shares of Dreamfolks. It's at a price of 234 rupees per share. Wants to know whether he should continue to hold this one or exit the stock. Dreamfolks, your view coming in for this one, Shaina. Obviously, we've seen those recent issues that came in for the company as well. And in the last 1 month itself, the stock is down 32%. What should the viewer do?
Yeah, unfortunately, even after the sharp correction, I would still say fundamentally it's better to exit. Look for some other story. Basically, they are facing increased competition from Adani itself, Adani on the airports, and that is their major bread and butter. And they have lost some of their key clients starting from July. Some like I believe ICICI Bank, Axis Bank. So and there is like a pressure on their margins. So, it's better to switch.
Okay, you would say a switch. And Dream folks, on the technical front, Ashish, for you as well?
Very similar view, because the stock started correcting from 300 levels in the month of May. It's already 150 to 50% cut in just 2 or less than 3 months of time. It's not a very, very good sign. So it's best to be out from here. It is already breaking the prior day and prior week's low also in today's session. So best to be out from here and look out for alternatives, possibly in the space of maybe something in an automobile or a banking space, something like an ICICI Bank, and from automobile sector, maybe Mahindra and Mahindra. It's better to be diversifying into that space.
Okay, that's a view coming in there for Dream folks on the fundamentals and technical front. But IndusInd Bank, like I was talking about that one as well. Now, IndusInd Bank, in a response to CNBC-TV18, has denied reports of expanding its CEO search. Ritu is joining in with us to give us more details on this one. Ritu, after we actually flashed this on the screens, we've seen a bit of a spike up that came in for the stock as well from the day's lowest point. What does this mean? What is it entailing? And what is the clarification we have gotten here now?
Well, Winnie, in summary, IndusInd Bank is really reiterating that the CEO selection process remains on track. There were some concerns this morning because there were certain reports that had suggested that the RBI had asked IndusInd Bank's board to expand the CEO search because there was some concern or some hesitation on the part of some of the so-called shortlisted candidates in taking up the assignment, and therefore RBI had, according to this report, asked the board to also look at additional candidates, including public sector bankers and even bankers of Indian origin who are working abroad. However, IndusInd Bank has now come out in a clear, statement to us where it has said these reports are false and they're speculative. It has said that the appointment of a new MD and CEO, including seeking the relevant approvals, indicating approvals from RBI, remains in process, and the bank will make, disclosures at an appropriate stage. Keep in mind, in the last week of June, that is when the RBI given deadline for the bank to submit CEO names really was. That is when we were the first to report that there were 3 names that had been submitted to the Reserve Bank of India, including Rajiv Anand from Axis Bank, Rahul Shukla from HDFC Bank, and Anup Saha of Bajaj Finance. We've been given to understand these 3 names which were submitted by the board remain under RBI's consideration, and the approval on one of these candidates is expected in the coming few weeks. Remember, we had also reported that the RBI is going to expedite the CEO name approval process simply because of the unique situation that IndusInd Bank currently is in, where it doesn't really have a CEO. The deputy CEO also resigned along with Suman Katpalia, and the bank is currently being run by a committee which is being guided by the board in turn. So RBI also wants to expedite, the appointment of a new CEO, and these 3 names remain under consideration, with IndusInd Bank really saying that reports saying otherwise are false.
Okay, Ritu, thank you so much for that update coming in here. That's a word coming in from IndusInd Bank to CNBC-TV18, and obviously the appointment of MD and CEO, the process is still on. There's nothing of an issue on that front coming in there. So you'll wait out for more details coming in on that front. But on that note, we're going to slip into a very short break. We'll come back with more queries on the other side. Welcome back to Your Stocks and CNBC TV18. Let's keep it going with all your stock-related queries, and we still have our experts Ashish Gyal as well as Shaina Mukaddam. Let's move on to the next query for today. We have Girish Kumar, who's writing to us from Dubai. He's holding 100 shares of MRF, and this is at a price of 1,07,915 rupees per share. So he wants to know the outlook for the stock. Should he continue to hold or exit? MRF, what's your view coming in on this one, Shaina?
Yeah, he should continue to hold in my view, because we've seen the sharp correction in rubber prices in the last 3 months. In line with that, of course, the price of MRF has also started moving up. But I believe that the balance sheet is very strong. Valuation's not too expensive. EV by EBITDA 10 times FY27, price to book about 2 times. So he can continue to hold even at current levels.
Continue to hold even at current levels. That's over there. And Ashish, your view coming in for MRF?
See, it's not very often we get a question on MRF.
Yeah.
The stock is trading at around 1,48,000 levels, no split even now. So the overall trend for the stock still remains positive. I think there is a possibility the entire auto ancillary and the tire space, I think, is doing very well. If you look at C8, if you look at MRF, if you look at other stocks also, I think MRF has continued to outperform. We can expect the stock to reach towards the level of around 1,65,000 also on the upside. And on the downside, the support for the stock is going to be around 1,40,000. So hold on over here. The medium to long-term outlook remains strong. And I think the auto sales will also start picking up eventually, given the lower interest rate scenario, which will also help the auto ancillary stocks to outperform from here on.
Okay. That's a word coming in there for MRF. Let's move on to the next query for today. Unicommerce. That's the next stock we'll talk about. Sumit Ghosh is writing to us from Noida. He's holding 500 shares of Unicommerce e-Solutions. Price is 210 rupees, making a loss on this one. Wants to know if he should continue to hold or just book his losses and get out of the stock. Shaina, what's your view coming in for Unicommerce? Because I don't think, like, in terms of overall returns also, it's managed to give anything to investors since its listing. Post that we've seen those ups and downs, and more of downs that has actually come in for the stock since listing.
Yeah, you're right, Vinny. Actually, but now it has been consolidating after having given up most of its, listing gains. But if you see, I think this is a concept stock. Though even while valuations even today are expensive, the space in which it's operating, I think that potential is huge. They're SaaS platform for e-commerce companies, and there I believe the opportunity is large. It's a small cap company, just about 1,350 crores type of market cap. So these type of companies, I would say you should continue to hold for the long term.
Okay, continue to hold for the long term. And also, Shaina, would you say that averaging makes sense right now? Because the price is much lower than what they bought it at. Right now, it's just at 127. They bought it at 210. Then would averaging be a good bet?
Yeah, if you have a long-term perspective, I would say averaging would make sense. But then you really have to hold it for the long term.
Okay, then you have to be committed to holding it for the long term there if you just start averaging out. But Ashish, your view coming in on the stock as well. What should the viewer do now?
See, the stock corrected from the levels of 250, made a low of 100, and it has been consolidating in a zone. On the downside, the support for the stock is around 117. And on the upside, it has failed to break above that 145 mark. So that's the range within which it is consolidating. But yes, the downside momentum has reduced. I think eventually the stock should reverse back on the upside. And one can average it here, maintain a stop loss of 117 if you are looking at from a short-term support perspective. And above that level of 145, if the stock manages to break, we can expect a good upside momentum towards 175 levels. So trade on the basis of these levels.
Okay. Keep an eye out on those levels over there for Unicommerce. But let's move on to the next query for today. Dhruv is writing to us from Ahmedabad. He wants to know the long-term view for 3 to 5 years. This is long-term what he's talking about for DAM Capital. Should he look at making an investment here? Shaina, your view?
I think he should wait for 2 days. Wednesday is the results for the Q1. Actually, what has happened is that if you see 2 years, not much history in terms of financials that we have.
Yeah.
Still, if you see 2 years, there was a good growth, good numbers. But post the listing, which is recent listing, actually first quarter numbers of March were very disappointing. So I think you better wait, see what the management commentary is, and then look to invest. So wait for now.
Wait for now is the word coming in there. And Ashish, your view, I know there's not much history in terms of charts or anything, but what was your suggestion? Because it's a long-term investment query.
See, if you look at the charts, I think the stock is failed to move on the upside. It's breaking the previous low made in the month of on 19th of June. Also, it's just about to break that. It's better to be out from the stock here, and maybe something like an AB Capital looks much more promising, given that the stock has a good history, has shown a very strong rise as well, and an impulsive move on the upside. So I would suggest to be out from DAM Capital, park somewhere, something like an AB Capital. That makes more sense.
Okay, that would make more sense for you right now. That's a word coming in on the technical front. But that was the last query for today. So Ashish as well as Shaina, thank you so much for joining in with us as always, helping our viewers solve all their stock-related queries. And viewers, as we're going to wind down this edition, you have the numbers of IDBI Bank that are flashing at the bottom of your screens. So wait out for there. That seems like NI is down 2%. Net profits has seen a bit of an increase. We'll wait out for the asset quality. What's that on that front? Will be coming in closing bell, which is up next to take you through the last hour of trade, so don't go anywhere.
Beyond market headlines, to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
So while we're seeing Taiwan index that's down 0.3%, we're seeing Hang Seng that's trading with an uptick of around 0.5%.
Which had raised some red flags about Axis Bank's asset classification practices.
56,000 odd levels, 56,000, 56,030 or so.
Investec says that the JV with JNT will provide exposure to the largest EV market.
24,986, 24,970 opening up this morning.
Equity predictability is always low, not just on a one-year basis, but sometimes even on a 5-year basis.
The tariff uncertainties have also caused trade flows to get diverted.
Also decided to increase our secured book mix.
कि राजनीतिक दलों से भी कहूंगा कि देश ने एकता की ताकत देखी है.
100-point uptick on the Nifty is what we are witnessing right now.
All of the indices in the green, and that is something to start the week off on a positive note.
Well, that is the day so far, and the last hour coming up here on the show. We are coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleagues Surabhi, Reema here in the studios. Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, good afternoon, folks. And it's not looking bad at all, right? I mean, at one point in time, the Nifty had given up 24,900 as well. So it's a nice 150-point recovery from the lowest levels of the day. And we've got some green.
We have some green, definitely. Surabhi, before we take it any further, let me just quickly run our viewers through the top 5 or 6 names which are coming up here on the program. And then we'll sort of talk a little bit of markets before we get our guests in, right? So this is what you will hear about. We'll talk about CET. There is a downgrade, and we'll address that with Sudarshan in just a bit from now. Results came, I think, on Friday, but the cut is coming in today. The big move is coming today. Banking stocks are in focus after a slew of earnings over the weekend. HDFC, ICICI are up about 1.5% to 2.5% in that range, while the smaller financials like AU Small Finance Bank, L&T Finance are also reacting. So Gaurav will help us with that as we go along. Refiners, Nigel is putting the spotlight on MRPL and Chennai Petro, both in focus as global refining capacity tightens. I mean, is there a bit of a move here which could develop? Ultratech reported numbers about 30 minutes back, and we'll get some more details. They seem to be bang in line with consensus expectations. We'll have more on that. We, of course, also take a look at some earnings expected later. Eternal will report today. Ultratech is already out of the way, and I think we've got 1 or 2 more, but that's largely the stack up as far as earnings previews are concerned. So that's the lineup. Now, the market is barely holding above the previous low, which is 25,000. I mean, of course, we've broken that and we've sort of gone below it. The last low was 25,001. We are trading around there. I mean, is there absolute clarity that this is it and the market perhaps starts to do better and better? I think that we don't have yet. The other big talking point, which may one fine morning you'll come in and you'll have something about the India-US trade deal. So that very much is perhaps on the table as well as a interesting and important possibility if it were to happen, which is about 2 weeks to go to the 1st of August deadline. Otherwise, I mean, it's all about single stocks. It's all about specific earnings with some buzz, with some chatter, which we will cover with Nimesh in a bit from now. Reema.
Well, on the way up, it's the 2 banking heavyweights. So ICICI Bank, HDFC Bank are gaining. Eternal is your top Nifty gainer ahead of numbers. So that's up about 3.25%. So your top 3 Nifty gainers today, leading is Eternal, followed by an ICICI Bank and an HDFC Bank. So that's on the positive side. But on the flip side, what's counterbalancing this is the weakness in Reliance Industries. Reliance Industries had hit a fresh 52-week high earlier this month. On 9th of July, the high on Reliance Industries was 1,551. And from there, we've seen the stock correct close to about 8%. Well, the numbers were fine, but as analysts pointed out, in the last 3 months, the stock had gained close to about 20-25%. So a lot of optimism was built into the price, and therefore it's retracing a bit. So Reliance is weak, IT is on the back foot. You've got cuts in Wipro, HCL Tech, TCS, and then 2 of the FMCG giants, HUL and ITC, are in the red. Not by a whole lot, but it's a red tick.
That's right. I mean, we don't have too much of the large FMCG names supporting the screen today. And the other thing is that, yes, while there was a recovery from the early morning opening lows, the market has not been able to really push through or build on any kind of momentum in a meaningful way. Having said that, let's not forget there are still plenty of gainers out there. The mid-cap index is outperforming the large-cap screen. And we'll talk about that as we go forward. Stocks like L&T Finance, stocks like Hudson Agros. Many of these are actually result reactions. And look at Tilak Nagar Industries, up 10%. What a move for Monday, Nigel. Tilak Nagar.
Well, indeed, should be a big move out there. But, you know, the price action today is encouraging that we have recovered from the lows of the day, but the markets are not out of the woods. You'll get greater confidence if you can make a higher high. So if you can get, 100-point rally from here on before the time we wind up, 25,150 is the important level we'll be looking at. Let's see whether or not, for the time being, it's pretty okay on the Nifty. On the Nifty Bank, it's encouraging because it protected the 50 DMA. And as we speak, we're pat at around the 20 DMA as well. Let's get in Mitesh Thakkar back on the show. Mitesh, price action, well, was pretty okay on the Nifty. The Nifty Bank, though, that's encouraging. Comment on both these two?
I spoke about this in the morning that you kind of have managed to hold on to 24,900, bounce back from there. So maybe will not decline much. And the reason is Nifty Bank, as you rightly pointed out. The Bank Nifty has managed to bounce back very strongly with ICICI Bank and to a certain extent HDFC Bank, contributing on the upside. For the Nifty, the counters are same 24,900 and then 220 to about 25,250. But what could be interesting is the Bank Nifty. Bank Nifty, if it sustains about 56,700, 600 zones, then you might see some more upside to about 57,200 to about 57,250 zones. So I think there's mild upside left in the Bank Nifty, and ICICI Bank would be interesting over here. I, in fact, have that as a trading recommendation, just trying to get past the earlier highs of 1462, 1465. So I would say if it starts closing about 1470 today, buy with a stop at about 1455, 54, and look for a 300 plus kind of a target over there to begin with. And that about, I think, the cement stocks have very well to me. And we had Dalmia Bharat earlier in the day. Ramco Cement has given a pullback. So Ramco Cement is something which I would want to have a look at. Try to buy with a stop below levels of 1135, look for targets of 1185.
Okay, ICICI Bank and Ramco Cement. All right. Let's talk about CEAT. Mitesh, do stay on. Sudarshan is now joining in. So CEAT is under pressure because Nomura has downgraded the stock. So what is it that they didn't like? Sudarshan joins in with the details.
So ahead of its earnings on July 17th, company had given, the stock basically had given returns of almost 30% in last 3 months. But after the earnings, there has been a sharp fall in the stock, and now it's down almost 10% in last 2 sessions. So why, and if you talk about the earnings of Q1, so earnings were largely lower than expectations. Gross margin had seen a sharp decline. It was down 250 basis points year on year, and even down 70 basis points on a sequential basis. And that was mainly because an increase in input cost against management's expectation was of flat input cost on a sequential basis. Now, Nomura has come out with a note today. It has downgraded the stock to neutral from buy, and target price is cut to 3,906 from 3,945 per share. Now, what's the reasons behind the downgrade? First, Nomura believes that Camso value accretion may be lower than its expectations. Why it is so? Because it's saying that Camso was acquired with a revenue of $213 million in 2023, but with a sharp drop in the revenue, it believes that EV EBITDA of 10x might be expensive. Second, US has imposed tariff that would be effective August 1 on Sri Lanka, and the tariff rate is 30%. What it will do, it will delay the Camso's recovery. That will have an impact on CEAT's revenue. Second, input cost concerns. As I've told you that management was expecting that input cost might be largely flat on a sequential basis in Q1, but it has increased. Now, Nomura is saying that if recent rise in input cost sustains, it might have an impact on CEAT's earnings, and that's the reason it has decreased in EBITDA estimates by 9% for FY26 and 5% for FY27. Also, it has cut EPS estimates by 16% and 6% for FY26 and 27 respectively. As far as the valuations are concerned, it's currently trading at 7.8 times FY27 EV to EBITDA, and Nomura finds that it's a fair value, and that's the reason it has downgraded the stock.
Sud, thank you very much for that. So that is CEAT for you. Mitesh, technically, what's the price action telling you?
The last few weeks, tire stocks have gained, but today I think there is a negative breakdown on the charts of CEAT. It made a low of 3,500, closing low of 3,500 in June, 23rd of June. and then rallied from there and has come back to that level today. We got a low of 35.24. So this 3,500 is a good pivot for the stock, but if it breaks that and there's a chance of that on a closing basis, I think I would expect another 200 points on the downside.
Okay, that's CEAT definitely under pressure and cooling off very, very rapidly after a equally sharp build-up. 2,400 in March when all the tariff mayhem was playing out, just around that time. And since then rallied very sharply. Anyway, now let's talk about financials because that's been the other big headline of the day. And it's very clear if you're looking at stocks like HDFC Bank and ICICI Bank, that's where the numbers have been in line with estimates. That's where the buying is happening. And if you're looking at tier 2 financials, it's been not a very clear picture. It's muddled picture, one parameter up, other parameter down, and which is why the market is a little circumspect on names like AU Small Finance and RBL Bank. So tier 2 financials largely are under pressure. Let's bring in Gaurav to parse through all the major financial earnings and how the market has interpreted them. Gaurav.
Well, yes, when we talk about major financial earnings, let's talk about some stocks which are really creating an impact in the market today. First, let's talk about ICICI Bank. When it comes to numbers, growth has been higher than what the street is expecting. So, net interest income increased almost by 11% on a year-on-year basis. We saw PPOP, which is pre-provisional operating profit, growing at around 17%. And as a result, profitability also increased almost by 15% on a year-on-year basis. What remained as a key positive thing is that net interest margins actually declined only by 7 basis points versus the expectation of the decline of around 18 basis points. There was some change in the accounting practices, and as a result, management also suggested that the net interest margin fall has been in the range of 4 to 6 basis points only. Going ahead, they also said that the cost of funds will start easing and keep easing even in the quarters going ahead. So definitely a positive commentary which is also supporting the stock price. On the other hand, we saw stock like AU Small Finance Bank actually struggling in trade today, and the reason being that when it comes to the margin and the overall credit cost guidance, now AU Small Finance Bank has increased their credit cost guidance from 85 basis point to 100 basis point for the year. And the reason being that they said that the recovery in MFI is actually weak in this quarter specifically, and going ahead as well, they believe that the credit cost specifically in the MFI segment can go as high as 5%, which was earlier guided at 3 to 4%. Now, let's also not forget that management has said that in Q2 we will see the peak of MFI and the credit cost cycle. So definitely that is something which is relieving. But another factor to consider here is that the net interest margin fall was at around 40 basis points on a sequential basis. So that was also something which is hurting the sentiments of investors right now. Let's also not forget about L&T Finance. Now, this stock is also shining in trade today, we could say. And the reason being that when we look at the profitability, we actually saw a little bit of positive surprise in terms of profitability, and that was because of the lower provisions. So let's understand the numbers first. First of all, the loan book growth was actually strong at around 15% on a year-on-year basis. Specifically about the retail loan book, that increased at around 18%. So companies moving towards their retailization portfolio, which they had promised earlier. Other than that, when we talk about provisions, that have gone down, and as a result, profitability was actually up almost by 10% on a sequential basis. Now, they have used their provisions, the macro prudential provisions worth 300 crores. But other than that, the commentary also remained very positive. Net interest margins are again in line with what they had guided earlier. Credit cost is coming down at around 2.23%. Net stage 3 assets, they are also in line with what they had guided earlier. And as a result, we are seeing some positive sentimental impact in the stock price. As we speak, the stock is up more than 2%.
Thank you very much for that. Well explained. In fact, let's listen into the management commentary of L&T Finance. Realization and loan growth remains a tailwind, for optimism, according to analysts. Here out Sudipta Roy, Managing Director and CEO at the company.
The objective of the management to be as prudent as possible and to use as little of that as possible. And I do believe that the guidance on the credit cost that we have given, I do believe that we will be able to test those marks without sort of support on any macroprudential provisions in Q4 of this year. Because by that time, I expect sort of the asset quality headwinds which had appeared in the microfinance segment and to a certain extent in the two-wheeler and the unsecured asset segments to completely dissipate by then. The gold loans business that we acquired from Paul Merchants, actually we'll be setting up about 150 to 175 branches in the remaining part of new branches in the remaining part of the year. So our gold loans business also will grow strongly. So overall, yes, we continue to guide toward that 20 to 25% AUM growth for the rest of the year. And in terms of ROAs, to probably by Q4, we should test near 2.8%. However, that remains also to see how the credit quality pans out, which are very hopeful right now.
Well, that's a couple of major earnings that have been in focus, especially on the financials front. We have Sudeep Bandyopadhyay joining in to take us through the next leg of trade. Sudeep, thanks for joining in. So, that'll be my first question. And I remember we've been discussing this for a while. The market's expectation was running far higher from tier 2 financials, that they will show the growth, there will be turnaround stories, whether it's RBL or AU, etc. But Q1 numbers, small hiccups here and there. Would you still be a buyer of tier 2 financials? If yes, which stocks?
Very selectively, Surabhi. I think, of course, the ICICI, HDFC numbers were pretty good and NIM was better than expected. But when you look at the tier 2, I think the credit cost issue is still bothering most of them. And the unsecured lending book, which all these guys had, and unfortunately, the tier 2 banks had a higher proportion of unsecured book compared to the larger players as a proportion of their overall book. And the unsecured book is taking a hit. We know there are challenges there, and the challenges are not yet over. Whether they get over in the second quarter or third quarter, or the whole year continues with this kind of pressure is anybody's guess, and different opinions are around that. But having said that, I think some of the tier 2 financial institutions have also come up with good set of numbers. CSB, for that matter, is one bank where I did like the business update which they came up with, and I will carefully watch what kind of numbers and what kind of projections they come up with. Similarly, there are some other City Union Bank, I think I do like. But as I'm saying, you have to be extremely selective in tier 2, tier 3 kind of banks and NBFCs.
Okay, all right. Sudeep, I wanted your view on refiners, MRPL as well as CPCL. I'll tell you why. Because refining capacity globally, well, it's in a bit of a short supply, which could probably throw up a refining opportunity just in the near term, in the next 2 quarters or so. And hence, the core refiners will be in focus, which I mentioned as MRPL and CPCL. But before we explain the thesis to you and what's going on, let's explain to you the risk first. It's a sunset sector. So re-rating may not happen, and GRMs, they're very volatile. So earnings projections as well are rather tricky. That said, MRPL results were weak, but that was because of 2 factors. Shutdown, which impacted the refinery throughput, which came down by close to 24%. And inventory losses as well, which were reported. That's what led to GRMs declining. The question is, can Chennai Petro do relatively better? Let's state a few reasons out. Because there's no major shutdown, right, for CPCL in Q1 FY26. So on the volume parameter, it'll do relative outperformance. Secondly, the GRMs, well, they'll be hit by inventory losses, like it was the case with MRPL. But there was no shutdown, which will cushion the hit, as CPCL has been focusing on the reduction in fuel and loss, which has come down from around 10.7% to around 8.5%. Now, analysts estimate that could be a few hundred crores that's been getting added on an annual basis. That's on the profit before tax parameter. So the operational efficiency is something that they've been looking at. Next up, the share of diesel in the refining mix for CPCL, it's at more than 50%. Remember, diesel cracks, well, they're higher than petrol cracks. So in that parameter as well, they're relatively cushioned. And on the valuation parameter, if you look at it, CPCL is trading at a discount to MRPL. And on the replacement cost basis as well, it's trading at a bit of a discount. So valuations give some comfort. And the other factors we need to track from here, if it's actually going to be so good for them, then the dividend payout will be important. Last couple of years, they've paid out close to 30-35% of an FY24 as well as FY25. And interest costs have come down sharply. Last year, on an annual basis, it was around 245 crores. A few years ago, it was more than 410 crores. So sharp reduction in net debt as well we have seen. So I'll keep an eye out on both these two in case things are going to be so good. Debt reduction as well as dividend payout. So there is always a risk with regard to refiners because the GRMs are very, very volatile. But in the near term, the next couple of quarters, particularly Q2, could look up for both these two names. For the time being, MRPL's numbers are disappointing, but the street seems to have bought into the dip on CPCL. Sudeep, it's a tricky subject, GRMs. What's your view on on this space? Too tricky, or do you think as a tactical play you like to participate?
Well, I think, I'll tell you the basic thing which, foxes everybody is that the GRM and the volatility of the GRM. And look, our view is that, if a unit has a capacity to process multiple grades of crude, I think that gives them much more flexibility in maintaining and enhancing the GRM vis-a-vis the standard GRM. So in case of, even in this case, between MRPL and Chennai Petro, I think Chennai Petro has a larger flexibility, with diesel being about 50% of what they're doing. They are in a better position. And I continue to maintain my view that the guys with a more flexibility will be the winners, will be better positioned. And of course, I do like Reliance because they have, to a great extent, that capability of using multiple grades of crude and processing the same. So they are always trying to, better the GRM compared to the Singapore numbers which they come, and they almost always come up with better set of numbers. So yes, I can look at tactically some of these players, and definitely between the two, Chennai Petro does look better. Of course, on the valuation front as well, it does look interesting.
Okay, all right. So the refiners looking good.
Maybe there is a flash at the bottom of the screen.
Tilaknagar Industries.
Yeah, it's come off sharply.
The stock was roaring 10% when we started the show. And now this regulatory issue obviously is hitting hard, and this is coming in from the Informist. Alleged liquor scam. We'll of course be reaching out to the company. I'm sure our guest team has already done that, and we'll try and get
it's not a completely new story, Surabhi. The basic story essentially is that when the last government in the state was there, the allegation goes that the company, not just this company but others also, a bunch got gained unfavorably at the expense of others. That is the basic story under the last government. So this has been going on. I remember asking them on the air whether they've received something from the police or something from the government, etc. So, but this has now come out again. This is from the Informist. So we'll, that's the one. Police allege that the company paid some 200 crores, etc., etc. So we'll have to wait, and we'll come back on this particular story as we go along. I think it's still up 10%, right?
It just showed up 4.5%. Now it's up 10%.
I think it's
again. Maybe we'll do a tick by tick on this a little later.
Did it just move up?
Yeah, even I saw 10.5% when we started, then 4.5%. Now again about 10%. So I'll get more on this in just a bit.
But this is not, all I'm saying is it's not new.
Yeah,
not
this has been ongoing.
This has been ongoing, and this has been around for, the information has been around for a while. Yeah.
So there's a difference between the, I think the rates we're getting on the different exchanges, NSE rate and BSE rate. And therefore, this is very large variance between the two exchanges. We'll again go back and just do a technical check on this and come back. But in the meantime, Sudeep, otherwise, Alcobev as a space has been doing very well. And with a lot of these FTAs getting signed, there's just a lot going on. Look at a stock like Radico. It's just been such a huge wealth creator over the last several years, right? I don't know if you like Tilaknagar. If yes, just give your overall sense on the company if you can. Any advice to investors who are looking out at the Alcobev space?
Definitely, it's a good space to be in. And with all these FTAs getting signed, there is definitely long-term benefit. Though I heard the Radico management on your channel some time back when UK FTA was signed, they definitely were looking very positive. Their views were very positive. I'm not sure how to quantify the benefit at this stage till the T's are crossed and I's are dotted. But definitely they will benefit, and it's a good thing for this. So Radico Khaitan has been our favorite for quite some time, and we maintain our positive view there. Of course, the valuation is not cheap, and you have to, if you're buying now, you have to be prepared to be in the stock for a 1 year plus kind of time horizon. Some of the other names, including Tilaknagar, also we have been examining. I think this Andhra Telangana, there are too much of confusion and too many issues surrounding the entire liquor distribution. We know the government was holding on to payments, and some of the large players stopped supply in some of these states. So there was a lot of confusion. So companies having significant exposure in these southern states, we are generally a little careful. So I will rather go with a Radico than a Tilaknagar.
Okay, by the way, just checking the proper rate Now on both exchanges, what's reflecting is what you're seeing on your screen, which is about a 5% gain on Tilak Nagar. Got that. Thanks very much, Sudeep, for all the advice there. We do have to take a quick break on that note. Come back on the other side, and we'll have Atul Mehra of Motilal Oswal AMC joining in with some thoughts.
Welcome back. The Nifty is holding 25,000. The Sensex is higher, is above that 82,000 mark. It's a quietly positive session. Banks are leading from the front. But what else? What's happening in the mid and the small cap universe? Hormus joins in with the top buzzers at the moment.
Plenty of movers in the broader markets, most of them being earnings reactions, and we've spoken about the usual suspects, but the ones that are not, one of them being K-Solves India, and that is now down almost 13% in response to its results. The margins took a bit of a hit this time around, and the fall is interesting because this 13% fall was preceded by a 14% gain in the 3 sessions before today's drop, and the drop today also comes on the back of very significant volumes. That 25 lakh shares have been traded in the 3 prior sessions, and that comes on the back of a 20-day average of just 1 lakh shares. So it shows the kind of volumes with which the stock has dropped in today's session. The other one, and most of the earnings reactions today have been on the negative side, and Newgen Software is the other one that just keeps continuing to get pummeled after the earnings it reported last week, down another 5% today, third day of Losses now is down 15% in the last 3 sessions, was down 6% each on Thursday and on Friday as well. And volumes continue to remain on the heavier side for this stock as well. It is down 47% so far in 2025, which is the worst calendar year that it has had since its listing. And this is preceded by an almost 10x jump that the stock had seen over 2023 and 2024. So some bit of reversal coming in from higher levels. You take a look at some of the others on the positive side. Paradeep Phosphates is one of them. Slightly off the highs of the day, was up almost 10-11% at one point, but the stock though is gaining on very heavy volumes. And if you look at today's volumes, nearly 5 crore shares have already been traded, and that is compared to a 20-day average of just 22 lakh. So heavy volumes, a strong move for Paradeep Phosphates, and it is the 4th highest volumes in a session that this stock has had in its trading history. Some of the other earnings reactions, then Control Print is one of them, and that is the 5th day of losses. Another earnings reaction, 8% lower on the stock, and it fell almost 9% after its results. And the volumes, which until the result announcement were below their 20-day average, have seen a very sharp spike. 2.5 lakh shares already traded compared to a 20-day average of just 50,000. And lastly, Dodla Dairy is the other one. Hatson Agro doing very well at one point, and Dodla Dairy is the other one. 8.5% lower now at the lowest point of the day. 5.5 lakh shares already traded compared to a 20-day average of just 63,000. So some movers and shakers on the earnings front. This is the highest volumes that Dodla Dairy has seen in a month, but most of the reactions that have come in are on the negative side.
Right. Hormoz, thank you very much for that. It's an interesting bunch of names that Hormoz will get to you every day in terms of the movers and shakers that we don't typically discuss and talk about, but they're happening. Atul Mehra is with us, fund manager at Motilal Oswal Asset Management Company. Atul, good afternoon. Good to have you here with us. You know, if you think about it, and maybe you disagree, but I was just thinking that either you've got to be very short term, or you've got to be not very long term, but you've got to be long term. This in-between period has kind of disappeared. That I don't know. I mean, do you feel that way? Because things are priced quite finely. In the very near term, of course, things will move based on this or that, earnings or otherwise. Otherwise, things are kind of priced for FY27 and beyond. What's your sense, Atul?
Yeah, hi Prashant. Hi, good afternoon. Yes, to some extent, I would agree. Yes, that given that, say, stocks are priced in terms of taking into account FY27 earnings and so on. So what you're actually seeing is reactions on either side, on the positive side or on the negative side. So the delta in terms of surprises, either positive or negative, is what is getting reflected in terms of day-to-day prices. Otherwise, stocks broadly are just consolidating per se. So to that extent, yeah, it's right that stocks are going broadly nowhere, and only the surprises are getting in terms of priced on a day-to-day basis.
Atul, you look at the IPO space, lots of new listings recently. Anything that you purchased in your portfolio?
We've had a number of names added to our portfolio, and even this week, like, we would have about 3 new IPOs open up. So there's a lot of activity in the primary market, not just IPOs, even in QIP, in terms of a lot of other deals, etc. So actually, if you look at it, what is really happening is the secondary markets are kind of consolidating in this very narrow range, and a lot of incremental activity is on the deal market side, and that is where I think most of the incremental attention, energy, money is going towards. So even last week, like for example, you saw a $3 billion QIP. You had a number of blocks in the last 1 or 2 months, $1 billion plus blocks. So what you're seeing is secondary markets broadly consolidating, and a lot of deals getting basically in terms of activated and dealt on a day-to-day basis.
Atul, with the disclosure, can you share where you've participated in a big way?
We would avoid any stock-specific name. But fair to assume that we have been active in a number of IPOs over the last 3 months, and even the pipeline in the next 3 to 6 months is a very large pipeline. Number of names that are lined up to hit the markets.
Interesting. Speaking of IPOs, today's listing has done so well. Anthem Biosciences stocks holding on to a gain of 28%. So yeah, I mean, there is a fair amount of interest for specific stories, specific companies, I suppose. Quite evident. Overall, by the way, just reiterating, the market is trying to make a bit of a move now. The Nifty is trying to inch towards the 25,100 mark. It has another half an hour left. Let's see if it can get there. It's the first meaningful move otherwise what's been a completely ranging session. So let's see if this takes us anywhere further up. Atul, hi. So, tell us what you've been doing largely in the last couple of weeks, 2-3 months since the market got into a range. The range is now almost a month old. I mean, what is the preference? Mid caps, large caps, in terms of sectors? How are you primed for the earnings season?
Sure. So I think in the last few months, it's primarily been a little bit more stock specific because the index has gone nowhere. And incrementally, what we've seen is in terms of names which are in terms of on the small and mid side, especially, they are having sharper moves in terms of appreciation. So incrementally at the margin, we've looked at more stock specific individual names, some of the newer names that we've added to the portfolio. And that is where I think the delta is. Broadly, if you look at it from a sectoral perspective, like we continue to, in the fund that I run, remain overweight on financials and telecom. Those have been the key overweight sectors. Other than that, there's been broadly most of the other sectors have been more or less in terms of aligned. Metals, we continue to remain underweight as a sector. So that is the sector positioning at this point in time.
Metals not finding favor with you, Atul. It's a tricky one, and maybe you'll believe that there is money to be made in other sectors. Let's talk about the banking space, because today you have the Nifty Bank that's roaring away. It's up 700 points technically as well. It took support at 50 DMA. It's crossed the 20 DMA. That's great. But how are you positioning yourself on the banks? Because the larger banking names, they're doing extremely well today. While some of these mid-sized banks that actually, or smaller-sized banks that trade at a sharp valuation discount, they're getting pummeled actually. But their weight on the Nifty Bank is so less that no one's really talking about it. What do you like? Do you go for the value names, or do you believe you rather stick to the large cap names?
Sure. So I think in terms of, if you look at the results that have come by so far, the large set of banks, large private banks especially, they have been very, very strong in terms of performance, and they've been beat in terms of NII as well as asset quality has been quite stable. What you're seeing in the mid-sized banks is some level of issue on the asset quality side, especially like we've seen in case of a lot of commercial vehicle exposures and so on. Those have been the ones where we've seen some level of asset quality in terms of negative surprise that is coming about, and which is what is getting reflected in some of the NBFCs as well as the small finance bank space. So it is in that sense on the mid side, it's a little bit of a mixed bag on the asset quality side, which is why the stocks are perhaps reacting on the negative side. Large banks, they continue to remain very robust. And so far in terms of our positioning, portfolio positioning in the fund I run, so it's primarily towards the large banks and not too many of the mid financials. So some of the names we own are more on the HFC side, where we believe that with the interest rate cut that is perhaps further getting in terms of accentuated, you'll see that some of the HFCs which have a large fixed rate book, they tend to benefit disproportionately because your lending side is fixed while your liability gets repriced lower as you have in terms of the interest rate cycle playing about. So there we believe there could be some beneficiaries that could come about. But other than that, very, very selective on the mid financials.
Thank you, Atul, for joining in. He's also overweight telecom, and one of the stocks, Bharti Airtel, has now become India's third largest company by way of market capitalization. So today it's overtaken TCS. TCS, remember, post the numbers last week, has fallen close to about 6-7%, while Bharti Airtel continues to gain ground. So now this telecom company is overtaken TCS to become the third largest by way of market cap. We'll get into a break. On the other side, we'll get you a quick check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you what to buy or sell today from our technical expert.
Well, the markets have seen a good recovery actually in the last few minutes. Eternal is one stock. I think Nirmal Bank had come out with a note, one of those brokerages that I read earlier today. And, that stock is now up 4.5%. It's been a gradual up move is what we're seeing on that particular name. But besides that, I think stocks like Grasim that were trading in the red, that's moved into the green, as is the case with the Adani Ports as well, putting on some weight in the last few minutes. And good to see the Nifty now hit a century. But it's time for D Street Chatter. Nimesh joins us to tell us what is he picking up in terms of the flows and how trade setup is. Nimesh?
Nigel, looks like this last 30-minute MOC is playing out. It was part of my graphics as well that in the last 30 minutes, I'm expecting a small MOC buy, especially in the Nifty name. So I guess that explains a bit of uptake in the large cap Nifty stocks in today's trade. But otherwise, in general, it's been a mixed day of trade. I think it's the earnings which is reacting across the street, whether it's bank stocks, whether it's the likes of Reliance as well. So today, banking stocks are leading the way, but even within that, it's a mixed day. Large private banks are doing good, but the smaller mid-cap banks have actually underperformed on the back of weak quarter one earnings. From a flow perspective, as I said, there is a small MOC buy in Nifty name, so that explains the last move in the Nifty in the last 30 minutes of trade. And in general, metals have done well today on the back of strong commodity prices globally. But net, I guess it's earnings which is impacting a lot of reactions and a lot of stocks as well. And that's going to be the trend, at least in the near term. We have Infosys day after, and that's a big bellwether to watch out for. So again, IT has seen some bit of pullback in today's market. But today, I think the big sector of the day is clearly the financials. And within that, large private bank stands out.
Okay, all right, but plenty of chatter. Nimesh, what are you picking up today?
Well, so the first stock on my list is UPL, United Phosphorus. That's been buzzing in trade. In fact, in the last couple of days, it has actually outperformed overall markets as well. And the flows have picked up from larger FIs is what I understand. But for UPL, apart from the earnings, the next big trigger would be a potential corporate development. Essentially, the buzz is that there could be restructuring of business within UPL going forward. So that's a big trigger there. The second stock is Reliance Industries. While the stock is reacting to a little bit of weak earnings, but there is a small MOC buy is what I understand at a leading FI desk today. So expect some bit of recovery in Reliance as well in the last 30 minutes. The third stock, a couple of stocks where there is delivery-based selling. Shriram Finance within the FNO stock and South Indian Bank. These are the two names which stands out in terms of delivery-based selling at an FI desk today. So expect high delivery volumes there. And the last is JSW Infra. A bit of accumulation has started is what I understand. So there are small buy flows. But I understand a domestic mutual fund has been aggressively accumulating at current levels in JSW Infra.
Okay, all right, got it. So plenty of action. Thanks for that. And indeed, we'll have to watch out for the delivery stats on Reliance as well, given the stock's been down over 3%. Thank you for that, Nimesh. Well, we've got Mitesh back with us, so let's get some final trading updates. Yeah.
Sorry, Eternal numbers are flashing at the bottom of the screen.
25 crores of net
25 crores profit compared to 253 crores. That's the number. Revenues are up 71% as compared to 7,170 crores. So top line is a very large jump. Bottom line, year on year, I mean, basically it's about 10% of what they did the same quarter last year. Stocks starting to come off a little bit. There were we didn't put out a poll. I think there was only one or two sort of brokers who listed their expectations for the quarter. And Mangalam should be with us in a bit from now to talk to us about what these numbers look like. And I mean, the sort of the presentation is detailed from Zomato, both in terms of the segments that they operate in, and that is looked at very, very closely. So we'll try and have that for you. But for now, we have the basic profit and top line number, which is flashing at the bottom of the screen. So 266 on Zomato at this point in time. Mitesh is with us while we wait for Mangalam to come in. Mitesh, what do you have?
In fact, UPL and Paytm, UPL features on my list as well, making a fresh swing high, finally, getting past 695, 795 kind of a zone. BTST here with the 708 stop and 725 target, and Paytm is the other one. Paytm is a BTST with a stop at 1,005 for targets of 1,035.
Okay, all right, got that. Thanks very much. While we are waiting to do the fundamental check on Zomato, Mitesh, just very quickly, levels to watch for Eternal, 265 now?
See, this stock has kind of, come back from a corrective movement. And the recent highs were around these levels. This 271 was the closing which we got on the 14th of July. And if you look at the retracement levels on the long-term charts as well, they are near these levels. But the chart structure is improving. So I would, want to see if we can get it on a mild decline or if the breakout happens at a much higher volume. then you would tomorrow maybe want to initiate some kind of a long position.
Okay, let's go across to Mangalam. Mitesh, thanks very much for that. Mangalam, tell us more. Zomato.
For Zomato, a couple of things. Revenue growth at 70% is higher than what the street was expecting, anywhere between 55 to 60%. But that is led by, no surprises, Blinkit. In the quick commerce business, the revenue has actually grown by about 154%. But remember, this is something that the street was anticipating already because of the upfront investments that they had done. So revenue growth wasn't a concern for Blinkit. The question was, what happens to the operational performance? And out here, Blinkit EBITDA loss has come in at 42 crores. This versus a gain of 43 crores the same time last year. So there's a near 80 crores swing which has taken place. But despite that, the stock is holding in the green because this loss has narrowed from 82 crores in the fourth quarter to a loss of 43 crores in the first quarter of this year. So that's a positive. The second part is that, the food delivery business, which had been seeing a declining growth trend in the last quarter, had grown at around 16%. This quarter, the food business has grown. The delivery revenue has grown 16.4%, which tells you that, it may have perhaps bottomed out at the pace of growth level, which explains why the stock is holding with a gain of about 4%. So now we need to watch out for a couple of things. How the food business margins have done. There has been a slight contraction quarter on quarter on the food delivery margins, but the fact that revenues continue to stay stable at around that 16.5% doesn't have the street very worried about. So all said and done, these are decent numbers coming in from Eternal. Why is that? Because on the one hand, quick commerce, the revenue growth has come in at 154%, which is higher than the street anticipation. The EBITDA has turned into a loss versus last year, but sequentially there has been a reduction in the loss, which is also a step in the right direction. The food delivery business, which was showing signs of slowing growth, has stabilized at around 16.4% in terms of revenue growth, notwithstanding the mild compression in the margins. And the stock has already seen a correction from the top. So as a result of which, it's holding with a gain of about 4.3%. More details when the shareholders letter is uploaded to the exchanges.
Okay, all right, Mangalam, thanks very much for that. So that is the first look as far as Eternal, that is Zomato, is concerned. Stocks actually moved up and sort of even sharply 5% now, about 2.5%, 3% when the numbers came out, almost about 270 odd rupees on Zomato. We'll get you more from that letter as Mangalam was talking about as we go along. But let's move on. IndusInd Bank, we've been talking about, Ritu's been, of course, telling us this big story on Axis Bank that she broke. But IndusInd was also in focus because the bank, in a response to CNBC-TV18, has denied reports of expanding sort of its CEO search. Ritu's here with some backdrop and what we're being told by the regulator. Ritu, take it away.
IndusInd Bank, in a statement to CNBC-TV18, has firmly denied any reports of the Reserve Bank of India asking its board to expand the CEO search. For context, certain reports had indicated that the RBI had suggested the board look at new CEO names, including public sector bankers or Indian origin bankers working in foreign banks, and even went on to suggest that RBI's directions followed some concerns or hesitation on the part of the shortlisted candidates to take up the assignment. However, now IndusInd Bank has dismissed these developments entirely. In its statement to us, it has called these reports false and speculative, and also said that the appointment of a new MD and CEO, including seeking relevant approvals, is in process. Remember, CNBC-TV18 was the first to report the 3 shortlisted CEO candidates for the top job at IndusInd, including Rajiv Anand of Axis Bank, who is the front-runner, Anup Saha of Bajaj Finance, and Rahul Shukla of HDFC Bank. We had also earlier reported that RBI could expedite the CEO appointment, which would typically take 6 to 8 weeks or longer in other cases, given the gravity of the situation at IndusInd Bank, which is currently without a CEO, with an executive committee running the bank's day-to-day operations. So in summary, IndusInd Bank making it clear that the CEO appointment process remains very much on track.
Thank you very much for that. Anand Tandon is now joining in. And by the way, markets are picking up now. So it's moved up about 50 odd points in the last 30 minutes or so. So now inching closer to the 25,100 mark. And it's gained more than 100 odd points. Anand Tandon is now joining in for the last leg of the show. Anand, first, a quick word on Eternal's numbers. I don't know if you had a chance to listen in to Mangalam's first take.
Well, I did listen in, and as you said, the numbers for Blinkit, what you are looking for is simply the top line growth, and the fact that they have managed to reduce their losses over the last quarter is a positive, which means that at least the unit level profitability exists. So as you continue to grow, hopefully there will come a time when you'll start to make money. Overall, the level of intensity of the fight in that sector has actually increased because the other players are also putting in their best. So it will take a little while before you would expect to see stable numbers. But overall, I would not be too worried about what these numbers are. In fact, they are, I would imagine, relatively positive.
Would you buy? Do you own Eternal in your portfolio?
Well, it would be in one of the portfolios which are managed by others. I also have PMS investments, but it's not my own personal choice.
No, absolutely. 6.5%, 7% on Eternal. I mean, that is a big move, which is coming through. And all of it, mostly all of it has basically come through after the results have been announced. I think you've got to say something about lack of positioning as well, right? I mean, the stock actually did correct from about 278 to about 256 in the last 4-5 days. So there is that as well. So going into the results, the stock was weak by about 30 odd rupees or so. So that's coming up very, very sharply, very, very quickly. So almost 20 rupees now after the numbers have come through on Eternal. Let's just look at Swiggy as well as the other one, right? I mean,
it's moving up.
Yeah, it's moved up. It's moved up a little bit, not much. So from about 389, it's moved up to about 395. So about $6 on Swiggy after Zomato has reported numbers. Anand, good afternoon. Good to have you with us here as always. The banks, and I don't know if you heard Ritu on IndusInd, she of course broke that story on Axis as well, that RBI basically forced Axis's hand to recognize all that. I mean, the regulator thought that they were being lenient in terms of NPA stress recognition, and that is what led Axis to disclose all that stress. Your thoughts? I mean, troubled financials, if I can sort of put that in a category. There are a few others as well.
Well, I think, larger banks are doing kind of okay, right? Clearly, we are still in a stage where credit growth is nothing great. And more importantly, I think people are not recognizing the fact that the Indian consumer today is a heavily leveraged consumer. If you just even take out the housing loans, the rest of the unsecured credit to Indian households is probably the highest it has ever been. And on a relative basis is actually as much as many of the developed markets are. So there is not that much place to go, which is why I had mentioned even in the last conversation we had that you will see a lot of growth in the Ninja loans, but you will also see NPAs coming through, and that is what you are going to see now in the smaller banks. Some of that has already happened. I think it can only deteriorate from here. So if you are looking at financials, clearly the most conservative ones are the ones that one should be looking for. Already the growth has to be factored down. That said, the profitability will still remain quite good for some of these banks, especially the bigger, larger ones, which are able to have a deep deposit franchise. And there is no particular reason to migrate to the others. If you are looking for growth, look for NBFCs. Remember, they are lending to ninjas.
Okay. By the way, I just want to make one point on Eternal. I mean, a lot of the comparisons that we are flashing are year on year. Perhaps another way of looking at it, and that's how the market is looking at it as well, is quarter on quarter. Because remember, year on year, Eternal had flagged off that there will be some burn in the quick commerce business. Now, quarter on quarter, that burn is definitely coming down. Look at the quick commerce losses from 82 crores. The losses come down to 42 crores. The going out business loss is steady, but it hasn't increased too much. From 44 crores, it's 48 crores. Overall, of course, the food delivery business, there the profits keep rising. 439 crores has become 465 crores. So sequentially, this performance is looking really good, and the market is taking note of it for sure. So Eternal looking very, very good. Big Nifty move up, the biggest actually Nifty gainer this afternoon. Well, let's quickly head back to that story on Tilaknagar Industries as well. We just saw that news flash about regulatory issues and allegations of a scam in Andhra Pradesh. We have Shilpa joining in with the latest. Shilpa, fill us in.
Well, the Andhra Pradesh police has now called out Tilak Nagar Industries in the larger liquor scam that is under investigation. Now, the state police has named the company, and which is a big name in the alcohol industry, as one of the companies that is involved in an alleged 218 crore kickback when it comes to this particular company. Now, what the charge sheet says, as per the details that we've seen, is that between 2019 and 2024, Tilak Nagar Industries was one of the biggest liquor suppliers to the state, which is a, Andhra Pradesh State Beverages Corporation Limited, or the SBCL. Now, it was pushing its top-selling liquor brands like Mansion House, Brandy, and also Cooper Napoleon. Now, the investigators say that 1,472 crore in revenue is what the company earned from the SBCL, and an estimated 218 crores was siphoned off as kickbacks. Now, this was actually routed to a liquor syndicate that allegedly controlled the state's liquor procurement sales. This is as per the larger investigation. Now, the police claims that these kickbacks weren't paid directly, but they were laundered through gold. Now, sums were transferred to jewelry businesses like Sri Jewellers, Uday Jewellers, Uday Jeweller Industries, Sona Chandi Jewellers, Mangathrai Pearls, and these were amounts of about 3-4 crores each. And in return, gold was allegedly handed over to the syndicate handlers, helping the company convert that into white and bank money into untraceable assets. Now, with the alleged GST invoice also is something that they had to show for it. Now, according to the police, this wasn't just, corruption. They have said that there was coercion also involved as per the charge sheet, and that the syndicate allegedly held such tight control, and even large legacy brands like Tilak Nagar Industries were forced to play along. That is the allegations that have been given in the charge sheet, and this was to be able to just retain a market share in the state. Now, let me give you a little bit of the larger context. This is part of a larger liquor scam that has come to light. Now, this was come to light in the state based on a complaint by a man named Yedi Venkateshwar Rao Srinivas. Now, his complaint led to a 5-member SBCL committee, which then submitted a report which found that during the YSR Congress Party's rule, some popular liquor brands were unfairly sidelined, while certain players dominated supply orders. Now, based on this, the Principal Secretary for Revenue, Mukesh Kumar Meena, filed a formal CID complaint in September 2024. Now, this scam is being pegged at about 3,200 crore, with the alleged mastermind being identified as K.C. Reddy Rajshekhar Reddy, who was the former IT advisor to the then Chief Minister Y.S. Jagan Mohan Reddy. Now, Tilak Nagar Industries has not yet responded to the allegations, but CNBC-TV18 has reached out. Back to you.
Okay, well, that is a lot of information, but there is important context to what we are seeing now, which news which flashed on our screens right now. We'll wait for a comment from the company itself. Shilpa, thank you very much for that. I think Anand may have some views on this, and I'd like to go across to him, but I'm being told we have to take a break here, so let's do that. We are back. There's 5 minutes to close.
Welcome back. 1 minute to go. Less than that. The Nifty is ending at the 25,100 mark. So picking up a little bit towards the end. Anand, any stock, since we have less time, so I want to leave it to you. Anything that you'd like to talk about? Any new opportunity that you've spotted?
Well, I guess you continue to remain bullish with financials, and especially, insurance is the area that I would prefer among that.
Okay, thank you. We'll continue our conversation after the break. For now, it's counting down. The Nifty is ending closer to 25,100, 128 points higher. A significant recovery from the day's low. Benchmark indices ending up with a gain of about 0.5%. Banks provided a lot of support. The Nifty banking index higher by nearly 650 points, with ICICI Bank, HDFC Bank up more than 2%. Eternal was the star. The street likes the improvement on a quarter-on-quarter basis, 7.5% on that. HDFC Life, M&M, Shriram Finance, BEL were some of the Nifty movers with a gain of more than 1.5%. On the way down, Reliance was the top drag, closed below the 50-day moving average, 3.25% down. IT names weak, Wipro, IndusInd Bank, Eicher Motors, HCL Tech were some of the other notable losers.
Absolutely, and if you look at the results screen today, it's a mixed bag. So on the gaining side, you have names like Mastech, something like Aarti Drugs, Hatsun Agro. These stocks fared well on the earnings calendar. Even Ultratech Cement, by the end of it, 0.5% gain coming in over there. On the flip side, AU Small Finance Bank, Union Bank, Bandhan Bank, RBL Bank, not a great day for Tier 2 financials. Many of the earnings, the market is choosing to look at the glass half empty side of it rather than the half full. So that's how it's played out. Mid-cap index outperforming the Nifty on day one of the week. The Nifty itself not too bad, getting closer back towards the 25,100 mark. Well, with that, we'll take your leave on this closing bell. Many thanks for watching, but don't go anywhere because we have Markets Forward taking the action ahead. The Nifty and the Sensex gain over 0.5%, led higher by banking heavyweights. The Nifty reclaims the 25,000 mark. The Nifty Bank outperforms the blue chips to end over 1% higher.
ICICI Bank over-delivers. HDFC Bank too turns in a steady showing with a moderate decline in net interest margins, unlike the mid-sized banks, many of whom also feel the credit cost pressure.
Reliance Industries shares end lower despite the company posting a good quarter, delivering a healthy profit even after adjusting for gains from the sale of Asian Paints shares. Meanwhile, Zomato delivers a solid show in the first quarter. Healthy growth coming in from Blinkit. Food delivery business also does better. The stock zooms 7% in afternoon trade.
Hello and welcome to Markets Forward, your go-to show where we get you up to speed with regard to what went on in today's trading action and set you up for tomorrow as well. I'm Nigel. With me is Surbhi. Well, Surbhi, a green close, good to see. Maybe not out of the woods, but at least we took support at around the 24,900 and saw a bounce.
Absolutely, because intraday, the market had fallen below that level as well. So it was looking a little tricky in the morning. But from then on, there was a recovery. There were some decent earnings. And what we had was a pretty positive-looking screen. And we'll talk about it. It's basically very, very earnings-heavy and earnings-driven. Not too much of global news flow that was driving the markets today. But the banks were a big story. Pull up the Nifty Bank. And I think that's pretty much what it was. I mean, the big boys, the big banking boys have told you cannot ignore them. The market was positioned more for the mid-cap banking space, but actually the large boys, HDFC Bank and ICICI, delivered. So we'll talk about all of this and more over the next 20 minutes. Of course, all the corporate voices of the day, all the day's action and the events to watch tomorrow. But in fact, of course, the movers and shakers of the day will come through as well with Hormaz. And of course, we'll put the spotlight on Reliance Industries shares being down in trade despite what was a pretty steady first quarter. The spotlight on banking names will continue, as I just said. The smaller banks took it on the chin today. So we'll focus on some of those names as well, like AU Small Finance, and then map out tomorrow's events. But let's get to Nigel and your sense on the way the trade played out today.
Well,
Nigel.
today was actually a good trading session. Should be the 24,900 mark was something that the bulls were waiting for, and they replied to it in style. What was good today was the Nifty Bank. Well, it defended the 50-day MA. It conquered the 20-day MA on a closing basis. Good going out there. However, the Nifty needs to get past the 25,150 odd mark and the 25,300 mark. Why do I say this? Because Friday's high was at around 25,150 and 25,300 is when we do have, the 20 DMA. That said, let's get straight to our first segment. Hormaz is standing by on the big ball with all the movers and shakers of the day. Hormaz, take it away.
Well, there was a green on the screen, yes, but then you can't deny the fact that there were a lot of earnings reactions that were on the other extreme as well. You take a look at Dodla Dairy at one point of time is down 8% at the lowest point of the day is where it ended. Eternal came out with results just a few minutes before close, and boy, did it build on to those gains. It was already up 3 to 4% before the results were announced, and now it ended 7.5% higher. And EPAC Durables, MRPL, of course, some poor earnings reactions again, and L&T Finance bucked the trend though among the negative NBFC reactions, ending almost 4% higher. It was the financials that continued to dominate proceedings today. It was the financials that ensured that the Nifty ended in the green. You take a look at HDFC and ICICI Bank. Of course, we'll talk more about that in greater detail. But AU Small Finance Bank, Union Bank, Bandhan Bank, all of them seeing a negative reaction today. Bharti Airtel has now become the third biggest company in India in market cap terms, surpassing TCS. So it was good going for that stock. GPT Infra won an order, as did Titagarh. Bajaj Consumer is going to consider another share buyback, and Newgen Software continues to get pummeled after its results last week. A sector that did well today though was the metal names. Lloyds Metals, Nalco, almost every constituent of the metals index ending higher today with gains of anywhere between 2% to as high as 4.25%. And lastly, stocks that ended at a 52-week high in today's session. Paradeep Phosphates, Borosil Renewables is another one, 7.5% higher on that stock as well. UPL had a good day, and as did UTI AMC, following the HDFC AMC path from last week, ending at a 52-week high. Back to you guys.
Okay, all right. Thanks a lot for that, Hormaz. Well, Reliance Industries, that's been in fine form. However, in today's trading session, the stock ended lower in trade despite clocking a good quarter. The firm saw a healthy profit even after adjusting for gains from the sale of Asian Paints. Brokerage firms, though, remain bullish on the stock. Sonal joins us to break it down for us. Sonal, the stock was falling there, but take us through some of those details. What are brokerages making of it?
Well, let's talk about the basic numbers and then we'll talk about the segments. For the revenues came in at 2.44 lakh crore rupees. EBITDA was higher on a YY basis to come in at 42,900 crore rupees. Margins at 17.6%, which compares with 16.7% in the year gone by. Profits, that is something that came at quarterly records at around 27,000 crore rupees. It was aided by an element of other income of 15,100 crore rupees, out of which 8,900 crore rupees came in from Asian Paints stake sale. In terms of Reliance Retail, reported double-digit revenue yet again, and this time around their area per square feet increased by, or revenue per square feet increased by 16.5% at 10,847 crores. Jio reported inline set of numbers, so the revenue growth came in from both subscriber growth and ARPU growth this time around. O2C EBITDA margin higher on a YOY and on a quarter-on-quarter basis, but do remember this time around it was also impacted by a maintenance shutdown that was taken in the month of April. Mukesh Ambani reiterated their plan of doubling their business every 4 to 5 years, so that was an important statement that came by. In terms of brokerage commentary, Morgan Stanley said that new energy, telecom, balance sheet were the bright spots this quarter. They have an overweight rating with a target price of 16.17. Jeffrey says that while O2C was impacted because of a refinery shutdown, the outlook continues to remain positive. Focus will shift to the AGM expectations. That will be possible listing of Jio. There is also a possibility of a tariff hike. They project 11% EBITDA growth in FY26. They have a target price of 1726. Motilal Oswal, they've gone ahead despite calling it a soft quarter. They've increased the target price to 1700 versus 1685 earlier because they're sanguine on growth prospects across the segments for Reliance Industries.
Got that, Sonal. Thanks a lot for that. But a slew of banks came out with their first quarter numbers. While the big fared well in the first quarter, it was a mixed bag for the smaller banking names. Gaurav has had a very, very busy weekend and a busy Monday morning as well. Gaurav, break it down for us.
Well, yes, it was a day full of action for banking names. We saw a few banks actually outperforming in trade today, and on the other hand, we also saw some banks who struggled in trade. So first, let's talk about HDFC Bank. When it comes to profit, the number increased almost by 12% on a year-on-year basis. Net interest margins, they declined almost by 19 basis points, but at core level, the net interest margins declined only by 12 basis points. Another key trigger here was that the asset quality remained stable, and all of which actually helped the bank getting up in trade today. Other than that, ICICI Bank actually was in focus, and the reason being that strong performance is what we saw. Profits increased almost by 15% on a year-on-year basis. Let's also not forget that the net interest margins declined only by 7 basis points, which was anticipated to decline almost by 18 to 19 basis points on a sequential basis. Again, the asset quality remained stable, and as a result, we saw some uptick in this counter as well. Let's also talk about Yes Bank. We saw a good set of number here, and I'll tell you why. Because the ROAs are actually moving towards that 1% mark. Bank reported ROAs of around 0.8%, and at the same time, net interest margins also remained stable for the quarter. Bandhan Bank, on the other hand, actually came up with inline set of numbers, we could say, but the weakness was there in terms of the asset quality. Specifically, when we talk about fresh slippages from the EEB segment, we saw the stress was rising, and as a result, we saw some kind of pressure in the stock price as well. RBL Bank also, same kind of pressure was seen in the stock price, and the reason being that although bank is saying that ROAs can reach around 1% in FY26, in this quarter specifically, net interest margins declined almost by 40 basis points. Now, the street was anticipating 30 basis point of fall, and as a result, we saw some pressure in the stock price. AU Small Finance Bank, here also we saw some kind of stress coming up in the asset quality side, specifically in terms of credit costs. They have actually upped their credit cost guidance from 85 basis point to 100 basis point for FY26, and specifically for MFI, this credit cost guidance has been up to 5% on a year-on-year basis versus what it was anticipated at 3 to 4%. Lastly, let's also focus on Union Bank. Now, the numbers, when we talk about loan book growth, it was a little muted and lower than what the industry growth has been for the quarter. But what was another trigger is that in the near term, brokerages are not seeing any kind of triggers which will make the bank outpace the peers, and that is the reason why they have actually downgraded the rating. As a result, we also saw some pressure in the counter today. So definitely it was a day where we saw banks like HDFC and ICICI soaring in trade, but at the same time banks like AU Small Finance Bank and Union Bank actually struggled in trade today.
Absolutely not a big day for Tier 2 financials. It was a day for the big boys. Gaurav, thanks very much for that neat wrap-up. Let's go to our guests and quickly discuss the way forward for some of these banking names. We have Chandan Taparia joining in from Motilal Oswal Financial Services. And of course, we have Anand Tandon to give us a fundamental viewpoint. Anand, first to you. Now, when we are going into these earnings, I mean, I kept hearing a lot of people sounding fairly optimistic about Tier 2 financials, just purely in terms of growth, getting better bang for your buck in the near term from a positional perspective. But what we've seen is that some of the concerns like asset quality stress or higher credit cost stress or margin pressure, it's still showing up more in Tier 2 banks than the large cap banks. What would your advice be looking at today's numbers for the next several quarters?
Well, that's inevitable for the simple reason that, the cost of funds for larger banks will be a little lower compared to the smaller banks. For them to make the same kind of profit, they will have to lend to the worst kind of credit quality. So while you typically have growth there because they are more eager to borrow, you also have the highest NPA possible. And, like I have been sounding out for the last some months now that, we are now at the peak of the cycle in terms of clean balance sheets. From here on, it only goes downhill. And the more that there is pressure on banks to try and outperform in terms of earnings and so on, it will be at the cost of poorer provisions and the poorer credit quality. That is inevitable. Also, with the falling interest rate scenario, we will always have a pressure on NIMs. So the pressure becomes even more for the smaller banks. So at this stage, one should not be very adventurous and look for more stable banks which are more conservatively run rather than looking for the most aggressive growth.
Got it. Okay, all right. Got that, Anand. Let's go across to Chandan. Chandan, what do you make of today's trading action, though? 24,900, that was the line in the sand. We went to the line and the bull said, game on. Let's take this on. And that's why you saw a big recovery. But what about the trend? How's it looking on the Nifty? And the Nifty Bank, the Nifty needs to do well. You need that star performer to come in there and make the runs. That seems to be happening. Where's it headed from here?
Yes, Nigel. Fantastic, I think. The summary you've given about the market, that yes, bulls are finding tough from last couple of days, but today's recovery is giving some stance that yes, market again can head towards 25,250 marks. During the day, index drifted below 24,900, but somehow it reclaimed and managed to hold above 50-day exponential moving average. If I look at the weekly chart, index started to form lower top, lower bottom. But on the daily chart, if it manages to negate the lower top, lower bottom by holding about 25,050 or 25,080 by tomorrow, then I believe the index will again reclaim to 25,250. But one need to keep in mind that 25,250 is a major level. If market manages to move over the same, then only the major stance will be changed in the market. So I'm keeping two views in mind. First, the 24,800 is immediate support. Market needs to surpass about 25,080, and then momentum could be there towards 25,250 and higher levels. When we talk about Nifty, we need to focus on Bank Nifty index because the major recovery was seen in the Bank Nifty index, which managed to reclaim from the lower levels. Technically, it formed a hammer sort of candle, took support near 56,250, again managed to reclaim a key level of 56,750. So I believe if market has to hold, then the selective private bank and the Bank Nifty has to take the lead. So with support of 56,500, I believe Bank Nifty has potential to again get into the trading range of 57,000 to 57,250 marks.
Okay, that will spell good news for the Nifty as well. Got that, Chandan. Thanks very much. Stay on. We'll have more questions for you in just a bit. But let's talk about Eternal, the big zooming stock on the Nifty towards the afternoon. As soon as those numbers hit the screen, the market loved what they saw. So what's the fine print that the market is liking so much in Eternal's numbers? Let's ask Mangalam. Mangalam, so Zomato hitting all the right notes. What's working?
It is hitting all the right notes. If I told you that a company reported 70% revenue growth and stopped at that, it would be a good set. But if I told you 70% revenue growth, 35% decline in EBITDA, and 90% profit decline, and the stock went up 7%, you'd say, why? What exactly happened? Well, it seems like the worst is behind because one, management commentary is positive. Remember, the company has been disappointing on the food delivery growth front and the quick commerce margin front over the last few quarters. But now it seems like, the Blinkit losses have narrowed quarter on quarter and food delivery growth slowdown have stemmed. So two major problems the company both arrested. The management says year on year growth slowdown has bottomed out as they expect recovery from here on in the food delivery business. And in the very near term, quick commerce margins have also bottomed out. They expect if the competitive scenario remains the same right now, they will go ahead and see improvement in margins. Food delivery. cross-order value has been stable at 16%. The last quarter also it was at 16%. Remember, the previous few quarters it had been coming down, so that has been stemmed. Blinkit revenue growth at 154%. EBITDA loss has narrowed quarter on quarter. Same time last quarter, the EBITDA loss was close to around 180 crores. Now that has come down to close to 160 crores. And add to that, the company has continued its store expansion. Now their total reach is at 1544 stores. And on District, which is the third growth vertical of the company, they see at some point in the next 5 years, annual revenue run rate to be $3 billion with EBITDA at close to around $150 million. So these factors working well. Remember the last quarter, the one thing that annoyed the street was that despite them raising cash and because of the competitive intensity, cash balance of the company had come down quarter on quarter. That problem seems to have been addressed as well, with the cash balance increasing from 18,824 crores to 18,857 crores. So all things pointing in the right direction, and that's what the street got excited about. The stock ended at the high point of trade.
Okay, wow, fantastic. And what a comeback. Remember last few quarters ago when there was this whole thing of bigger losses as the rollout continued in quick commerce? Well, Eternal really answered its critics today at least. Thank you for that, Mangalam. Let's quickly go back to our guests on this. Chandan, let's talk levels first. Do you see a bigger breakout? Do you see more upsides on Eternal?
Yes, in fact, the price behavior of Eternal is making higher top, higher bottom. I still remember the entire price setup that earlier it used to take support at 200, that zone shifted to 220, then it headed to 240, and now the support is shifting to 255. So I believe with support of 255, the way it has negated the lower top, lower bottom, formed a strong bullish candle, it has potential to rally towards 278 to 300 marks. So I believe it offers a better opportunity after the corrective move of last 4 days, and stock has potential to head towards 300 marks plus.
Okay, just very quickly, Anand, do you like Zomato?
Well, I mean, from a business perspective, it's doing well. From a valuation, it is highly overpriced. If you have a 10-year view, it might be still worth it.
Okay, all right. We'll get to Manisha in just a bit to tell us about the commodity space, but let's focus on UltraTech Cement. You know, the numbers came in today, and initially the street was a little bit disappointed because there was a miss on the top line. Revenue did miss a little bit. You had the EBITDA number, though, that came in more or less in line, and that's why the stock did see a bit of a recovery. The only problem was that the volume growth was a smidge lower because it grew by around 9.7%, because they've included Kesoram in their base year. And Jeffries was one was expecting close to around 11%. But besides that, actually, the numbers look good. They were focused a lot on the cost side, which has helped them. On a core business, the core UltraTech business actually grew by only around 3.8%. Some would say it's a little bit disappointing. But otherwise, when the profitability is in line, the street will digest that. Very quickly, Anand, what's your view on UltraTech Cement?
Well, obviously, the consolidation in the industry continues. The only issue I have with the industry is that they are increasing their capacity faster than the sales growth. And therefore, to that extent, the economic growth in terms of profits doesn't keep pace. But as the consolidation progresses, there will come a time when you will be able to manage both the volume and the prices. And at that point of time, you should expect to see a steep upside. Right now, I think the sector is fully priced.
Okay, all right. Thanks for that. Well, let's focus on the metals pack. Strong economic data coming in from the United States and hopes of some kind of stimulus from China. That's what's sparking a rally in metal stocks. Manisha joins us to decode that for us. Manisha, nothing wrong in hoping, right? And we keep hoping that China is going to throw up something. Tell us more.
Oh, well, absolutely, Nigel. Every few days and weeks we hear that statement coming in from China, but it always does support metal prices, and that's exactly what we're looking at in today as well. The decline in dollar index has been supportive. Markets are anticipating a China stimulus measure to come in. Remember, there is China Politburo meeting happening as well, and that would set course for the rest of this year in sense of economic policies coming in from China. And then apart from that, you also have seen strong US economic data as when come in. The retail sales was better than expectation, and the jobless claims did decline, so that has been supportive as well. If you look at the copper prices, we're not trading too far away from its all-time highs, especially in the US market. the premium between the US and LME still stands at a tall 25% there. Remember, we are getting to go to that tariff starting from 1st of August, and that is what is keeping the market jittery, given the fact that US only has 2 mining smelters there, and that would keep prices supportive. Aluminum prices trading at a March high as well. We've seen prices gain up by 4.5% in the matter of last 1 month. Not just copper and aluminum, you have zinc trading at April highs too. The Chinese smelters are facing pressure to cut, and there is product capacity outpacing demand right now. That is another thing to watch out for. And in the ferrous metals, you have iron ore prices trading at a 3-month highs. You have steel trading at a 2-month highs as well. There is lower supply, expectation that China demand will increase quite strongly. All of those factors clearly supportive. So when you look at the last 1 month in sense of metal prices, the best of the gains clearly coming in with copper with 15% of a jump up. You have iron ore prices up by 13% as well. But it has been between 6 to 7% of gains that you have seen coming for the rest of the metals as well. So it's not just about today, but on a weekly basis, monthly basis as well, metals seem to be doing well.
Indeed, metal shining today yet again. Thanks, Manisha, for that. And thanks, Anand, as well as Chandan, for joining in and giving us your view on the markets and individual stocks. Well, we'll slip into a short break. On the other side, we'll tell you about all the top corporate voices that joined us. And also then we'll be telling you how to prep up for tomorrow, all the events you need to track. Don't go anywhere. Welcome back. You're with us on Markets Forward. Well, let's quickly take a look at all the key corporate voices that we picked up during the course of the day. First up, JSW Steel. The company reported a strong set of numbers for the first quarter. Speaking to us, the company's joint MD and CEO Jayant Acharya said that while the steel industry witnessed robust growth in the first quarter, global demand could be impacted by tariffs and the ongoing geopolitical tensions. He noted a moderation in Chinese steel production and added that the Indian government is expected to take a final decision soon on duties to safeguard the domestic steel industry. The company's overseas operations, especially in the US, have seen a strong turnaround. However, lower exports led to higher inventory, which in turn resulted in an increase in the debt. Acharya added that JSW Steel has filed a review petition in the Bhushan Power and Steel case and remains quite optimistic about a favourable verdict. Well, up next, L&T Finance gained closer on 3% despite a muted showing in the first quarter. Speaking to CNBC-TV18, the MD and CEO Sudipta Roy said that the firm's credit cost guidance could be achieved without any macro-prudential support. He added that the MFI asset quality is now expected to bottom out in quarter 3. Earlier, they were guiding for around quarter 2. Roy also said that he expects 20-25% AUM growth in FY26 with strong traction in gold and two-wheeler segment. On the ROA or return on assets, it's likely to reach 2.8% in the next couple of fiscals.
Okay, next up, let's talk about the day's listing. Anthem Biosciences rallied almost 30%. This is on day one as it listed today. The firm's management is expressing optimism about the company's future outlook. While China has long been a dominant player in the contract development and manufacturing organization space, a clear shift is underway towards other countries, says the management. The company has seen a surge in inquiries recently, with conversions anticipated over the next few years.
Well, and before we wrap up, let's get you all the key events you need to track for tomorrow. Vamakshi is joining in to give us a run-through of that neat list. Vamakshi, take it away.
Well, absolutely, Nigel. Not many economic cues to watch out for. It is largely expected to be an earnings-driven market. Now, global earnings, we'll be watching out for Coca-Cola as well as General Motors. But back home, we'll be watching out for companies like Colgate, Palmolive from the financial space. Keep an eye out on Credit Access Grameen, M&M Financials, as well as Paytm, Dixon Technologies, KEI Industries, Idea Forge, Dalma Bharat, so on and so forth. All of these companies are expected to report their numbers in tomorrow's trading session, so watch out for all of them. As far as corporate action is concerned, some companies are going ex-dividend. This list includes Poltam Transformers, Strides Pharma, as well as Happy Forging. And lastly, keep an eye out on Shyam Metallics, because along with their Q1 numbers, the company is also expected to consider fundraising.
Okay, all right. Thanks a lot for that, Vamakshi. For the time being, we'll wrap up on this edition of Markets Forward. We'll be back, though, on the other side with more news and updates.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end at the high point of the day after a steady session. The Nifty reclaims 25,000. Bank stocks lead the rally. CNBC-TV18 exclusive. We learn the Reserve Bank prodding Axis Bank to recognize stress prompted a review of the bank's NPA framework, which the central bank had flagged as too lenient. Sources say it was this review which led to the higher provisioning in the first quarter. India and the US set to hold further talks over a trade deal after completing 5 rounds of talks so far. Commerce Minister Goyal says no compromise on the interests of farmers and small businesses as President Trump's August 1st deadline to impose additional tariffs looms large.
सदन के पहले दिन सदन को बाधित करना उचित नहीं है। अपनी सीट पे जाएं। आप अपनी सीट पे जाएं।
Stormy start to the winter session of Parliament. Protests erupt in both houses as opposition demands discussions on the Pahalgam terror attack and Operation Sindoor. Questions raised about government's foreign policy after US President Trump's remarks about brokering a ceasefire between India and Pakistan. Aviation Minister tells Parliament it's too early to draw any definite conclusions on the Air India crash in Ahmedabad, says Aircraft Accident Investigation Bureau is totally unbiased and the government will only comment after the final report is submitted. The rise of Blinkit drives Eternal. The Zomato parent reports a healthy first quarter, revenue up 70%. Order value from quick commerce business is more than the food delivery business for the first time in a full quarter. A CNBC-TV18 News break has confirmed Sona Comstar set to enter China's EV market, signs a binding term sheet to set up a component manufacturing joint venture with China's JNT. Sona Comstar will hold 60% stake in the joint venture and is expected to invest $12 million. The Supreme Court dismisses a petition by the Enforcement Directorate against Congress leader and Karnataka Chief Minister Siddaramaia's family in an alleged land allotment scam. The Chief Justice asked the ED, why is the agency being used for political battles? Siddaramaia says justice has prevailed. The Bombay High Court acquits all 12 accused in the 2006 Mumbai train blast. The court rules the prosecution utterly failed to establish the offences beyond a reasonable doubt. The series of explosions in several local trains left 189 people dead and more than 800 injured. Well, let's go straight to the day's market action. The Sensex and the Nifty closing the day in the green, led by banking heavyweights. The Nifty reclaimed the 25,000 mark, ending today's session 0.5% higher. The Sensex closing about 440 points higher. The Nifty Bank up over 1%, and the mid-cap index also closing about 300 points higher this afternoon. But let's go straight to the big CNBC-TV18 exclusive. It is a regulatory intervention from the Reserve Bank that resulted in a surprise spike in Axis Bank's bad loans and provisions in the first quarter. Now, CNBC-TV18 learns from sources that Axis Bank was prodded by the Reserve Bank to recognize the stress. In fact, the central bank flagged the bank's NPA framework as being, and I quote, too lenient. Ritu's here with that big exclusive story. Ritu, many thanks for joining us. Axis Bank's numbers disappointed. There was that sharp spike that we saw in provisioning. But what you're getting to hear is this was not a voluntary action on the part of Axis Bank. This was prodded by the regulator.
Well, the surprising spike in bad loans, which dented Axis Bank's profitability in the recently announced first quarter numbers, which the bank had attributed to a technical impact, we've been given to understand was not entirely a proactive move by the bank, but rather followed a regulatory intervention from the Reserve Bank of India. Now, our sources indicate that RBI had flagged some lapses in Axis Bank's asset classification practices during a supervisory review sometime in the January-March quarter this year, where RBI found the bank's NPA recognition policy to be too lenient. While Axis Bank was compliant with the income recognition and asset classification norms on paper, we understand the regulator felt these internal policies were not really aligned with the spirit of the regulation, and in some cases, these lapses were leading to either a delay in recognition of stress or even under recognition of stress, and this was particularly noted in the bank's unsecured retail and small business loan portfolio. So RBI had asked Axis Bank to make all of these corrections in the first quarter itself. It was in response to this nudge from RBI that Axis Bank revised its internal framework. That in turn led to that 614 crore rupee hit to the bottom line, the additional 2,700 odd crores in gross slippages, and so on because of the technical impact. On its part, the bank even called the move a prudent application of enhanced qualitative criteria that was aimed at making its balance sheet more resilient. Now, importantly, keep in mind, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that this case should not be compared to IndusInd Bank, where accounting lapses had come to light, because in the case of Axis Bank, the issue was only policy interpretation and not financial misreporting.
All right, Ritu, that's an important news break there from Ritu on Axis Bank. And staying with banks, IndusInd Bank has refuted media reports claiming that the RBI had asked the bank's board to expand its search for a CEO. The bank has said that the reports are false and speculative. The lender also clarified that the process of identifying a new MD and CEO is underway. As Ritu had reported, 3 names have already been sent to the Reserve Bank. Rajiv Anand, formerly with Axis Bank, is one of them. Reliance-owned Jio Financial has announced a 50-50 reinsurance joint venture with Germany's Allianz Group in India. The binding agreement has been signed with Allianz's wholly-owned subsidiary. The JV will tap into Allianz's global expertise and existing reinsurance and commercial portfolios in India. In key earnings, Ultratech Cement met expectations in the first quarter. The Birla Group company reported a 31% rise in profits compared to the same quarter last year. Revenue rose nearly 18%. Margins also saw a healthy expansion of nearly 200 basis points. On to the big numbers of today. Zomato's parent Eternal has delivered a healthy first quarter performance as its quick commerce business, that's Blinkit, has reported strong growth. The order value from quick commerce is more than food delivery for the first time in a full quarter. Mangalam standing by with more details. Mangalam, no wonder Zomato changed its name from Zomato to Eternal. It anticipated this kicker coming in from Blinkit.
It is hitting all the right notes. If I told you that a company reported 70% revenue growth and stopped at that, it would be a good set. But if I told you 70% revenue growth, 35% decline in EBITDA, and 90% profit decline, and the stock went up 7%, you'd say, why? What exactly happened? Well, it seems like the worst is behind because one, management commentary is positive. Remember, the company has been disappointing on the food delivery growth front and the quick commerce margin front over the last few quarters. But now it seems like, the Blinkit losses have narrowed quarter on quarter and food delivery growth slowdown have stemmed. So two major problems the company both arrested. The management says year on year growth slowdown has bottomed out as they expect recovery from here on in the food delivery business. And in the very near term, quick commerce margins have also bottomed out. They expect if the competitive scenario remains the same right now, they will go ahead and see improvement in margins. Food delivery. Gross order value has been stable at 16%. The last quarter also it was at 16%. Remember, the previous few quarters it had been coming down, so that has been stemmed. Blinkit revenue growth at 154%. EBITDA loss has narrowed quarter on quarter. Same time last quarter, the EBITDA loss was close to around 180 crores. Now that has come down to close to 160 crores. And add to that, the company has continued its store expansion. Now their total reach is at 1544 stores. And on District, which is the third growth vertical of the company, they see at some point in the next 5 years, annual revenue run rate to be $3 billion with EBITDA at close to around $150 million. So these factors working well. Remember the last quarter, the one thing that annoyed the street was that despite them raising cash and because of the competitive intensity, cash balance of the company had come down quarter on quarter. That problem seems to have been addressed as well, with the cash balance increasing from 18,824 crores to 18,857 crores. So all things pointing in the right direction, and that's what the street got excited about. The stock ended at the high point of trade.
All right, Mangalam, many thanks for joining us. So that's Blinkit, bigger than Zomato in terms of food delivery in this quarter. A quick check of some of the other big headlines that we're tracking. Foreign portfolio investors continue to remain bullish on select companies despite maintaining a cautious outlook on the Indian stock market overall. Yusuf analyzed data from 150 companies in the BSE 500. He identified at least 10 companies where FPI holdings have risen quarter after quarter for the past 4 quarters. Let's start. Page Industries has led the way, followed by Minda Corporation and Autumn Investment. You can catch the entire analysis on CNBC-TV18.com on our service access. So do visit and send us your feedback. Now, Bharti Airtel has surpassed TCS to become India's third most valuable company. Its market cap has hit 11.45 lakh crore rupees. Reliance Industries remains the country's most valuable company with a market cap of 19.3 lakh crore rupees, followed by HDFC Bank at 15.3 lakh crore rupees. India and the US have concluded the 5th round of negotiations for the proposed mini-trade deal. Sources tell CNBC-TV18 that key issues including agriculture, dairy and auto remain unresolved. Even as the 1st of August tariff deadline draws nearer, addressing an event in Mumbai over the weekend, the Commerce Minister Piyush Goyal said the government will only sign trade deals if they serve India's interests. Take a look.
There is absolutely no way we will compromise on the interests of our farmers, MSMEs, the interests of our workers. Our effort is to give them more opportunity, to give them more trade internationally along with their growing markets in India with growing incomes. Our effort is to make sure workers get better, higher skilled jobs. Our effort is to get investments and technology. Our effort is to focus on innovation, like we did with the EFTA countries, Switzerland, Norway, Liechtenstein, and Iceland.
Well, that's the Commerce Minister, and the suspense continues on the Indo-US trade deal. Now, travelers to the US who require a visa will have to now pay a new visa integrity fee of at least $250 from the 1st of October. Now, the fee was mandated by provision of the Trump administration's recently enacted One Big Beautiful Bill Act. The fee is non-waivable and applies to tourists, business travelers and international students. It will be charged only if the visa is granted and will be in addition to an existing visa fee. While the fee is intended to be refundable, the reimbursement process is unclear as of yet. So that's going to be a significant addition to the visa charges. Now, China has exported around 353 metric tons of rare earth magnets to the US in June, marking a 660% rise since May. China has also exported 3,188 tons of these magnets globally last month, rising nearly 160% month-on-month. Now, this comes after Beijing placed curbs on several critical magnets in April, requiring firms to receive licenses for exports. Remember, this continues to be a big pain point for India. We told you first, and it is now official, Sona Comstar is set to enter the Chinese EV market amidst the rare earth curbs. The company signed a binding term sheet to set up an EV component manufacturing joint venture with China's JNT. Now, in the first phase of the joint venture, Sona Comstar will invest $12 million for a 60% stake, while JNT will invest $8 million in assets and business. The joint venture is expected to commence operations in the second half of this fiscal year. It's a CNBC-TV18 news break that's been confirmed. Anthem Biosciences made a strong debut on the Lal Street, listing at a 27% premium from its issue price. The company had priced its IPO between 540 and 570 rupees per share and received strong demand. The issue was subscribed 64 times on the final day of bidding and helped them raise over 1,000 crore rupees from anchor investors before the IPO itself. We will head into a break, but up next, Tommy, start of the monsoon session of Parliament. Protests erupt in both houses as opposition demands discussions on the Pahalgam terror attack and Operation Sindhu. A stock in focus today, Tilak Nagar Industries has been named as one of the companies involved in an alleged liquor scam in Andhra Pradesh. The police has accused the company of routing funds to a liquor syndicate through jewellery entities. Shilpa standing by now with more details. Shilpa, take us through what the police claims in its charge sheet.
Well, you're right. The Andhra Pradesh police has named Tilak Nagar Industries as one of the companies involved in the Andhra Pradesh liquor scam. Now, according to the charge sheet, which was filed on Friday, Tilak Nagar Industries allegedly gave kickbacks worth 218 crore rupees. Now, let's get into the details. As per the charge sheet, between 2019 and 24, Tilak Nagar Industries was one of the biggest liquor suppliers to the state of Andhra Pradesh Beverages Corporation Limited, or the APSBCL, and it was pushing its top-selling brands like the Mansion House Brandy and Korean Napoleon. Now, the main allegation is that Tilak Nagar used its privileged position and influence in the APSBCL to be able to secure massive sales. Now, the investigation shows that Tilak Nagar Industries generated revenues of approximately 1,472 crore rupees from the APSBCL, and an estimated 218 crores was paid as kickbacks to the liquor syndicate based on the quantity and price pushed through the State Beverage Corporation. Now, the police claim that these kickbacks weren't paid directly, but they were laundered through gold. Now, money was transferred to jewelry businesses, like 107 crore was transferred to a Sri Jewels, and about 3.5 crore each to Sona Chandi Jewelers and Mangatrai Pearls. And these were among others. Now, in return, gold was allegedly handed over to the syndicate handlers, helping the company convert white money into untraceable assets, but with a legal GST invoice to show for it. Now, according to the police, this demonstrates that the liquor syndicate in the state exerted, and I quote, ruthless control, compelling even major legacy players to divert part of their legitimate state income through gold transactions to the liquor syndicate, end of quote. Now, Tilak Nagar is just one of the many companies that was named in the 3,200 crore liquor scam, which came to light on the basis of a complaint by a man named Yidi Venkateshwar Rao Srinivas. Now, this complaint led to a 5-member APSBCL committee, which then submitted a damning report. It found that during the YSR Congress Party's rule, some popular liquor brands were unfairly sidelined, while certain players dominated the supply orders. Now, based on this, the Principal Secretary for Revenue, Mukesh Kumar Meena, filed a formal CID complaint in September 2024, and the alleged mastermind was identified as KC Reddy Rajshekhar Reddy, former IT advisor to the then Chief Minister YS Jagan Mohan Reddy. Now, Tilak Nagar Industries, we have reached out but has not yet responded to the allegations. Back to you.
All right, many thanks, Shilpa, for joining us. Heavy rains and waterlogging gripped Mumbai this morning. The Meteorological Department has issued an orange alert for extremely heavy rain in Mumbai and Raigad, and a yellow alert for Mumbai, Thane and Palghar. Heavy showers are expected to continue for the next 24 hours. The department has also warned of possible localized flooding, traffic disruptions and reduced visibility during intense spells, especially in the western and central suburbs. In international news, Israeli forces continue to pound Gaza, killing at least 115 Palestinians, including 79 aid seekers on Sunday. Gaza's health ministry said that around 19 people have died from starvation in the last 24 hours. The UN has issued a warning that the hunger crisis in the Palestinian enclave has now reached a new level of desperation. Pope Leo XIV has called for indiscriminate use of force to be stopped in Gaza without mentioning Israel. Addressing crowds in Rome, the pontiff continued his call for an end to what he called the barbarity of war in the enclave. The Pope also spoke of his anguish over the strikes on Gaza's only Catholic church last week, which killed 3 people. Israel has opened an investigation into the strike on which the church, which housed 600 displaced people. Peace remains elusive between Russia and Ukraine. Russia launched a series of drones and missiles against Ukraine in an overnight attack. At least 1 person was killed in Kyiv. Several commercial properties and houses were also damaged. The attack came after the Kremlin claimed that Russian President Putin was open to peace with Ukraine. Meanwhile, Russia's defense ministry said it downed 117 Ukrainian drones overnight. Ukrainian drone attacks led to flight disruptions at major airports serving Moscow. The Prime Minister will embark on a 4-day visit to UK and Maldives from the 24th to the 27th of July, and India and UK are likely to sign that landmark free trade agreement during the Prime Minister's visit. The deal is expected to double bilateral trade from the current $60 billion by 2030. The Prime Minister will then visit the Maldives as a guest of honour for the country's 60th Independence Day celebration. This will be the Prime Minister's first trip to the 2 countries after the change in leadership in both. The Bombay High Court has acquitted all 12 people convicted in the 2006 Mumbai train blast, which killed around 180 people. The High Court said the prosecution utterly failed to establish its case against all the accused. Santhya joins us now with details. Santhya, the court giving a virtual clean chit to the 12 accused. This is a matter that's been going on since 2006.
Yes, absolutely. 19 years after a series of 7 bomb blasts, and these bomb blasts shocked and scarred Mumbai, killing 187 people and injuring 824 people, Shireen, the Bombay High Court has acquitted all 12 accused in the case today. In 2015, Mumbai Special Makoka Court had awarded the death penalty to 5 accused and life imprisonment to 7 others. But on Monday, that's today, the Bombay High Court in its order said that the prosecution, and I quote, that the prosecution had utterly failed to establish the offence beyond reasonable doubt and acquitted all 12 accused. So what exactly are these grounds on which Bombay High Court acquitted all these accused? Let's take a look. The first ground is confessional statements. The court observed that the confessional statements by the accused were not truthful or complete on various grounds. Some portions were either found to be similar or copied. The accused successfully established that they were tortured mercilessly to extort confessions. The court also noted that the police failed to follow due procedure while recording these statements. The second ground is evidence and recoveries. The prosecution failed to establish what kind of explosives or bombs were used in the blast. Therefore, the recovery of RDX, cookers, circuit boards, detonators, etc. couldn't prove any connection. And court also said that other recoveries like books, CPUs and maps also failed to directly link the accused to the blast. The next ground is witnesses and eyewitnesses. The court observed that ATS did not follow due process while recording witness statements. Identification parades were not conducted for the witnesses to identify the accused. For many witnesses, this happened, and some witnesses were neither called for parades nor asked to identify the accused in the court during the trial. One witness who also deposed in the Ghatkopar blast case had his testimony thoroughly dismantled by the defense. Shrini, this was the same person who was a witness in Ghatkopar blast case as well as the 7/11 blast case. Now, the next ground is CDR, call detailed records. The court noted that the prosecution could have easily proved the movement, assembly, location and connections of the accused through CDRs. Instead, the ATS, the investigating agency here, destroyed the CDRs, raising serious doubts about the integrity of the investigating agency. For 19 years, Shireen, the Maharashtra ATS and prosecution claimed they had an airtight case. But despite the defense exposing the loopholes in the investigation over the years, prosecution failed to prove the offence beyond reasonable doubt, and all 12 accused have been acquitted by the Bombay High Court now after spending years in jail. Shireen.
Yes, 19 years. Many thanks, Santhya, for joining us. Meanwhile, the monsoon session of Parliament has seen a stormy start as protests erupted in both houses, with the opposition demanding a discussion on the Pahalgam terror attack and Operation Sindoor. Opposition parties also raised questions about the government's foreign policy after US President Trump's remarks about brokering a ceasefire between India and Pakistan. Leader of the Rajya Sabha and BJP President JP Nadda maintained that the government was ready to hold a detailed discussion on the issue and is not running away from any debate.
सब मिलकर के डिफेंस के क्षेत्र में आत्मनिर्भर होने के इन प्रयासों को बल दें, सेना के सामर्थ्य की सराहना करें। और मैं आज देशवासियों के सामने जरूर कहूंगा और देश के राजनीतिक दलों से भी कहूंगा कि देश ने एकता की ताकत देखी है, एक स्वर का सामर्थ्य क्या होता है देखा, तो सदन में से भी सभी माननीय सांसद उसको बल दें, उसको आगे बढ़ाएं।
मैं चाहता हूं कि उनके तरफ से हमको मालूमात मिलना चाहिए, जैसा कि पहलगाम हमला 22 अप्रैल को हुआ था। अब तक आतंकवादी पकड़े तो नहीं गए, लेकिन हुआ क्या?
कहीं ये संदेश नहीं जाना चाहिए कि सरकार पहलगाम और ऑपरेशन सिंदूर पर चर्चा नहीं चाहती। हम चर्चा करेंगे, हर तरीके से करेंगे, और ऑपरेशन सिंदूर के सारी पॉइंट्स को देश और दुनिया के सामने रखा जाएगा।
मगर इशू ये है कि कन्वेंशन कहता है कि अगर सरकार के लोग कुछ बोलें तो हमें भी स्पेस मिलनी चाहिए। हम 2 शब्द कहना चाहते थे मगर विपक्ष को ये अलाउड नहीं। थैंक यू।
And staying with Parliament, Civil Aviation Minister Ram Mohan Naidu has said that it is too early to draw any definite conclusions on the Air India crash in Ahmedabad. Responding to a question on the crash in the Rajya Sabha, the Aviation Minister said the Aircraft Accident Investigation Bureau is totally unbiased. End of quote. And the government will only comment after the final report is submitted. Here's the Minister.
What we have done, what the AIB has done, in fact, through the preliminary report is to kind of address what happened. Based on the facts it found out in the CVR, based on the facts it found out from the FDR, and only the facts that it was able to determine was mentioned in the preliminary report. To have a definitive answer and a definitive future correction measures, we have to look at the final report, sir. This also I can say that the AIB is totally unbiased and looking into the facts. Now, there can be many questions also. I have seen multiple articles myself. I have seen multiple articles not only by the Indian media but also the Western media trying to promote their own narrative, their own viewpoint, their own kind of consideration. But I have to tell you that the way we are seeing the investigation is through the facts.
Well, that's the Civil Aviation Minister. And staying with aviation, Air India flight from Kochi to Mumbai veered off the runway while landing at the Chhatrapati Shivaji Maharaj International Airport on account of heavy rain. All passengers and crew members were reportedly safe and were deboarded without any injuries. The Mumbai airport authorities have confirmed that the runway suffered minor damage. Well, with that, it is time for us to wrap up this edition of Business 360. More news and updates will continue right here on CNBC-TV18. Till then, from all of us here, goodbye. Many thanks for watching. Winds of change are blowing through India Inc. More than a dozen companies, including HUL and Nestle, will see a change in leadership within a few days. More than 140 companies listed on the NSE saw a change in the corner office last fiscal. Now, while that number looks large, it accounts for just over 5% of all the companies listed on the NSE. But another change is blowing through industry, and that is the shift towards a professional CEO. In fact, in a candid interview with CNBC-TV18, Marico's Harsh Mariwala explained why he chose a professional CEO over his own son, but this was, of course, dating back several years. Dilip Piramal of VIP Industries, in another candid conversation on CNBC-TV18, opened up on why the younger generation does not seem to be interested in running the company, and hence he has decided to exit. Now, this leaves us with a few questions. How will this shift towards professional CEOs impact India Inc.? Why is the next generation not so keen on growing the family business? And if it's not, will we see more promoters exiting? This is the editor's playbook, and each week our team of editors will put the spotlight on the most compelling events across the world and try and decode what they could mean for India. I'm Shireen Bhan. With me, our crew, Prashant Nair, Nimesh Shah, Surbhi Upadhyay and Sriram Iyer. But before we begin, here are those candid moments with top business leaders on balancing the interests of the organization and professional management as well as the family. Here's a look.
In the last 5 years, we have not been doing well. We've had a management, I would say, crisis in the last 2-3 years. And our market shares are going down. And the younger generation is not interested in the management. So what do I do?
Indian families, now they are realizing that their children are not going to be interested to succeed. There are more exciting opportunities the subsequent generations want to pursue. And they all want to call out something as their own rather than taking the reins from their father or grandfather.
I think if you look at Indian businesses, there is an expectation that your children will step into your shoes in terms of the role. My son also thought that he will step in. My wife also thought that he will step into my shoes. But I deviated from the normal practice. I am grooming him to take over Marico's chairmanship from me over a period of time.
Well, several interesting and important questions here that we will hope to address on this edition of the Editor's Playbook. Guys, they're connected, but they're also separate in many ways. One, of course, is the change that we see on account of people retiring, their tenures ending, and so on and so forth. Sometimes replacements are forced because of underperformance. There's another story that's playing out at this point in time, which is the apparent reluctance of the next generation to take forward family-owned businesses, which is forcing promoters to look outside, look at possible exit opportunities. And then there's the other aspect, where you may retain control, but act as a strategic investor. As Harsh Mariwala explained to me, he decided to do when he put Shogato in charge of Marico. His son Rishabh joined the family office, but now he's grooming Rishabh to become the chairman of Marico and succeed him. So they continue to hold control, but the company's been run by a professional CEO. So Nimesh, before we address all of these issues, let's look at what the data is telling us in terms of the CEO churn that we're likely to see.
So Shireen, first on the number of changes that has already been announced, but largely, at least for the last 5 years, I was looking at the BSE 500, which is not a very large universe, but a sizable universe. And within that, the data very clearly suggests that the change in CEO has generally led to a re-rating in the stock price. For some of the whatever reasons, but the stocks have actually outperformed. So as I said, it's a very small sample of BSE 500 companies. But look at the kind of performance the stocks have given. The first stock on my list is Persistent. They announced a new CEO, Sandeep Kalra, in 2020, October 2020, and since then the stock is up 850%. That's the kind of outperformance we've seen in a stock like Persistent. Similarly, Newgen Technologies, the stock is up 300%. Himadri Chemicals, a small company, but they got a new CEO in 2022, and since then the stock is up 500%. And there's a long list: Aegis Logistics, Welspun Corp, Zensa Technologies. In fact, I was looking at the data. Nearly 20 companies in that 100-odd companies which have seen a change of CEO, they've given an average return between 30% to 200%. So that's the kind of outperformance we've seen in the companies. Yes, there will be some outliers where some stocks don't do well or the companies don't do well, but that's only 10% of generally the basket of companies that we track. Now the important one. In 2025, some big announcements have already been announced in terms of CEO changes. The first and big company is HUL, right? Priya is now going to, Priya Nair is going to head as a new CEO there. Root Mobile, Titan, Cyient, DLM, Max Financial Services, L&T, Mindtree. There are so many such companies where already the CEOs have been announced or they're going to take over in the months to come. So this is a basket to watch out for in terms of outperformance. But the past data clearly suggests that any change in CEO normally leads to a big re-rating in the stock price, and they generally do very well.
I guess the market perhaps...
that's a whole bunch of stocks that have seen a re-rating on account of that. And obviously, it will also have to reflect in the performance of the company. If performance doesn't keep pace with the promise of what change will bring about, we wouldn't have seen those kind of returns as far as the stock prices are concerned. Surabhi, you wanted to make a point?
No, I was just adding to Nimesh's list, Shireen. In fact, I mean, to take this forward, there's Lever. Obviously, Lever is the marquee change because the first time in the company's history, 90+ years, that a woman is finally taking charge. And Priya Nair is going to come in. And this was the outlier. In a lot of the other cases, for instance, I mean, I looked at some of the other FMCG names like Mr. Suresh Narayanan, but he's exiting because he's simply retiring.
He's completed his tenure. He's had a 10-year run, and he's now handing over the baton.
Absolutely. But in Lever's case, it was interesting. Mr. Rohit Java's tenure was a lot shorter than what people would have perhaps anticipated. And the company note cited that he's moving on for personal and professional reasons. And it's coming at a time where growth is the biggest challenge for these companies, right? I'll throw one more very interesting example where the market suddenly got excited. This is Avenue Supermart. We know, again, growth is a challenge for some of these big retailers as well. And Neville Noronha, not sort of continuing or renewing his contract. The contract is ending and there's no renewal there. The new person coming in is Anshul Aswaha, and this is happening in February of next year. Now, Anshul is coming in with, 3 decades of FMCG experience. So again, the hope being that some of these new names will bring in new energy, new expectations. I'll give you one small example from this week, Shireen. Arvind Fashions. Yes. Now, Arvind Fashion, the stock popped up 8-9% just earlier this week because of the CEO change. Yeah. The new lady coming in, and again, women leadership here, Amisha Jain is coming in. And she has 25 years of experience, and she's come from a lot of global brands, including Levi's, there is Nike India, McKinsey, Motorola. And the market feels that she'll give some new ideas and really jumpstart things at Arvind Fashion. So just some examples. There's a lot of change going on, and the market is excited about the new people who are coming in.
No, I was just wondering whether we can sort of combine Nimesh's historical data and your forward-looking data. And for our viewers, can we come up with a list of, say, 3 companies,
which are going to
2 or 3 companies which will outperform? Is there a way we can do it? Now, it's not our job to do it, but I'll give you just a frame of thinking. And this came from Persistent, Nimesh. Sure. Persistent, Mr. Anand Deshpande is the founder. He's himself a technologist. He's actually a pretty visionary guy, right?
Technocrat, correct.
But he ran the company from 2000. I mean, for what 15 years before that. I just looked at on my phone the price chart, right? From 2010 to 2020, 10 years, actually more. To go back a little bit more, the stock did nothing. I mean, 100 to 150, 170. Right. And then 2020, the new CEO comes in, who's done a fantastic job, and we speak with him on earnings, etc. all the time.
It shows up in the numbers as well, Prashant. Yeah. So look at the...
So but there are 2 things. One, he took over when there was this huge IT boom.
This whole COVID, guys, you have to give him that.
And there was that tailwind. Well, but, Surabhi, but to be fair, he did a fantastic job as well. My point is that the companies that you mentioned, can our viewers take out... I mean, well, at this point in time, we are wiser in hindsight, but at this point, is there any way to tell? Yeah. I mean, this is the company to put your money on. So, maybe this is one way. Huge underperformance in the past. Maybe that gives you a bit of a springboard to do well.
So again, Prashant, my data only says that it's a good starting point for somebody to identify a stock for a potential winner.
Absolutely.
If there's a change of guard, you potentially...
let me give you one example from my list. So, I mean, how do you try and project something into the future? You can only make intelligent guesses, I suppose. So in certain cases, and again, this is no indication of any stock price performance or any company performance in the future, I'm just going back to my list. So let's go back and look at what's happening with the Anshul at Avenue. going back and looking at Anshul's track record, I mean, he's been known as the master in terms of e-commerce and digital strategy.
Exactly.
Where he's been earlier. I mean, all the years that he's spent at HUL, particularly in the home and personal care business. So if some of that, and maybe that's a niche that DMart is looking to break and
that is
reach.
something which is missing
It's
in
the
DMart.
E-commerce challenge that
Right.
you have to take on.
Exactly.
So here's a specialist coming in, and let's see what that leads
That's
to.
exactly what maybe R.K. Damani wanted, right?
Yeah.
I mean, he's grown organically in a very brick and mortar format for very long.
Yeah.
Now he's facing the challenge of e-com.
Absolutely.
And you can feel it. You can see in the stock prices as well. The stocks are not doing good. The numbers have been quite weak as well. So they need a fresh.
You should have picked somebody from Flipkart or Zomato or something like that.
To actually look at e-com.
Why HUL?
I think, I think that, there are legitimate reasons for why people may be considering bringing in fresh blood and fresh energy today, because the market has changed. I mean, look, for the FMCG sector, it's been a difficult period. It's been reflected in volume growth and so on and so forth. But look at how the landscape has changed. What was the big moat for companies like HUL? It was their distribution might. You just didn't have anything else available on the shelves. That's completely changed today now with the D2C, emergence of D2C brands, with the emergence of e-commerce, now the emergence of quick commerce. Distribution muscle is perhaps not the kind of leverage that you enjoyed or the benefit that you enjoyed previously. So I think you need to rethink, you need to reimagine, and you also perhaps need to get muscle that understands the workings of this new environment, and perhaps that's weighing on some of the decisions that we're seeing. But, this is one aspect. But the other aspect, and we brought up Renuka Ramnath's conversation that I had there, along with Dilip Piramal, I think that's the other big focus area to look at. What is happening with the Indian promoter? What is happening with Indian promoter groups? Is there an intergenerational transition, a massive intergenerational transition that we're seeing? We've heard Uday Kotak talk about it as well. In fact, he was the first one saying, look, the next generation now is interested in managing money, not managing business. But does that also then throw up opportunities for investors? I mean, now Dilip Piramal selling VIP to multiples and a bunch of other investors. Let's look at that piece as well and what that could potentially mean from a market's perspective.
So last 2 years, 2023 and 2024, we've had humongous amounts of promoter exits. I mean, the numbers are very, very large. They will come up on your screen. 2025 so far, by the way, that number already stands at, this is the first half of 2025, almost 65,000 crores.
Yes.
So you're going to end up at this pace, promoters are going to sell shares in their companies to the tune of 1,20,000, 1,25,000, 1,30,000 crores. The 23 and 24 numbers are on the screen as we speak, right? So these are very large numbers. What has happened over the last 3 years, promoters across all NSE listed companies used to own about 44%, right? India is a very peculiar market. US, there are lots of companies where
zero promoter holding.
No promoter holding.
No promoter
completely
holding. Virtually
institutionalized.
zero.
India is a very different market, but it's changing. 44% promoters. 3 years back, that number is now 41 point something, around 40 basically, around 40 odd percent, largely. Now, what are they doing, right? They are exiting, and Nimesh and I have spoken about this a lot in the past. A lot of this money is coming back.
Back to the market, yeah.
But there's no way to tell how much money is coming back. But there is one sort of indication which we can get. Family offices.
Yeah.
Family offices are not a new concept. They're a very old concept. I mean, but I mean, I think it's got popularized in the US in the 90s, and it's come into India in a big way. From 2018, when there were 45 family offices, that number now is almost 300 family offices, and assets under management, and I picked this up from a Julius Baer report, $30 billion is managed by these family offices.
That's what they're now forced to reckon.
That's huge, right?
That's huge.
So why family offices? Preserve wealth, succession planning, separate business from personal,
diversification.
Personal wealth, enable global investments, professionalize, of course, money management, etc. And this Julius Baer report talks about 50% plus portfolio in growth assets. I mean, across these family offices, 25% plus exposure to PE, VCs, VC, big bets in AIFs, private credit, REITs, and diversification, risk-taking, etc. So there's global aspect as well. A lot of these guys are based out of Gift City, which enable them to access global markets as well. So, I mean, the short point is a lot of this money is coming back into the market. And I think, as Shireen said, maybe managing money is easier than managing businesses. Correct. It is.
This is
Make money, lose money, but it is.
I wrote about this, Nimesh, because when Shireen mentioned Uday's tweet a couple of months ago, and I think we had written a piece, I had written a piece on this and reacting to what he had said about all these Nepo kids not wanting to run a business, which I think is fair because there is too much pressure on them. And we have there is an opportunity, like Shireen said, for policymakers also to review that what is the incentive on capital versus what is the incentive for effort. And so your income tax and your corporation tax is much higher than your capital gains tax. And as long as there is, incentive, like if you can just make $10 billion from capital, and it will be taxed less. But the same thing you have to do as a business, then you'll be taxed more, there is a lot more effort, there's a lot more anxiety, and you are carrying the weight of your family name on your shoulder. So your margin for error is much less. So obviously they will choose to just put up a family office and manage the money.
But who
wants to take the risk?
I have a slight counter view to this. Ultimately, if you're saying that you're going to manage a family office and you want to buy somebody else's company, if everybody is managing family office, who's going to run the business?
People from tier 2 and tier 3 cities. Your Vijay Shekhar Sharma
make money if a promoter is putting in his hard effort.
I'm saying your Vijay Shekhar Sharmas and Ritesh Agarwals and other people.
I think if we go one layer deeper in the debate, and you guys raised the point about the US being a different market where you have far more, many professionally run corporations. And Shireen, maybe your thoughts on this, because you speak to leaders across the spectrum, right? So India till now has been a very promoter-driven market, promoter-driven businesses, sweat and blood and animal spirits and all of that. I mean, in all your conversations, do you see maybe an evolution towards a corporatized model? I mean, will professional boards, professional companies still be able to fire and inspire the same animal spirits? What do you pick up in all the people, global and local, that you speak to?
At the end of the day, there's something to be said about having promoter-driven entities because, your blood, sweat and tears are invested. You have skin in the game. But there's equally something to be said about companies that have promoters but are run by professional CEOs, have strong independent boards that help the company design and play out their strategy as per the needs of the market. So I don't think it is it's one versus the other. But I think what is important today, and how many times have we had this conversation? I don't like the word Nepo kids, Sriram, but I don't like labels.
Yeah, the Nepo kids have embraced
in general, but I just feel like there was always this thing that what's the big deal? You're the son of the promoter, so now you've become the CEO and so on and so forth. It was always looked at with a little bit of sort of like, I wouldn't say disdain, but it was looked at, okay, what's the big deal that you've done? And now if that person is turning around, the kid is turning around and saying, I don't want to do what my father and my grandfather and so on and so forth have done. I'd much rather either turn entrepreneur,
which I support,
different from
which
what
is the great point,
is, or run a family office or whatever the case is. I'm saying if it is in the interest of the organization, and I go back to Harsh Mariwala's point. He said the reason why he got Shogato in over a decade ago when he decided to step down and not his son, because he felt his son was not ready for the job, was not ready for the role at that point in time. And he said, I was absolutely sure that I would ensure that the organization's interest preceded my interest as a promoter. And I think if that is how promoter-run families are approaching succession, so be it. It's good for everybody. It's good for the companies involved. It's good for investors. It's good for all stakeholders. So I'm all for the fact that if bringing in a professional actually ensures better performance and delivers on growth, why not?
Why not? Which is what Mr. Piramal said, right? He said, I'm selling it to a private equity entity. And by nature, by definition, private equity is in it to make returns, to run the business well, and to create shareholder value.
I think one company we speak to, and Shireen, you speak to all the time, is Mahindra and Mahindra.
Absolutely,
right?
I was about to
look at what Mr. Mahindra has done.
Exactly.
He stepped away, given up control. Anish has taken over the last 4 years, has done a phenomenal job. I mean, he's basically gotten rid of loss-making businesses.
When a change of CEO comes in, you have to look at the stock.
And again, during COVID. Right? I mean, around that time is when he took over.
And again, he was very clear. The day he started, he was very clear. His first goal will be to make sure that there is proper capital allocation. And that is something which a lot of investors took a leap of faith and invested in, right?
So many businesses, SsangYong, all this. I mean, he kind of sort of, whittled all those down and focused on the numbers.
In the last 4 years, he's shown in the numbers.
Coming back to Sriram's point and this idea that if the next generation of Indian promoter families are not running businesses, who will? There are plenty of people. I mean, if there is one thing that I'm absolutely willing to bet my money on today, and I wish I had the opportunity of being able to do it 23 years ago when we started Young Turks, is India's startup ecosystem. India's aspirational quotient has changed. There is capital. All of these family offices are willing to write out checks. And there is an aspirational Indian that is willing to do the heavy lifting when it comes to setting up enterprise. We need to make it easier for them. We need to make it a lot easier. It's not easy starting up a business in India. It has gotten easier, but it's not easy starting up a business in India and running it to any kind of scale. That's the opportunity. And that is where I believe, the government's policy intervention, attention, and all of that also needs to focus on. But that is another, we could do a whole other show on that, but
absolutely.
That's another aspect.
That is exactly what I just want to add to that, Shireen. Essentially, in simple words, what I'm trying to say is this arbitrage between the incentive, the benefit of for capital as a capital investor versus somebody who's investing their effort. That gap has to shrink and come closer to zero. That's the short point. So if you still want to be an financial investor...
People in the investors are going to throw things at you, Sriram.
That's fine. It's an opinion.
Don't push that line
that's a risk. The gap between... there should be equal appreciation of effort as much as there is capital. That's all there is for capital.
I just want to throw one last thought as we wind this up, guys. One sector, and we've listed a whole lot of CEOs changes, MD changes that are happening next 6 months. None of the large cap IT services figure in that list. And that is the one sector that's going through the biggest amount of disruption, existential questions in front of them. So we hope current promoters, current management, professional or otherwise, they get through and they ride through the challenge.
That is why I was about to tell you that, when you compare that persistent data of outperformance, and you compare with all the IT companies, I'm not saying Persistent did well because of the COVID lows and whatever. Since then, in terms of numbers, in terms of growth, this has been the best performing company as far as the growth is concerned. So something that, you know,
Leadership's
Sandeep has done well
definitely
in
brought
terms of
something
going out
to the table.
and taking right decisions and you know, reaching out to the right sorts of
But I won't
companies
be
for
surprised
growth.
if tomorrow a bunch of these, there is a need for all, like right now technology is like sort of ubiquitous, right? It's a requirement for everyone. So whether you're a retailer, whether you're a manufacturing guy, whether you're making shoes, whether you're making nuts and bolts, everybody is going to need some guy to lead the technological disruption and the transition. And a lot of these people, you know, I wouldn't be surprised if some of them move into different companies. And I'm
That's an interesting point, because look at who's coming in place of Suresh Narayanan at Nestle. It's somebody from the tech universe that's actually coming into FMCG, because the nature of the game has changed as far as FMCG.
Which is why I asked why DMart chose somebody from HUL and why not from a Flipkart or a Walmart or some, you know, some other.
Actually, on a lighter,
brick and mortar experience combined with, I think, you know, digital
on a lighter
experience.
note, FMCG and IT are quite similar nowadays.
In terms of numbers, at least.
Everything is IT now.
Return ratios are high, cash flows are high, but P&L growth is very slow. So,
See, no matter what your
IT companies like 0% growth these days.
no matter what you're selling, your product officer is a techie. so that's a fundamental,
But,
you know.
I just want to end by saying that, you know, while we're talking about change and we're talking about churning people perhaps every decade and so on and so forth, I'm going to come back to the fact that, look, don't link it to tenure, link it to performance. For all of our sakes, we've all been around for more than 10 years. So for all of our
That's the theme of the month. That's the theme of the month.
It's running into decades now.
But Shireen, like you said, your point on the
for the sake
startups.
of self-preservation.
Yeah. But I think Shireen,
Absolutely.
we have the capital now. I think I want to summarize what everybody has said into one line. Prashant pointed out that we have the capital now. The family offices have bulked up. That money has to go somewhere. And like you, Shireen, pointed out that there are people in young entrepreneurs, aspiring entrepreneurs, who are waiting in the wings in smaller cities, etc., who are going to take whatever comes their way because they have a point to prove. This capital has to flow there. The only thing...
It's actually flowing, Shriram.
Correct, it is.
Actually started flowing.
It has to flow there.
The avenues have opened up. Look at the SME platforms. Look at like how family offices are putting in money in unlisted companies. There is ample liquidity which is there for smaller India Inc. to capture and grow.
So to what I'm saying is, for anybody who wants to throw things at me I'm saying let this money is going from the people who have the wealth to people who want to do the things.
Who have the ideas and the ambition.
Correct. And I'm asking the government, don't come in the middle and take it away. That's all I'm saying.
That's a new angle now.
Fair enough. Fair enough. That point is well taken. But you know, we've given you some ideas on this program on the changes that are underway, the winds of change that are underway in terms of leadership. Some, as I pointed out, on account of tenures getting over and so on and so forth. Some on account of apparent need for leadership change to keep pace with the current environment. And some, of course, because the promoter family has decided to exit or has decided to professionalize. But all of these are going to be interesting developments, and these stocks will be stocks that we will watch closely. And let's see which hypothesis plays out. But Prashant, Surbi, Nimesh and Sriram, thanks very much. As always, it's been fun. We'll see you again on the Editor's Playbook. Till then, from all of us here, goodbye. Thanks for watching.
Hello and welcome to News Centre. I'm Parikshit Luthra. The monsoon session of Parliament saw a stormy start as protests erupted in both houses, with the opposition demanding discussions on Pahalgam terror attack and Operation Sindoor. Opposition parties also raised questions about the government's foreign policy after US President Trump's remarks about brokering a ceasefire between India and Pakistan. Leader of the Rajya Sabha and BJP President JP Nadda maintained that the government is ready to hold a detailed discussion on the issue and is not running away from debate. Sessions in both houses have been adjourned till tomorrow after protests. The government has listed 15 bills for consideration, including major reforms like the new income tax bill as well.
सब मिलकर के कि देश ने एकता की ताकत देखी है, एक स्वर का सामर्थ्य क्या होता है देखा, तो सदन में से भी सभी माननीय सांसद उसको बल दें, उसको आगे बढ़ाएं।
मैं चाहता हूं कि उनके तरफ से हमको मालूमात मिलना चाहिए, जैसा कि पहलगाम हमला 22 अप्रैल को हुआ था। अब तक आतंकवादी पकड़े तो नहीं गए, लेकिन हुआ क्या?
कहीं ये संदेश नहीं जाना चाहिए कि सरकार पहलगाम और ऑपरेशन सिंदूर पर चर्चा नहीं चाहती। हम चर्चा करेंगे, हर तरीके से करेंगे।
अगर इशू ये है कि कन्वेंशन कहता है कि अगर सरकार के लोग कुछ बोलें तो हमें भी स्पेस मिलनी चाहिए। हम 2 शब्द कहना चाहते थे, मगर विपक्ष को ये अलाउड नहीं। थैंक यू।
To take this discussion forward, we're now joined by Charu Pragya, who is a spokesperson of the BJP. We also have Salman Soz, who is a spokesperson of the Congress Party. Salman Soz, if I can begin with you. During Operation Sindoor, the opposition, including the Congress, had wholeheartedly supported whatever the government was doing in terms of retaliation against Pakistan. Now, one of the main reasons why there was sloganeering and the House was adjourned was because the Congress and the opposition wanted a debate on Operation Sindoor. What exactly are you seeking as answers from the government at this stage?
Well, there are lots of unanswered questions. It's not just about the operation itself. We first have to fully understand what happened in Pahalgam. Who were these perpetrators? How did they manage to get to that particular location? What kinds of lapses led to that massacre of 26 innocent people? And the destruction of the peace of so many families. From there, and you talk about apprehension of those people, we don't really know where they are and all that, but that's one aspect of it. The second aspect is the operation itself. There have been many revelations now since the operation started about how, because of what the government strategy was, the Pakistani establishment seemed to know everything that we were going to be doing. And because of that, we may have suffered some losses in the initial days. Now, those losses should not have, if those losses were suffered by our side, those should not have happened. And if that happened because of a political decision, then we need answers for that too. So that's the other aspect of it. Then there's this foreign policy aspect of this. And the foreign policy aspect of this has become very, very pertinent. How does the US president claim that he brokered something between 2 nuclear powers? They're both great nuclear powers. He says there's no condemnation of Pakistan. There's no Security Council resolution condemning Pakistan or condemning terrorist activity sponsored by Pakistan. So that is the other aspect of it, that the US government has basically taken it upon itself to manage our affairs.
Okay.
How can that be?
So, Salman Soz, I'm going to just break this down. I'm going to break this down. I'm going to return to you. But let me also bring in Charu Pragya to answer the first question. At the time of Operation Sindoor and after that, Charu Pragya, there was support from the Congress party. But now the time has come to answer those critical questions in Parliament. First, Why were there security lapses that led to the Pahalgam terror attack? And where have those terrorists actually gone? Yes, we've taken action against Pakistan, but what about the actual perpetrators? What will be the government's reply?
Parikshit, good evening, and good evening to my fellow panelists and all our viewers today. It's unfortunate that our parliament session yet again has begun with a ruckus instead of a debate. We were waiting for a very constructive discussion. Even the citizens of this country want to know exactly all the details about what happened in Pahalgam, also Operation Sindoor. And the government is ready to discuss this. The government wants to discuss this. Yet what do we see? We see an opposition coming in prepared to cause disruption. No discussion. Only disruption. If the government wants to speak, you want to stall that. If the government says, yes, we will speak on every single agenda listed by you, they want to give a timetable. And when the timetable is also kind of ready to be expected, they set one other goal. So the fact is, they keep shifting the goalpost. They don't realize that every single day we lose in parliament, it is a loss to the nation. It's our loss. There are important bills to be tabled, important discussions to be had. Yet how can we have those kind of discussions when our opposition just wants to focus on one thing, that our productivity becomes zero? Parikshit, if I can quote, around 16% of our parliament's time in the 16th Lok Sabha was lost due to disruption. This figure rose to 35% in the 17th Lok Sabha. 35%! And we've seen visuals never seen before. We've seen marshals manhandled into hospital. That is the extent to which the opposition has gone. You can't keep shifting the goalpost. When the government wants to discuss something, why don't you just sit down, open your ears and your minds, more importantly, and listen to that discussion. You will have ample chance to respond. Today, even before the House gets into order, even before the day begins, the disruptions begin. Tell me, who is going to believe that this is not orchestrated? This is not spontaneous. You walk in with placards, you don't want to discuss policy. You have reduced our parliament and its time to a joke, and the joke is on you.
Okay. All right. Salman Sost, here you have the BJP saying they're ready for any discussion. Then why the protest in the House? If there was a notice given by the opposition for discussion and internal discussion with the government would have allowed a debate to take place, what was the need to resort to sloganeering on the floor of the House?
Let me just begin with reminding Charu and the BJP and all of the viewers about what Mr. Jaitley said about and Mrs. Sushma Swaraj said about BJP's disruptions of Parliament when Dr. Manmohan Singh was the Prime Minister. But this is not about that. In fact, if you look at our discussion here between Charu and me, how did it start? Why is this discussion happening? You asked me a question, I answered, and then Charu got an opportunity. Similarly, in Parliament, the norms are, as Rahul Gandhi said in that bite, there are parliamentary norms, which the BJP under Narendra Modi has, those norms have been destroyed. The defense minister makes a remark, makes a statement, and the leader of the opposition says, okay, can I say something? No, but you cannot say something because you're Rahul Gandhi. You're leader of the opposition. Opposition does not matter. Why is it that the speaker consistently acts as if he's an agent of the BJP? What is the difficulty in the leader of the opposition? Because the leader of the opposition represents 240 seats. You're not giving the leader of the opposition not even one sentence? Is that fair? Or do our
Salman Soz, yes, the Congress has the right as the opposition party to protest in the House, lodge a protest with the government, and I think the BJP spokesperson has alluded to what the government's reply to the opposition's sloganeering would be. One question that I'd like to ask you about Justice Yashwant Verma. At this stage, do you feel this is an issue that can be taken up by the Parliament at the earliest? There is enough consensus on the motion for impeachment, both in the opposition and across opposition ranks, actually?
Our party has made a very clear statement on some of the top priorities for this parliamentary session. And of course, if we have extremely serious allegations about justice, we have to take that up. But the Congress Party has said that for us, the national security, Operation Sindoor, that is a huge issue. The relationship, our foreign policy and rivalry with China and how that will take shape, that is very important. How the American president, how the American administration is dealing with India, which quite frankly is not very good. We need to discuss that. And by the way, we have the issue of Jammu and Kashmir and Ladakh and Manipur. Those are extremely important to us in the Congress Party. We will be pushing for those items, and I'm sure the government. These are national security. These are not just national security. These are national interest issues, and we must discuss them.
National security and foreign policy questions. We're having a trade deal with the United States. Where have we reached? What are our relations with China? China has cut off supply of rare earth magnets, specialty fertilizers. How is the government going to answer these critical questions of foreign policy? It's not just Operation Sindoor, it's China, it's the trade deal with the United States, and also the US talking about a trade deal with Pakistan. How will the government explain this, and how soon can we expect a response from the government?
Thank you, Parikshit. Yes, these are important, pertinent questions. But if I can quote Piyush Goyal ji here, who stated very clearly that India is not going to sign anything which is not to India's benefit. And these discussions are underway. Very soon we will start having all the details unfold in front of us. And this is why I must again stress upon the fact that our parliament needs to function smoothly. There's a lot of legislation that needs to be done. There's a lot of discussions which need to happen. And none of it can happen if the leader of opposition is encouraging another MP to jump into the well, to disrupt the discussion which is already going on. This is not dignity. This is, it's being looked upon by the entire nation with a lot of distaste, and we have to do away with this. There are critical issues which involve our country, even at the international platform. There's so much happening domestically in India itself. How are we even going to have these discussions when the hint at disruption begins even before Parliament begins? And whatever Mr. Soos is saying right now, you sound like you want to support the government, but the fact is it didn't happen, right, sir? It didn't happen. After Operation Sindoor, after Pahalgam, you gave statements in all party meetings saying that the opposition stands behind the government. Yet what did we see unfold? Over the next weeks and months and even till today, we have seen unfold an entire scenario where the opposition is seen to be siding with India's enemy, not standing with India. Yes, demand your answers, but the time to demand answers is now. It's now when the parliament is in session. What were you doing for all these months? Why were you working so hard to bring down all of our country's hard work on the international platform? You have done that. And I don't know how you can go back home and look into the mirror and not admit to the damage you have been causing to your country because you need your own politics to seem a little shiny with those extra 15 seconds of media fame today. That needs to stop. All the answers will come.
Over the next,
I assure you.
Till 21st August, we are going to see about 20 to 23 sittings, and it's going to be an important session. A lot of important answers that the government has to give, and we'll also have a future discussion, and we'll probably have Salman Soos with us once again on whether he would be and the Congress would be supporting the Jan Vishwas bill and the new income tax bill that will be discussed and taken up in this session. We've run out of time, but thank you very much to both Charu and Salman for joining us. A select committee of the Lok Sabha has made 32 observations on the income tax bill, which proposes sweeping changes to current laws. The panel was headed by BJP MP Vijayant Panda. The report runs into more than 4,500 pages and was tabled in the Lok Sabha today. TMC Jaipuria is here with the details.
The Select Committee of Lok Sabha makes 32 observations on Income Tax Bill 2025. The Select Panel's observations pitch for clarity, realigning definitions to avoid confusions. It calls for corrections to drafting errors and ambiguous wordings. For example, the Select Panel's observation includes aligning the definition of capital assets with recent amendments in Finance Act 2025. It says that the capital asset definition must reflect legal landscape for treatment of sections held by FIIs, investment funds. Further, for infrastructure capital companies, the panel noted that the definition is unnecessarily complex and amendments should be made to directly incorporate the full definition of infrastructure facility. The panel also proposes clarity on deduction computation on income from house property to enhance fairness and transparency. On income from house property, it says that the law should explicitly state standard 30% deduction to be computed on annual value after deducting municipal taxes, and the purpose allowing deduction for pre-construction interest for both let out and self-occupied properties. Similarly, the panel is in favor of ensuring that there is no ambiguity arising regarding deduction allowed for business operation expenses. There should be a specifically clarity that should be present which says that expenses are disallowed and where expenses are allowed. It also suggested that the government should consider redrafting the section on expenditure on scientific research, basically to clarify that an approval of scientific research should be required from which specified authority to claim this deduction, and a lot more. Now to be seen is how soon there is more clarity and a fewer headaches when it comes to a fairer tax code being presented, which will come into effect from 1st April of next year. The ball is now in Parliament's court, and how soon the government gets back with these changes, something that we'll have to wait and watch for.
Time for a short break, but don't go anywhere. News and updates continue on the other side. India and the United States have concluded the 5th round of negotiations for the proposed mini-trade deal. Sources have said that an American negotiating team is expected to visit India for the 6th round of talks in the second half of August. Abhimanyu Sharma joins us now with the details. Abhimanyu, what are your sources telling you?
India's trade delegation has already returned from the United States after concluding the 5th round of negotiations with the United States for a bilateral trade agreement. Government sources have indicated that now the American trade delegation is expected to come to New Delhi in the second half of August for the 6th round of negotiations with New Delhi. It remains to be seen how early both the sides are seeking to conclude any kind of a deal, even as the negotiations are still continuing. Now, speaking about the overall change in trade, the overall change in exports, speaking about Q1 of FY 25-26, there has been an increase in exports from several countries to the United States, which include countries like India as well as Mexico and the EU. However, trade, particularly exports to the United States, have declined, with the highest decline being noted with China, the highest among G20 countries, which has witnessed a decline. Also, Canada has witnessed a decline with exports to the United States. Speaking about overall trade data from the United States, there has been a decrease in overall import orders from the United States due to uncertainty, and trade substitution is also taking place since the past year. Now, speaking about data from May 2024 to May 2025, there have been several trends which have been noted. China's share in textiles exports to the United States has fallen from 27% to 14%, and India's share in textile exports to the United States has increased from 9% to 12%. Vietnam's share has increased from 14% to 18%. Speaking about other commodities, China's share in agri exports to the United States has fallen. There has been a marginal rise in India's share in agri exports to the United States. Also, speaking about commodities like electronics, India has seen an increase in its overall share in exports to the United States, particularly in segments like solar cells and mobile phones. It remains to be seen how early the negotiations are going to be concluded between both the sides, based on which any further negotiations, any further deal is going to be signed.
And United States Treasury Secretary Scott Bessent said that though talks with several nations are progressing ahead of the August 1st deadline, it is less about timing and more about the quality of the agreement. Listen in.
Talks are moving along, but the important thing here is the quality of the deal, not the timing of the deals. And President Trump has created maximum leverage, as only he can do. And what we are seeing is like these imbalances built up over 20, 30, 40 years. And we are more concerned with high quality deals than getting these deals done by August 1st. Our trading partners were told that the rates could boomerang back toward the April 2nd levels. We can continue talking then, but again, we're proceeding at pace with the negotiations, but we're not going to rush for the sake of doing deals.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
and welcome to the Medicine Box. I'm your host, Ekta Batra. Today, we're diving into what can only be called a digital epidemic, India's screen time crisis amongst children. What starts as harmless exposure in infancy is now a silent emergency. Babies under the age of 2 are spending 1.2 hours a day on screens, despite the WHO recommendations of none. Kids under the age of 5 average 2.2 hours a day, double the advised limit. Post-pandemic, screen time has jumped to over 4 hours a day, often unsupervised. And it doesn't end there. 42% of kids under the age of 12 spend 2 to 4 hours daily, while teens can hit up to 10 hours a day. A local circle survey shows 60% of kids aged 9 to 17 spend over 3 hours daily on social media or gaming. Nearly 60% of kids aged 5 to 16 show signs of digital addiction. What's driving this? A changing lifestyle, nuclear families, fewer social interactions, and a growing reliance on screens as digital babysitters. Physical activity has plunged. Indian kids average just 86 minutes a week against the WHO's 420-minute recommendation. Outdoor play is 50% lower compared to previous generations. From speech delays and obesity to aggression, anxiety, and social withdrawal, the impact is real and rising. So how much is too much? And how do we raise children in a digital world without risking their well-being? Joining us today, Dr. Nihar Parekh, pediatrician, and Dr. Kamna Chibber, head of mental health at Fortis Healthcare. Welcome, doctors, to the show. Dr. Parekh, I'll start with you. You're seeing children every day. What are the red flags which have come up when it comes to screen time exposure, say when you compare it to, say, 5 to 10 years ago?
So 5 to 10 years ago, we never had that kind of addiction levels that without a particular screen, a child wouldn't do something. Screen was never a part of a day-to-day activity schedule in such a way that without that, the schedule would not exist. Now today for a parent, when there is, or a child above a certain age, a screen has become a go-to. It's the first thing that they ask for when they come from school. They don't eat without it. They won't sit without it. Before sleeping, before any activity, it's a sort of what we call as the only form of gratification that they're now getting. And that addiction is the scary part, where they've stopped enjoying anything and everything else. And that's what's happening now.
Okay. Well, Dr. Chibber, just wanted to narrow down on the part with regards to content as well. Because it's not just the screen, it is the content which has changed as well. There are images which change every 5 seconds, there are louder noises, it's more dopamine driven. So tell us about how exactly content is driving addiction amongst children.
See, the biggest thing is that the content is being created in a way that it really grabs the attention of the children and the adolescents. And the kind of content that is put out there often is on topics that would be exciting for the mind of the child. What also ends up happening is that because sometimes monitoring may not be available, children may end up watching content which may not be necessarily age appropriate, and that too would grab their attention, because how many times during the day would parents or adults really be available to keep on constantly keeping a watch on what exactly is the child watching? So understanding the mechanisms or the tools and strategies that are being used with content being very interactive, creative, using a lot of sounds, a lot of color, it really grabs the attention of both children and adolescents, keep them wanting to go back to it again and again, and seems to be replacing a lot of their activities which should be happening in person, outside, through even unstructured time. Those pieces keep on going missing in their interactions, in their day-to-day routines.
Children under 2, according to a lot of data in India, are watching around 80 minutes of screen time per day. The WHO recommendations, the recommendations in India itself is 0. How harmful is this exposure?
So, we live in a very practical world. So, today's day and age, when you recommend a certain things, it is considered that the recommendations are to be followed, but they are less likely to be followed. But there's this one recommendation that I sincerely request every parent to try and make it happen, is try and keep the screen time under 2 years of age in children to as close to 0 as possible. Because in these times, it's the stimulation of the brain, the neuronal connections which are being made, and if that is not being shared as eye contact with parents, as interaction of noise and parents singing to the children, interacting with other people around, this is where the children learn how to communicate. And that is what is lacking. And research also shows that screen time under 2 years of age, if given not only skills of communication, we have digital autism in which they don't speak when expected. They're normal, but they don't because they've never learned to speak and they're never been communicated with. And number 3, because they're listening to only that voice, the recognition of the parents and other people around, also they're not empathetic as they grow. And they're more prone to have other addictions if screen time is shown within the first 2 years as they grow on later. So there are a lot of strict no's for screen time under 2 years of age.
Okay. But what are you seeing in your practice?
They all do it. So it is, what we can do is, rather than saying no, is explain them what all can go wrong. If they do it now, it's not harmless. And number 2, try and ask them to bring it down to as less as possible, number 1. Number 2, no small screens, because those are way more addicting than bigger screens. Number 3, we want interactions. Only interactions with parents, people, those are as stimulating as they can get. It is very difficult for any parent in a micro-nuclear family to not have screen. They have a gazillion errands to run in a day. They have their child not eating. They want to finish the meal quickly. They want the child to sit at one place so they can do other things. So yes, these are some pros, but again, we beg all our parents not under 2 years of age.
Yeah. Between 2 to 5, I think that's where the bigger problem is, right?
Yes.
You know, the average screen time is 2.2 hours a day. That's again double the recommended limit. Right. What is the impact of development at this stage? Because they can understand, they can talk back, and they do have opinions as well.
So I'll tell you what, this is the new age addiction for children. And research shows that, like you first mentioned, the word dopamine, the feel-good hormone in the brain. It is such a surge with the digital exposure and is so addicting. It's not less than any of those drugs that adults consume. So the addiction level is twofold. One, to keep doing it again and again. And second, what happens to their brain when it's not given, when it's taken away, when it's not. So we've seen 2 problems. Number 1, they're addicted. They don't do anything without it between 2 and 5. That is their time where they are behaviorally not that easy to manage. So that's the time where the parents tend, the terrible twos and the temper tantrums and behavioral issues, normal. But the parents, to find an easy way out, that's the time they use the help of digital. And when they see the advantages that their life becomes easier, then they keep doing it again and again. The child gets addicted to it. The child doesn't do anything without it. The minute the one fine day the parent realizes, or they come to me and say, look, this is out of hand now. And I say, you know what, a child is addicted. So there's another approach to it, going cold turkey. Now, any addiction, when you want to stop, and if you try going cold turkey, we warn the parents, it's not as easy as it sounds. They say, no, we will do it. In 2 days, I get a call, he's hitting me, he's biting me, he's screaming, he's running to the neighbor's house, finding the phone. If I don't show the phone, he's taking my phone and throwing things. So you have to prepare yourself. So I want to warn, by saying this, I just want to warn the parents that that piecemeal of screen time they're doing every day, just to keep their schedules intact, be mentally prepared. The day you think things are going overboard and you want to control it, it's not going to be easy.
Okay, but what is the impact of this screen time? I know the temper tantrums, but separately in terms of development.
They don't like, so it's twofold. Physical, mental, emotional. Physically, eye issues. Mentally, early posture, physically, early posture issues. Obesity. They're stuck to the screen. They don't like going out to play. It's not as much fun. So they stay home watching the screen or the phone, and they're happy with their parents. And it's like the Pavlov's bell effect. The minute there is screen and food, the next time they see screen, the body wants food. So they keep eating even though they're not hungry because all their meals have been given to them in front of screen. So next time, even after the meal, if the screen turns on, I'm hungry. Obesity is a big problem. So these are things, and they don't want to interact. So later on, they're isolated, they've not made friends, leads to early depression, and childhood depression is a big thing. And screen time has a huge role to play in this.
Okay. What about educational videos? How do you feel about that?
That's fine. Good content done. So all the screen recommendations that is recreational. WHO recommends 2 hours. That does not include your educational. So educational is fine. Again, under parental guidance, age appropriate. It should be okay. And I prefer the bigger screen.
And how long?
So again, I would say half an hour extra above the recommended recreational screen time, under 5, and an hour extra above the recreational screen, above 5.
Okay, all right. Well, Dr. Chhibber, you know exactly what Dr. Parekh said, that this excessive screen time results in these behavioral issues. Just tell us about what you've probably seen in your practice, and how does one practically withdraw your child from this in order to prevent those temper tantrums?
I think in a lot of situations, what we end up seeing is that the tantrums do not stay restricted only to the home. It's also that those tantrums often will appear in social settings or settings outside. When you're out, say, for instance, at a shopping complex as well, or you're out at, say, a relative's house. The understanding of those social behaviors or socially appropriate behaviors also keeps on getting compromised, and parents tend to find themselves in a very difficult situation where they feel this sense of embarrassment, and often later on it starts getting accompanied with an emotional experience of even shame at times, that, okay, why is my child responding in this way? There may be other children who are behaving differently and who are not reacting in the same way. And I think that a lot of times parents find themselves compelled to keep on repeating the same pattern, giving in to the child, inadvertently reinforcing that tantrum behavior. So what becomes extremely crucial, I feel, is that one, of course, prevention is the best policy. If you can ensure that right from an early stage, you do not give in to the screens as often or for as long a duration, that would be ideal. But if you have found yourself in a situation where screens have become a part of the child's routines, they are used for specific activities. If you're looking to withdraw them, you can't make it from 100 to 0. You will have to do it sequentially. You will need to reduce the duration. You will need to focus on one type of activity first. And what will happen is that the child will resist. They will also keep on testing your boundaries. We need to understand that that is a developmentally appropriate way of responding from the child side as well, that they will keep on testing your boundaries to see how much they can do and how much they can get away with in a situation. So when they're doing that, you have to be firm enough to be able to wait patiently and still tolerate the tantrum of the child so that it gets shaped over a period of time.
Well, Dr. Chibar, while there's research has indicated there's no direct link between screen time and autism, there is this term that we're hearing about, which is called virtual autism. Just take us through that, and how exactly does screen time result in this term called virtual autism?
See, I think a lot of terms get coined because we start seeing certain behaviors and patterns which are manifesting, and it becomes easy for people to communicate in a certain way. But we need to understand that the term autism has a clinical significance, and it should not be used very loosely, I feel. But what patterns we are seeing when we're looking at something like when people are talking about this virtual autism, I think the idea is to try and help individuals understand that what happens is that the child's ability to engage with people on the outside keeps on getting more and more compromised because they are developing a reliance on screens, and most of their engagement is happening on virtual platforms. So they do not necessarily always develop the ability to, say, for instance, form an eye contact. They may not know how to engage with individuals on the outside. The basic social skills that we would hope keep on developing over time sequentially as children interact with other children or even with adults around, that starts getting compromised over a period of time. And then children often also start wanting to repeatedly have that screen available to them, almost in a manner where there is a repetitive pattern to their behavior, which is getting constructed in their repertoire of responding to situations as well. So somewhere these are the aspects that we start seeing, which have then been put together in this fabric of virtual autism, almost to indicate that it's a social communication, it's the development of skills that are needed to navigate through life, which are getting compromised, behavioral patterns which have repetitiveness associated with them, where the child is not being able to pull themselves away from the screen, even though a parent may be trying, or they themselves are able to see that they need to be focusing on other parts. Those do not come together.
Okay. Well, Dr. Parekh, children are playing 50% less than they used to. They are either involved with screens, educational content or not, and structured classes every single day. How harmful is this drop in unstructured physical play for children?
See, obesity is on the rise. And a lot of parents don't understand that the number of fat cells in the body develop in the first 5 to 7 years of age. Now, every child who sits and spends more time in front of the screen, like I told you, it's the brain stimulated and trained in such a way that every time any screen is put in front of them, they do get hungry. Parents forget that even though the child under 5 and 7 looks thin, lean, but the more unhealthy food and the calories they consume, the number of fat cells are increasing. So when that same child who's thin and lanky hits puberty, every fat cell grows. And suddenly you will find children 10 years down the road who are right now very thin and lanky because of excessive screen time, excessive consumption of food and calories, increased number of fat cells have suddenly grown. So you've not even seen what's going to happen over the next 10 years with obesity in children. And the root cause of that is going to be giving food in front of screen. So even though screen time is given, my first request to every parent is do not give screen when they're having meals. Digital free zones in the house is one of them is meal time.
Yeah.
Bedroom, yes, but meal time is one.
But what about the fact that unstructured free play has gone down 50%?
So Ekta, you and me will have to come to live with that. Unstructured free play doesn't exist anymore. How we used to run in building gardens and parks, and this is not going to happen. So it's either you have them going down for a particular soccer class or going for gymnastics, so that unstructured play is not going to happen. So we also, the generation that has been without screen and with screen, have to now change our mindsets of what's going to happen, because these kids are coming up with zero, never ever had screen has not happened. They have been given an option from the day they were born. So we, beyond a certain point, will be nobody 20 years down the road to form these norms of this is normal, that is normal. That may be the new normal. We are just taking our past and our research where there was no screen time and basing these theories that this is what's going to happen. Maybe 20 years down the road, you and me may be the odd ones out. And all these generations communicating will be doing it the right way. So we have to open our minds, but at the same time do what's best for the child's health.
Yeah. Well, Dr. Chibber, you know, now just coming to the 9 to 17-year-olds, and that's where social media also makes its presence felt, because we don't have any rules in terms of banning social media. How important is it, considering that 60% of kids between 9 to 17 are actually spending 3 hours a day on social media or gaming? How harmful is it?
Substantially. And there is no way to compromise on help building this understanding that this impact on children and the negative impact on children that happens on account of the excessive exposure to social media is enormous. And I think it's important to understand why that is so. Because one, there is no regulation of what is the content that's available. Like you also rightly said that what is coming on the screens, we don't know, and how much time they're spending on the screens. We certainly know that that's way in advance. Like the screen shares, it's plus 3 hours of a day that a child, that an adolescent would be spending on that screen. And the conversations that are happening on the social media platforms often do not get controlled, they do not get monitored. Parents, adults may not always have the time to sit down and to keep on monitoring and engaging with exactly what is the content that a child is consuming. Certain information may reach them. Sometimes they may talk about it. A lot of times they may not. Often the understanding for that is that, okay, there is paucity of time. There are so many different things that need to be tackled on the weekdays, on the weekends, that some of these conversations go missing. What we don't realize is that this is impacting children in multifarious ways, including leading to rising levels of aggressive conversations, aggressive communication, rise in the levels of meanness, harshness. It's not just objective trolling or bullying that is a concern. It's the level of the kind of language that gets utilized, where there is increasing desensitization to aggression and violence, which is becoming a large concern because it is impacting children's ability to be able to empathize, to be able to understand the import and the effects that their actions, that their conversations would have on others. And there is a level of callousness which comes in how they tend to communicate or look at situations. So the kind of sensitivity we would want, the kind of compassion that we would want, that gets completely sidelined in a situation like this. And of course, it affects their sense of self, their self-esteem, their body image, their feelings of worth. It takes away from a lot of times the sense of positivity that children may have, because the content they're consuming does not often get monitored, and they may be interpreting it without fully understanding why was the media message constructed, who constructed it, could there be another way to look at it. And you cannot monitor everything, and a child may not always come and ask you about everything, which is the challenge, which is largely there in front of all of us.
Okay, Dr. Parekh, what is the harmful impact of social media on children? It reminds me of, the recent television series, Adolescence. But is it that serious a concern in terms of what's taking place when it comes to social media amongst this age group which can access it, understand it?
So I've been through teenage daughters in the house, and it's very difficult. It's very difficult for them. It's very difficult for us. I mean, the big tech plays a major role in their life. Their entire universe is about this. Their entire self, like Doctor said, Chibber, that this entire self-worth sense comes from what people think about them on the social media and what they're talking about them. So it's very fragile. One bad comment, one dislike, one odd little statement, and some fake profiles can break a child emotionally, physically, mentally. But this is the new truth. Beyond a certain point, a parent, a teenage or preteen has to go through this. Because if you shield them, there's going to be one fine day where they jump into this and they don't know how to handle it, and they will break.
But how do you shield them?
So there is shielding in the way of parental tools, of maintaining guides and locks and this. But bigger tool is opening up lines of communication between your child, physical communication. Befriend them, don't begrudge or push them away from social media because they are going to be on it no matter what. Tell them, look, you're on it, you're on this, you're gaming, you're chatting with people, but I want you to tell me, even in the middle of the night, if this come knock on my door and I will listen to you. When they have that confidence, there are lesser chances of them being, down the rabbit hole and being really traumatized, because if that were there, you will reach a point where everything's gone wrong, and at the end of the day, your child will come and say, all this has happened. It's too late.
Do you think it derails ambition?
Significantly, if the child, I always tell my daughters that being successful at our time was way easier than now because of two things. Number one, huge amount of distraction by social media. And number two, the huge number of options they have. It's very simple. Every third teenager on social media is a multimillionaire. We did a quick survey in my clinic for 300 children between the age of 10 and 13. And we asked them, what do you want to do when you grow up? 87% of them had only one answer: I want to be rich. They didn't say, I want to become a doctor. They didn't say, I want to become an engineer. They didn't say, I want to take up my farm. I want to be rich. Now, where does that come from? That comes from social media. When they see kids of their age driving Lamborghinis and Ferraris, these gaming consoles, the people who play games, they had a recent function, and all of them came in Porsches and Lambos. They're 18-year-olds. So when they see that, their sense of achievement needs to be fast, needs to be quick. And what is the percentage of that happening for them? Less than 0.001%. So what happens to the 99.99%? They get dejected. They feel like a failure. They're depressed. They never reach the goals, not set by them or their parents, but by these social influencers. So it's very difficult now for a child to maintain focus, pick a stream, and keep doing it, because nothing's easy. What is happening is the minute they don't do well, they want to change. The minute this doesn't work, that's not how careers are made. So it's very difficult for them, and I empathize.
Okay, well, we just have a couple of viewer questions, and I just request your answers to be brief for this. Dr. Chibar, can social media addiction be medically diagnosed?
Currently, no. It is something which is being explored more at a research and clinical level at the moment. From a diagnostic standpoint, social media addiction is not a diagnosable condition at this moment. What is also actively being considered is online gaming or internet gaming. As a behavioral addiction, which is also somewhere related to social media usage amongst individuals.
Dr. Parekh, what are the signs that one needs to watch out for?
Like any depression, any childhood depression, staying away from people, preferring to be alone, locking themselves up, not crying, or what we call as emotional fragility, where they cry or get aggressive at a drop of a hat, very emotionally unstable, not wanting, either eating a lot or eating nothing at all, either not sleeping at all or sleeping a lot. So these are early red flags that every parent should look out for, sudden changes in behavior.
For the younger lot, can the screen be in the background?
Yeah, I mean, medically, if you're talking from the radiation or rays point of view, there's...
Just the viewing point of view?
Not that harmful currently.
Okay, all right. Dr. Chibar, can screen time, what is the right way to get your child off the screen? What is a practical middle path that you can probably look at?
I think one, don't start with a no, but instead talk about the boundaries that you could be drawing. So you need to sit down and have conversations to be able to come to a mutual decision, which is something which would be far more implementable, especially if you're looking at a slightly older child who will have will and willfulness in at that age or stage of their life. I think that is one aspect. Second is that you would have to do it with them. So you cannot expect the child to be able to implement whatever rules or boundaries you're talking about on their own. Third part is then if you are telling them to do something, you also need to be modeling the right kind of behavior yourselves. I think that is an extremely crucial part. A lot of times we talk about language, we talk about how much content is being consumed, but we don't necessarily reflect the same in our own actions. And that, of course, completely compromises whatever you're telling your child, because they are not going to be able to follow that. So I think even if we can just look at these three pieces, it would make a huge difference. And I think slowly, steadily, one behavior or one aspect at a time, if you address an issue, it is far more easy to resolve instead of saying a blanket, no more phones or no more devices. That would not necessarily work.
Dr. Parekh, last question for the show. Is social media an addiction that you would possibly compare to, say, sugar, drugs, etc.? Or not even social media, screens?
It is. I would say as much as drugs. It has the same effect on the brain that any feel-good drug does. Sugar is not that bad, but screen and drugs, yes, it is as addicting. And why just the children? We can hardly keep our fingers away from the phone. So you can imagine the impact on them. And we are very aware of where we are and what we're supposed to do, what we're not. I see couples having dinner one-on-one and both are on their phones. So
it's a global epidemic across ages.
Yes.
Well, Dr. Chibbar as well as Dr. Parekh, thank you very much for joining in and speaking with us on the Medicine Box on a topic which is extremely pertinent and only growing in terms of concern. Thanks very much.
Thank you.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end at the high point of the day after a steady session. The Nifty reclaims 25,000. Bank stocks lead the rally. CNBC-TV18 exclusive. We learn the Reserve Bank prodding Axis Bank to recognize stress prompted a review of the bank's NPA framework, which the central bank had flagged as too lenient. Sources say it was this review which led to the higher provisioning in the first quarter. India and the US set to hold further talks over a trade deal after completing 5 rounds of talks so far. Commerce Minister Goyal says no compromise on the interests of farmers and small businesses as President Trump's August 1st deadline to impose additional tariffs looms large.
सदन के पहले दिन सदन को बाधित करना उचित नहीं है अपनी सीट पे जाएं आप अपनी सीट पे जाएं
Stormy start to the winter session of Parliament. Protests erupt in both houses as opposition demands discussions on the Pahalgam terror attack and Operation Sindoor. Questions raised about government's foreign policy after US President Trump's remarks about brokering a ceasefire between India and Pakistan. Aviation Minister tells Parliament it's too early to draw any definite conclusions on the Air India crash in Ahmedabad, says Aircraft Accident Investigation Bureau is totally unbiased and the government will only comment after the final report is submitted. The rise of Blinkit drives eternal. The Zomato parent reports a healthy first quarter revenue up 70%. Order value from quick commerce business is more than the food delivery business for the first time in a full quarter. A CNBC-TV18 News break has confirmed Sona Comstar set to enter China's EV market, signs a binding term sheet to set up a component manufacturing joint venture with China's JNT. Sona Comstar will hold 60% stake in the joint venture and is expected to invest $12 million. The Supreme Court dismisses a petition by the Enforcement Directorate against Congress leader and Karnataka Chief Minister Siddaramaia's family in an alleged land allotment scam. The Chief Justice asked the ED, why is the agency being used for political battles? Siddaramaiah says justice has prevailed. The Bombay High Court acquits all 12 accused in the 2006 Mumbai train blast. The court rules the prosecution utterly failed to establish the offences beyond a reasonable doubt. The series of explosions in several local trains left 189 people dead and more than 800 injured. Well, let's go straight to the day's market action. The Sensex and the Nifty closing the day in the green, led by banking heavyweights. The Nifty reclaimed the 25,000 mark, ending today's session 0.5% higher. The Sensex closing about 440 points higher. The Nifty Bank up over 1%, and the mid-cap index also closing about 300 points higher this afternoon. But let's go straight to the big CNBC-TV18 exclusive. It is a regulatory intervention from the Reserve Bank that resulted in a surprise spike in Axis Bank's bad loans and provisions in the first quarter. Now, CNBC-TV18 learns from sources that Axis Bank was prodded by the Reserve Bank to recognize the stress. In fact, the central bank flagged the bank's NPA framework as being, and I quote, too lenient. Ritu's here with that big exclusive story. Ritu, many thanks for joining us. Axis Bank's numbers disappointed. There was that sharp spike that we saw in provisioning. But what you're getting to hear is this was not a voluntary action on the part of Axis Bank. This was prodded by the regulator.
Well, the surprising spike in bad loans which dented Axis Bank's profitability in the recently announced first quarter numbers, which the bank had attributed to a technical impact, we've been given to understand was not entirely a proactive move by the bank, but rather followed a regulatory intervention from the Reserve Bank of India. Now, our sources indicate that RBI had flagged some lapses in Axis Bank's asset classification practices during a supervisory review sometime in the January-March quarter this year, where RBI found the bank's NPA recognition policy to be too lenient. While Axis Bank was compliant with the income recognition and asset classification norms on paper, we understand the regulator felt these internal policies were not really aligned with the spirit of the regulation, and in some cases, these lapses were leading to either a delay in recognition of stress or even under recognition of stress, and this was particularly noted in the bank's unsecured retail and small business loan portfolio. So RBI had asked Axis Bank to make all of these corrections in the first quarter itself. It was in response to this nudge from RBI that Axis Bank revised its internal framework. That in turn led to that 614 crore rupee hit to the bottom line, the additional 2,700 odd crores in gross slippages, and so on because of the technical impact. On its part, the bank even called the move a prudent application of enhanced qualitative criteria that was aimed at making its balance sheet more resilient. Now, importantly, keep in mind, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that this case should not be compared to IndusInd Bank, where accounting lapses had come to light, because in the case of Axis Bank, the issue was only policy interpretation and not financial misreporting.
All right, Ritu, that's an important news break there from Ritu on Axis Bank. And staying with banks, IndusInd Bank has refuted media reports claiming that the RBI had asked the bank's board to expand its search for a CEO. The bank has said that the reports are false and speculative. The lender also clarified that the process of identifying a new MD and CEO is underway. As Ritu had reported, 3 names have already been sent to the Reserve Bank. Rajiv Anand, formerly with Axis Bank, is one of them. Reliance-owned Jio Financial has announced a 50-50 reinsurance joint venture with Germany's Allianz Group in India. The binding agreement has been signed with Allianz's wholly-owned subsidiary. The JV will tap into Allianz's global expertise and existing reinsurance and commercial portfolios in India. In key earnings, Ultratech Cement met expectations in the first quarter. The Birla Group company reported a 31% rise in profits compared to the same quarter last year. Revenue rose nearly 18%. Margins also saw healthy expansion of nearly 200 basis points. On to the big numbers of today. Zomato's parent Eternal has delivered a healthy first quarter performance as its quick commerce business, that's Blinkit, has reported strong growth. The order value from quick commerce is more than food delivery for the first time in a full quarter. Mangalam standing by with more details. Mangalam, no wonder Zomato changed its name from Zomato to Eternal. It anticipated this kicker coming in from Blinkit.
it is hitting all the right notes. You know, if I told you that a company reported 70% revenue growth and stopped at that, it would be a good set. But if I told you 70% revenue growth, 35% decline in EBITDA, and 90% profit decline, and the stock went up 7%, you'd say, why? What exactly happened? Well, it seems like the worst is behind because one, management commentary is positive. Remember, the company has been disappointing on the food delivery growth front and the quick commerce margin front over the last few quarters. But now it seems like, you know, the Blinkit losses have narrowed quarter on quarter and food delivery growth slowdown have stemmed. So two major problems the company both arrested. The management says year on year growth slowdown has bottomed out as they expect recovery from here on in the food delivery business. And in the very near term, quick commerce margins have also bottomed out. They expect if the competitive scenario remains the same right now, they will go ahead and see improvement in margins. Food delivery. Gross order value has been stable at 16%. The last quarter also it was at 16%. Remember, the previous few quarters it had been coming down, so that has been stemmed. Blinkit revenue growth at 154%. EBITDA loss has narrowed quarter on quarter. Same time last quarter, the EBITDA loss was close to around 180 crores. Now that has come down to close to 160 crores. And add to that, the company has continued its store expansion. Now their total reach is at 1544 stores. And on District, which is the third growth vertical of the company, they see at some point in the next 5 years, annual revenue run rate to be $3 billion with EBITDA at close to around $150 million. So these factors working well. Remember the last quarter, the one thing that annoyed the street was that despite them raising cash and because of the competitive intensity, cash balance of the company had come down quarter on quarter. That problem seems to have been addressed as well, with the cash balance increasing from 18,824 crores to 18,857 crores. So all things pointing in the right direction, and that's what the street got excited about. The stock ended at the high point of trade.
All right, Mangala, many thanks for joining us. So that's Blinkit, bigger than Zomato in terms of food delivery in this quarter. A quick check of some of the other big headlines that we're tracking. Foreign portfolio investors continue to remain bullish on select companies despite maintaining a cautious outlook on the Indian stock market overall. Yusuf analyzed data from 150 companies in the BSE 500. He identified at least 10 companies where FPI holdings have risen quarter after quarter for the past 4 quarters. Let's start. Page Industries has led the way, followed by Minda Corporation and Autumn Investment. You can catch the entire analysis on CNBC-TV18.com on our service access. So do visit and send us your feedback. Now, Bharti Airtel has surpassed TCS to become India's third most valuable company. Its market cap has hit 11.45 lakh crore rupees. Reliance Industries remains the country's most valuable company with a market cap of 19.3 lakh crore rupees, followed by HDFC Bank at 15.3 lakh crore rupees. India and the US have concluded the 5th round of negotiations for the proposed mini-trade deal. Sources tell CNBC-TV18 that key issues including agriculture, dairy and auto remain unresolved. Even as the 1st of August tariff deadline draws nearer, addressing an event in Mumbai over the weekend, the Commerce Minister Piyush Goyal said the government will only sign trade deals if they serve India's interests. Take a look.
There is absolutely no way we will compromise on the interests of our farmers, MSMEs, the interests of our workers. Our effort is to give them more opportunity, to give them more trade internationally along with their growing markets in India with growing incomes. Our effort is to make sure workers get better, higher skilled jobs. Our effort is to get investments and technology. Our effort is to focus on innovation, like we did with the EFTA countries, Switzerland, Norway, Liechtenstein, and Iceland.
We will head into a break, but up next, Tommy, start to the monsoon session of Parliament. Protests erupt in both houses as opposition demands discussions on the Pahalgam terror attack and Operation Sindoor. A stock in focus today, Tilak Nagar Industries has been named as one of the companies involved in an alleged liquor scam in Andhra Pradesh. The police has accused the company of routing funds to a liquor syndicate through jewellery entities. Shilpa is standing by now with more details. Shilpa, take us through what the police claims in its charge sheet.
Well, you're right. The Andhra Pradesh police has named Tilak Nagar Industries as one of the companies involved in the Andhra Pradesh liquor scam. Now, according to the charge sheet, which was filed on Friday, Tilak Nagar Industries allegedly gave kickbacks worth 218 crore rupees. Now, let's get into the details. As per the charge sheet, between 2019 and 24, Tilak Nagar Industries was one of the biggest liquor suppliers to the state of Andhra Pradesh Beverages Corporation Limited, or the APSBCL, and it was pushing its top-selling brands like the Mansion House Brandy and Korean Napoleon. Now, the main allegation is that Tilak Nagar used its privileged position and influence in the APSBCL to be able to secure massive sales. Now, the investigation shows that Tilak Nagar Industries generated revenues of approximately 1,472 crore rupees from the APSBCL, and an estimated 218 crores was paid as kickbacks to the liquor syndicate based on the quantity and price pushed through the State Beverage Corporation. Now, the police claim that these kickbacks weren't paid directly, but they were laundered through gold. Now, money was transferred to jewelry businesses, like 107 crore was transferred to Shri Jewels, and about 3.5 crore each to Sona Chandi Jewelers and Mangatrai Pearls. And these were among others. Now, in return, gold was allegedly handed over to the syndicate handlers, helping the company convert white money into untraceable assets, but with a legal GST invoice to show for it. Now, according to the police, this demonstrates that the liquor syndicate in the state exerted, and I quote, ruthless control, compelling even major legacy players to divert part of their legitimate state income through gold transactions to the liquor syndicate, end of quote. Now, Tilak Nagar is just one of the many companies that was named in the 3,200 crore liquor scam, which came to light on the basis of a complaint by a man named Yidi Venkateshwar Rao Srinivas. Now, this complaint led to a 5-member APSBCL committee, which then submitted a damning report. It found that during the YSR Congress Party's rule, some popular liquor brands were unfairly sidelined, while certain players dominated the supply orders. Now, based on this, the Principal Secretary for Revenue, Mukesh Kumar Meena, filed a formal CID complaint in September 2024, and the alleged mastermind was identified as K.C. Reddy Rajshekhar Reddy, former IT advisor to the then Chief Minister Y.S. Jagan Mohan Reddy. Now, Tilak Nagar Industries, we have reached out but has not yet responded to the allegations. Back to you.
All right, many thanks, Shilpa, for joining us. Heavy rains and waterlogging gripped Mumbai this morning. The Meteorological Department has issued an orange alert for extremely heavy rain in Mumbai and Raigad, and a yellow alert for Mumbai, Thane and Palghar. Heavy showers are expected to continue for the next 24 hours. The department has also warned of possible localized flooding, traffic disruptions and reduced visibility during intense spells, especially in the western and central suburbs. In international news, Israeli forces continue to pound Gaza, killing at least 115 Palestinians, including 79 aid seekers on Sunday. Gaza's health ministry said that around 19 people have died from starvation in the last 24 hours. The UN has issued a warning that the hunger crisis in the Palestinian enclave has now reached a new level of desperation. Pope Leo XIV has called for indiscriminate use of force to be stopped in Gaza without mentioning Israel. Addressing crowds in Rome, the pontiff continued his call for an end to what he called the barbarity of war in the enclave. The Pope also spoke of his anguish over the strikes on Gaza's only Catholic church last week, which killed 3 people. Israel has opened an investigation into the strike on which the church, which housed 600 displaced people. Peace remains elusive between Russia and Ukraine. Russia launched a series of drones and missiles against Ukraine in an overnight attack. At least 1 person was killed in Kyiv. Several commercial properties and houses were also damaged. The attack came after the Kremlin claimed that Russian President Putin was open to peace with Ukraine. Meanwhile, Russia's defense ministry said it downed 117 Ukrainian drones overnight. Ukrainian drone attacks led to flight disruptions at major airports serving Moscow. The Prime Minister will embark on a 4-day visit to UK and Maldives from the 24th to the 27th of July, and India and UK are likely to sign that landmark free trade agreement during the Prime Minister's visit. The deal is expected to double bilateral trade from the current $60 billion by 2030. The Prime Minister will then visit the Maldives as a guest of honour for the country's 60th Independence Day celebration. This will be the Prime Minister's first trip to the 2 countries after the change in leadership in both. The Bombay High Court has acquitted all 12 people convicted in the 2006 Mumbai train blast, which killed around 180 people. The High Court said the prosecution utterly failed to establish its case against all the accused. Santhya joins us now with details. Santhya, the court giving a virtual clean chit to the 12 accused. This is a matter that's been going on since 2006.
Yes, absolutely. 19 years after a series of 7 bomb blasts, and these bomb blasts shocked and scarred Mumbai, killing 187 people and injuring 824 people, Shireen, the Bombay High Court has acquitted all 12 accused in the case today. In 2015, Mumbai Special Makoka Court had awarded the death penalty to 5 accused and life imprisonment to 7 others. But on Monday, that's today, the Bombay High Court in its order said that the prosecution, and I quote, that the prosecution had utterly failed to establish the offence beyond reasonable doubt and acquitted all 12 accused. So what exactly are these grounds on which Bombay High Court acquitted all these accused? Let's take a look. The first ground is confessional statements. The court observed that the confessional statements by the accused were not truthful or complete on various grounds. Some portions were either found to be similar or copied. The accused successfully established that they were tortured mercilessly to extort confessions. The court also noted that the police failed to follow due procedure while recording these statements. The second ground is evidence and recoveries. The prosecution failed to establish what kind of explosives or bombs were used in the blast. Therefore, the recovery of RDX, cookers, circuit boards, detonators, etc. couldn't prove any connection. And court also said that other recoveries like books, CPUs and maps also failed to directly link the accused to the blast. The next ground is witnesses and eyewitnesses. The court observed that ATS did not follow due process while recording witness statements. Identification parades were not conducted for the witnesses to identify the accused. For many witnesses, this happened, and some witnesses were neither called for parades nor asked to identify the accused in the court during the trial. One witness who also deposed in the Ghatkopar blast case had his testimony thoroughly dismantled by the defense. Shrini, this was the same person who was a witness in Ghatkopar blast case as well as the 7/11 blast case. Now, the next ground is CDR, call detailed records. The court noted that the prosecution could have easily proved the movement, assembly, location and connections of the accused through CDRs. Instead, the ATS, the investigating agency here, destroyed the CDRs, raising serious doubts about the integrity of the investigating agency. For 19 years, Shireen, the Maharashtra ATS and prosecution claimed they had an airtight case. But despite the defense exposing the loopholes in the investigation over the years, prosecution failed to prove the offence beyond reasonable doubt, and all 12 accused have been acquitted by the Bombay High Court now after spending years in jail. Shireen.
Yes, 19 years. Many thanks, Santhya, for joining us. Meanwhile, the monsoon session of Parliament has seen a stormy start as protests erupted in both houses, with the opposition demanding a discussion on the Pahalgam terror attack and Operation Sindoor. Opposition parties also raised questions about the government's foreign policy after US President Trump's remarks about brokering a ceasefire between India and Pakistan. Leader of the Rajya Sabha and BJP President JP Nadda maintained that the government was ready to hold a detailed discussion on the issue and is not running away from any debate.
सब मिलकर के डिफेंस के क्षेत्र में आत्मनिर्भर होने के इन प्रयासों को बल दें, सेना के सामर्थ्य की सराहना करें। और मैं आज देशवासियों के सामने जरूर कहूंगा और देश के राजनीतिक दलों से भी कहूंगा कि देश ने एकता की ताकत देखी है, एक स्वर का सामर्थ्य क्या होता है देखा, तो सदन में से भी सभी माननीय सांसद उसको बल दें, उसको आगे बढ़ाएं।
मैं चाहता हूं कि उनके तरफ से हमको मालूमात मिलना चाहिए, जैसा कि पहलगाम हमला 22 अप्रैल को हुआ था। अब तक आतंकवादी पकड़े तो नहीं गए, लेकिन हुआ क्या?
कहीं ये संदेश नहीं जाना चाहिए कि सरकार पहलगाम और ऑपरेशन सिंदूर पर चर्चा नहीं चाहती। हम चर्चा करेंगे, हर तरीके से करेंगे और ऑपरेशन सिंदूर के सारी पॉइंट्स को देश और दुनिया के सामने रखा जाएगा।
मगर इशू ये है कि कन्वेंशन कहता है कि अगर सरकार के लोग कुछ बोलें तो हमें भी स्पेस मिलनी चाहिए। हम 2 शब्द कहना चाहते थे मगर विपक्ष को ये अलाउड नहीं। थैंक यू।
And staying with Parliament, Civil Aviation Minister Ram Mohan Naidu has said that it is too early to draw any definite conclusions on the Air India crash in Ahmedabad. Responding to a question on the crash in the Rajya Sabha, the Aviation Minister said the Aircraft Accident Investigation Bureau is totally unbiased. End of quote. And the government will only comment after the final report is submitted. Here's the Minister.
What we have done, what the AIB has done, in fact, through the preliminary report is to kind of address what happened. Based on the facts it found out in the CVR, based on the facts it found out from the FDR, and only the facts that it was able to determine were mentioned in the preliminary report. To have a definitive answer and a definitive future correction measures, we have to look at the final report, sir. This also I can say that the AIB is totally unbiased and looking into the facts. Now, there can be many questions also. I have seen multiple articles myself. I have seen multiple articles not only by the Indian media, but also the Western media trying to promote their own narrative, their own viewpoint, their own kind of consideration. But I have to tell you that the way we are seeing the investigation is through the facts.
Well, that's the Civil Aviation Minister. And staying with aviation, Air India flight from Kochi to Mumbai veered off the runway while landing at the Chhatrapati Shivaji Maharaj International Airport on account of heavy rain. All passengers and crew members were reportedly safe and were deboarded without any injuries. The Mumbai airport authorities have confirmed that the runway suffered minor damage. Well, with that, it is time for us to wrap up this edition of Business 360. More news and updates will continue right here on CNBC-TV18. Till then, from all of us here, goodbye. Many thanks for watching.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. The rise of Blinkit drives eternal. The Zomato parent reports a healthy first quarter. Revenue rises 70%. Order value from quick commerce business is more than the food delivery business for the first time in a full quarter.
EduFund, a full-stack education planning and financing platform, has raised $6 million in a Series A round led by Circano Management and Mass Mutual Ventures. The new capital will help EduFund scale AI-driven advisory, broaden loan offerings, and deepen Tier 2 and Tier 3 reach.
Annie, a fashion tech brand, has raised 10 crore rupees in pre-Series A funding round led by Atomic Capital. The startup is aiming to hit 100 crore rupees in revenue by next year and will use the funds to expand product categories and enhance its proprietary tech stack.
BizData, a venture enablement platform, has reported that 126 crore rupees, which is roughly 60% of its total investment portfolio in FY 24-25, was allocated to startups led by founders from Tier 2 and Tier 3 cities. Out of the 21 startups funded in the fiscal year, 11 originated from smaller towns, with Nashik and Jaipur emerging as prominent hubs.
Indian cryptocurrency exchange CoinDCX, which recently suffered a theft of $44.2 million, announced to offer up to 25% of recovered funds as a reward for information that helps in the retrieval of stolen assets and identification of the culprits. The total loss is being absorbed entirely by CoinDCX using the company's treasury reserves.
Well, those were the headlines we've been tracking for you this evening. When you think of bank lockers, what comes to mind? Long wait lists, restricted access, and inconvenient processes. Now imagine this instead: 24/7 access, military-grade security, and lockers placed right inside your community, all backed by insurance of up to 1 crore rupees. That's the promise of Aurum, a private vault company. Founded in 2023, Aurum already has 5,000 lockers across 20 gated communities. And to tell us more, joining me today is the man behind this bold new vault tech play, Shaurya Chakra awardee, Air Force veteran, and serial entrepreneur Vijay Kumar Arisetti, the founder and CEO of Aurum. Vijay, many thanks for joining us on Startup Street today. From rescuing tsunami victims in the Air Force to building gate security apps with MyGate and now Aurum, what inspired this pivot to private vaults, and where did the idea for Aurum come from, and what does it mean?
Thanks, Smriti, for hosting me on the show.
You're on mute, Vijay.
I'm actually able to talk. Am I audible?
Yes.
So thanks, Smriti, for having me on this show. I would like to say that my career has always been centered around security and finding solutions. Through my work at MyGate, I observed one pattern that is happening in India. The affluent Indians are moving into gated communities, and these gated communities are getting concentrated in few pin codes of the country. And the number of banks continue to remain the same in these pin codes. And that exposed us to a critical gap. And basically, these affluent Indians need to keep their valuables safe at home, and the only option available to them today is to go to a bank locker. And because of this density, banks are not able to keep up this demand. And once you get a locker also at the bank, it's very difficult to operate given the traffic conditions and parking problems and working hours of the banks. So the consumers needed a different solution and a better solution, and that led to Aurum. And we built Aurum with a commitment to provide highly secure and exceptional convenience way to access your valuables.
And tell us what it means.
So Aurum means gold. AU is gold in the periodic table. It's from Aurum. And basically it comes with Indian store wealth in the form of gold, and we want to protect this wealth what Indians are still keeping for them.
All right, Vijay, tell us, how is Aurum reimagining the locker experience for today's customer? What is your tech edge? And while home safes have always been the go-to fallback, how does Aurum offer a safer and smarter alternative, especially within gated communities?
See, Aurum redefines the locker experience by providing 24/7 access, and it's fully automated. And it does not require any human being to operate. That provides complete privacy and efficiency. Our tech edge is a combination of multi-layered security system that encompasses biometric authentication, AI-powered surveillance, advanced robotics and digitized audit trail. Unlike home safes, Aurum provides institutional grade, safety and security protocols that can prevent thefts, and it can also protect against fire, floods, and even termites. And we also provide insurance to all the contents of the locker. Within the gated communities, we offer superior safety and peace of mind to access your wealth or to access your valuables at any point in time, right at your doorstep.
Okay. Now, Aurum also offers insurance coverage of up to 1 crore rupees per locker. How have you structured this with your partners, and what kind of customer confidence does that bring? And also the fact that these walls are inside gated communities and open 24/7 is a huge differentiator, Vijay. So what drove this hyperlocal approach?
So the fundamental, design of bank lockers, right, where the customer has to go inside the strong room to access the locker, and to provide privacy, these lockers in the banks cannot install any CCTV cameras, right? And because of this reason, insurance companies cannot investigate in case of a theft. But what we have done in Aurum is we have divided the entire setup into two. That is the strong room where all your valuables are, stored. That comes with complete, surveillance and sensor system to protect any kind of intrusion. But the access where you get to access your locker is a completely private area that gives you privacy. And the customer need to authenticate himself and press a button. His locker box would be picked up and presented to him in the access bay. This technology helped us to get insurance from insurers. And, the reason we went about this hyperlocal approach is, right within gated communities. The reason is gated communities today have become self-sufficient. All the social functions that people need to attend are happening right within the gated communities. So we said that why don't we have this set up inside the gated communities? And that's how we have taken this hyperlocal approach of having these lockers within gated communities. And
all right, Vijay.
The intent is to give ultimate convenience and, so that people can access their lockers at any time, any point of the day.
Okay, let's talk about revenue, Vijay. You offer both annual rentals and lifetime leases. How much do these plans cost? And also, what kind of traction are you seeing across these plans, and who's your typical customer today?
Yeah, so we offer, our pricing is very, very competitive, the bank locker pricing, and we offer very flexible pricing. Our locker, we offer both rental and lease plans. The owners staying in the gated community, they go for this, lease plan that is ranging from 1.5 to 5 lakh rupees, one-time payment, and the tenants generally go for the rental plan, which is around 10,000 to 30,000 rupees based on the size of the locker these people subscribe to. And we see a strong demand for both based on the customer's preference. And our typical customer values security, convenience, and privacy. And we see a strong demand coming for both the plans.
Okay. Let's talk about your recent partnerships. You partnered with Vaisakhi Developers in Vizag and the Prestige Group in Bangalore. What is the rollout plan, and are we looking at a pan-India presence soon?
Yeah, I think builders have identified this as an important amenity for their customers while they're constructing gated communities. And to start off with, we have a deep partnership with Prestige and Vaisakhi Developers in Visakhapatnam. We have also, every day we are partnering with one other builder across the country. And the aim is to provide these lockers as an amenity in these gated communities from the word go itself. And we see that in India, close to 1,000 gated communities are getting constructed every year in the top 10 cities. And we aim to partner with all these builders to provide, lockers at their gated communities.
You are targeting 40,000 lockers by March 2026 across 150 sites. What is going to be key to scaling at that pace? And will we see Aurum in high street commercial areas next?
Yes. So I think for us to make this scalable, the technology has to be robust. The security system has to function the way it is designed, and a good operational agility. So we have designed the system in a very modular structure. The moment we identify a space, we take close to 45 days to put the entire setup. We have built an organizational capability to set up 100 such sites every month. So we are, as we grow, since this is a new concept, we are targeting to grow to 150 communities across Bangalore, Hyderabad, and Visakhapatnam, hosting 40,000 lockers in this coming year.
All right, Vijay, very quickly, your mission is to create India's most compelling wealth company, not just a locker business. How are you going to expand that narrative? Will we see Aurum step into wealth infrastructure or financial products in the near future? Also, you've raised over $6 million so far from a mix of institutional investors. Are you looking to raise more capital? What does the road to profitability look like for Aurum?
Yeah, I think, we are building a relationship of trust with our customers. At this point, for the next few years, we'll be in this path to build the trust and giving a really good value to our customers who are taking this service. And once we establish the trust, yes, of course, we will roll out few financial products that can be embedded along with this lockers. And as far as the funding goes, yes, we are well capitalized at this point in time. Our business model is very profitable at a unit economics level. We generally, 60% to 70% of our lockers get subscribed within 3 months of the launch. And it's a profitable business. And at this point in time, we are not looking to raise any additional funds. But yes, if we have to, grow rapidly, probably we'll be raising funds a couple of years from now.
All right, on that note, I'll have to wrap up our conversation. But many thanks, Vijay, for joining us today on Startup Street, and wish you the very best with all your aggressive growth plans.
Thank you. Thank you, Smriti.
And moving on what's brewing today, Bengaluru-based startup Khiladi Pro raised $1 million a month ago to fuel its mission of discovering and developing young athletic talent using AI. The firm has also raised another round at a little over 10 crore rupees today. Backed by investors like Shastra VC and MGA Ventures, the platform uses smartphone-based visual assessments to deliver expert-level feedback to children across schools and academies. With plans to hit 200,000 assessments by 2025, K-Pro is aligning with Khelo India and India's 2036 Olympic dream, bringing world-class sports science to every corner of the country. Joining me now to discuss this further is Utkarsh Yadav, the founder of Khiladi Pro. Utkarsh, thank you so much for taking time out and being here with us on Startup Street. First up, I wanted to ask you, what made you start Khiladi Pro? Take us through what you have on offer and the gap that you were trying to address.
Right. Firstly, really nice to be here. Thank you for having us. Our main goal with Khiladi Pro was to be able to use AI as a technology because it's extremely impactful. Could we use it to actually stir mass participation in sport? India's sport participation levels are just about 6%. We face nearly 80 million kids pre-diabetic, a lot of inactivity, very sedentary lifestyles. And so we wanted to see if we could actually deliver AI on top of mobile distribution in India. And that opens up a bunch of opportunities. So we've obviously brought AI-powered assessments to the market, and they've been accepted really well. We're doubling down on our IP portfolio and now about to launch an AI coach, which you could really have an open-ended conversation like ChatGPT with on top of any sports video that you record. So that was the opportunity we saw 2 years ago. Obviously, it's been really helpful along with the consistent messaging from the government on them wanting to host the 2036 Olympics and a very dedicated effort towards making sport, a core pedagogical tool over the coming decade, where we also saw a lot of labor disruption imminent given the pace at which AI is growing. And we think sports will be very, very crucial to inculcating and nurturing our next generation correctly. So that was the idea, if we could bring AI and democratize access to both opportunity as well as improvement with products like AI coaches.
Sure. So democratizing that sports opportunity to everyone within the country. You're aiming for 200,000 AI-driven assessments by 2025, right? What kind of scale-up, tech or operational will be needed to sort of get there?
Very good question. So we've actually spent a year in a B2B2C phase where we've conducted these assessments, built out the SOPs. We've conducted them in actually very remote parts of India, Dibrugarh in Assam, Dhol in Chhattisgarh, Mahobah, Uttar Pradesh, to get the tech right for hinterland India. And now we've partnered with large event management companies and brought the entire offering D2C. So anybody in the metros would be able to take a full physical assessment, while we're able to offer other purely digital tools from any geography.
Sure. And you've raised this $1 million last month, and I think it's a follow-on round, or is it a new round of a little over 10 crore rupees? If you could sort of take us through how you plan to use the funds that you've raised, what's on top of the agenda?
Right. So on top of the agenda, firstly, we're a very IP-heavy company. We're looking to build world-class AI with the quality of team and Indian talent we have. So a lot of the capital goes into continuing to build out models. We've built out more than 60 models ground up, all in India, our data, trained ourselves, labeled ourselves. Along with that, obviously, moving this offering and spending this capital and activating the market again. As I said, sports participation levels are very low. And so we've conceptualized the entire offering into the world's first sports and fitness Olympiad, which we are bringing, as I said, D2C to market now. And a decent amount of capital would go in building out the property, executing it, and helping activate the physical education and sports market.
Sure, absolutely. And how does your visual AI system assess athletic ability using just a smartphone? Can you sort of, walk us through this tech edge that you have?
Fair enough. So one of the key constraints that we put on ourselves was that we wanted to make AI work on mobile video so that it could be distributed across India. Any new hardware becomes extremely expensive for us. And so we actually have a very dedicated and senior sports science team that works along with our 20+ sports scientists that we have. So through each sport, we actually go about building a portfolio of models, from identifying different actions to measuring different distances, tracking a shuttle, tracking a ball. So we have, as I said, 60 small visual models that we've built. And these have been built under the guidance and post-training and labeling through a set of very senior coaches from the NCA, from India's national badminton training setup. And so that allows our AI to be very, very aligned with what top quality coaching and top quality feedback would look like. And when we can distribute that over mobile video, the opportunity becomes massive. We have 500 million kids in India. And so the AI really helps us deliver this at edge, because we do a lot of our pre-training with top quality coaches and then allow it to be distributed over any Android or iOS distribution.
Sure. So how many sports do you currently have on this platform? How many can you look at? How many can you assess at this point?
Very good question. So we have a fair set of assessments in each of these sports. Badminton, we do nearly 5 different assessments. We have a set of assessments in cricket. Then we've built a set of assessments for kids under the age of 10, a general athletic ability test, a motor and movement ability test, which is a lot more fun-oriented. And we've just come out with soccer. So that's what we cover right now. Very soon we'll be out with handball, basketball, and a few more sports.
All right. So right now you have these key ones on the platform. If you could then take us through how does your business model work? What about, your revenues? Are you right now clocking? What are you making right now? And where do you hope to end this year?
Right. So we have a very healthy order book of nearly $500,000 for these assessments through academies, associations, schools. And as I said, we've now made a pivot along with the healthy order book. We've made a pivot D2C, which is post-revenue as well. We have more than 5,000 registrations effectively for the Olympiad across the last year. And now that we go D2C, we'd be looking to hit nearly half the quota of the 200,000 from the Olympiad, and another half comes from our B2B order.
Right. So healthy order book there for you. Now, you've also mentioned the alignment with Khelo India and the 2036 Olympic vision, right? So how are you collaborating with national or state level institutions at this point to help achieve that goal?
We've actually been engaged with them for a while. We've spent nearly a year consulting, speaking to the team as Sports Authority of India. There are some very interesting programs like Kirti, Khelo India Rising Talent Identification, which is exactly this. They want to do assessments so that we can get benchmarks and large mass acquisition of data to even drive policy making, policy making leading towards 2036. I believe the Home Minister made an announcement of expanding the TOPS policy to nearly 3,000 athletes receiving 50,000 rupees a month, which is a great step in the direction. But a lot more is needed. And so we want to actually build an ecosystem play where if we could actually help not only discover, but also fund and fuel the very expensive journeys pro athletes have through this large LinkedIn-style platform that we over a period of time create, we believe would be on path to achieve some of the targets we have for 2036, like ending up in the top 5 countries in that Olympics, ideally winning the bid, which is also a big question mark still, but very happy that the government has taken a very strong position on coming up with a very, I would say, well thought out bid still in the making. And if we could tie it up with mass digital health, mass consumer health, we could have some mass programs that help us be a little more active as a nation, eat better. That would be a true winner for the entire initiative to bring the Olympics to India.
All right, Utkarsh, thank you so much for outlining your vision for the future over here with your company. And we wish you all the best on that journey. But thank you so much for joining us here on Startup Street.
Thank you for having us.
All right, on that note, it's time for us to head into a short break. India's fashion market is booming and is projected to grow over 10% in a year through 2030. And Urbanic is trying to grab a larger piece of this pie. We check into Urbanic's India operations to find out more.
Welcome back. You're still with us on Startup Street. India's fashion market is projected to grow over 10% a year through 2030, led by Gen Z mobile-first shopping and digital-first brands. One of them is Urbanic, which entered just as Shein exited and has since delivered over 30 million orders. Now, expanding with a new label called Savannah, what's really powering its growth? Smart marketing, sharper pricing, or the tech behind your scroll? Aishwarya Anand reports from inside Urbanic's India operations. Take a look.
You've seen the ads, you've seen the clothes, but what you probably haven't seen is where it all begins. This is Urbanic's India warehouse. Started in London, scaled through TikTok, and now shipping over 1,000 pieces a day across India, this is the new face of algorithm-led fashion. But behind every reel and rapid drops, what is the real story? Who is making the clothes that you wear, and how fast is too fast? Today, we are going behind the scenes to understand Urbanic's India operations, meet the founders and ask them what does it take to fuel India's fast fashion engine in real time.
We really wanted to bring the latest trends from the West, from the UK, from Britain and the West to consumers in emerging markets or economies that are fast growing. Well, India is a country with hugely rich in culture and diversity, as well as a very powerful consumer base, consumer market. So those two elements coupled together, as well as the fact that it's a highly and rapidly digitalizing economy, meant that this was the first market where we wanted to really try our business in.
Fast fashion only works if your backend is faster. In Gurgaon, Urbanic's warehouse processes up to 1 million units a week. It's more like a fashion factory than a fulfillment center.
This is a bigger facility, and then we move on and around 600,000 to 10,000 in a week's time. And from a capacity perspective, this warehouse has more than 3 million units capacity in a month.
Behind the warehouse is an algorithm. Every tap, scroll, wish list, it's data, and that data designs the next drop.
We work heavily with our AI and proprietary technology, and that's been a huge focus of our business since the beginning. That's how we get a real-time feed and an appreciation of what sort of styles, what sort of trends the consumers are interested in, engaged with on the app or on the website.
In 2023, Urbanic added a new name to the closet, Savannah. Same DNA, different mood, affordable, trend-forward, and under 1,000 rupees. Urbanic says its bestsellers across both brands remain consistent: dresses, tops, and denim.
Urbanic, on an average, I can say it would be at 2x of Savannah in terms of pricing. And the median pricing for Savannah is always less than 1,000, which is we have made it affordable to all of users in India.
And how many orders have you clocked till date, including Urbanic and Savannah both?
So till date, it's more than 5 years now. Collectively, it would be higher than 30 to 35 million.
Fast fashion's biggest sin, waste. Urbanic says tech helps it stay lean, small batches, frequent restocking, minimal dead stock.
We have a predictive inventory analysis, which we conduct, and that has been very successful in reducing dead stock.
With profitability achieved, Urbanic is now eyeing global markets, starting with the Middle East and maybe a public listing.
We are profitable, so there's no urgency for rounds, but obviously we want to grow as well, 50% year-on-year growth. And with that, there are various ways plans we have in order to achieve that. Maybe a new brand, other ways of other markets we may enter.
As global fashion market slows, India is moving away. Projected to grow at over 10% a year through 2030, according to a report by Redseer. The ecosystem is also primed for growth. Over 800 homegrown digital-first brands have been launched since 2019, with several entrants having already crossed the $50 million revenue mark within the first 2 to 3 years of their launch. Now, in a market where Gen Z drives taste and speed meets purpose, the war isn't just going to be around the price points. It's going to be about who wins the heart of India's new shoppers. With camera person Balbir Singh, Aishwarya Anand for CNBC-TV18.
Well, with that, it's a wrap from Marundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Centre for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number, deflation in food inflation and core as well, pretty much under control.
So hi, Lata, thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets have been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the RBI, the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4 actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because, I mean, obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and other and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. I mean, the overall flow of resources in the corporate sector, that's very, very, I mean, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, I mean, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for further fall in rates?
In short, yes. Okay. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Internomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
It boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12, 13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity? Every day, bankers forced to give money to the Reserve Bank at 5/4, or even maybe if there is a rate cut at 5% to RBI. Would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious, or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samaran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12, 13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4, 5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember, between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in 2 separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samiran, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down, and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports, have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat, and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1, if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut, but I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. the government may rethink or the RBI may advise it to bring it down, then there is a bit of a rally perhaps at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know if tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah. So I think there's a little bit of concern that is there amongst investors as well. So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working